For the global economy, interest rates and geopolitical tensions are rising, while economic growth worldwide is slowing down. Domestically, it is also the last budget before the 2024 polls, so the market will be watching out for the balance between both fiscal prudence and populist policies. And even as India Inc.'s balance sheet looks good, the absence of growth drivers or growth booster is still being felt. The big question is, can the finance minister provide a thrust to growth without upsetting the fiscal balance? This is CNBC TV18's Budget Headquarters. I'm Manglam Malu. With me, Nigel D'Souza. Nigel, good morning.
Well, morning, Manglam, and morning to all our viewers. No bigger day than this, right?
It's B-Day. That's what we call it.
That's true. Well, let's get straight to our colleague, Parikshit Luthra, who's joining us now. Parikshit, what do we expect from the budget this time around?
Poor women, youth and farmers. These are likely to be the four main categories that would be prioritized in the interim budget by the finance minister. Poverty alleviation has been a priority for the government, and so we could see measures to bring more people out of poverty. Farmers, a big priority area for the government. In 2019, we had seen the PM Kisan Samman Nidhi program. The allocation under the scheme per farmer could increase this time from 6,000 to 12,000 rupees. So that's almost a 50% jump. When it comes to women, this is an important area for the government. Over the last few weeks, we have seen a number of policy interventions to increase the participation of women in the workforce. So different permutations are being considered. One, it's possible that women farmers may be brought under the PM Kisan Samman Nidhi. There could be a specific category for them, or there could be schemes to promote employment for women and women entrepreneurs. MSMEs, again, a big focus area for the government, and there is a consideration that the interest subvention scheme can be increased for MSMEs to benefit them. Middle class was a big focus last year, and it remains a focus for the government. You cannot rule out tax offs. Let's see what the finance minister does. When it comes to capex, we are only likely to see a modest increase in capex this time, as this is a vote on account. But of course, the big ticket schemes of the government, some big bang reforms, they will have to wait till after the general elections when the full budget is presented.
All right, thanks a lot for that, Parikshit. The full budget in July, but the Prime Minister did call it a Disha Nirdeshya budget, or a budget that lays out the direction for the full budget as well. So let's hear out what the Prime Minister had to say ahead of the budget session.
सभी माननीय सांसदों से आग्रह करूंगा कि आप इस अवसर को जाने मत दीजिए, उत्तम से उत्तम परफॉर्म कीजिए, देश हित में उत्तम से उत्तम अपने विचारों का लाभ सदन को दें और देश को भी उत्साह और उमंग से भर दें। मुझे विश्वास है, आप तो जानते ही हैं कि जब चुनाव का समय निकट होता है तब आम तौर पर पूर्ण बजट नहीं रखा जाता है। हम भी उसी परंपरा का निर्वाह करते हुए पूर्ण बजट नई सरकार बनने के बाद आपके समक्ष लेकर के आएंगे। इस बार एक दिशा निर्देशक बातें लेकर के देश की वित्त मंत्री निर्मला जी हम सबके सामने कल अपना बजट पेश करने वाली है।
Well, moving on to the big global cues then. Stocks on Wall Street fell on Wednesday after the Federal Reserve Chairman, Jerome Powell, said that the central bank will likely not be ready to cut rates in March. The Dow was down close to 300 points, the S&P 500 fell 1.5%, and the tech-heavy Nasdaq lost close to around 2%. The bond yields as well trimmed down their losses after the decision. The 10-year Treasury yield fell below that 4% mark. Yesterday, the Federal Reserve signaled that they are done rising interest rates, and it is very unlikely that there will be a cut in March. CNBC's Steve Leeson joins us with all of those details.
Very dramatic moves around stocks, around bonds, around Fed fund futures. I'll just show you one example of how things have been moving. You've been following the stock market. Look at the outlook, the probability for a March rate cut. It's come down 36%. We had been, I don't know, between the meetings as high as 80%. So hopes dashed around the world for that early Fed rate cut. But I have to tell you, I was somewhat amused because I didn't think Powell was going to answer that question as detailed or as specifically as he did, because the story is this. I thought, like he said, he didn't say this, but I thought he could have said, if you haven't listened to everything we've said between the meetings, if you didn't listen to what we said in the statement, and if you didn't listen to what else has been going on, we're not cutting in March. Let's hear the sound from what Powell said, dashing hopes for that March rate cut.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, right, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
Yeah, and I'll just leave it there, except for, I'm sorry, but that is consistent with things that the Fed chair has been saying, and the market has been listening to some extent, but not nearly as much as perhaps it should have been.
So that's the action from the Wall Street overnight. Let's also listen into some important opinion coming in from market experts on what the Fed did overnight and their decision to hold rates steady. When are the cuts likely?
Jay said, this is about data and how comfortable they are with inflation and how the employment picture evolves. We're as data dependent as I can remember at any time in the Federal Reserve's policy reaction function. And I think they want to go. They want to declare victory. I think they, in spirit, have already done it by telling you this is what they want to do. But they're going to be cautious and careful. And I think they're right to be cautious and careful. And I think the market's probably going to reward them in the end for maintaining that credibility and not kind of giving in too early to those that are whining about, well, we need to have our rate cuts because maybe something's going to go wrong. If something goes wrong, they can cut, and they can cut pretty fast.
It sounds to me like June, September, December is what they're thinking, 3 rate cuts this year, provided the economy keeps growing. And this is good. And the other thing is they put in a phrase about the balance of risks, and I really think that's what they're looking at here. There doesn't seem to be at the moment a sign that the U.S. economy is going to keel over and fall into recession anytime soon. And until they see greater damage or potential damage to the economy, given the huge run-up in markets we've seen, they just, see the balance of risk more being on the side of inflation being sticky than the economy falling into recession. And that's why I think they're being hesitant to have near-term rate cuts.
Well, so the commentary that came in overnight was read as hawkish. And because of that, you have the Asian markets that have opened up a little bit tepid today. So most of the markets trading in the red. You have the Nikkei as well. That's pulled back a little bit. The Hang Seng, though, that's doing a relative outperformance. Keep in mind, for the month of January, that was a relative underperformer, while the Taiwanese index as well is down close to under 0.1%. So the problem is that the rate cut may not be a surety in the March meeting, but the street is pricing in almost 100% probability that that rate cut will come about in May itself. The implied opening for us is more or less flattish as well. Yesterday was a very, very good trading session. Let's see how it goes today. For the time being, though, we'll slip into a short break. On the other side, we'll get you an entire trade setup for the day, the stocks in focus, and more on the other side. Don't go anywhere.
Elections 2024 is likely to be a turning point in India's history, and the upcoming union budget is the key critical policy event before these elections. What would I want from the finance minister? Ensure the growth trickles down, bringing employment and employability to the bottom of the pyramid. Share your budget expectations, hopes, and ideas with CNBC TV 18's Budget Ballot. Your voice counts, and we promise it reaches the finance minister.
The Budget Ballot. Vote for growth on CNBC TV 18, India's budget headquarters.
Well, election 2024 is a turning point in the history of India, and the Union Budget is a critical event that will define India's future, as a billion votes will echo a billion aspirations. In this budget, my suggestion to the Finance Minister would be to find an equilibrium between economic growth and sending out some incentives for the middle class. Share your budget expectations and wish list with CNBC TV 18's Budget Ballot.
Morning, you're watching us here on Budget Breakfast. We told you what is the expectation from the budget, what the global setup is, but how should our markets react and what is the setup for our own markets? Both Nigel and I will tell you that. Nigel, start with, yesterday was a good day. What did the FIs do in F&O?
Well, in the F&O segment, if you look at the index futures, they went ahead and they added long positions big time. So close to 18,000 long contracts for every 5,000 short contracts. So the ratio basically was 3 longs added for every 1 short. And now, in fact, the long positioning has gone up to around 30%. Remember, just a few sessions ago, it was down to around 20% approximately. So that proportion has moved up. And the shorts, well, they have relatively come down from that 82% to around that 70% odd mark. Keep in mind, they're very much still net short on the index. But at the start of the series, the net short positions were close to around 1.08 lakh contracts on the short side. That's come down to the mid-80s, 87,000 contracts out. So some bit of that net short positioning has played out. But though they continue to remain heavily on the net short side. But Mangalam, otherwise, how are they positioned? On budget day, how are the FIs positioned in the derivatives market, and what's the normal reaction we see on a budget day?
Well, you said that, they're net short this time around. That has been actually the case for all the budget sessions that I've seen, at least in the last 4 or 5 years itself. You start from Feb 2020. The FIs went into the budget with long exposure of just around 15%. What did the market do? That day, of course, we had the coronavirus scare, etc. So we saw a 2.5% decline on the frontline index. It was only the next year, which was Feb 2021, after the big rally that we saw, the FIIs were long, 63% long exposure. The Nifty moved around 5%. That was one of the best budget moves that we've seen in the recent past itself. Feb 2022, FIIs again, just net long with 32%. Feb 2023, which was the last budget, FIIs went into the budget with just 18% long exposure. The Nifty did fall from the highs, ended about a third of a percent lower. But today, after a big move that we saw yesterday and uncertain global cues and the fact that it's an interim budget, the FIIs are still net long by 30%, which means net short of 30%, 70%. Let's see where the Nifty goes.
Well, Mangalam, in an uptrending market, you want to see put writing.
Yes.
And yesterday, that's precisely what took place. So the 21,500 put, there was a fair bit of open interest in yesterday's trading session. In fact, that was the most active strike in trade yesterday, and the premium was roughly around 50 rupees. So there was aggressive writing being seen out there. On the upside, 21,900, well, that's being written for the last few days, and the massive open interest build up over there as well, close to around 25 lakh shares. Because of this kind of a change, you saw the PCR that moved up from around that 0.8 odd. Intraday yesterday, it went to around 0.75. It ended the day at close to around 0.9 odd. In terms of a reference point, when it goes to around 0.65 to 0.7, that's when we normally see a bit of a bounce out there. Let's get you the levels then. Since the 21,500 put was seeing aggressive amount of writing yesterday, the support zone is in this vicinity of around 21,400 to around 21,450. If that breaks, the reference point is the recent low that we saw, 21,140 or thereabouts. But on the upside, the 61.8% retracement of that entire correction from 22,200 to around 21,100 odd, that comes in that vicinity of around 21,800. And going by the options data as well, that's a bit of a resistance zone. We visited that mark actually a couple of sessions ago, and from there we saw a correction. But Mangalam, the last 2 sessions, the Nifty Bank is the one that's outperforming. And that's done very, very well. And that was the call that we made yesterday as well. But in the near term, if you need to see a bit of a pullback, then the 100 DMA becomes a bit of a reference point on the downside. And at that breaks, you don't want that 200 DMA to go at all, because intraday it has broken that. But from there, it's seen a bit of a bounce. And the Nifty Bank, the good news is, last couple of days, it's been in good form. But mind you, for the month of January, it was a big underperformer led by big boy HDFC Bank.
Led by big boy HDFC Bank, and it's also weekly options expiry today along with budget, so that will play out. And it was the HDFC Bank sell-off that we saw, which reflected in the cash market selling as well. The FIs in the month of January itself have sold nearly 36,000 crores. The DIIs have bought, they've done their best to buy about 27,000 crores, but that deficit still remains. And most of that was in big boy HDFC Bank, and that reflected in the way we've seen, the moves of the Nifty as well as the Nifty Bank. The Nifty is just about 2% away from a record high, ably buoyed by both the IT stocks as well as Reliance, but the Nifty Bank has been an underperformer there. It is down about 5.5% from a record high. The recent outperformance that we saw, let's see whether that sustains or not, because if that does, then maybe the record high on the Nifty is not too far away.
Well, that's right, Mangla. Actually, we had three big triggers for today, right? One was coming in overnight from the FOMC. The next one would be the budget, and then would be the expiry. One has played out, and actually it's played out in favor of the bears, because Jerome Powell, well, he sounded more hawkish than dovish. And that was a bit of a disappointment. So post that commentary that came in, that maybe in March meeting itself, we may not get a rate cut. You had the US markets that were under pressure. Risk assets, they sold out. Whether it was the Bitcoin or other assets as well, did see some selling. You saw some cooling off in the US 10-year yield, which came down to around 3.9%. The last time I checked, it was 3.95% odd. And the US dollar strengthened, obviously. The probability now of a rate cut in the month of March, it's reduced from nearly around 90%. It's come down to close to around 38%, thereabouts. So basically, the probability has reduced by half. But the street is very much anticipating that in the month of May or the meeting of May, he'll not disappoint, because 95% are still projecting. I was looking at the Fed futures, and they are saying that, yes, the probability is still 95%. So maybe this rate cut that was expected is a little bit delayed.
Or as they say, May, the rate cut happened in May itself. But Nigel, we aren't done with Qs yet, because not only is it the budget and expiry, we have the first of the month auto sales come by as well. Yes. That will be a forward-looking data point. Also, the RBI policy on Feb 8th, remainder of the third quarter results, FII flows and regulations around that. There is still some uncertainty around, how the flows are likely to pan out. Also, most importantly, we'll watch out for the movements in HDFC Bank. That would be a big swing factor for the Nifty Bank, and as a result of which the Nifty. And then political developments. We are just a couple of months away from the election, so campaigning for the 2024 India general election begins, and US elections as well. We have, we'll keep an eye out on how that plays out.
All right. Well, so that's the entire trade setup, but let's focus on an important stock to track today. That's going to be Paytm. The Reserve Bank has directed Paytm Payments Bank to stop onboarding of new customers with immediate effect. Ritu's been on top of that. She's here to explain what does it mean, its impact, as well as what a brokerage is making. Ritu, first of all, good to see you in Mumbai, and tell us about this piece of news.
Well, good to be here in Mumbai. But, first to make a differentiation between the payments bank and Paytm as you and I use it on the application. That is unaffected. Yes. It is the restrictions that have come in on the Paytm payment bank. Now there, for all practical purposes, it's as good as, the bank can't operate anymore until the restrictions are lifted, and there's no clarity on when that will be. So first, RBI said stop onboarding any new customers. Second, it has said that this action has been taken because of persistent non-compliance, and there were significant material supervisory concerns that it observed in the bank. So what it has said is that in the payment bank, there can be no credit transactions, there can be no deposits. Because the payment bank also has a wallet license, customers cannot top up their wallet balances after the end of February, that is February 29th. But if you already have balances in your wallet, you can continue to use it, you can utilize it. There'll be no restrictions whatsoever. Apart from that, in no mincing words, RBI said no banking services can be offered by Paytm Payment Bank other than withdrawal or utilization of the existing balances. The nodal accounts of 197 Communications, the parent entity, and Paytm Payment Services are also to be terminated by the end of Feb. Now, why this severe action, many people are asking, but do keep in mind that back in March of 2022, RBI had first taken, sort of a warning action against the payment bank for non-compliance when it came to IT, KYC processes, and so on. And it's been 22 months since then, and it seems that there's been no rectification of these deficiencies, which is why you've now seen the RBI ask the payment bank to stop onboarding customers. We spoke to our sources and we understand that about 3,000 to 4,000 crores is the total amount of deposits that the payment bank is holding. Remember, because it is a payment bank, it can't really lend. It only facilitates transactions. Paytm said that it expects an annual EBITDA impact of 300 to 500 crores because of these restrictions, but it is on a path to profitability. They said they're working with other banks here on and not Paytm Payment Bank for the payments business, because remember, the regulator also wants them to maintain this arm's length distance between Paytm and the payment bank. Bernstein now says that this effectively ends the operations for all practical purposes for the payment bank. It adds to the already heavy regulatory overhang. Macquarie says that the lapses are quite significant, and therefore it'll hamper their ability to retain customers. The bigger issue is that they're not in the good books of RBI, and their relationships with other banks and NBFCs who they tie up to give loans may also get affected. And Jefferies similarly says that the direct impact of this move could be 20 to 30% of EBITDA, and the reputational impact about 20 to 25%.
They've cut their estimates by about 45% on the EPS, Ritu, a spate of downgrades coming in. So thanks a lot for putting that into perspective. Paytm will, of course, be one of the stocks on our radar today. But that's not the only stock. A bunch of other stocks also in the news, for which Sonal joins us. Sonal.
Good morning. Earnings, they continue to come in, and we do have a couple of stocks which will be on our radar. Shree Cement, for starters, it was a good margin performance, while revenues were in line with estimates, and good margin performance came in on the back of lower costs. So EBITDA was at 1,234 crore rupees, margins higher at 25.2%, and net profit came in higher at 734 crore rupees. And volumes, they were largely in line with estimates. They were higher by 11% on a YY basis. Let's talk about Dixon Tech now, because margins were absolutely in line with CNBC TV 18 poll at 3.8%, and net profit mildly lower or largely in line at 97 crore rupees. Indus Towers will also be in focus, because sources have suggested to CNBC Awaaz that KKR and CPP, they are likely to sell shares in Indus Towers via a block deal, and they will be selling around 3,800 crore worth of shares in this particular block deal, which will be offered at 8% discount to yesterday's market price. We have JSPL, which was a good set. It was a margin beat. We had 24.3% margins versus a poll of 19%, and profits also came in at 1927 crore rupees versus a poll of 945 crore rupees. Lastly, looking at Godrej Consumer Products, good numbers, revenue growth of 1.7%, gross margins were higher by 400 basis points, and profits also higher by 6.5%. So it was a good operational beat on Godrej Consumer. All these stocks on our radar today.
Okay, all right. Well, thanks a lot for that, Sonal, for joining in and giving us all those stocks that we'll be tracking as well. But before we wind up, Mangalam, what's on your wish list?
My wish list, personal wish list will obviously be lower taxes, but from a country standpoint, more money in the hands of people so that we can revive consumption. That's from the FMCG standpoint, and you would obviously expect some more softs for infra so that more cement and metal stocks are, have a better demand.
Well, indeed, they've done very, very well on that infra and capex push.
Exactly.
And you'll expect that to continue and, draw a fine line between providing something for the rural economy and also keeping this infra boost going, because it's election year. So that's the only problem. I think from here on, things will just look up.
And what you and I say is not very different from a lot of people who wrote into the CNBC TV 18 budget ballot box. We actually compiled all of that and have given to the finance minister. If not this interim budget, of course, we will hear from, the team before the big budget that happens in July itself.
Okay, well, on that note, though, we'll wrap up on this edition of Budget Breakfast. It's goodbye from Mangalam and myself, but we will keep coming back to you all through the day for more budget action. You stay tuned. More coming up on the other side. Your voice counts, and we'll take it to the finance minister.
The Budget Ballot. Vote for growth on CNBC TV 18, India's budget headquarters.
Elections 2024 will be a turning point in the history of India, and the Union Budget is a critical event which will define India's future, as 1 billion votes will echo 1 billion aspirations. And in this budget, I would like to ask the Finance Minister the schemes and help which has been directed towards the lower income strata of the society that should continue. You can share your budget expectations, your hopes and ideas with CNBC TV 18's Budget Ballot. Your voice counts, and we promise to take it to the Finance Minister.
The Budget Ballot. Vote for growth on CNBC TV 18, India's budget headquarters.
All eyes on Finance Minister Nirmala Sitharaman to see if she will deliver a feel-good factor just ahead of general elections 2024. The hope of the business community is that this budget will continue to build on the momentum that India enjoys today. Share your budget wish list, suggestions and hopes for Finance Minister Nirmala Sitharaman on your budget ballot. We will make sure that the CNBC TV18 budget ballot box gets your wish list to the Finance Minister.
The Budget Ballot. Vote for growth on CNBC TV18, India's budget headquarters.
Elections 2024 will be a turning point in the history of India. And the Union Budget is a critical event that will define India's future, as 1 billion votes will echo 1 billion aspirations. My budget expectation is that with growth picking up, the Finance Minister tries her best to give more in the hands of the common taxpayer. You can share your budget aspirations and your wish list at the CNBC TV18 budget ballot box. Your voice counts and we will take it to the Finance Minister.
The Budget Ballot. Vote for growth on CNBC TV18, India's budget headquarters.
The general election of 2024 will be a defining moment in the history of India, and the Union Budget is a critical step leading up to that big event. Madam Finance Minister, I hope you shape financial policy to help fulfill our growing aspirations. You too can share your budget expectations, ideas and hopes with CNBC TV18's budget ballot. Your voice counts and we will take it to the Finance Minister.
The Budget Ballot. Vote for growth on CNBC TV18, India's budget headquarters.
The Union Budget, though, is less than 30 days away. What's your wish list for?
Finance Minister Nirmala Sitharaman stands on the cusp of history. Today, she will become only the second finance minister to present 6 consecutive union budgets, matching a feat achieved only by Morarji Desai and surpassing her predecessors like Arun Jaitley, P. Chidambaram, Manmohan Singh and Yashwant Sinha. This will be her first vote on account.
The budget that the government presents will just be able to, or would just be a budget to meet with the expenditure of the government till a new government comes to play. So, and that budget, following the British tradition, is called vote on account. So no spectacular announcements are made at that time.
The FM may have ruled out spectacular announcements, but with elections around the corner, expectations are running high.
There could be, if at all, there could be some incentives for the savings that will perhaps go a long way in terms of building up the capability of the economy.
But the overall environment in India is very positive, and we would like the government to ensure that there is further impetus towards startups.
The most important thing to watch from my perspective is the case of the missing FDI. India has driven FDI of about $40 billion over the course of the last couple of years annually. Trailing 12 months is only at 13 billion, and we're looking at a best case scenario of 20 billion for the current year. So significantly below trend.
India needs investment-driven growth rate. And that's what will drive consumption growth on a sustainable basis. But then, because if you have that investment growth, then you get the job growth, and then it follows. Consumption growth follows.
The RBI governor has ruled out any chance of a rate cut in the near term. What can the government do to ease credit cost?
Any premature pivot in our policy, it can be very, very costly for the economy.
India is projected to continue as the fastest growing major economy in the world. Can the budget secure the growth momentum?
There is a disconnect between the number of projects that are being announced, foreign direct investment projects that are being announced going into India. You've seen the real sharp increase in that, as opposed to when you actually see the money that's coming in. The money that's coming in, you're not seeing that yet. Now, this, of course, can take time. The only thing India can continue to do is keep on the reform path.
For the last 24 years, this has been your budget destination. The CNBC TV 18 special coverage of the interim budget starts right now.
That time of the year again. Hello and welcome to CNBC TV 18, your budget headquarters. In 3 hours, Finance Minister Nirmala Sitharaman will deliver her interim budget, which is also, importantly, a pre-election budget. I'm Sonia Shenoy, and with me, my co-anchors today, Lata Venkatesh and Prashant Nair. Folks, morning.
Hi, good morning, both of you. Yes, that's true. This is the last economic policy statement from the government before the polls, and hence, the big question on the market's mind is, can the finance minister continue to provide capex thrust and take populist steps without upsetting the fiscal balance? Now, India's profits are rising, but the government's huge capex thrust has not yet actually translated into a full-blown private sector capex cycle. So what the markets will worry is, will the finance minister give in to the temptation of more stimulus and more deficit?
Lata, and perhaps what makes life easier in that sense, Sonia, for the finance minister, is that global interest rates led by the US Federal Reserve are projected to fall in 2024. In fact, we heard from the FOMC, the Fed, last night, and while a cut in March, an imminent cut looks unlikely, rate cuts and not rate hikes are the next course of action, which of course should make the government's fiscal math easier to achieve even as it pursues spending on many growth areas.
And we just heard, right, Nirmala Sitharaman today will present her 6th consecutive union budget. So it's definitely going to be a very, very interesting day. Let me welcome our editors first to lay down the agenda. Shireen, first up, will lay down the political setup. Lata has all the big budget numbers for us. Anuj and Prashant with the market expectations, while I'll try and tell you about all the key stocks that you need to watch out for. So first, let me hand it straight over to Shireen on all the buzz from North Block. Shireen, morning.
Finance Minister Nirmala Sitharaman is all set to create history as she rises in Parliament in a short moment from now to present her 6th consecutive budget and the final budget of the Modi government's second 5-year term. She's the only finance minister after Morarji Desai to present 6 budgets. Now, will this be Sitharaman's 6th? That's the big question. A cursory look at the government's economic review tells you that it goes into this interim budget from a position of confidence, both as far as the fiscal situation is concerned and on growth, projecting FY25 GDP growth at 7%. Now, the question is, what will the government build on to deliver the Modi hat-trick? That is what the BJP is hoping for. Its slogan says so. Tisri baar Modi Sarkar, ab ki baar 400 par. So this interim budget is going to try and build on that momentum, build on that mood. So let's talk about the welfare war chest. Remember, it was the 2019 interim budget when the then Finance Minister Piyush Goyal delivered a new scheme in the form of PM Kisan to focus on the farmers. The expectation is that PM Kisan's allocation will be enhanced in the interim budget from 6,000 to about 9,000 rupees, and that is accounting for inflation. The other big one, the PM Garib Kalyan Yojana, that was from the COVID program, and that has already been extended ahead of the budget for another 5 years. So that has been done and dusted. We've already seen tweaking of the Ujjwala scheme, the LPG program, and that perhaps could get further boost in the interim budget. The PM Awas Yojana, rural housing could potentially be a focus area. So the welfare war chest will be something to watch out for. Next up, the infra imperative, a record historic government capex program that has been announced by the government, including in the previous budget. The hope is that it will continue to signal that directionally, as well as enhance allocations for road, railway, defense, etc. And hope is that at least a 20% increase in government capex will certainly be on the table, so watch out for that. Then the manufacturing aspiration, making India a manufacturing magnet, continuation of existing schemes, the PLI push, 14 schemes already announced, but as we've been telling you here, the DPIIT secretary confirming that perhaps 2 or 3 PLI schemes will be tweaked. Could the interim budget take that forward? Tariff cuts to continue to promote domestic manufacturing. Ahead of the budget, we've already seen the duty on components for the mobile manufacturing sector being cut to 10% from 15%. More sectors could be impacted in the interim budget is what we're given to understand. And of course, bringing down logistics costs will be key. That is something that the Economic Review also alluded to. Female focus, Nari Shakti. If you look at the Prime Minister's comments at the start of the budget session or the President's speech, it is very clear the government intends to focus on females, on women voters, on the women constituency. So could there be an additional scheme, a new scheme, or could there be, perhaps as far as Mudra and other schemes are concerned, any other tweaks? We will wait to see. Childcare could be something that is taken forward in some form or fashion, perhaps a public-private partnership. That's the buzz. We'll have to wait to see what the budget unveils. Ahead of the budget already, the Road Transport Ministry putting out a notification saying that there should be parity as far as highway construction is concerned. Climate call. Ahead of the budget, a new solar rooftop scheme for households being announced by the Prime Minister. That momentum could perhaps be taken forward in the interim budget. Push towards renewables. There is, of course, the expiration of the current FAME scheme. Will that be renewed or will it be tweaked? One will have to wait to see. Another scheme for EV program, a support scheme perhaps in the anvil as well. So the climate push and the energy transition, perhaps a green transition fund, which is the ask of industry, those will have to be some of the things that we watch out for. So the expectations are tempered given the fact that it is an interim budget, but it is an important moment for the government, for the Finance Minister to articulate the decade gone by, but more importantly, signal the times coming up.
Thanks for that, Shireen. Now, the key number to watch in any budget is always the fiscal deficit. Market is torn between the base case, that is those who see 5.3%, and the optimists who expect 5.5% fiscal deficit. Now, the base case is that fiscal deficit will be cut from 5.9 to 5.3 because the government is committed to bringing deficit down to 4.5% by FY26. That means 70 basis points lower deficit in FY25 and 26. These guys argue high deficits when growth is high will cause inflation. Now, the optimists say pre-election budgets will have populist promises. No harm running up a higher fiscal deficit since foreign funds are going to buy $25 billion of India government bonds due to index inclusion. Now, the second big number markets will watch will be CapEx. It grew by 35% in FY24. Now, the baseline expectation is this time CapEx will grow by a more modest 10% and still be 3.2% of GDP like it is in FY24. The optimists like Citibank see capital expenditure growing by 20% to 12 lakh crore rupees. If true, that will be good for construction and railway company stocks. Now, the other key numbers to watch, one, nominal GDP growth. After a weak 8.9% nominal growth in the current year, an 11% assumption of nominal growth for next year, which is 7% real GDP and 4% inflation, is seen as the base case. But many say that the government may actually be conservative and assume 10% or 10.5% nominal GDP growth. A second number to watch will be the overall tax growth assumption, or what economists call tax buoyancy. Tax growth surpassed expectations this year because income tax grew by over 30% in the first 8 months. In FY25, the poll of economists shows that the average expectation of tax growth is a more modest 12%, as corporate margins are likely to normalize. Tax tinkering will be more in the form of promises, say most economists. Subsidies and revenue expenditure will definitely be higher, but less than 10%. They will be higher because of pre-poll moves like, higher transfers under the Pradhan Mantri Kisan Samman Nidhi. It may rise to 8,000 rupees per year from the current 6,000. If true, this will be very good for rurally exposed stocks. More LPG subsidies are also expected. Finally, the big number for bonds and banking stocks is the government's market borrowing. Net market borrowing is seen at around 12 lakh crore rupees. If this number is true, bond markets will soar, as will banking stocks. But even a slightly higher figure won't hurt. Foreign funds, henna. Well, let me leave you with a final thought. At a time when growth is good, like it is now, a high fiscal deficit can always lead to inflation. So my vote is with those who are asking for a 5.2% fiscal deficit.
Well, one thing constant with budget has been the market volatility, not just on the budget day, but the days preceding the budget and even after that. And this time it's been no different. We have seen that play out over the last few days with the Nifty up 350 points on one day, then 250 down, then again 200 up. So it's been a bit of a ping pong game. And what has happened over the last few days is that both the Nifty and the Bank Nifty have come to the midpoint of the recent range. But the key highlight for me has been the defense of the 200-day moving average by the Bank Nifty despite whatever's been thrown at it. And I think it tested that mark 3 times and defended it every time. And amidst all this, the mid-cap index has remained quite resolute. In fact, we had an all-time closing high almost on the mid-cap index. And that's really been the index where almost every domestic investor is focused on. The large part of this Nifty and Bank Nifty differential, though, is because of two stocks which have got nothing to do with the budget, I guess. Reliance, which is up 10% for the year, and HDFC Bank, which is down 14% for the year, both because of their own reasons. Now, you know, February is traditionally a swing month, a big swing month, which is what we saw in January as well, a lot of volatility. But February is the one month in which market normally decides or, you know, takes a direction. And in that sense, the budget becomes important because it plays a large part in deciding that direction. But keep in mind, just for the day, the market will be reacting to the budget, of course, but also to the overnight Fed decision.
Thanks very much for that. Well, I want to start with what the FM, the finance minister, said late last year, which is that there will be no spectacular announcements in the interim budget. So she downplayed expectations with that one line. A lot of people in the market are latching on to this statement to mean that this interim budget will be just that. There are also those on the other side who point to 2019 and say that this could be a full-fledged budget. Why not? But this view is in the minority. In any case, most expect the budget to reaffirm government's long-term vision on growth more than anything else. A focus on fiscal consolidation, especially the pace of it, will be closely watched, and so will the focus on capex and measures to boost consumption, which is not fully recovered, especially on the lower end. As far as the market is concerned, January was flattish after very strong gains in both November and December last year. In that sense, we are really with Jan behind us through the seasonally weakest part of the year. So it's in that sense good for equities. The budget day itself usually and historically has been an extremely volatile day with big swings. So unless you're a compulsive trader on the index, the better thing to do is to let the market digest the announcements which we will hear from the finance minister. I'm saying this also because the market reaction on the day of the budget really is amplified over the next 1 month in the same direction. So if the reaction on the day of the budget is down, over the next 1 month, more often than not, going back the last 15 plus years, the direction is down and vice versa. So there is enough opportunity to participate both on the upside and the downside, depending on how this day goes. Back to you.
Well, thanks a lot for that. Let's kick it off with some of the infrastructure names, right? L&T, IRB, Infra, Dilip Bilkon will be top of mind because the emphasis is on infrastructure capex through higher budgetary allocations. The expectation is that there will be a 12 to 15% year-on-year growth in infra capex in FY25. The next focus area for the government has been the railway space. So I'm looking at names like IRFC, IRCTC, Texmaco Rail and Titagarh Wagons. Railway capex is expected to further elevate to 20% year-on-year. Nirmal Bang put out a report where they said that railways may see the highest increase in allocation, with spending having gone up 40% year to date. Now, ITC is always in focus during budget days. Any rise in excise duty on cigarettes and tobacco products will be seen as a negative. Not just that, any divestment announcement through the stake sale in Suti shares will also be taken as a negative. But other FMCG stocks, HUL, Dabur, Marico, Imami will also be in focus. Remember, rural India accounts for 35% of FMCG sales, and rural India has been in a slowdown for the past 4 to 5 quarters. Any SOPs or incentives announced for rural India will be taken very positively for this sector. Moving on, green energy has been a thrust area for the government. So we're looking at names like Tata Power, Adani Green, JSW Energy and Inox Wind. Any SOPs or incentives, some are talking about tax incentives for this sector, and the companies involved will be taken well by the street if it comes through. Let's get back to rural India now. Hero MotoCorp, TVS Motor, Ultratech Cement are stocks I'm looking at. Any significant boost to rural infrastructure or welfare schemes like Housing for All, village roads, income transfers will be a sentiment positive for this sector. There could be a renewed interest subvention scheme for affordable and mid-income housing, and that's positive for select developers. We're looking at Lodha, Suntech, housing finance companies that are on your screen as well. And finally, privatization candidates are always in focus during the budget. Keep an eye out on names like Concord, BEML, IDBI and SCI. Back to you.
Okay, thank you. That's a comprehensive list to put on your list, on your watch list. But as always, CNBC TV 18 brings the best local and global market watchers, economists, corporate leaders, and tax experts. So let's tell you what is lined up for you over the next couple of hours. Catch the most authoritative analysis of the Interim Budget 2024 with the biggest and most influential voices. Our CNBC TV 18 budget editor, former Chief Economic Advisor K.V. Subramanian, will give us his take on what Finance Minister Nirmala Sitharaman has to offer. Stock market has been roaring in the run-up to the interim budget, and our market masters, Ramdev Agarwal, Mahesh Nandurkar, Neelkant Mishra, Nilesh Shah of Kotak and S. Naren will tell us their expectations for the street. The budget is likely to set the tone for the markets ahead of the general elections. So Madhu Kela, Prashant Khemka, Sunil Singhania, Sandeep Bhatia and Tahir Badshah will be here to tell us the way forward for markets. Finally, Nilesh Shah of Envision, Ashok Wadhwa, Gautam Trivedi, Rahul Arora and Dharmesh Mehta will join in to talk to us about market trends and what lies ahead after a good 2023. Foreign investors are in sell mode in the run-up to the budget. Some of the biggest India investors will talk to us about their take on the market. The key ask from Finance Minister Sitharaman is to balance fiscal needs with structural reforms to support medium-term growth. And some of India's leading economists will map the macro layout for us. Industry's creme de la creme will tell us how balance sheets are looking and what their wish list is from the Finance Minister, from seeking lower individual taxes and higher capex for infrastructure to creating better employment opportunities. These are some of the key asks from Nirmala Sitharaman. Tax is the other big factor to watch in this interim budget for the salaried class and for the corporates in particular. We will be joined by top tax experts with their take on the tax angle.
Well, that's a power-packed lineup, isn't it? And we'll keep at it all day through. Just want to quickly spend 2 minutes looking at the market itself, right? I mean, how is the setup this morning? The GIFT Nifty is indicating a flattish kind of a start. It's neither here nor there. And I mean, you know, you'd take it with both hands because the last few days have really have seen astounding volatility. I'll just start with, a few points. Budget days are usually extremely volatile, right? I mean, there is no question about it. Go back the last 4 or 5 budgets and we've seen massive swings, 500, 600, 1,000-point swings in some cases. The handoff from Wall Street is weakish. The S&P is down about 1.6%. The NASDAQ is down about 2.33%. The Russell is down about almost nearly 3% as well. The message from the Fed overnight, the big message, if you really want to just know one thing, it is that rate cuts are coming, but not in March. I mean, they've kept the optionality open that March perhaps is also possible, but most likely it's going to be post-March, so it's not imminent. One new thing which has sort of emerged, which is completely out of our minds, was these regional US bank troubles seem to be creeping back up once again. One particular regional bank in the US posted a loss and they cut their dividend massively as well. There is an index in the US which tracks these regional banks that was down 6% last night. That is the KRE index. So, I mean, this is a new thing which the market has not got on its minds. The US 10-year lost about 10 basis points. We left off under 4%. You would think that's very dovish. But the reason behind this 10 basis points fall is not what the Fed did or said. It's basically the fact that these US regional bank troubles started to emerge at the margin. So I'm not sure if this 10 basis point fall is really all that positive in that sense. We are past January. January is seasonally the worst month for stocks, not just here in India, but globally as well. We are in the month of February. So at the margin, seasonality-wise, that's a bit of a positive. And of course, I mean, as I said, the last 3 days have been spectacularly volatile. Plus 400, minus 200, and yesterday plus 200 as well. All said and done, we're in a 300-odd point range. 21,450 to about 21,750 is that range for the Nifty. Beyond 21,750, which is the upper end of the range, it's possible we take that out the all-time high comes into view, which is about 22,124. Will that be as easy, at least today? I think that's the question we need to ask, and that will depend on what is announced today. The Nifty Bank, that's the much weaker index really here, that needs to cross 46,824, which is the 61.8% retracement of the fall that we've seen. And on the downside, we must, for bulls, it's imperative that we don't break the recent low on the Nifty Bank, which is about 44,429. My sense is, and I said this earlier as well, what happens on the day of the budget, if it is big enough on the upside or downside, it's followed through in that same direction over the next 1 month. We've seen that all, 13 out of the last 17 or 18 budgets or so. So there is enough opportunity beyond just this day zero, which is the day of the budget, to participate depending on what is said and what is done in this particular budget.
Absolutely. I think the big statement is the Fed saying that don't expect any rate cut in March, and you had a steep fall in the US markets overnight as well, right? The Nasdaq, in fact, saw its worst day in the last 4 months. In fact, we'll pose all of these questions to our guests on the other side of the break. Let's do one thing. When we come back, Robert Sokin, the global economist at Citi, will be with us. We'll also connect with Jahangir Aziz of JP Morgan and Arvind Sanger of Geosphere Capital Management. Stay with us. Presenting the CNBC TV 18 budget ballot box coming to a hotspot near you. We'll be placing these ballot boxes at popular public spots, malls, colleges, theatres and others across major cities. We'll also be asking the newsmakers who drop into our studios for their budget wish list. So come join us and tell us what's your top budget wish list from the Finance Minister. Drop your wish list at a CNBC TV 18 budget ballot box near you. We'll compile them and present it to the Finance Minister before she presents the Union Budget.
Infra and construction and capital goods, the investments theme continues to remain, very robust. I don't think there's any change in that. But, the markets have run a bit fast, and you are seeing these +7, -7 in any kind of result, right? If it's a disappointment, it's a -7%. If it's a surprise, it's a +7. So I think the markets are a bit stretched in some of these segments, and you can see some, sharp reactions. We've seen in some of the financials also, sharp reactions on a little bit of disappointment. Budget, the key thing to watch is whether they continue the capex push. Last 3 years, we have seen revenue expenditure growth of just about 3% and capex growth of almost 30%. And that's what's creating a lot of the excitement in some of the capex names, construction names, which has been sustaining the market. See, I'm more bullish on the domestic economy and the domestic consumer demand. So some of the names where you have international demand, international operations are far bigger. It's difficult to take a call.
Clearly, as an investor, I would always want that. I don't think that tinkering with the LTCG should happen. I still think India needs a differential tax rates on long-term capital gains.
Dividend tax?
Sorry?
What about dividend tax?
Dividend tax, if that can be, because that's double taxation.
That's double tax.
So obviously...
And it's hurting a lot of investors.
That's right. I mean, and if you actually...
Yes, the budget is big and the markets will react, but immediately it is the FOMC statement and the Fed chair's statement that you shouldn't expect a rate cut in March. Robert Sokin, the global economist at Citi, joins us to give us an analysis of the impact. Robert, thank you very much indeed for staying up for us so late. Deeply grateful. But really, what's the impact? We saw shares fall, but is this going to continue?
Well, I think ultimately what the message the Fed was sending was a positive one. If you look at where they're sitting, they have core PCE running at a 2% rate over the second half of last year. You've seen continued cooling in wage growth from the ECI that we just got, which is the Fed's seemingly preferred measure of wage pressures. And at the same time, that growth is continuing on a strong pace. And most likely, we'll get a strong jobs report this coming Friday, which would likely boost the markets a bit. So I think ultimately, even though Chair Powell pushed back against the possibility of a March rate cut, didn't close the door completely, but pushed back against it, I think the ultimate message here is pretty positive, that the Fed's getting pretty close to being convinced they're achieving that soft landing, and that easing is coming. It just may not be coming as fast as maybe markets were hoping, but it's not that far off on the horizon.
Absolutely. I think the markets will have to be a little more patient, right, before the first rate cuts come through. Got it. Robert, hi, good morning. It's a big day for us here in India. We have the union budget. From a global economist standpoint, what is your key expectation this time around?
You know, I think what we're seeing that's very interesting, and this is true for India, not just India, but globally, is you know, a lot of economies are performing better than expected, particularly in emerging markets, and fiscal policy is probably going to be less supportive generally than it's been over the past few years. And I think also India is in a particularly strong position because growth has held up very well. We're expecting strong growth again this year. And you have to start thinking about that trade-off between, you know, running a budget deficit at a time where growth is strong and there's still that risk of boosting inflation. So I think it's a very careful balancing act for the Indian government, but fiscal authorities more broadly heading into this year, especially as inflation is more under control and growth is holding up fairly well.
Robert, do we need to be worried about the regional banks in the US once again? The index there, which tracks these banks, was down 6%.
Yeah, it's a great question. And I think it's interesting that we saw stresses in the regional banking system last March, but at a very different point. You know, the Fed was still hiking rates aggressively. There was a lot of uncertainty about exposures within the system. And there was a lot of uncertainty about the economy's trajectory more broadly. Right now, those things are in a much better place. So, you know, the Fed is moving towards an easing trajectory, and the economy is holding up well. There's less worries about exposures in commercial real estate. Those fears haven't gone away, but maybe they're less acute than they were last spring. So I really think this is a concentrated issue within a specific bank. It's probably unlikely to spill over. Similar to as we saw last spring, you saw some issues within some banks, but the broader banking system was quite healthy and held up well. So I very much expect that to be the case again this time around. But of course, you know, there are risks around that, and you're seeing that reflected in markets.
Okay, got it. Now, Robert, finally, what are your currency and bond guys telling you? What might be the range of the bond index and the range of the dollar index? That's what worries EMs. So do you think it's going to, a yield's going to fall, dollar going to weaken, or the other way around?
Yeah, it's great question. And I think, you know, on balance, where the 10-year is right now, kind of in the high 3 range, we think that's pretty fair. You're probably likely to get a little bit more downside as the Fed starts to ease. You know, so somewhere a little lower than we are now, but not too much lower on the 10-year. And then on the dollar, well, it really depends, I think, on the currency pair that you're looking at. But broadly speaking, over the medium term, as the Fed starts to ease, rates come down, the dollar should cool against a lot of currency pairs. But again, of course, it'll depend, as always, on the Fed's posture and when and by how much it eventually cuts rates.
Got that. Robert, deeply grateful to you yet again for staying up so late for us. Thank you for joining us.
Thank you so much.
Well, I think the key takeaway from Robert is that you should not see this as bad news. You know, after all, what the Fed is saying is that it can manage a soft landing. And let's put that to our next guest. Jahangir Aziz, the global head of EM economics at JP Morgan. Jahangir, again, thank you very much, like Robert, for staying up for us. What's your sense? Do we have to take this as a negative message at all? Although the stocks fell, is this ultimately telling you that a soft landing is possible?
Look, I think the market was over-exuberant about a March rate cut. That's one of the things, right? And therefore, there was a lot of positioning, hoping for a March rate cut. So the reaction today, most likely, and I'm not exactly an expert on equity positioning, but I'm guessing a lot of it has to do with positioning. And as Robert said, look, what ultimately comes out of the Powell statement is that he's becoming very, very comfortable with the idea that you don't really need a recession to get inflation down to that 2% level. In fact, they've already achieved 2% at the PCE level, and they expect few more data points to confirm that. And the fact that he's so comfortable with the idea that you really do not need a massive slowdown in the economy means that, our rate cutting cycle is at hand. It is obviously not going to be in March, but, May, June are now very high probability dates at which the Fed will start its easing cycle.
Okay. Jahangir, hi, good morning, and thanks for joining us in a big day today. What is the expectation in terms of the fiscal deficit number this time around in the budget? Do you think, given that it's a pre-election budget, don't have your hopes too high in terms of fiscal profligacy? What is the number that you're going with?
So first of all, look, it's an interim budget, right? So let's not get too excited about it, right? My guess is that given the fact that they have been hell-bent in proving that they can stick to the fiscal consolidation line that they had announced, my guess is that they are going to target the 4.5% 2 years down the road. I'm cutting the difference in middle, and I'm saying that it's going to be a 5.2% fiscal deficit target. This is not, it could be 5.1, 5.3, but I'm guessing it's somewhere in the middle. So 5.2% is my number for this budget. And again, this is an interim budget. Let's keep that in mind.
No, absolutely. Jahangir, hi, morning. Prashant here. Just to sort of, we're going to, toss you from one to the other, budget and global. So back to the global, the 10-year fell about 10 basis points in the US last night. It's not the Fed, it's this, once again, festering regional banks in the US, because most of that fall happened before the FOMC decision, etc. Is that once again going to be a bit of a worry at the margin?
Right. So once again, if you look at the morning place, it actually started with the ECI number actually surprising on the downside. Right? So that was when it actually fell. Then again, the next drop that takes place is after the Fed speak. Look, in the March event when you had rates going up close to 5%, and then you had the major banking event, I think people have very bad memories of that. And I think people still haven't recovered from that episode. So I think there's some of that obviously going through, but I don't think that a 10 basis points drop when the Fed more or less said that they are probably going to start cutting rates not in March but very soon thereafter is that big of a surprise event. If you look at where the 10-year was, before the ECI number, and at the end of the day, they're broadly the same.
Jahangir, are we really picking holes in what is a superb Goldilocks time for us? I mean, look at the US numbers, GDP numbers, the way they have surprised. 50% more than what people expected. People expect 1%, it gives you 2%. Likewise, core inflation, especially in Asia. It's surprising on the downside month after month. It's a great moment. This is going to be a good at least 6 months. Can we take that Goldilocks to continue for some time?
Sometimes, Lata, we like to look at the gift horse in the mouth. So I think we are doing. I think, a whole bunch of us had this view that, look, the last mile of inflation is going to be very, very difficult because the first 2/3 or 3/4 of the inflation decline was essentially being driven by the normalization in the supply chain dynamics, and therefore the last mile will require some sacrifice to be made from growth. Growth is surprisingly on the upside. The supply side normalization, that is also fading away, and therefore there is this concern that, well, you're not going to get the last mile. But in line with what you said, I think, look, even if the last mile is not reached, right? So let's say the Fed doesn't even make it to 2%, but somewhere the market expectations and the rate cuts are not hinging on the Fed actually hitting 2% and keeping it there. It is a trajectory that inflation is on the path towards that 2% mark. That is sufficient for the Fed to start cutting rates as long as the Fed is convinced that that trajectory is actually there. And that's all that the Fed is asking for. Few more data points that the trajectory is actually being maintained. And I think that's about all it requires. And I agree with you. Look, even 6 months back, if you'd said that, in the month of January, we would be looking at a world where, growth is surprising on the upside, inflation is surprising on the downside, central banks are poised to cut rates. Some central banks have already started to cut rates. You wouldn't have believed us at all, believe me at all.
Absolutely. Lata was talking about growth in the US, right? So I wanted to bring that discussion back to India. Because, the finance ministry put out a review the other day saying that the economy will grow 7% in FY25. They're looking to become a $7 trillion economy by 2030. In this budget itself, what do you think the growth measures could be that the government can announce, despite it being an interim budget?
And if I can add one more to that, the growth expectation is a big question. Tax buoyancy, what would you think is a par for the cause? But more importantly, Jahangir, is it okay if they, breach on the fiscal deficit? After all, look at core inflation. Why are we worrying?
So the worry is not there, Lata. So let's look at the context of India's growth. So we can quibble about where the growth momentum is faltering. You've had 4 straight months of industrial production momentum slowing down. Global economy is slowing down compared to what it was before, even though it's doing very well given expectations. But whether we go into that quibbling about the last second decimal or not, growth is going to hold up reasonably well around the 5.5–6% in the remainder of this fiscal year and in 24-25. Inflation is on the downtrend, even though it hasn't reached the 4% magic number for India. It is on track of doing that. Once the Fed starts cutting rates, even the RBI will start cutting rates. So the fiscal does not require to provide another dose of fiscal support in 24-25. And I think that should be the starting point. Instead, what we have are 2 separate issues facing India. One on the fiscal front and the other in the economy. On the fiscal front, despite the fact that we will achieve the 0.5% fiscal consolidation this year, that 0.5% fiscal consolidation was entirely on the basis of tax burdens. There was very little expenditure compression that took place. And if you look at the stock of debt actually rose from around 80% to about 83%. And just to stabilize the debt stock, you will require the overall public sector deficit, and I'm not talking about center versus state versus PSUs, but overall fiscal deficit, overall public sector borrowing to come down by about 2 percentage points, just to stabilize it, even if you assume a very healthy, let's say 9.5–10% nominal GDP growth rate. So these are very difficult numbers. So the budget needs to consolidate and start consolidating now. And I think that, that should be the way to achieving that 4.5%. You will need help from the state governments to reduce their fiscal deficit from the 3.1, 3.2 this year back to the 2.5%. Both of them need to be done just to stabilize the debt dynamics. So that's the first thing. The second thing is that while we are achieving these very, very strong overall GDP numbers, there are serious imbalances within the economy. Private consumption remains weak. Private investment remains subdued. If you look at the export fronts, it is largely being driven by services, not by manufacturing. As I just said, for the last 4 months, industrial production has actually been losing steam for last 4 straight months. And even within consumption, there is a huge gap between low-end consumption versus high-end consumption. Now, these are imbalances that are natural to happen when an economy is shocked by global shocks of the kind that you've seen over the last 3-4 years. The concern is, are we closing those gaps or are these gaps widening? And what should fiscal policy do? And I think the fiscal policy now needs to address these gaps and fiscal consolidation at the same time, rather than continuing to provide support to the economy. I think that's the basis of looking for a fiscal consolidation and the granularity of the budget, even though it's an interim budget.
Jahangir, thank you very much. Actually, there are two different narratives. If you read the economic review of the CEA, it looks like we are 7, 7.5, and just all guns blazing. And then, as you correctly point out, there are some weaklings in the growth story as well in terms of consumption.
Yeah.
Point taken, this debate will go on. Thank you very much indeed for staying up for us.
Sure.
Okay, well, that's the global and the emerging market scenario, the macros. But now one very important micro that we have to handle at this point in time, the news that came in on Paytm. The Reserve Bank has directed Paytm Payments Bank, not the app, Payments Bank, to stop onboarding new customers with immediate effect long back. Now they have told them to stop even taking, fresh deposits into their wallets and other instruments. So let's just hear out what RBI has done and the impact. Ritu's here. Ritu.
Good morning, Lata. There are very significant restrictions on Paytm Payment Bank, but first let me just distinguish for the viewers. Paytm, the app that you and I use for UPI transactions, etc., is not affected. What is affected is the payment bank, and there RBI said Paytm Payment Bank cannot onboard any new customers. It is said that no credit transactions, deposits, or wallet top-ups can happen by customers after the end of February. Even your FASTags, your national mobility cards that are linked to that, you cannot use after the end of February. But if you have, balance in these wallets, there's nothing to worry about. Customers can use it or withdraw their money without any restrictions whatsoever. But that said, in no unclear terms, RBI said that no banking services can be provided by Paytm Payment Bank anymore, apart from the withdrawal and utilization of existing funds. And the nodal accounts of 197 Communications and Paytm Payment Services are to be terminated no later than the 29th of Feb. Now, one would ask why this harsh action, and I'll take you back to March of 2022, which is the first time when RBI sort of, directed Paytm Payment Bank to stop onboarding customers because of various deficiencies it had observed. And those, we understand, even after 22 months, they continue, whether it is KYC-related norms, transaction monitoring, alert system setup. So that is why this action has been taken. Also, this arm's length distance between Paytm, 197 Communication, and the payment bank, there were concerns relating to that. The balance in these wallets, we understand, is only close to 3,000 to 4,000 crores, so it's not very significant. But, what is significant is that in past such instances, RBI has made it very clear that if you satisfy certain conditions, the embargo may be lifted, which is absent when it comes to this particular notification. So what is the impact? According to Bernstein, this ends, the operations of Paytm Payment Bank for all practical purposes. It adds to the already heavy regulatory burden. According to Macquarie, this will significantly impact Paytm's ability to retain any customers because the lapses, it says, are quite material. And it is indirectly revoking the prepaid payment instrument license of Paytm, which, remember, was transferred from 197 to the Paytm Payment Bank in 2017. Jeffrey says the direct impact could be 20-30% of the EBITDA.
All right, that's a significant blow, almost a body blow to Paytm. Ritu, thank you very much for that. Arvind Sanger is with us, Managing Partner at Geosphere Capital Management. Arvind, good morning. Great to have you with us here. We'll talk about the global and, of course, the budget here in just a bit. But if you've been listening into Ritu describing what's happened with Paytm, for viewers, what is the impact? I mean, for investors who are holding the shares, it's going to be a big day on the downside for the stock.
Well, we haven't looked closely at the stock, but obviously this is not good news. So, I mean, clearly they have been somewhat lax in their response to RBI's requirements for being more, diligent about some of their customer onboarding and everything else. So, yes, I think it'll definitely have a negative impact on the stock.
Okay, it'll definitely have a negative impact on the stock. Got that. Big blow coming through this morning. But Arvind, hi, good morning. What is your expectation from the budget this time around? Given it's an interim budget, are you keeping your expectations low? And from a market standpoint, how are you going into it? Because the market has been pretty strong so far.
Well, I think the market is probably not expecting much. And we are not, the number one view, in my opinion, is avoid big surprises. At the end of the day, the last thing that the market needs is a big surprise. And so, as long as they continue on their somewhat disciplined, on the current account deficit, on the fiscal deficit, and there are not massive, spending stops to the, to prepare for the election, I think the budget should be largely a non-event. And I think we're watching other things that matter more. This budget, as you said, it's an interim budget before an election. So I think it's hopefully a non-event.
Okay, let me play the devil's advocate. First, Arvind Sanger, really grateful that you're staying up for us so late. It's early morning here, but I guess very late for you.
I'm on a flight to India in about half an hour. So
okay, welcome. We'll meet you in the studio. Okay, should we really worry if the government spent a bit? Because core inflation has been falling. Secondly, although GDP is good, consumption hasn't been good. So isn't a bit of a spend actually good from a market point of view and even the economy point of view?
I think the government has done a very good job in terms of some of the support that they provided on food and other items. So I think that the government is already doing something. So a little bit, you're right, a little bit is not going to hurt. Clearly, it's a bit of a K-shaped recovery. So therefore, helping a little bit at the bottom of the pyramid would not hurt. But as long as the fiscal deficit is not, too far. I mean, I think, yes, India has had very good inflation discipline. It's had good fiscal discipline. I'd hate to see them, let anything too meaningful go. But, doing a little bit is not going to matter too much.
Arvind, one thing they can do, and I think they should do, is stake sales in government companies. If there is ever a time to do it, PSUs have been to the moon. Valuations are rich. It's a very, very sort of hefty kitty they can raise if they do it, especially in the first year of the new government. I mean, of course, if they're re-elected.
Well, here's my simple point, right? You don't have to announce in a budget. I mean, you can announce all kinds of intentions, and sometimes they get hit, sometimes they don't get hit. Just do the damn thing. I'm sorry to be blunt about it, but when the markets are there, as they say in our business, when the ducks are quacking, feed them. When the market is there, do it. I don't care whether it's in the budget or not. Somebody in the bureaucracy, in the government needs to realize that when the markets are willing, it's something to act on, whether or not you've thought about it in the budget and you've put it in the budget or not. You just have to have some ideas that long-term you're wanting to bring your stakes down. And you do it when the opportunity is there, not when it's in the budget. Who cares? I mean, this budget exercise is a little bit of, in my opinion, kind of an anachronism that, they shouldn't drive so much focus, but it still does, I guess, in India. So maybe they need to put it in the budget, but I think they should definitely take advantage of it.
You're veering to that point of view, Arvind, but that's when suddenly industrial policy returned. Import tariffs jacked up, PLI schemes. Industrial policy has returned, and how? Not just in India, even in the United States, as we see with the CHIPS Act. But just a final question to you. How are you looking at the market's valuations itself? You must have seen the earnings season. We've had some good numbers. Auto sales, auto numbers were very good. FMCG was not too good. Banking numbers have been worse than last time, but still inherently good. So how are you looking at valuations, and how are you looking at HDFC Bank?
Well, we think valuations are not particularly compelling, but they're okay. I mean, I think there are still some pockets of opportunity, but the market, let's be clear, especially in the mid caps, is not cheap. As far as the HDFC Bank is concerned, I think, a lot of bad news is priced in. But, when I was on your channel about a couple of weeks ago, somebody asked me about the private sector banks. And my statement then, which stays today, is that the biggest concern I saw in private sector banks is the loan to deposit ratio and whether the deposits were going fast enough. And that's turned out to be the big negative concern that has emerged in the market since the earnings report. I think HDFC Bank obviously has unique problems in digesting HDFC, but a lot of bad news is priced in. We don't own it right now, but I think this is one high quality bank that seems to have gotten to, very interesting valuations.
So, a couple of final questions before we let you go, Arvind. One thing that the government has made very clear is that apart from, maintaining the fiscal glide path, they're also looking at this being an investment-led, growth-driven economy, right? So they're looking to do all that it takes in order to let growth pick up. What do you think the announcements could be this time around leading to that? And what is your view on how to approach these infra-driven names? I mean, whether it's not just the L&Ts of the world, but a lot of these companies in the broader markets as well. Do you think it's a good time to put money to work here?
Well, I think, anything related to industrial capex, anything related to even some of the power sector capex, those are good. And I think the government has, the PLI scheme is obviously a big one, but other measures that they've taken have been pro, infrastructure. And I think anything that is infrastructure related is good. But I think it's time for the private sector to take over. I think the government just needs to, allow the fiscal space. I think it is time for the private sector to step up. And I think it's starting. But I think the PLI scheme and the other things are enough, and anything the government can do to facilitate more movement in that direction rather than government doing infrastructure here and infrastructure there, which is great. But I think it's also time for the private sector. So anything they can do to encourage private sector investment, I think, is critical at this time.
Okay, Arvind, finally, I mean, I'm asking I'm asking this question to all the global guests I get. Are we really in a very good scenario and we are just picking holes? I mean, look at the way the GDP growth surprised on the upside for the US. Similar thing happened in India. A good 0.5 percentage point, 1 percentage point more than what the street is expecting. And plus, core inflation is consistently falling. It's Goldilocks time. Are we just supposed to just enjoy it?
Yeah, no, I think it's Goldilocks times. I mean, the only, if I can make a comment, if China, when it was at the same demographic dividend, was growing at 7.5%, it would be considered disastrous. It was growing at 10+%. I don't think we should be satisfied with 7.5%. I think we have to be aiming higher at this stage of per capita GDP, at this stage of a demographic dividend. I don't think 7.5% is enough. I mean, I think it's very good. I love it. I invest, I make money. But I think from a policy standpoint, declaring victory at 7.5%, in my opinion, is aiming too low. And that's something you have to keep in mind. Look at the Southeast Asian countries when they were going through their growth phase, demographic dividend. Look at China, and don't be so self-smug and satisfied at 7.5%.
All right.
I completely agree with you. Thank you very much, Arvind, for putting it so beautifully. We should be aiming higher. Maybe 12 and 14 that China did because they were in a different global environment at that time. Yeah, go ahead.
Thank you. Thank you. 10 is enough. I think at least double digit.
Yeah, I agree with you. But surely we shouldn't be satisfied with 7.
Absolutely. But, we have a market to trade as well. In half an hour from now, we're going to get the pre-opening rate. So let's get our colleagues in to tell us about all the stocks that you need to watch out for. Rima is joining in first up with some stocks in the news, and then we'll toss it across to Ekta as well. Rima, morning.
Hi, good morning. Let me start with Indus Stars, where sources to CNBC Awaaz suggest that we're likely to see a big block deal. KKR and CPP. CPP's Canadian Pension Fund, they're likely to sell shares amounting to 3,800 crores in Indus Stars via a block deal, which could happen up to an 8% discount. The stock, remember, yesterday was down 3.5%. GSPL, now getting to the numbers, GSPL has reported a good beat, particularly on the operational front, as the raw material costs have come down. So compared to estimates of a 20% margin, the company's delivered an EBITDA of 24.3%, and the PAT2 has come in 100% higher than the CNBC TV18 or the consensus poll. Godrej Consumer, GCPL, has also reported a very strong margin expansion. Their volume growth is in line. So the domestic organic volume growth is 5%. On a consolidated basis, the India volume growth is coming at 12%. But what the street could focus on is the margin expansion of 280 basis points year-on-year to come in at 23%. Now, GMR Airports, well, the revenue growth is very strong. It's coming at 26%. The passenger traffic is only going up. On a quarter-on-quarter basis, the passenger traffic is up 6%. But because on account of very high interest costs, the company has reported a big loss this time, and that's very disappointing. Shree Cement has also reported an operational beat driven by lower power and fuel costs. Volumes at 11% have come in line with expectation. But again, here, the beat is on margins and profitability. Back to you.
All right, Rima, thanks very much for that. More stocks with news flow. Ekta is here with that list. Ekta, morning.
Morning. Well, I'll start with a couple of brokerages on Sun Pharma. IIFL has a buy with a target price of 16.25. According to them, they expect Sun specialty business to clock a 13% CAGR over FY 24 to 27. Elara has an accumulate, and they've raised their target price on the stock to 15.24. So the stock is probably going to positively react to these brokerage notes. Mankind, they came out with numbers post-markets, revenue up 25%, margins 23.3%. Profit has grown significantly as well. Domestic revenue was up 20% year-on-year. Exports was up 118% on a year-on-year basis. Ajanta Pharma, revenue up around 14%, margins 28.4%. Profit was higher as well, so stable set of numbers there. Westlife, it was a weak set of numbers, so revenue was down around 2% on a year-on-year basis, and the profit was down over 50% year-on-year. Dixon Technologies, margins 3.8% versus our poll of 3.9%, and net profit was lower at 97.1 crores versus our pool of 104 crores. Lastly, IRB Infra, strong operational performance, net profit up around 30% year-on-year. There is a CEO change which has taken place there as well.
Okay, thanks a lot for that, Ekta and Rima. Those are some stocks in focus. Joining us now is Dipan Mehta, Director at Elixir Equities. Dipan, hi, good morning. Everyone's going to be watching the impact on Paytm this morning after the RBI restrictions. The management has said that they expect a worst-case impact of 300 to 500 crores on their annual earnings. I wanted your thoughts on this. It's pretty much come as a shock to the entire system, especially the startup ecosystem, right? What do you do as a shareholder in this stock now?
Yeah, good morning, and thank you for having me on your show, Sonia. I think it's very detrimental to minority shareholders, and it raises a lot of corporate governance issues over here as well. And certainly the trust factor is going to be impacted. So the management may say that their revenue is getting impacted by whatever percentage of whatever crores. But as a Paytm customer, I'm going to think twice about working with Paytm, and that's the real damage. Having watched banks and NBFCs for the past decades or so, trust is the most important factor when it comes to dealing with them. And this certainly is going to be a body blow. I mean, all of us have got money in our wallets, and asking us to withdraw the money from the wallet is akin to, what happened in the Yes Bank, that, you were asked to, your withdrawals were curtailed, and, you were asked to take steps to kind of risk, to limit your risk against a bank or an NBFC. So that's not a good news from Paytm shareholders' point of view. And I expect that there'll be a major reaction in the stock price.
Okay, I just want to point out, Deepan, as you point out, for investors, it's a very uncertain time ahead. But for consumers, or rather users of the bank, it's not going to be a big problem. They will be allowed to withdraw, and Paytm, being a payments bank, has to put all its money in T-bills. So I don't think liquidity also will be an issue for them. This, I don't think, is a consumer problem. Of course, they will have to change their FASTag from one to another and things like that. But it's not a loss of money. Whereas if it was a normal commercial bank, you would even worry about who will underwrite the savings.
What Dipan's saying also makes sense. So, for example, right, I use Paytm a lot for a lot of transactions, but now my concern is, what if they move to the next step, and what if my wallet money, the money in my wallet, I mean, it's an additional hassle. So I might as well just download other apps and move to that. That is the fear.
Exactly. That's why the Reserve Bank has given 1 month where you can even load on your wallets. Yeah. But most people will think like you. Why should I load for a month when ultimately I will have to anyway withdraw? So that 1 month is given so that there's no panic. Okay, Deepan, let's move from Paytm to the other stocks. Results-wise, what impressed you overnight? I thought the Shree Cement numbers were good. I thought the Godrej numbers were good. But you tell me, what's your pick of the latest numbers?
Yeah, good morning, Lata. The pick has to be Sun Pharma. A disclosure, we and our clients are invested in it and pleased with the set of numbers. See, this company has been steadfastly working on its specialty products. There were many doubters that whether it would scale up well and whether it would be profitable or not. But I think they've done a commendable show over there. And I think that gives a lot of confidence to investors that as they pursue this strategy and more products are added to the specialty list, you will have Sun Pharma in a different zone as compared to all the other pharma companies. And it'll be more like an IP-driven type of a company rather than just a pure generics player. So from that point of view, I think it's great news. I like the results very much. And of course, there's a cyclical improvement in the operating profit margins. because of lesser competition and better price discipline in US generics. How long that will last, one cannot say, but certainly specialty is becoming a bigger portion of their revenues, and that's great news.
Okay. The other really strong set of numbers came through from JSPL, right? Big margin beat coming in this time versus expectations, as well as versus what they did last time around. As far as I remember, metals has not interested you much in the past, Dipan, but any thoughts on JSPL? It's already rallied about 20-25% in the last 3 months.
That's right. I think, because we generally like to avoid cyclical businesses because of the volatility in their earnings, but you have to hand it to steel companies, right from Tata Steel, JSW, Jindal Stainless, and Jindal Steel and Power. All of them have reported excellent numbers. And they are in that sweet spot where raw material prices have remained stable, slightly lower, and steel prices also have firmed up. And because of all the spending on real estate infrastructure, they are seeing good volume demand as well. So yes, I think, in a cyclical business, you're going to have some quarters which are going to surprise you on the upside. But, from an investor's perspective, it's always better to buy these businesses when there is stress in the industry and when these companies are reporting losses or flat kind of sharp declines in profits, and then wait for the upcycle. Buying a steel stock at an upcycle doesn't usually result in outperformance.
Dipan, hi, morning. Just a few, this is a market which is finding sort of underperformers and bidding them up, right? I mean, for example, Voltas out of the blue, big move yesterday. I looked at something like a Balaji Amines, has not done anything for a couple of years. Is that it's rotating to try and find newer and newer ideas because there is money and there is momentum. You just need ideas.
That's right, Prashant. But the quality of the ideas also is not that great.
Yeah.
The management can talk up its stock and investors believe it, and you can bid it up. This is the classic bull market, make no mistake. And I'm getting a bit concerned about the way some stock prices have moved up. Valuations clearly are very, very uncomfortable. Good quality businesses are trading easily at 60-70 times trailing 12-month. And we can see that because of base effect or because of transient issues, the earnings are not growing as much as you'd like them to. Like, look at Larsen and Toubro, 1-2% lower than what the street is expecting. And that I see across the board that companies are reporting earnings which are slightly below analyst expectations, and it's more to the profits are coming more on account of lower input costs rather than higher volume growth. And how long that can sustain, I don't know. And the valuations are extremely rich. So you have 2-3 dull quarters, and suddenly the investors start thinking whether it's worth paying this much of a valuation premium for such businesses. So I'm a bit cautious, and it could be the market could scale higher from these levels, but I'm not getting comfort levels to buy anything at these prices.
Oh, anything? Okay, that's actually answering my next question. See, we are all expecting a capex-heavy budget. It's possible, will it be 10% higher than the current year? Current year was 35% higher capex. Now, will it be 10% higher, 20% higher? No. Would that make you buy anything? If yes, what?
See, Lata, the way the valuations are for a lot of companies, sure, you could be overweight in some of the engineering construction companies, the road construction companies. But if overall the market view is negative as we have at this point of time, then you rather wait for a correction. And mind you, this is just a kind of, not that the long-term fundamentals are under any threat or the long-term bull market is in any way going to be impacted. It's just that prices have gone a bit ahead of themselves. And this earnings season has not been all that fantastic. There have been many patches, I think. And from that point of view, looking at the valuation, looking at the way, the trading positions are, the leverage positions are in the market, I just want to be a bit cautious. And, it's better to be 15-20% of your portfolio in cash. That strategic cash, should there be a correction of 15-20% or so, then that cash should be very valuable to get the outperformance in the next leg of the rally upwards.
Okay, we just stay on with us, Dipan. We'll come back to you in a bit. I think in less than half an hour from now, we have the pre-opening rate. Some more questions lined up for you. But we also have right here in our studio, Rahul Arora, the CEO of Nirmal Bang Equities, who's here with us to help us, understand what we can expect from the budget. Rahul, thanks for being with us here in the studio. It's the same drill every year, right? I mean, this time as well, you can't expect much given it's an election year. But nevertheless, we were talking about some of the incentives that will be provided to certain sectors. And one sector which has been a thrust area for the government is green energy. So this time we understand that there could be a green transition fund that is, created to for financing of green projects, etc. All these stocks, do you think they've priced in this news, or is there more to?
So I think, first off, good morning and thank you for having me on the show. I think, Sonia, a lot of these were either too new or too under-owned. And I think, as we saw, say, at the start of the pandemic, when chemicals was not a very big sector, and within 18 months, these stocks went up 5-6x, and then they've gone nowhere for an extended period of time. You've seen that in PSUs and a lot of these. These are visionary statements, but there's not too much of a direct way to play them from a listed capital market, right? This will evolve over a period of time. And I think to that extent, I think while the steps are in the right direction, and I think, a lot of companies are talking about decarbonization and alternate fuels, and a lot of large industrial conglomerates are investing in those directions. But I think any kind of incentive towards that direction is welcome. But I don't see too many listed direct ways sort of to play.
The Tata Powers, JSW
Absolutely.
Energies of the
There'll
world.
probably be a handful of them. Yeah. I mean, take a look at Suzlon, right? Everything had a price. Suzlon had gone down to about 5 rupees and it became a multi-bagger from there. You've seen that with Adani Green.
So you mean none of them are worthy of, are priced correctly at the point?
So I think that holds true for the market by and large. I think it is priced to perfection. And I think the earnings season is also telling you that, whether it's the biggest banks in the country or the biggest IT companies in the country, if you are not giving the results or if things are not panning out as per expectations, corrections are definitely happening. But I think, we should have probably, from where we started off, probably already been much more ahead in our journey for EVs, for example, already. But that has not quite happened. And I think it will eventually happen. And I think recently at the IBLA Awards, only Piyush Goyal was sounding very bullish about where EVs will be by 2030. But these are not immediate, like from a retail stock market perspective, what do I buy after this? Those options may be very few compared to what the rest of the market has to offer.
First of all, I want to welcome you. Rahul is a former colleague, and on the budget day, we invite the best. So I'm so happy to see you with us on budget day as a guest, not as an anchor.
Thank you so much, ma'am. And I will never forget that my first live show on television was with you as a co-anchor. And I was nervous sick. And I think in that 1 hour show, I must have spoken for all of 5 minutes. But you've always been a great support, and thank you so much for having me.
Okay, now in the budget,
yes,
I mean, the same question I asked Deepan as well. If there is a good CapEx announcement, will you be enthused for any stock? If there is a big income transfer announcement, these are the things we're expecting.
Right.
A PM Kisan Samman Nidhi going from 6,000 to 8,000 rupees. Will that make you buy rurally exposed FMCGs?
So I think, Lata, it's pretty much known that the capex number will come down. As you said, the 35% growth, that will probably come down to a 10 to 15% kind of growth. I think the government will probably want the private sector to do most of the heavy lifting on capex from here. And to a large extent, Lata, if you see, that has already started in the road announcements. I think if you see the kind of announcements that NHAI has done, it's been a very disappointing year from a road project announcement standpoint. So it's somewhere already started. But I think a good proxy to this, Lata, would be to play through cement. Because I think most of the high-cost inventory has been replenished. And I think if you look at Shree Cement, JK Cement, and some of the others that have come out, there's been a huge expansion in margins, right? So I think if you're looking at CapEx be doing, whether public sector or private sector, I think the proxy to play it could definitely be cement, and valuations are not too expensive there. I think post the, the interim budget and the elections, I think road projects announcements would go up in a very material way. So you could play through stocks like PNC Infra, KNR Construction, Ashoka Buildcon, and there are a lot of private equity deals happening on some of their projects as well. The only thing that's disappointing me, Lata, as a former consumer analyst myself, is the kind of volume growth that FMCG companies are showing. I'm not even talking about double digit. It's not even structurally going to a mid-single digit number, and that's very challenging. And
Godrej did overnight.
Yeah, but I think those are, few and far between. I mean, even Dabur, I think consolidated was 5-6%. But I think for the, for the valuations that these guys are trading at, Lata, I hold lever. But even then, to be paying 50 times for a 2% volume growth, I don't know. I mean, even Dabur, right? The return ratios, the return on equity and return on capital employed is in the mid-20s. The stock's at 42, 43 times. So it's almost, going at double of what the return ratios are. So as an investor, I'm looking at those metrics with equal measure. But I think it'll probably be, at the margin to help rural. There will be some announcements.
I have to interrupt you.
Sure.
There's a huge breaking news flashing. Wall Street Journal is reporting that Disney's deal with Viacom is done, Viacom 18, and the India assets have been bought by Viacom 18. That stock is incidentally owned by TV 18 and Network 18.
No, the story
so
here
the
is
usual
Disclaimer. The story here is that it's a great deal for Viacom 18 and Reliance Industries because
the valuation.
I think they started with, there were reports that the India business is valued at $10 billion. Then recently we heard a number of $5 billion, $4.5 billion. Reliance Industries in a statement to exchanges recently said that they can't comment on these numbers, etc. And now what we learn is that the valuation, the India business is valued at under $4 billion, right? 60% of the business is being sold to Viacom 18. So I think, from a valuation perspective, this looks like a pretty good deal. We've been sort of, focused on the other one recently, which of course did not happen, which is Sony and Zee in the media space. But I mean, this has gone through and looks like a pretty good one for Reliance.
As you were saying, the value. Okay, by the way, that's Nirmala Sitharaman getting all set to present the interim budget in just a while from now and rushing inside. So we'll try and get you more snippets of that in just a bit. But as you were saying, the valuations of this deal have gone down over the last one and a half years. And one of the reasons for that is because of a part write-off of the revenue that was originally due to Disney from the sale of its cricket TV rights to Zee. And, there was an expectation that they were unable to pay up that amount. And hence the business was valued. It started off at 10 billion and it was valued lower. Any comments on this that you want to make?
Well, I think, Sonia, Disney's always been a very big India player. There was a time on the movie production production side, they had tied up with UTV and Ronnie at one point in time. And Ronnie had made a very good exit at that point. And I think even when OTT started, they didn't waste any time in tying up with Hotstar. So I think they're a very big India player. And as Prashant was saying, I think if you look at the two or three heavyweights in media today, it is Reliance Industries, it is Sony, and it is going to be Disney going forward. So I think it makes a complete... it's a marriage made in heaven, so to speak. I think Disney's been wanting to make that play. I think it was unfortunate that Zee's deal fell through because I think Sony has just so much, since you mentioned cricket, I think Sony has just so much going for itself in terms of sports and even other properties like Kaun Banega Crorepati, the singing and the dancing shows. I think Sony is doing so well. I think the only competitor is a Viacom 18 channel, which is Colors predominantly. So I think between these three players and the fact that two of them are coming together and consolidating, I think this could only be good news for the entire sector overall.
Did we discuss Paytm?
Would it make you buy more of Reliance and any of the related stocks?
I'd be a buyer in Reliance any which ways, Lata. I think because I think if you look at, what 70% of the market is IT, banks, FMCG and Reliance, right? I think at the short end, you're still seeing deposit rates go up. So I think NIM pressures may still be there. I don't know how much the bank Nifty will re-rate from here. Consumer, we've discussed already, and IT, we've seen some of the results haven't been up to scratch. So I think if there's going to be one thing that leads the market from here, regardless of this news, I'd still probably be a buyer in Reliance. And,
okay, well, actually, let me put that to Deepan. Sure. Can Deepan hear us? I wanted to ask Deepan, this big deal. Viacom 18 has purchased Disney India and for all of $3.9 billion. Not as, Prashant was saying, where we started hearing the news at 10 billion. What do you make of it? It's a Wall Street Journal story. The deal is done.
Yeah, I think it's really great news for all of you guys. And, Network 18, TV 18 have been a bit of a, underperformer if you compare last several years' growth. And maybe this is just what is required to take the stock to higher levels. As shareholders of the company, we really welcome this particular deal. And there are a lot of synergies. See, for a media company, the biggest cost these days is the investment which they make in the content. And that's getting more and more expensive, and it's getting very competitive to find the right talent also. So stronger the balance sheet, the better chances you have of growing the business per se. So I think eventually, all the OTT applications, the channels, you can expect better content. Better content drives higher subscription, higher advertising, and you get into that virtuous circus because you have the revenues to support even more content. And there's fast consolidation happening within the sector, so that also will help improve the yields. And valuations are really at attractive levels. So, I think that both these companies should do exceptionally well on account of this particular M&A activity.
So those are the stocks to watch in that sense if you're looking at how this deal kind of plays out and is received by the market. Deepan and Rahul, stay with us. We'll take a quick commercial break here. Plenty of market talk coming up. Sudarshan Sukhani is going to be with us with an eye on technicals. We'll also have Atul Lal, Managing Director at Dixon Technologies, talking to us about what he's expecting for Make in India in the budget a little later today.
effective tax rate goes really much higher. And we've seen also several kind of people move out of the country, and there are reports that one of the reasons could be because of high tax rates on dividends. So I think if that gets plugged, I think that will be quite meaningful.
I would expect the capital expenditure growth to continue, especially when we are talking about railways, defense, roads. I think that thrust will, at least for FY25, will continue. I would expect some more extension or increase in amounts under schemes like PM Kisan, because there is rural stress. We are still talking about a K-shaped recovery. So that should continue. And I don't think the fact that it's a vote on account should make it not possible for the government to increase allocations, because it's an existing scheme. So you can always increase allocations to existing schemes. Some more tweaking of the income tax slabs for the middle class, so that consumption gets a little bit of a further boost. One more thing that I think they could announce, again it's an existing policy, is extension of the 15% tax rate for fresh investments, because that's, I think, lapsing the next few months. So that if you want to do PLI and make in India, that 15% tax break extension should happen.
I think there should be some kind of benefit given for long-term investors who come to the bond market, okay, through the mutual fund route. I think that parity is somewhere I think one would like to, because you've seen since then the flows into the mutual fund industry, into the fixed income space has kind of dried out. And it's very important if you're trying to build the bond market and liquidity, and that's an area where I think we would like to some kind of relook into it.
It's important that we give this relief to the affordable housing. And if that can be done, it will be great. It will spur the affordable housing more. Plus, like you said, the pricing. Now, the pricing has always been a challenge. Now, pricing is a component of land plus construction. We all know that. And
All right, 2 hours to go, and we'll find out what's on the finance minister's mind in this interim budget. In the meantime, the market has been very, very strong. Yesterday, there was buying both from FIIs and DIIs, and the Nifty is barely a % away from its all-time high. Sudarshan Sukhani joins in now to give us some technical cues. In a bit, we'll get a couple of other guests as well. Sudarshan, morning. What is the expectation on the index itself? Do you continue to stay long? Do you wait for the budget to move out of the way before taking the next call on the upside? And what are the stocks to look at today?
Well, good morning. I think the Nifty is now giving us a sense that it's willing to go higher. All of January, the market was choppy. I had suggested that February, that is a post-budget month, is usually bullish, although it's volatile. And that volatility is understood. But there's no sense in waiting for the interim budget. Traders should be long. If not long, I suggest you go long at any dip or even after the open today. Now, there may be volatility because of news, because of sudden, say, spurts up and down, but stay put. The chances are that we are looking at a target of 22,200 or very close by. So there is money on the upside. So for the Nifty, there's a very clear view that we should be long in the market and be patient. Keep a reasonably loose stop loss so that volatility doesn't stop you out, 200 points approximately as a stop. Bank Nifty, unfortunately, doesn't have the same clarity despite yesterday's big move. So all I can say for the Bank Nifty is that if you want to go long, keep a tight stop, but the Nifty is the much better index.
Okay.
Now for the stocks. Bajaj Auto has been recommended earlier. The stock had a very nice big rally, again a 3-day trading range, and it's probably likely to break on the upside just following the Nifty. Buy with the stop under 7510. Chola Finance is one stock that's an intraday short. A very large distribution pattern is now visible. Intraday short with a stop above 1210. Cipla is a buy. It had a big rally, gap up, then it fell down to support, and that support is holding. So buy with a stop under 1330. And finally, Dixon is a buying opportunity. That stock had a small correction. That correction ended with a trading range. And given the fact that, Make in India could be an interesting idea for the budget today, and the chart patterns are conducive, buy with a stop under 5850.
Sudarshan, thank you so much. Unknown to you, the Dixon Technologies management is actually listening to you. They are our next guests, so I'm sure you're going to be very happy. Thank you, Sudarshan. We'll get back to you later on in the day. Okay, Mr. Atul, I assume you have heard what our technical expert was saying. The stock is doing well, but I wanted to begin before the results with, the news at hand. First of all, of course, welcome. Good morning. Thank you for joining us. This import duty cut on mobile components to 10% from 15%. What do you make of that? Is this going to be a big bonanza for you? How much? How much does it improve margins, revenues, and bottom line?
So undoubtedly, it's an amazingly positive news for the industry. There has been industry's request, and this is a big gift the finance ministry has given us before the budget. In fact, we were asking for component duty cuts, which has happened. We were asking for certain clarifications on certain components, which has been done. And beyond mobile, also there were certain exemption notifications on which there was certain element of doubt. Those have been extended. So these are extremely positive things. Now, in our case, we will be passing on these duty cuts to our customer. We are B2B company. Hopefully, this is going to give a significant flip to the demand side, because let's see how the brands react to it. But undoubtedly, it's a very, very major positive for us.
From a, Mr. Lal, hi, morning, Prashant here. From a policy perspective, and since it's the budget today as well, has everything that needs to be done been done now, or is there anything which you seek from policy and from the government?
So undoubtedly, Prashant, on the policy intervention side, the government has rationalized the tariff structures. They announced a phased manufacturing program. The PLI schemes have been rolled out. The semiconductor policy has been rolled out. In various products, the manufacturing is taking place. So it's a no-brainer. The devices being sold in India are going to be manufactured in India now. The policy framework is well in place. And not only for the products being sold in India, in various categories, India is emerging as a hub for servicing the global markets. Our request for the government now is that we need to deepen this manufacturing. We need to create more value addition. For that, a package is required for also non-semiconductor components. And that is not only for servicing domestic production of electronic goods, it's also going to make India a part of GVC. So the government has been extremely positive in their response. We're working with the government. Let's see how it pans out. But that's our ask.
Mr. Lal, good morning. I also want to talk a little bit about your earnings. One word on that. Very strong numbers this quarter, around almost 100% growth in your top line, right, year on year. Tell us a little bit about what the next couple of quarters look like. The mobile EMS division has done very well. Is that the growth engine for you? And what would the average growth be by the end of FY24 and 25?
And if I can add, sir, if you can give precise numbers, how much does mobile contribute, and how much does this fall in component cost help in the next earnings?
So the contribution of mobile to our overall revenue is going to be more than 50%. And it's going to be the largest trigger of growth. Lata, I don't want to give a number because we are still going through a budgeting exercise. But let me assure all the stakeholders, the growth rate is going to be very, very strong because the order book is very strong. We target producing almost 35 to 40% of the outsourcing phones that are manufactured in India. That's the aspiration. And we have an order book and direction towards that. Specifically on this component duty reduction, we will not retain this duty reduction in our books. We want to pass it on completely to our customers. But we feel that it's going to help us in growing the volumes.
Mr. Lal, I just want to ask you one thing. I'm not sure if you saw this note. Goldman Sachs, a broker, put out a note recently, and they raised this one concern. They said that their view, the Dixon's ability to win contracts in non-mobile businesses on the IT side, etc., is not very well demonstrated. Just a very brief response. How would you like to kind of respond to that?
You see, we are the beneficiary for IT PLI too. We have already won a couple of large contracts with largest of global brands for notebooks and tablets. And the lines are being set up. We are targeting to start production in August, September. Discussions are on with a couple of other large global brands. We feel fairly confident that our order book is going to be healthy. But any business to ramp up and reach the similar kind of growth that we have shown in, let's say, a domain like mobile, it takes some time. In our other vertical, in telecom devices, wherein we have a JV with Bharti Group, again, for the broadband CP devices, we have an extremely good order book from the largest of mobile services operators. So order book, please be rest assured, is very, very healthy.
Okay. Mr. Lal, we are actually brimming with questions, but out of time. Thank you very much, and we'll take a rain check from you and ask you for more on your company and the sector on another day. Thank you very much indeed for joining us, and thank you very much, Rahul, as well. Really kind of you to give us both the macro and the micro perspectives on the market.
Thank you for having me.
Have to take a break, and thereafter we'll be joined by Nilesh Shah of Envision Capital, Tahir Badshah of Invesco Mutual Fund, and Nilesh Shah of Kotak AMC. So stay tuned, lots coming up, and of course the market opening.
At the developers' margins, all the listed companies work with single-digit PAT margins. So it's not that the margins are very high and then we are making a lot of money. It's not the fact. So there is, this is not something to do with budget, but GST is where some correction, if it happens, if we get the input credit or if something can be done on GST for affordable housing, that will be a big relief for the buyers.
Anything which helps drive the demand further up, whether it is the infrastructure projects or it also we can look at any other, the road infrastructure that should continue. We should also be getting a lot of other economic activity because finally for us, if the freight movement that we measure in billion ton kilometers, if that is going to be steady, that is going to be strong. And that has a direct correlation with the GDP growth.
I think the ask from budget is to keep that focus on boosting public and private investment because that's the only way you can have that strong compound annual GDP growth rate of 6.5 that we are expecting.
The most important thing to watch from my perspective is the case of the missing FDI. The narrative in a lot of the popular press has been India as a prime beneficiary of supply chain relocation. Then critically, the core support for the Indian economy has really been government-driven capex. The central government has stepped up with a very significant capex program. However, it spent most of it. And if you look at the way the budget works out, federal capex was up 16% in the first half of the fiscal year. That implies it will only be up 1% as we look at the second half of the fiscal year. You've seen a very strong step up in state level capex, but that's off a very low base.
There could be some incentives for the savings that will perhaps go a long way in terms of building up the capability of the economy. That I believe will be very positive.
But the overall environment in India is very positive. And we would like the government.
Welcome back. It's 9 o'clock in the morning, and we are, of course, racing towards the interim budget 2024. The pre-open session is going to come up on your screen. I mean, rates are still adjusting, so the very initial numbers are a little volatile. So we'll give them a minute, 2 minutes to settle down and look at them. Lots to track. Maybe if we have 30 seconds, we can put up Paytm and see what it is doing in the pre-open, because there will be a lot of interest on that one. That's the Sensex and the Nifty, 1/4%, 1/3% higher, much better than what the GIFT Nifty was indicating. But Paytm in the pre-open should also, I mean, if you can look it up and see what that is happening because of what the RBI did yesterday. There you go. It's down 20% on your screen. It's at about, what, 609 straight off the bat. Volumes are at about 57,000 shares or so expected, as we've been discussing. Nilesh Shah is Managing Director and CEO, Envision Capital. He's with us here in our studios to run us through what he's making of the day with the budget, the FOMC, and of course, this Paytm news hitting us yesterday as well. Nilesh, great to have you with us here. Thanks very much. Let's just begin with this one, Paytm. What are your thoughts in terms of what the RBI has done? It's kind of, in a way, unprecedented. How the order is, in a way, devastating for the company, right?
Oh, absolutely. I mean, this is a huge challenge, I think, for Paytm, and it looks like that it will take some time for it to basically be able to overcome this challenge. And yes, it creates a whole period of uncertainty for the company, the business, and the stock, because how long it would take for them to resolve, these challenges is anybody's guess. And it's been a series of regulatory actions. It's not like this one thing. I think probably for the last, over the last 1 year, there have been 2 or 3 such situations where they've had a similar situation. But obviously, this one is the most aggressive kind of a situation to be in. So I think it's going to take some time for them to be able to resolve it. The question is how long and in what form. One really doesn't know, but I think right now there is still a lot more pain to kind of in the stock.
Okay, Nilesh, first of all, thank you for dropping by on a very big day for us. 2 questions. We have invited you to ask you budget reactions, but 2 big stocks are going to react. Reliance. The Disney deal has been announced in the Wall Street Journal. Disney has sold Indian assets to Viacom 18 for all of $3.9 billion, a far cry from where they began. Any thoughts?
No, I think this is a huge positive. I mean, we own Reliance, so to that extent, I have a vested interest. But it's a huge positive. I think it's a massive kind of consolidation which is there, and it puts Reliance and its media business in a pole position. So to that extent, I think this is a huge and a massive and a positive development.
Okay. I just wanted to point out...
Do we have, Mangalam? Nilesh, I'm really sorry if you can wait. No. Okay, go ahead. Sorry.
No,
we just wanted to put the details of the contours of the deal, but go ahead.
Yeah, no, I just wanted to point out one thing on Paytm, right? Despite the fall that we're going to see today, there are brokerages that believe that the numbers could go much lower in terms of the stock price. Jefferies downgraded Paytm and they cut their target price to 500 rupees. And they say that the impact on the lending business is going to be huge. 20% of their business comes from the lending business, and the impact will be huge. So that is a big stock to watch on the downside. On the upside, Shree Cement is the one that you need to look at, actually. Very strong numbers coming through this time. Margins have grown to 25%. The poll was 22%, so Shree Cement is the one that's up about 3% right now.
If I may add a word on this, in Paytm, they were making money because of their wallet. The wallet gives them, you can't use the data on the app, because that's like a UPI app. That data, Reserve Bank, no one allows, Google Pay cannot touch it, nobody can touch it. So the Paytm app is still functional, but that data is not available to the company. Wallet data was available, and that was I think some 300 million customers. They had a decent number. If that data is not available, how will you lend? Yeah. So that's how the connect comes on the lending business.
Absolutely. Okay, let's get back to the other big story, right? Reports suggesting that Disney plans to sell 60% of its India business unit to Viacom 18. This deal was in the works, but now perhaps it's come through. Mangalam is here with more details on what this really means for the stocks at hand. Mangalam, over to you.
Well, indeed, if reports from Wall Street Journal are to be believed, Mickey and Mukesh Ambani will perhaps shake hands on this deal where Disney has reached a pact to sell 60% of its India unit to Viacom 18, which of course is a direct subsidiary of Network 18 itself. Disney's deal with Viacom will be announced in a month. The most important aspect of this report, however, is the valuation. It will be sub $4 billion, and it's a steep discount from what earlier reports were indicating, a little over $10 billion itself. Now, while this dip in valuation can be part attributed to the expected loss in revenue because, or write-off of revenue because of the sale of the cricket business by Disney to Zee, the other part could also be Disney's own struggling numbers. I mean, just looking at Disney Plus Hotstar's subscriber numbers up until September, the December results are still to be out. They've nearly halved from 61 million in September 2022 to nearly 37 million in September 2023 itself. Between June to September itself, they lost almost 1.2 crore subscribers. These subscriber losses were on account of 3 big factors. One, no IPL, no HBO content, and stiff competition coming in from Jio itself. So much so that Disney Plus Hotstar was compelled to stream the World Cup and Coffee with Karan, 2 of its flagship properties, for free. So all these factors coming in, the valuations have come down, and that will definitely be a big positive for Viacom 18 as well as eventually Network 18 too. Though these are Wall Street Journal reports, we're awaiting comment from Reliance, and at the same time the standard disclaimer, the fact that Network 18 and Viacom 18 are companies that eventually own the channel that you're watching. This is a deal which one must keep on their radar.
Okay, when you said, Mickey and Mukesh Ambani shaking hands, I was wondering who Mickey was for a second. I tried to look, the Disney India CEO, he's Mr. Madhavan though. But yeah, only Mangalam can say that. Thanks, Mangalam, for putting that into perspective for us. But, once again, just a follow-up from your end. I mean, this is going to be a huge, media giant in the works, right? Where once this deal goes through. From a retail investor standpoint, what is the big take?
No, I think from a retail investor's point of view, I still believe Reliance represents one of the best opportunities from all the businesses put together, be it the conventional energy business, the retail business, the new age GeoMart, as well as now the media business. And in each one of them, it's essentially a leader. So pretty much gives you an exposure to all the kind of high growth or hyper growth businesses going forward. So I still think Reliance is a fantastic buy.
Okay, now for the budget.
Rather, just one more question before we get to the budget. PB FinTech, and congratulations. You've had that in your portfolio. Yesterday we saw a very large move. We spoke with the management saying that 30% top line growth for many years to come. But you already know that. I mean, you were telling me before we came on air that they've maintained that for some time now. Market's realizing it. What's your sense on PB FinTech? Is it buyable here if one does not own it?
So Prashant, obviously the stock has kind of moved up, but I think if you basically want to kind of own a business for the next 5 or 10 years, I still think PB FinTech is attractive. It may probably from a very short-term point of view, it may not make sense, but from a 5 to 10 year perspective, I think it's a great buy. The runway of growth is massive. And the way I see it is that the way we talk about, say, a Pidilite or an Asian Paints or a Titan as a great franchise, my view is that some of these new age businesses, including a PB FinTech, 5 or 10 years later, will kind of get emerged as a consumer franchise, where the growths may not be as hyper as what they are today, but they would still be outstanding businesses. The business is growing, the business is capital efficient, it does not need any capital or cash flows to grow. And it has several adjacencies and optionalities on which it can essentially sustain, relatively higher growth for a longer period of time. So it has the making of a great business going forward. And these are the kind of businesses which will continue to have very premium valuations.
Okay. Nilesh, we're going to come back to you for the budget questions. We are being joined by two more peers of yours. Nilesh Shah, the Managing Director at Kotak Mahindra AMC, and in a bit, Tahir Badshah of Invesco also joins in. Gentlemen, good morning. Thank you very much indeed for joining us. Nilesh of Kotak, to you first. What would you want to hear in the budget and what do you not want to hear in the budget?
So thank you, Lata, for having me over here. I want this vote on account to do two things. One, push consumption at the bottom of pyramid to grow as fast as the top of the pyramid, and push private capex to grow as fast as the government capex. If these two catalysts work out with fiscal prudence, Indians will become proud of their own country, and neighbors will envy us. In this budget or vote on account, we want to hear three things. One, investment will continue. Second, growth will be inclusive. And third, path of fiscal prudence will be achieved.
Okay.
By the way, Nilesh, that's well put, like an Onida ad, huh? Owner's pride, neighbor's envy. But anyway, it's the finance minister and the entire team that you can see. You can see Sanjay Malhotra, TV Somanathan, the entire North Block bureaucracy, the army of the think tank, as well as the finance minister. I was hoping she would wear pink. I wore pink. But anyway, it's a lovely, she always comes in lovely sarees.
Did you guys notice that there is unseasonal rains as well?
Yeah.
I don't know where the rains have come from.
I was going to see that. I know there were people, our Delhi colleagues were complaining the cold is bitter. It snowed in Gulmarg, a late snow, and that's impacting. And the rain is just making it way more chillier. There's all the secrets that you want to know. You will know it, of course, in 2.5 hours.
I think that is not now. I think it's no longer a book, right? It's an electronic device, right? I mean, I think they changed it a couple of years ago. It's paperless, I think, right? The budget sort of document in the finance minister's hand as she, of course, proceeds to the parliament. But Nilesh is with us. Nilesh bhai, good morning. Prashant here. You know, one thing, we were discussing this earlier, which the government perhaps must do, because we talk about fiscal consolidation, the pace of it, etc. They've got a huge stock of wealth sitting in government companies, PSU companies, and we've seen an unprecedented wealth creation there. And the biggest wealth creation has happened with the government of India. Of course, they've got to realize it in terms of, actually monetize it. Do you think we will see that? And the best way to do it perhaps is going to be in the first year of a new government. Your thoughts?
Undoubtedly, Prashant bhai, every year, no matter where the markets are and which government is there, we have never achieved our divestment target. So I thought this time I will not speak about it. Maybe that will help in achieving divestment target. But undoubtedly, as you mentioned, we have to maintain path of fiscal prudence while spending money on infrastructure investment and creating inclusive growth. The only way that can be achieved is through better tax compliance, which is work in progress. But low-hanging fruit is asset monetization and divestment. Today, a large part of wealth creation in PSUs has happened because they have been, corrected from a management point of view, from a shareholder value creation point of view. But a small part is also attributable that in many counters, the floating stock is so limited that price discovery is not necessarily a market determined. A divestment will create supply. It will create more sustainable return from PSUs rather than volatility. And on top of it, it will help in funding budget and achieve path of fiscal prudence. So like all the years in the past, it is no-brainer that asset monetization and divestment should get priority.
All right. Okay, we just have about 30 seconds left for the market opening. An important day of trade lined up ahead as the budget unveils itself in about a couple of hours from now. Remember, a couple of things to watch out for. Very strong close on the Nifty yesterday. There was buying both from FIs and DIIs, but the US market cues overnight were on the weaker side. The Dow was down about 300 odd points. And as we know, we can't expect any rate cuts from the US Fed, at least in the March policy. That's the indication that we got.
You know, we must note that the rupee is stronger. It's costs less than 83 rupees to buy a dollar now. 82.96 is where it opened. And bond yields also a couple of basis points lower. I think that's reacting to the US yields falling, but we haven't discussed the FOMs.
50 points higher.
Yep. And the markets are open now, and they're opening about 50 points higher at this point in time. Okay, 35 points now, and the Sensex up about between 140 and 150 points. Basically 0.1% higher, and the Nifty Bank is about 0.3% higher. Nifty Bank would be encouraged by the fall in yields as well. Now, the top performers, well, it's all BPCL, Eicher Motors, Tata Motors, NTPC, M&M. So a lot of the auto companies doing well at this point in time. Auto sales perhaps expected to be very good, but I'm really waiting to see if we have a number on Paytm. Yes, it is down 20%. So circuit down on Paytm, and we haven't yet seen too much of an action on Reliance, but to be fair, that news was very much in the price. Prashant?
We've got lots of other names, right? And I'm going to look at the broader market for a quick bit. What's coming right very strong out of the gates. Suzlon is one, which is up about 4%. So, we've been talking about this entire renewables theme. IREDA is a big gainer. It's up about 4% or so. We just had the management of Dixon on the budget and on the earnings. 5% higher on Dixon. 6,300 plus is where that one is starting at. There is Godrej Consumer Products, which is up 8.5%. That's a very large move coming through. Stocks at about 1263 on GCPL right now. Shree Cements is starting 4.5% higher, 29,878. We've got Urja, which has been locked up 10% for the last 4 days. Every day it's up another 9% this morning. Shipping Corporation of India is up about 6.5%, 225 on Shipping Corporation. Large volumes, I'm only mentioning things with very large volumes. Transport Corporation of India is up about 11-12%. There is Policy Bazaar. We were just discussing this with Nilesh, 2.5% higher on Policy Bazaar. There is Data Patterns, which is up 6%. I mean, so volumes are not a problem this morning at all, with most of what I mentioned having very, very strong volumes overall. Just a few things on the downside before I go any further. Indus Tower is down 3%. There is, of course, I mean, that share sale which has been planned. We reported that 215 on Indus Tower. It'll be on your screen. There you go. So top is the number one volume traded name. Indiabulls Housing is down 11%. That's a very large move. And I think, they were doing a rights issue on very, very favorable term for investors who wanted in. And we talked about it, just under 200 rupees on Indiabulls Housing. Shriram Finance, decent move after numbers 2 days back, 2% lower. Jubilant Food reported numbers yesterday. Numbers looked okay, but the stock's down about 3%, 503, 504. And of course, I think Lata mentioned Paytm, it's still down 20, but that's a temporary freeze. And I think it'll open up in a bit from now.
Prashant, Sonia is at the video wall. So, yeah. Sonia, is there anything more that you're spotting?
Well, Prashant has covered a lot of stocks, so I'll just avoid them. But just a couple of things to watch out for. Paytm, as we've been telling you, is down almost about 20-odd%. So that really is the big focus area. Apart from that, Shree Cement is the one that I'm looking at. The earnings were above estimates and the stock is doing pretty well this morning, up almost about 5.5%. Volumes are also picking up on Shree Cement. In fact, the metals and the cement space have been doing pretty well. So JSPL is the other one. Very strong Q3. Margins at 24.3% versus a pole of 19.3%. So look at JSPL now, about 0.5% higher. Now I want to look at some of the budget-oriented stocks as well. There's L&T, there's ITC. L&T, there's an expectation that there will be a 12 to 15% growth in infra capex, so keep an eye out on that. ITC, any hike in excise duty will be negative for the company. And a couple of these result reactions as well. On Maruti, by the way, HSBC has a buy with a target price of 12,500. They say it was a stable quarter this time around for Maruti. There is some buying action that you're seeing over there. And green energy stocks is something that I'm focusing on as well. If there are any tax incentives for names like Tata Power, Adani Green, etc. Adani Green, well in the green right now, up about 1.5%. Back to you.
Okay, so clearly on the front foot on all those stocks. Thank you very much for pointing out that very helpful list, Sonia, which investors and traders should keep on their radar. Tahir Badshah, welcome to the show and thank you very much for waiting patiently. The first question really is to you on the budget itself. There are a lot of these green energy and generally infrastructure related expectations with the budget. Would you be on the front foot on any of these infrastructure or power stocks?
So, we have some positioning, of course, in some of these segments that you mentioned of the market. And I think Nilesh Bhai already alluded to the fact that, he almost stole my thunder when he summarized what are the expectations out of the budget. And I think it's very clear that, we want continuity of what is happening. And at the same time, we need to have additional levers for growth to be visible for calendar year 2024 and beyond. We've had the industrial and investment cycle lever, which has been working very well for the last 2-3 years. And it will remain to be seen as to, what is the intensity that we can maintain. This time around, I think the budgetary compulsions will probably be a little higher. Last 2 years, a little bit of looser fiscal was tolerable, given that we were passing through COVID-related conditions. I think, given the fact that we are up against, the MSCI bond inclusion and in general, we have to kind of maintain, get back to the FRBM targets. I think this time around it'll probably be a little difficult. Let's see how much comes about in this vote on account. Or we might have to probably wait for the later part of this year. So I think continuity is most important, and we need to have additional levers, particularly at the bottom end of the pyramid. So that's something which will keep the market up. Otherwise, we might have some challenges.
Under that Nilesh stole when he said that the bottom of the pyramid needs income transfers. But so Nilesh, what you're saying is if that PM Kisan Samman Nidhi or something is raised to 8,000 or 10,000, that will be good. Populist this time is not negative. It's a positive. Is that what you're saying?
Undoubtedly, yes. This is an election year. We have to remember that. Second, 70% of India even today lives at sub-Saharan Africa level. We have to upgrade them. And third, we should also focus on improving productivity of our spending. The government has done a great job through Jan Dhan Mobile and Aadhaar Trinity to plug the leakages, which has expanded the coverage and also left resources for infrastructure investment. But now we should focus towards, apart from food, healthcare and education, which can lift these people permanently from bottom of pyramid. So there should be some more focus on how we are spending money, how we are providing subsistence in a manner that they are coming up on their own. Education and skilling will be the best way to upgrade a population from bottom of pyramid towards higher level.
By the way, the stock that is taking top honors right now is Godrej Consumer. Just look at that, almost 8% higher on that stock. It's been a solid operational performance, and it's a fresh 52-week high that Godrej Consumer is sitting at.
No, actually, it's very important because all the other FMCG companies, Hindustan Unilever and all, 2% volume growth.
Hardly anything.
This guy has produced 5% volume growth. So clearly, in the peer group, stands out in terms of performance.
Absolutely. And that was the point I wanted to get across to our viewer, that despite Godrej Consumer's performance being decent this time, the rural market is under a lot of pressure, right? And 35% of FMCG sales comes from rural India. Do you think there's anything in the budget that can be announced which would not just be a sentiment positive, but would actually put more money in the hands of rural India?
So probably, some of the conventional measures like expanding the outlay on Manrega, for example, that could be a potential driver. Deepening the overall financial inclusion program and ensuring that it reaches every rural household. I think that could be a key driver, and ensuring that whatever DBTs that we have been doing for a set of accounts, if that's further expanded, I think that is something which would leave more money in the hands of the rural households. The other thing is that it's probably not directly rural, but I think the continued focus on infrastructure built up. Last year, we've seen a 30% increase in outlay for infrastructure spending. Infrastructure spending is now 3.3% of the GDP. If that's enhanced, that's going to create more employment, more jobs, more activity out there for rural households, which they can basically send back to their houses in the villages, and they be able to spend more. So I clearly believe that it's going to be a comprehensive set of measures which can potentially lift the spending power of the rural households.
Okay, Nilesh, just before you, we had some guests saying that, yes, all this is good. CapEx will be good, income transfer will be good, but everything is priced to perfection. So two-part question, do you think that we are running at, very rich valuations or adequate valuation? And secondly, where is your pocket of comfort?
So, Lata, I would agree that we're trading at very rich valuations. Yes, we're trading at premium to essentially the historical averages. We are trading at a premium, but so is the growth. This growth is quite phenomenal, the kind of growth that we're seeing, not just at the GDP level, the real GDP or the nominal GDP, but earnings growth is quite phenomenal. And we're seeing all-round vibrancy. This is not just about, domestic consumption. This is not just about exports. It's not just about services. It's not just about infrastructure. It's all of them firing on all cylinders simultaneously, which is propelling growth. And as long as growth sustains, I don't think valuation should be a concern. The day growth slips, valuations will become a concern. So I think till then, I think it's best to keep riding.
Yeah, absolutely. I just want to mention a few other stocks here because it's a very active screen. I mean, the index is absolutely flat. But look at, I mentioned Jubilant Food, but Westlife is selling off. I'm not sure if that's, just sentiment kind of impact here coming through. Cyient is down it's pulling back about 3.5%, if you can have these names up. AB Capital is down 3%. Manappuram is down 2%. So, is it the NBFC, Paytm kind of broad shadow on some of these names? I'm not sure. Piramal Enterprises is down about 2.5%. Piramal, of course, reported numbers as well, and market did not like the numbers very much. MapMy India is down about 5% as well. So Amber is down about 3.5%, although Dixon, which reported numbers, is higher. So very, very extremely strong, vibrant kind of open is what we have.
We have to remember, Prashant, that we are in an ambience today in the last 12 hours of a global market that's not doing well. So there will be, I guess, that level of activity. But let me toss that to...
When is that stop? Does that?
Sometimes it does. See, overall, we get back to the global, tango. But why not the expert answer that? Nilesh of Kotak, that question to you. How much should we worry about, or how would you parse the global occurrences, the FOMC statement, yesterday on our markets?
So one, FOMC statements were in line with market expectation. Market did expect rate cuts to begin in March earlier, but there were enough indication from Fed that this cycle is not happening in March. It may happen in May or June. So Fed did not surprise the market. It is saying it will be data dependent. Typically, when Fed starts cutting rates, US markets have witnessed a correction and emerging markets have witnessed higher flows. And more importantly, as Nilesh of Envision was saying, we are priced for perfection. But as long as we deliver on that perfection, as long as we deliver on that expectations, the ride should be fine. To some extent, we are benefiting from other self-goal, Russia's invasion of Ukraine, Brazil's choice of a communist government, China's design on Taiwan, South Africa's strife. All these things are limiting choices for emerging market investors. And India continues to remain one expensive but preferred destination.
Well, higher for longer, right? But in a different context, Nilesh. In terms of valuations, valuations perhaps will stay rich. Tahir, good morning. You know, I just want to talk about the PSU space with you because you actually have a PSU fund. And my colleague Hormaz actually looked at all the PSU funds out there in the market, and we sort of parsed through your holdings. NTPC, BEL, Coal India, State Bank of India, HAL are some of the biggest holdings as a percentage of your assets in that fund. I think the fund has got some 700 crores of AUM. All large caps. I mean, do you own some of these railway stocks as well? Have you gone down the list, or this is some of the big PSU names in some of the old economy sectors? How are you looking at this space now, Tahir?
So I think, Prashant, we've got a fair bit of coverage. We've not necessarily tried to kind of, get into every possible aspect of the PSU space, but I think we've got adequate, areas which to us make sense and probably have a somewhat more longer longevity as far as the business is concerned, and competitive advantages are strong. So that's the starting point. But for us, I mean, this strategy all along, we've been running this strategy now for more than a decade and coming up to about 15 odd years. But point is that all along we've only had to kind of look at the strategy from a value standpoint. This was always supposed to be a cheap kind of strategy with dividend yield and so on and so forth. So it was positioned in that manner, and much of the time it was that. But I think this is the first flourish of growth that we are seeing. And, now obviously we are compelled to look at this strategy and look at the space and PSUs in general as a growth oriented strategy. We have to basically, we are now at a stage where, for us, evaluating public sector companies is equivalent to evaluating any other private sector enterprise as well, with the same kind of lens. We have to look at the growth characteristics going forward because valuations are no longer, affordable, so to speak. So I think that is the change that has happened in this portfolio. We don't have a choice but to look at it from a growth orientation point of view. And as I said, that so long as if we can continue to see the thrust of the government in maintaining the overall capex intensity, continuity of the investment cycle, I think these areas can still do well. There is some area like PSU banks, etc., which probably might provide some value. And then there are always certain pockets and individual stocks which might appeal. But by and large, I think we don't have a choice but to now look at it from a growth standpoint versus a value standpoint earlier.
Okay, thanks a lot, gentlemen, for joining us. Tahir, Nilesh, thank you for being with us. Of course, we'll speak to you through the course of the day once the budget comes out and we need more analysis. But in the meantime, just watch out for infra, capex, power companies, all doing pretty well this morning, whether it's IRB Infra, PTC India, Suzlon Energy, Genus Power, that whole lot, IRDA as well, all well in the green. So maybe there's some expectations from this budget. But let's talk about Cummins as well. The numbers came out and, they were, the company hopes to see a double-digit growth by the end of FY24. The margins were a beat. The revenues, though, were impacted a tad bit because of weaker export sales. But today, we're, of course, going to talk about larger issues, which is the upcoming budget and what they can expect this time around. So we have the management joining on. Ashwath Ram, who's the managing director at Cummins, is with us. Mr. Ram, thanks a lot for joining in. This is expected to be an infra-led, capex-driven budget. If not now, then once the government, whichever government comes back to power. So from your industry and company standpoint, what are the key expectations? What would you need in order to boost your revenue growth?
Yeah, that's certainly correct that over the last 3 or 4 years, our company has been quite successful because of the continued spend in infrastructure. So as India aspires to become a 3 trillion and then a 5 trillion kind of economy, this cannot happen without a significant amount of expenditure in the building of roads, in the building of rail, metro. The entire power grid needs to be modernized, investments in new energy. So all of those kinds of areas are areas where companies like Cummins also stand to benefit. So we would like the government to continue this spend on infrastructure. Certainly the private capex is now slowly starting to creep up, and that is also going to help in the next few years. But the main investment that needs to continue without any slowdown is the investment in infrastructure. And we have seen that when countries like China or South Korea or even Thailand and Malaysia, when they did their spend on infrastructure, they didn't do it for 3 or 5 years. They continued it for a couple of decades. And that enabled them to set up a base for their economy to then keep building on. And that is what is required from the government to continue this growth in our GDP that we have seen for the last few years.
Extremely well argued, Mr. Ashwath Ram, that the capex thrust is not a matter of years but decades. Specifically in the budget, is there something other than the capex number that you will watch out for? We just saw the government announce the reduction of duties on mobile components. In terms of tariffs, excise, any other policy measures, any expectations?
Certainly, we have an expectation that the FAME scheme, which is the incentive provided to launch products with new energy, things like electrification of buses, use of hydrogen fuel cells, etc., in mobility. I think the maturity of those products is going to take almost a decade or so. Until then, the government needs to continue to incentivize some of those products so that investments are made in the country. The infrastructure for producing some of those components, etc., are created in the country. So we are looking forward to FAME 3, and we look for hydrogen internal combustion engines as well as fuel cells in a larger proportion to be added in those schemes. Linked with that, we feel there needs to be some kind of GST subsidy for tighter emissions on fossil fuels, which means that India plans to become a zero carbon nation by 2070. Countries like the United States are going to be zero carbon by 2050. So but that is still 26 years away. So for 26 years, it's not that overnight one can switch to EVs or to hydrogen. There is a transition, and there needs to be incentives to help those companies which are making the air cleaner or reducing the pollutants in the system. I think it's a curve which the government needs to support. It's been doing that by accelerating the pace of BS6 and CPCB 4+, etc. It needs to continue on that path.
Yeah, I take your point entirely. They've already been giving green power a lot of encouragement, and actually we're doing reasonably well in renewable power across targets. But your point is taken that let us use GST and all these tax incentives to encourage. Just final question, very interesting, you whetted my appetite when you said that private capex also has begun. Where are you noticing it?
See, what we are seeing is utilization seems to have gone up. So which means all throughout COVID, where utilization dropped to something like 25, 30, 40%, we are seeing factories getting utilized at greater than 70% as of now. And so as you launch new products or you start investing in newer technologies or newer items that you bring to the market, the investments to support those areas have started to slowly start creeping up. So I would say industry is starting to invest in newer equipment and better equipment to produce the modern goods. But I think it still needs the government to continue its thrust to change the scale of the economy before we see significant more capex from the private side start to come in.
All right,
Fair
we'll leave it
point.
at that. Thanks a lot for joining us and appreciate your thoughts here on CNBC TV 18. Let's do one thing. Let's cut across to Shireen Bhan, who's in conversation with the former CA, KV Subramanian. Shireen, over to you.
Well, guys, good morning and thanks so much for joining us here on Budget 2024. Finance Minister Nirmala Sitharaman is going to be ready to present her 6th consecutive budget, creating history in a way. And, you know, we brought in Tarun Bajaj, the former Revenue Secretary, as our budget editor here last year. And it is my pleasure to have with us KV Subramanian, the former Chief Economic Advisor, joining us as budget editor today. You would have been in Parliament with the Finance Minister 2 years ago. Today, you're sitting here with us in the CNBC TV 18 studio. So thank you very much. Look, let's understand the context of this interim budget. It is the last budget of this term of the Modi government ahead of the general elections. We go into this budget with a feel-good factor. So the finance minister is going to be mindful of not wanting to change that mood. If you look at the review that the government has put out, it goes into the interim budget from a position of confidence, both as far as growth is concerned, as well on the fisc. So on balance, do you expect this budget to directionally signal what the government may or may not do if it were to be voted back to power, or do you think that there may be some new announcements this time around?
I think it'll be both. I think our viewers have to understand that this is a vote on account, and therefore what the government is really doing is essentially getting an approval from Parliament for spending for a few months till the actual budget.
But 2019 was a vote on account. Piyush Goyal delivered PM Kisan.
Yes. So my contention, and because I was at that time part of the government, I can tell you the two measures, PM Kisan was there and there was actually a increase in the standard deduction. But as we discussed a couple of days back, PM Kisan to me was a very good move from an economic perspective. At that time I had mentioned that you know, because if you take a farmer who, let's say, earns about 20,000 rupees a month, for that farmer, the 2,000 rupees a month is 10% of his income. That's a significant amount. And importantly, that amount for sure will come to him or her, right? And that takes care of some of the left-tail risk and which will bring in investment. This paper by Pulak Ghosh and a PhD student from University of Chicago, Booth School of Business, have actually shown that that has indeed happened. So in some sense, it was a very good move from an economic perspective. Yes, it may have actually helped them garner votes, but I think that's beside the point.
So a higher allocation, given the consideration?
Yes. I would say that if we take into account the average inflation that has prevailed, about 5.5% over the last 5 years. So if we account for that in real terms, I think an increase of about 30% would be justified to keep the real amount the same. So anywhere about 8,000 rupees, 7,800 to 8,000 actually would be, you know, in real terms would remain the same. And I think anything more than that would mean that they're actually giving more to take care of some of the left tail risk. And just to finish the thought, I think the other part you mentioned, which is the vision, I think that is something which, you know, one is likely to see. The Honorable Prime Minister has talked about Amrit Kal, the fact that the coming 25 years, I think, is a very important phase for India. I'm in the process of writing a book, India at 100, where actually, you know, I resonate with those thoughts. And therefore, I think a vision for how India is positioned now and how it will look to grow forward, I think would be something that will be very, very well justified.
You know, I don't know if our viewers can see this, but KV Subramanian's got notes lined up on our budget table here. And of course, he's got his laptop as well, and he's been going over the numbers. You know, as far as CapEx is concerned, and this has really been the big one as far as the government is concerned, in this interim budget, do you really expect a big number? Because that, I would imagine, would be left for July.
Yeah, just to respond to, you know, you would remember, actually, I like responding with data. And you know, a lot of numbers, I think sometimes actually memory fails me, and so it's just useful to have them with me. So I think that point is well taken, that, you know, in a full budget, the capital expenditure amount, actually specifying it makes sense. But in a vote on account, it's possible that that number may actually maybe the Honorable Finance Minister may decide not to talk about it, which may be the right thing to do because, capital expenditure, you need the outlay for the entire year. And therefore, the actual number that we may want to, note carefully would be when the full budget is presented.
That's right.
But I think a vision, and my humble submission, would be that the push on capital expenditure that we've done post-COVID is something that should be continued. And I'm a firm believer that many of those commentators...
But the 30-35% kind of increase that we've seen, or do you believe that it will be tapered down?
The way I look at it, actually, rather than looking at the, the number from a supply side perspective, 30-35%, I would rather look at it from the demand side perspective. If we look at our infrastructure, if we have to indeed become an advanced economy like the Honorable Prime Minister has envisioned, then our infrastructure has to be of the level of advanced economies. And that is basically the way I look at it from the demand side. And from my perspective, when we look at the fiscal math, I think the two most important numbers are we generating enough growth by investing that capital expenditure to make sure that the R-G differential is sufficiently negative to offset any primary deficit there will be. Those are the two numbers. If that is, I would not go by 30-35%. I would just go from the demand perspective. What we need to build in infrastructure, we should go ahead and provision for that.
And I'm speculating here, but what I heard from the Prime Minister, what we heard from the President in her speech, my gut tells me we're going to see a focus on women as far as this budget is concerned. Do you concur?
I think I would. In fact, the Honorable Prime Minister, as is his wont, he actually coined this acronym GYAN, right? Where G for Garib, Y for youth, and then A for the farmer, the Annadata, and N for Nari. So I think, of the 4 pillars, N is for Nari. So I'm sure, there'll be something for women, definitely. One aspect that I would definitely want to highlight, and the CA's report has clearly brought this to attention, the female labor force participation ratio has increased significantly, especially in the rural areas, and this is over a 5-year span from about 26% to 41%. And that is something which is not just because of, women sort of joining their, let's say, the spouses at work. It is because their time is now getting saved. Now they are not having to spend as much time, cooking because the LPG connections that have been given. They don't have to spend as much time maybe walking miles to get water. Right? All that has made them more productive, and therefore their household activities are taking less time, which is basically saving them time to be productive, at work as well. So I think that's a very good sign to supplement that and just to push that further. I think, a focus on women would be absolutely welcome.
PM Garib Kalyan has already been extended. It's happened outside of the budget. Even as far as the Ujjwala scheme is concerned, there has been tweaks and more sweeteners provided. Do you believe that there could be something more on some of these existing social sector welfare schemes?
I reckon there may be, some additional provision for the PM Awas Yojana, because again, that ties in with the theme that I mentioned about capital expenditure. While of course infrastructure creation creates these big, huge assets for the nation, but PM Awas Yojana creates assets at the household level.
And more on the rural side, you think that's going to be the emphasis?
on the rural side. And, from a household's perspective, I remember, in 2000 when we had bought a house, my parents were so happy because for the first time we had a house to call our own. And therefore I can relate to actually people who want to have their own house. I think outlays increase in PM Awas Yojana would be something that I might expect.
Okay. Crunch time. What is the sense that in Parliament, when you were part of the Finance Minister's team, what's the last minute prep ahead of the budget speech?
Well, so I must actually remind, the first couple of times, the first time especially when I was part of, that cavalcade goes from the President's, Rashtrapati Bhavan to Parliament. I was like a kid in a candy store, enjoying that moment. And being able to see history being, sort of written is, I think, for me, each occasion, I was part of 4 budgets. I had basically goosebumps every time. And, I think it's, of course, a privilege to be able to contribute to the nation. I just want to wish absolute good luck to ma'am for the budget.
6th budget, will Nirmala Sitharaman deliver a 6er? And what is it that you would be watching out for in terms of key numbers?
Well, as a cricket fan, I actually would like to see a 6 there. A 6 time, chakka maro.
So the numbers that you're going to be watching out for, fiscal deficit?
So yes, I think, three numbers as we had discussed a couple of days back. I think the real growth number, my sense is 7%. I think for the budget projections, the nominal growth number matters far more because that's how the tax projection is done, tax revenue and the non-tax, non-tax revenue as well. So GDP deflator, I would expect it to be about 4%. The time where there was basically a lot of sort of movement in the WPI inflation, 2 years back it was going up very high and then negative last year. Some of that I think is behind us. So we can expect the deflator to be at the median of the 2 to 6% band at 4%, which would translate into nominal growth of about 11.3%. If we take a tax buoyancy, and I'm actually being very conservative here in the tax buoyancy that I'm assuming, and for the benefit of viewers, tax buoyancy, basically remove the jargon, it is just, if there's a 1% increase in GDP growth, what is the percentage increase in tax revenue? That's what tax buoyancy is. So if it is 1.2, then a 1% increase in GDP growth will translate into 1.2% increase in tax revenues. So if you multiply 11.3% by 1.2, you get about 13.5% as the... Now, the reason I'm saying this is conservative is if you look at the last 10 years, and I've actually looked at the data, the average tax buoyancy ratio has been about median and mean has been about 1.5 to 1.6.
Okay.
So 1.2 is very conservative compared to that. So a 13.5% increase in revenue, that's the number I would be watching. The third number, which then implicitly leads to the fiscal deficit, is the change in the expenditure. And my sense is if the expenditure increases by about 8% or thereabouts, with a 13.5% increase in revenue, I think they'll be able to get a fiscal deficit of 5.2%, which will then be sort of, a commitment to the fiscal consolidation path leading up to 4.5% for FY26.
Yeah, and as far as disinvestment, privatization, I don't imagine that this is going to be the budget that we hear anything more on that front.
Yes. This is one area where I think more needs to be done. Even when I was in the government, I used to sometimes actually mention this and bring this to the attention that even in my conversations with the secretary, I think we need to do more for sure. As you would recall, I'd written a chapter on privatization. So I am because that leads to a lot of productivity improvements. I'm all for it. But this is not the year that they will talk about it. I would expect
this is certainly not the budget that they will
talk about. It's not the budget,
about.
exactly. I think thanks for the correction. Yeah. Quite likely they'll talk about it in July, or end June or July when the budget for the new government comes in.
Okay, that is our budget editor KV Subramaniam with us at our budget headquarters in the capital. Of course, we are counting down to Finance Minister Nirmala Sitharaman's 6th budget. Markets are trading, and let me toss it back to you guys in the studio, and we'll join you again in a short while from now. Lata.
Thanks a lot for that, Shireen. Okay, we have another economist joining us now, Samiran Chakrabarti, the chief economist at Citibank. Also, Neeraj Gambhir of Axis Bank will be with us to tell us how the bond markets, what they're expecting and how things will go from here. But first to you, Samiran, how important is the fiscal deficit number? You're yourself going with 5.5. The market, the bond market today is pretty cheerful, 7.13 actually on the 10-year, decent rally in bond markets. Do you think 5.5 will ruffle feathers?
Well, I mean, this is only an interim budget, and we'll know about the final numbers in a few months' time. And this is also a very peculiar year when, because of the global bond index inclusion-related inflows, I think the market should focus less on the gross borrowing number this year, which is derived out of this fiscal deficit number. The only signal that people would try to get is whether that path towards the 4.5% by FY26, there is any risk to that path. As long as it is more or less assured that that path will be sacrosanct, I doubt that whether the number is 5.5 or a little higher, lower, it would make a big difference. We have kept this number slightly higher, thinking that being a pre-election year, there is a possibility of a small amount of additional expenditure. if that does not happen, then we could see a lower number as well.
Okay. In terms of the disinvestment target, what are you going at? It seems like the government is set to miss its target for FY24 as well, but you put the numbers in front of us. What is the expectation this time around?
So our suspicion is that they will start off just like every other budget, start off with expectation that they will do something on divestment side. So maybe about 50,000 crores kind of a divestment target could be there in the budget. The interesting thing is that because we expect that the RBI dividend could be much larger this year, there is a bit of a buffer room that the government can have. Even if the divestment numbers fall short, that can be made up by RBI dividend. Just like in FY24, the shortfall in divestment has been made up by higher dividend from PSUs.
You know, bulk of, Samir, hi, morning, Prashant here, bulk of the sort of consolidation, whatever has happened not by reducing expenditure, but because revenue growth has been so strong. Do you think that can continue to be the case as we look into the next year? Or should we assume aggressive revenue growth targets?
So this is where analysts have been caught on the wrong foot. I would say the tax buoyancy has been significantly ahead of what the historical trends has been. And that's why we are finding that the tax to GDP ratio is almost approaching its historic highs. Definitely, it's at a post-global financial crisis high right now. Our sense is that in the budget document, the government will not be so aggressive with the tax buoyancy assumption. We are working with something like a 1.1 on the tax buoyancy, but historically we have worked with a 1. So we have also taken it higher by a small amount. But it would be a surprise if the tax buoyancy is taken to be even higher than a 1.1. In that case, the fiscal deficit targets could come down even more.
You know, we've got the April-December tax numbers yesterday. Samiran, income tax has grown by 28% April-December. And corporate tax by 18% April-December. The overall tax is going down to 14% only because of indirect taxes. So why not a higher buoyancy?
So yeah, I mean, there is the thing is that there's no real good study on exactly what is causing this buoyancy to be higher. If it is about tax compliance, then we have to be mindful that the benefits of tax compliance is not infinite. Okay. In fact, one of the arguments is that because this year's tax revenue growth has been so high, it creates an unfavorable base effect for next year's tax revenue growth. So we have to be mindful of that as well.
Okay, yeah, that's a fair point. It does look like GST has helped get even more direct taxes. But that's visuals coming in of the finance minister entering parliament. She just posed for the media cameras and now entering parliament. The first pictures we had was of her entering North Block, and now the cavalcade has reached the parliament. And we should be, of course, we are only about 65 minutes away.
Yeah, we're only 65 minutes away. And, you know, I always wonder why the Bahikhata is red in color, right? I mean, a lot of people wonder about that. So it's largely because of good luck. Oh, so, yeah, according to a tradition, that if you wrap anything in red, then it's luck and prosperity.
It's an auspicious color. It's a bridal color in India. Though, of course, it's not a positive color abroad. It's definitely an auspicious color. Samiran, thank you very much for joining us and prepping us to tell us which are the exact numbers we should watch out for. Of course, fiscal deficit, tax buoyancy, and the nominal GDP as well. Thank you very much, and we'll touch base with you after the numbers. Yeah. Neeraj Gambhir, the Group Executive at Axis Bank, is also with us. Neeraj, before I come to the budget, just parse the global environment for us. The chairman has said something, the Fed chairman, that he's pushing out the rate cut further down, quite emphatically, so it's not in March, but the yields have reacted lower. All told, what's the take for India?
So clearly, I think we are done with the rate hiking cycle at US. I think that's the affirmation that Chair Powell has made. And they're looking at the opportunity to start rates, but they don't seem to be in any rush to do that. And hence, the pushing out of the expectations of rate cut from March down the line to maybe May or June. I think May would be a live sort of committee for that. I think one of the things that has happened in the recent past is the fact that US yields have actually inched down quite significantly from a high of about 5% to now down to about 4% or a little lower than that. And that has resulted in a significant amount of financial easing. And my view is that one of the reasons why they have kind of tried to push down the expectations to May or June is that they did not want to trigger a further round of financial easing in the markets because there is still concerns about whether this level of inflation is sustainable. And he mentioned that whether we will settle down at this or a higher level of inflation. So I think inflation is pretty much at the center stage at this point in time, and they will look to see at least 3 or 4 data points before they get fully comfortable about starting to cut the rates. But the next step is a rate cut is something which is kind of sort of affirmed in this policy.
Okay.
And that's what the long end of the market seems to be reacting to. The long bond yields in US have actually gone below 4% after the policy. I think markets seem to be taking comfort from the fact that now indeed the rate cutting cycle should start sometime soon.
Yeah, fair point. And there's of course a bit of a regional bank issue over there with some results not coming into good. But Neeraj, we have you on a slightly shaky line. We'll just set that right, take a quick break and come back. Lots more questions for you on the budget and the market borrowing program. In a bit, we are also going to be joined by Mr. Sudhir Kapadia, the partner, tax and regulatory services at EY, and Sunil Badala, the deputy head of tax at KPMG. We'll be discussing tax angles with them. Stay tuned.
There is further impetus towards startups, and generative AI is becoming a very, very important technology advancement, has become a important area. So what can we do to indigenize it? Like, there's so much of opportunity in bringing it to the masses, particularly in India, where there are so many regional languages and people living in rural areas. How do you make it to their advantage is something that we should encourage in, and it will be very happy if the government could focus on that area as well.
I do think that they will have to look at the affordable housing segment in order to give more incentives for the affordable segment to get a higher income tax rebate. Because what has happened with the interest rates going up and the amount of standard deduction being the same, people are not able to get that benefit. And this is one, interest rate being higher and income tax deductions being leveled at for a long time not being increased. I think the people of India would want that standard interest deduction should be increased in order to give the benefit to that. I think that should be the first demand from the Finance Minister of India.
Impetus on defense spending and infra spending should keep going because the top 3 budget outlays for 23 was defense, rail and metro and infrastructure.
First wish list with the government is always that at least the domestic players should have a level playing field. I think we are seeing unabated imports from China. In some form, it should be contained. There are also already DGTR recommendations of the CVTs and anti-dumping. I don't know how this can be addressed in the budget.
We think 3 segments, mainly roads, airports, and what they call a new energy ecosystem, are currently worth more than what all of Adani Enterprises is valued at right now. The segment that I'm probably most positive on, I would say within 5 years, is probably airports. This is a segment I think can do $1 billion plus of EBITDA within 3 or 4 years. Close comps are trading at 20 times that, so you could see within 3 or 4 years, Adani Enterprise look to demerge that business at a value close to 20 to 25 billion.
The Budget Ballot. Vote for growth. On CNBC TV 18, India's budget headquarters.
Welcome back. We are continuing our special coverage on the union budget. Actually, the vote on account that's due anytime now. We have been speaking with Neeraj Gambhir, the group executive at Axis Bank. He heads Treasury there. Neeraj, yeah, you told us about the global environment and how we should parse it. That the direction clearly is yields are getting lower, but more importantly, on the budget itself, would a 5.5 upset the bond market if the fiscal deficit were higher? What kind of a market borrowing is the market prepared for? And what may be good, what may be bad?
So, Lata, in terms of absolute fiscal deficit number, I think we should see consolidation. Now, whether it is 5.3 or 5.5 is a matter of debate. But I think anything less than 5.5 will be a good number for the markets to sort of parse. In terms of borrowing numbers, gross number in the range of about 15.5 lakh crores and a net number of about 11.5 lakh crores is what the market seems to be sort of thinking at this point in time. So this will basically keep us at the same level as last year. And therefore, I think it basically means that from supply side, there is not likely to be any adverse shock in the next fiscal year. Again, this is a vote on account, so these are interim numbers. So there will be some tentativeness to these numbers, but if this is broadly the range, then I think market should be okay. Anything less than that in terms of borrowing program, and there is some expectation that given the fact that small savings have been doing very well, whether that could allow the government to actually look for a slightly lower borrowing number. If that materializes, then obviously it's a big positive for the bond market.
So actually, basically what you're saying is no negatives and perhaps one big likely positive if the borrowing number is lower. I mean, if it is higher, we don't mind because there is going to be big FPI buying. And if it is lower, it's bonus. So only upsides now for the bond markets likely. Is that the way to look at it?
That seems to be the case. I'm expecting that the borrowing numbers will not go up. They will either stay the same or they'll probably marginally come down.
The FX market needn't bother at all about the budget? Nothing over there for them?
Well, I think it depends upon what the policy is, and if we see a good cheer in the equity market and that results in some of the outflows that we've been seeing in the equities from FPIs, if that reverses, then obviously that's a bit positive for the FX market as well. But that remains to be seen how the market takes the budget outcome.
Anything at all that the budget can do about the tight liquidity that is bedeviling the banking system? The Reserve Bank has been giving money through repos, but clearly NBFC stocks are impacted. Everyone's impacted. Banking stocks, all of them reporting lower margins because of a high deposit cost. Can the budget impact this in any way at all?
So one of the key things that we would like to see in the budget is what is the cash balance that the government is expecting to carry forward from March to April. At the moment, the government is sitting on a fairly high cash level. I think in the month of December, it went up to as high as about 5 lakh crores. It has come down some bit because of the expenditure and some bond redemptions. But if the cash balance numbers are high, that basically means that this liquidity is unlikely to be spent going into the March. And this is, the last quarter of the year, and therefore there is a lot of focus on deposit growth and borrowings, etc. So if liquidity eases because the government is spending and hence Reserve Bank doesn't need to do as much of intervention in the short end of the market, I think that will be positive, and that could have some soothing effect on the money market rates.
All right,
that's important. Thank you very much, Neeraj Gambhir, for telling us what to train our eyes on, and have a good day yourself. So bond markets really don't have much of a downside here. There is only a possible upside if the borrowing is even less than 12 lakh crore. And of course, if the amount of cash that they have on their books is less for the current year, that will also be positive.
Absolutely. Well, Lata, all of this, right, the big buoyancy is coming from taxes. Taxes collected. It's not coming in from curtailing expenditure or anything. So that's the theme. So what can we expect as far as taxation is concerned for you and me, the salaried class, and of course for the wider community? Surabhi is standing by with the tax expectations from this interim budget. Surabhi, over to you.
Thank you very much. Well, stability, I think, is the biggest ask and the biggest expectation that we're going into this budget with. Now, the Feb budget, of course, is a vote on account wherein no major tax changes are expected. But the fact that this is a pre-election budget is raising hopes that personal income tax perhaps will see some tweaks and that the government will partially sweeten perhaps the concessional income tax regime which was also sweetened last year because they had introduced standard deduction at par with the old tax regime. So the big hope is that the standard deduction amount perhaps will be raised from 50 lakh to, who's to say, 1 lakh rupees this year, perhaps for both the old regime and the new regime. So that's the hope, or that is the big ask. The other demands for increasing deductions under popular sections like, ATC, medical insurance, ATD, home loan interest, which is section 24, the 2 lakh rupees deduction that we get. All of those are hopes and asks, but changes are really unlikely. Now, let's talk about other major direct tax expectations. Topping that list is an extension of the concessional 15% tax rate that is offered to new manufacturing units. As of now, the lower rate will be offered only to companies that set up operations by the 31st of March 2024. Industry is hoping that this timeline will be extended at least by 1 year, if not more, to power the Atmanirbhar or the Make in India push of the government. Then I'll come to 3 critical, long-standing, long-awaited tax policy moves that experts are hoping that the finance minister will address in some measure. Now, the first is the much-needed simplification in the capital gains tax regime, which currently involves, of course, a plethora of rates, as we all know, and different definitions of long-term and short-term. The holding periods vary across asset classes as well. The present regime is also not uniform with respect to the indexation benefit. Remember the big headline from last year. Some investments get that indexation benefit, while others, like debt mutual funds, no longer do. CII, in fact, has proposed a simplified capital gains regime, which will define long-term very simply as 12 months for all financial market assets, whether it's equity or fixed income assets, with a uniform 10% tax rate for long-term gains and a 15% uniform short-term rate for short-term gains. Now, the second major tax policy signal that the tax circles are really awaiting is the implementation of the global minimum 15% tax as part of the international tax framework, which is known as BEPS, base erosion profit shifting. Now, why do I say this is important? And signaling is going to be critical and vital over here. Over 40 countries have already put this global tax norm in motion, and India is expected to announce rules for its implementation here as well. This global minimum tax is likely to shore up the government's tax kitty, so the government should be quite happy to do it, but it does require amendments in our tax laws, in the Indian tax laws. Now, while a rollout will probably happen after the general elections are through and done, industry is still expecting the PM to announce the intent and the directional action plan with respect to this global minimum tax and how India plans to implement it. So maybe some announcement in this budget. Let me come to the third major tax policy issue, and that is TCS and TDS. And we had so many headlines on this last year as well, right? Now, the hike in the TCS, or the tax collected at source for overseas remittances, remember that was hiked from 5% to 20% in last year's budget, and that had made sort of lots of news. The hope is that the FM will offer a way to perhaps offset this 20% TCS that we have to pay against the TDS, which employers are anyway cutting on salary income. So that would ease a lot of the cash flow issues that the salary class is facing. Then there is the long-standing request of, reforming, rationalizing and simplifying the entire TDS regime itself by reducing the multiple rates and all the types of, payments to perhaps only 2 or 3 main categories, because right now you have, this going into several sections, almost 30 sections of the Act, and there are multiple, rates in effect. So that would streamline the TDS payment and collection process. Finally, the industry is hoping for some tax incentives, perhaps to boost some of the key focus sectors like AI and green energy, with a specific ask of granting the green hydrogen and the green ammonia industry perhaps infrastructure status. So tax and consulting professionals will perhaps be hoping that if not immediate changes, the FM will offer some clear tax cues and clues to indicate the direction of tax policy on these big matters in Budget 2024.
Oh, that's a huge list, Surabhi. Thank you very much. Let's get the expert in. You spoke about tax professionals. We have one with us. Sudhir Upadhyay, thank you very much for dropping into the studio. It's an exhaustive list that Surabhi has presented. Most likely announcement.
Most likely, I think about 75% of that we will have to wait till July, because it's very difficult to get all this in an interim budget. I think 2 very important points Surabhi made, capital gains overall and the TDS issue. Let's come to TDS. With the kind of tax buoyancy we have and the fact that 95% of the cash tax collections come from TDS and advanced taxes. Honestly, and with the fiscal deficit glide path in mind, I doubt if government will be having the boldness to reduce significantly the TDS rates, at least in the interim budget. So I think that part we should just, manage our expectations. On the capital gains, Lata, as I've said before, frankly, the debt side has been completely overhauled in the last budget. This ask from industry, which was mentioned about making it 1 year for both listed equity and debt, I think we have to be careful there. The reverse may happen. I don't think we are going to get back on the shortening of the long-term tenure for debt. The simple reason being that this has been an ask, and rightly so, from the banking system for a very long time. And we know today that we are still in the banking system struggling for deposits. So I don't see a reversal of that at all. But, in other countries, why should it be only 1 year? Long-term gains on listed should be 2 years. If real estate is 2 years, gold is 2 years. So I think the reverse can happen. It may not happen now, but it can happen later. But, I think asking for this 1 year is, I think reminding the government too often may not be a great idea.
The other thing which Surabhi began by saying, the standard deduction from 50,000 to 1 lakh.
So I think that there is a very fair. So my personal view is that government will focus on the new tax system for sure. There is a clear and the right, right disincentive to move away from or to move towards the new system. And therefore, it's a simpler way to have a proxy increase in standard deduction, in my view, rather than try and have a mission creep and bring back some deductions from the old system. Because frankly, in a developing country, everything is important. Housing is important, health is important, social security is important. So rather than pick and choose, you'll get back to the old system. So I think it's much simpler, and that one can expect.
So only in the new regime, the deduction?
Yeah, I think that would be a very strong signal to say, right, that we want to move to so come into the new regime, move on and increase it only in the new regime. It helps also that, with the whole K-shaped recovery discussion, it really helps where it really is needed, which is at the relatively lower income slabs, right? And the thing about, in an election year, can you tweak? Well, more like optics, but now you have 10% kicking in after 9 lakhs. You can consider making that 10 lakhs. We talked about tax buoyancy, which government has some leeway there.
Yes.
And that would genuinely help a certain level of, income earners, which is what the ask is. But beyond that, I doubt if anything can be done.
April to December, the income tax growth is 28%.
Right.
The nominal growth of the GDP is only 8.9.
Right.
That's the level of buoyancy.
Yeah, absolutely.
So can there be some scope for giveaways?
So therefore, I said that they will do this, but I think knowing the government's fiscal rectitude, they'll keep a lot of buffer for the main budget.
I think it's all the other sections, they end up being, better favorites, whether it's CapEx, whether it's rural. I think the salaried class has been waiting for a long, long time. But I do want to, bring in Sunil Avadala into the conversation as well. Of course, he looks at all the taxation matters at KPMG. Sunil, good morning and welcome to the conversation. So we've discussed, obviously, the personal income tax, and, that's a huge hope and expectation. But let me now come to some of the important issues on capital gains, because the fact is that while we are not getting this overall, simplification of the regime, we keep getting these tweaks. And they, at times can play havoc with not just the products that the industry is making, but with how investors are looking at our portfolios, whether it's debt funds or this or A type of insurance or B type of insurance. And we've seen that over the years. What would you expect?
So frankly, as Sudhir mentioned, that we have to be realistic. This is a vote on account, and therefore 75% or maybe more than 75% of these expectations will find place in the final budget. So if you ask me personally, I'm not expecting any big changes as far as capital gains tax regime is concerned. I think what we are really expecting right now is, Surabhi, you talked about certain exemptions or concessional rate for, let's say, manufacturing company, which is coming to an end on 31st March 2024. I think that should be extended at least by a year. Likewise, there are other, provisions. So for example, you have sovereign wealth funds, pension funds, which get exemptions for investing into infrastructure. There are, units in IFSC, which have special exemptions in the taxation regime, many of which are actually coming to an end on 31 March 2024, whether it is aircraft leasing, shipping, whether it is FPI investing from, GIFT City and so on. So I think all of those, we are expecting that, we'll get another year or so. So I think that is what is the realistic expectations. Yes, capital gains tax, regime needs some corrections, and which is what we've been asking for quite long. But honestly, I don't expect anything to happen today.
Okay. What do you expect will happen? I mean, any one major, most likely proposal?
So, as I said, all these sunset clauses will get extended. Yeah, there is one more thing. If you recall, in 2019, the government came up with faceless scheme for the income tax assessment. Now, the transfer pricing and the DRP was kept for a later date. So earlier they said it's going to be implemented by March 22, which then they extended to March 24. I'm not sure whether government is prepared to actually roll out the faceless scheme for transfer pricing assessments and the DRP. If they are not able to do so, then I think today they will have to defer it by another year or so. So I do expect some mention of that in today's vote on account.
Okay.
The other thing which I really expect is that when we are talking about individuals, there are 2-3 things, and we you did talk about complicated TDS regime.
Yeah.
One specific issue is that these days we are seeing lot of NRIs who have invested in the properties and selling to the domestic people. So let's say if I were to buy a house from an NRI, I have to actually deduct TDS at the normal rate of 20% plus surcharge, and also I have to calculate how much is the actual capital gains tax. And if I'm unable to do so, I have to ask my seller to actually go and get a lower certificate from the tax office. Now that needs to be corrected. So for example, when I'm buying from a resident in India, it's a very simple process. I just deduct TDS at 10%, at 1% of the overall proceeds, and just deposit the tax. So I think something on those lines should come even when I'm buying house from a non-resident.
Sure.
So I think.
So simplification, Sunil, got your point, simplification of the TDS regime, even if in part, if it comes through. Mr. Kapadia, come in on this. And also, I just want to, before we get into the break, also want your take on the larger, bigger issue that we don't talk about enough, which is BEPS. I mean, we're moving towards a global tax system.
That's right.
And there's been no word from the Indian government on which way we're going. Typically, the taxman should be happy, right? Because this allows India to earn more tax or collect more tax.
No, that's a very important. I wanted to come in on that as well. So there are 2 things here. See, we have to remember that coincidentally, in 2019, when India reduced the corporate tax rate for new manufacturing units, we arrived at a rate of 15% plus surcharge, which happens to be your global minimum tax threshold. So luckily for India, as far as the inbound investments are concerned, it will have very minimal impact as far as top-up taxes in the home countries are concerned. See, today multinationals are worried about top-up taxes, because if they have operating businesses in countries with a rate lower than 50, that's where they have to really worry about. So which is a great positive for India. It will not, however, lead to any increase in tax revenues.
Okay.
But India comes out as a responsible tax jurisdiction amongst those who are trying to compete at the bottom.
It's not undercutting on tax.
Right? So that's the inbound part. The point you made, Surbi, is relevant for outbound MNEs who are headquartered in India. Indian multinationals. Anecdotally, size-wise, I don't think there are so many. But yes, UAE has been a very popular jurisdiction, some others. There, India can hope to get some top-up taxes by introducing this. And India is a very responsible member of this. To your point, I think there's a lot of work going on at the back end. They have not probably broadcasting it. But I expect a policy statement for sure from the finance minister, particularly on the back of G20. In fact, there's one minutiae here that the OECD has come out with a handbook. They have recorded at the specific request of India on how the BEPS global minimum tax pillar 2 will operate guidance to policymakers. Only India's role has been acknowledged. So I think there's a huge contribution by India. But you are right, they've been very quiet about
and
it.
speaking, that's pillar 2, which deals with this global
Yes.
minimum tax. And there's also the whole issue of, taxing global companies in India, significant economic presence.
That's
and I
the
think
big one.
there's a
That's
lot of
pillar
confusion,
one.
right?
That's pillar 1. That's in fact, frankly, a more complex but a bigger reform. And that's where India would hope to get much more tax revenues. Remember, when that comes in, India will have to give up the equalization levy.
Yeah.
Right?
Oh.
And like other countries will give up their digital service tax, etc. So that's a much bigger one, more complex, but that's where certainly India would hope to get more revenues because of the inbound digital businesses operating in India.
But in the interim, you don't expect changes on digital.
On pillar 1, no, because there is the consensus is still eluding on pillar 1. Pillar 2 is certainly policy statement, yes, but pillar 2 we can expect more detailing.
Movement.
India will have to come out with legislation on that. Yeah.
If the overall take, therefore, is that these reforms, Pillar 1 and Pillar 2, will actually mean a little more money for Indian companies. Well, Sunil, comment on that. Do you think, therefore, some giveaway on income tax is good? First of all, the buoyancy is good. Secondly, it hardly ever gets indexed to inflation.
We're really hoping, Sunil, give us some hope.
No, I'm just saying there are arguments. You have the money, there is an election ahead, it's not inflation indexed at any point in time. And, when was it last revised in terms of brackets
even
itself?
the deductions, absolutely, even those
5-7 years ago. So is there, a case, do you think, that pre-election something may come?
No, I certainly think that there's a case for, let's say, increasing the standard deduction. There's a case for rationalization of some of the tax rates in those slabs. But one thing which I think, the government can easily do is that, if you remember, we have now this old regime and the new regime of taxation, right? So, frankly, for a layman, it is very confusing and very complicated, because I have to actually calculate after claiming deduction under section ATC, ATD, if I'm coming to an income of 5 lakh rupees or low, then I go under the old regime. If it is 7 lakhs without claiming the deduction, then I am under the new regime, etc. I think what government can simply do, and by the way, this is what was intended, that eventually they want to move to the new regime where up to 7 lakh rupees you don't pay any tax. But what you are actually doing is by not giving deduction under ATC, ATD, etc., you are discouraging people to invest into all these small saving schemes, etc. So my hope and expectations would be that let's move to the new regime where up to 7 lakh rupees of taxable income I don't pay any tax, but I'm also allowed to invest into PPF and all other small saving schemes, insurance. I am allowed to take Mediclaim, and therefore I'm allowed to take deductions under ATC, ATD, which will effectively mean that, up to 9 or 10 lakh rupees, I don't end up paying any tax. So I think that is something which, in my view, the government can do it today. I don't know whether they'll do it or not, but let's keep our fingers crossed.
Okay. Gentlemen, while we discuss taxation, we got markets, which are, by the way, at the day's highest point. The Nifty is up 52 points. And there is news at the bottom of the screen. This is significant for India Cements. Stock sold off 6%. We've got basically information that there have been searches which have been conducted. This is all source-based information. Enforcement Directorate, ED, has searched India Cements' offices in Chennai, where the company is headquartered. Although, we've written to the company, we're awaiting a reply, but we've seen many of these come through with regards to companies where these searches have been conducted. Stocks, of course, have taken a bit of a dive. Talking about compliance, etc., this is, we've seen many of these, right?
So, so there are two things.
But this is ED, this is not the tax department. This one particular case.
So there are two things here, and it's interesting because in absence of the economic survey, you had the economic policy document, and it specifically mentions, ease of doing business for medium and small businesses in particular. I think, and you're right, it has nothing to do with the direct tax budget, some of these, but even if you look at the GST, kind of activities on investigations, etc., certainly the feeling is that one has to be more discriminatory and discreet, rather than just have an airbrush and say, that, okay, on this issue, we'll go after every company and do phishing inquiries. But that's what is happening on the ground in some areas of controversy, for example, in GST, as also in some cases in income tax, particularly on TDS. And therefore, this oft-repeated point to make that, the design simpler. But I think the net, the maturity has to come to say, go after the wrongdoers, but don't try and paint with the same brush everyone in that sector. I think that we need to really acknowledge that.
Absolutely.
Okay, all right, gentlemen, thank you very much for being with us. Great having this discussion with you. And of course, we'll connect once the speech is over. Sunil as well as Mr. Kapadia, thanks very much for joining. And we need to take a break on that note. Up next, we will be joined by a whole host of market guests to discuss their key expectations from Interim Budget 2024. Back in a bit.
Enterprise's current market cap is just 40 billion. Beyond that, you look at new energy ecosystem, which includes solar manufacturing, wind turbine manufacturing, and then there are plans for green hydrogen ecosystem. That green hydrogen ecosystem, which actually is not in our current valuation, is something that could, within 10 years, do, call it 7 billion hours of EBITDA. Here you're getting airports, your roads, renewable energy, called old energy or fossil fuels, with what they do with mining and called commodity trading. So it's call it a diversified play on India, but with leadership that I think has proven the success of growing above market rates. I do think that has been a hindrance. I think some of that has been the lack of institutional coverage on the Adani Group. There's not many analysts out there writing research on it, which, when we first kind of stumbled upon it was a bit surprising, given I think it's the 10th largest non-financial stock in India, which is, now the most populous country in the world. So I do think that's a bit surprising in terms of feedback we got. We thought interest was very good.
The fundamentals piece has been good for 25 years. I don't think anybody watching this show needs to be reassured on HDFC Bank's fundamentals. It's been 20% loan book growth for many, many years. Over the last 6 months, over the last 6 years, take any horizon, this bank has pulled market share at a rate not seen in Indian banking. No other private sector bank, even in the current fiscal, no other private sector or public sector bank has come close to matching the rate at which HDFC Bank has pulled market share. For the last 5 years, the price to book has come off from, I think, 4.5 down to now 2 almost. This is trading at the lowest price to book it's ever traded at. And therefore, that's why in the last 6 months, we increased the position size quite sharply in HDFC Bank.
We are now counting down the last 30 minutes before Finance Minister Nirmala Sitharaman rises to present her 6th consecutive budget. You know, I have with me the gentleman here from CII and, of course, our budget editor, also the ED at IMF, KV Subramanian. It was at a CII event that the Finance Minister said, this is a vote on account. Don't expect anything spectacular. But that hasn't stopped CII from saying a long list of budget wishes to the Finance Minister, Dinesh. But if I were to ask you, if there was one big idea that you believe could come through in this budget, what would it be?
No, I think if you really look at it, it is making sure continuity. So you can't say that, you know, you want one big idea. It's intelligent, and you want to make sure that this continuous focus on the infrastructure, and at the same time, make sure the equitable growth of the government is continued.
Okay. Rajiv Memani, we just finished a long discussion on the tax wish list, from TDS to TCS to BEPS and so on and so forth. But realistically, you know, what's the expectation on the tax front as far as the interim budget is concerned?
Yeah, I mean, I would say that on the tax front, two things will be one is the continuity of the some of the sunset clauses that are there, so which is really new manufacturing companies.
So 15% concessional tax, another year extension?
I would say they should do two. That's what we have recommended from CII's standpoint, specifically as manufacturing is picking up and it takes time to take those things. The second is, given inflation and given maybe what happened in 2019, I think there is some anticipation that on the personal tax side, especially under the new tax regime, the rebate may go up. The existing rebate is about 25,000, so that may go up to 30 or 35,000, which gives relief to people at the income levels that are lower. So I would say those two areas.
FAME and extension?
Yeah, I think that FAME is definitely something that people are expecting some policy. I don't know whether they will introduce that in the budget or that will be a separate piece. I am not sure of that. But maybe allocation towards that will be something that people will watch out for. So a lot of this budget would also mean, on sticking to tax, on whether it's on the capital gain side, whether it's on withholding tax side, BEPS, I think definitely they will make some statement on that. I think the government is well prepared. I think they know the issues last year. I think they are well prepared. Capital gains, I'm not sure whether they'll introduce in the budget. Withholding tax also, given the tax buoyancy that we are experiencing, I'm not sure whether they'll introduce in this budget. I think when we do the main budget in end of July, sometime in July, I think that's something those are the things to watch out for.
So the concessional tax rate of 15%, at least a 2-year extension beyond the sunset of 2024, that's the big ask and that's the big hope. My bucket man, Vinayak Chatterjee, not here with us in person, but joining us virtually. Thanks very much, Vinayak, for being part of the CNBC TV 18 budget coverage every year. You've got your buckets lined up for us. Take us through them.
Yeah. So, Shireen, pre-budget, I have 3 buckets lined up for you. And hopefully post-budget, I may have 5. But we'll discuss that when we after the budget. Now, the 3 pre-budget announcement buckets. First is the level of allocation expected. Please remember, in FY22, the allocation increased by 30% from 5 lakh crores to 7.5 lakh crores. In FY23, it increased 35% from 7.5 lakh crores to 10 lakh crores. So this budget, FY24-25, I am expecting another 30% increase, which will take the union budget allocation from last year's 10 lakh crores to 13.5 lakh crores or 13 lakh crores. So watch the space, Shireen. And if it hits 13.5, then you got to recognize the fact that I hit the same button last year was correct. And this year, hopefully, one should hit the bullseye again. Bucket number 2, I am expecting a higher relative share increase in rail over road. That signal is very clear. And bucket number 3 is that there is, as core infrastructure sectors mature, particularly road, rail, and power, I am expecting a higher allocation this time, particularly pre-election, in the social infra sector, which is health and education. So these are my 3 buckets. Over to you.
Thanks very much, Vinayak Chatterjee. If your CapEx hits the bullseye, the allocation number that you've given us here on CNBC TV 18, it's going to make industry very happy. It's better than the CII demand. CII demand is 12 lakh crores, and you're saying that you expect the government to deliver 13.5. So it's going to make everyone very happy. And of course, we'll have to talk about your 5 buckets, but that of course is post-budget. But the one big idea, and you know, if PM Kisan was the big idea of 2019, what's the one big idea you think they might deliver this time around?
You're asking me to guess.
Yes, of course.
I think while I'm not able to point out the specific big idea, my sense is it could be in the area of women, because as we were discussing earlier, that acronym of GYAN that the Honorable Prime Minister created, where N is for Nari, I think there might be something. The big idea that I would love, you know, if either it happens now or maybe in the budget in July, would be, as it is, the labour force participation ratio, as we've seen, has increased significantly, you know, in the last 5 years. So a further push, and one of the things, if you start thinking about, and Sherin, you would know this much better than all of us here men, oftentimes women actually, you know, choose to possibly not join the workforce because they have to take care of their children or elderly parents or parents-in-law. And if we look at many of the advanced economies, the infrastructure that they have for elder care and child care is something that really encourages women to go and join the workforce. And it also it can be a double benefit, because you can have women taking care of, you know, of children and elderly, and thereby releasing other women who want to actually have these people taking.
I have to say, I think that this could perhaps, and this is my gut as well, we're speculating, but I think that this could perhaps be one of the big ideas that comes through, incentivization of the child care industry with the women focus. That perhaps could be something that we see the finance minister deliver on. You know, again, going back to directional statements, because that perhaps is what the finance minister is likely to do beyond the nitty-gritties of the next few months. A green transition fund, something that CII has proposed as well. And investment ministry is also something that CII is putting on the table. You know, do you believe directionally they might signal, the finance minister might signal some of these ideas around AI and so on and so forth as well?
Yeah, AI I think will definitely feature in some form or fashion. Green, something around how India's allocation on whether it's green hydrogen, green transition fund, also PLI schemes that are directed towards the green supply chain. I'm sure that those things will definitely find references. But I think the key thing, I would say the key highlight will be the way in which in the last 2-3 years the tax revenues have grown up. I think, and what is the because every allocation that we are talking about, a lot of it would really depend on what's the assumption that they take of the growth in tax. I mean, last year one understood that they'd underplayed the growth in tax revenue, they'd underplayed this subsidy so that there is space and there is conservativeness in the way it was built up, so that, you know, being the election year, the fiscal subsidy would go up and there's space there. If we are able to project a 12, 13%, 14% growth in tax revenues next year, then a lot of what you're saying, I think there will be enough fiscal space.
That's the number that K.V. Subramaniam has put on the table, that a 13% growth is what the government is likely to project. Gentlemen, we are still about 15 minutes away from the finance minister's speech. Vinayak, a final word from you on the big idea that you expect outside of the capex number before I let you go.
I will give you very quickly 2 big ideas. A certain tilt towards rural infrastructure to address the discussion throughout the year on low demand coming from rural India. And I agree with Rajiv that the next big idea would be a lot of mention on green energy. These are the 2 big ones.
Yes, Dinesh, please.
So employment-linked incentives so that it is linked with job growth, and I would say MSME focus.
Employment-linked incentives to promote job growth. You wanted to make a point as well.
Just want to actually add to what Dinesh was saying. If you would recall the employment incentive scheme that was announced as part of the Atmanirbhar Bharat Yojana, PM Rozgar Yojana, you know, has actually done very well. That 24%, you know, 12% employee contribution and 12% employers contribution for firms less than 1,000 employees, and for firms greater than 1,000 employees taking care of the employees contribution. I think that has helped. I was looking at the data, about 60 lakh jobs have been either created or saved. I think that is something to build on overall, because employment steps taken in that direction I think would help. Just quickly a couple of points. I think on CapEx, I just want to highlight, because oftentimes I hear a lot of commentary that in my opinion actually is too conservative fiscally, and this is something that I've actually been talking about, written about it in the COVID economic survey. I think the key point to remember is that we have to look at CapEx on the demand side perspective, infrastructure, and I think make sure we do not copy paste what we see. The 3% fiscal deficit number and the 66% debt to GDP number, that is actually from the Maastricht Treaty, which was a political union, bringing fiscal consolidation for a monetary union. So that is not something that we should just be taking and copy pasting. We should be thinking for ourselves.
You're on Vinayak's side as well.
Absolutely,
that
we need to. Yes, and bottom line is, if we have to be an advanced economy, our infrastructure has to mirror that of an advanced economy.
All right, so that's the wish list. Those are the asks that the Confederation of Indian Industry is going into the interim budget with. Will Finance Minister Nirmala Sitharaman deliver on all of this? We will, gentlemen, check back with you post the budget, but the market's holding at this point in time. Let's go back across now to our market desk to tell you what's buzzing.
Shireen, thanks very much for that, Shireen. Well, the market's holding, as you said, absolutely. We're about, 50, 55 points higher at this stage. And of course, this is into the budget, so not bad after a flat kind of a start. Although I must say, there are lots of single stock accidents, which I just want to quickly mention, right? Start with Aurobindo Pharma. If you can just have these 4 names up. Aurobindo sold off 10%. All of these news related. That's a big move on a large pharma name. There is India Cements. There was that news on Enforcement Directorate conducting searches in Chennai, 8% lower there the last I looked. Paytm, of course, from the word go this morning has been down 20, that's locked down. And there is Fusion Microfinance, which is the latest edition, which the last time I checked is down about 10% as well. As I said, we're about, 15 minutes away from the budget speech, and we'll hear from the Finance Minister. Let's welcome in our next set of panelists. We have Ashok Wadhwa, founder of Ambit, joining us here. We have Sajid Chinoy, Chief India Economist at JP Morgan, also with us. We'll be joined by Mahesh Nandurkar of Jefferies, Neelkan Mishra of Axis Bank in just a bit as well. Gentlemen, great to have all of you here. Thank you very much for your time. Ashok, we're going to start with you. First of all, it's a vote on account. And we were just talking about before we hit air, you were saying that will that speech last? How long will the speech last? You're not expecting very much, right?
No. I mean, it's a vote on account. So I think they will just do the usuals. Sunset clauses will get an extension. Hopefully not just until the budget, but a year, 2 years ahead. I don't really see many big changes happening in vote of account.
Well, Ashok, let me give the devil's argument. See, 2019 also was a vote on account, and we saw the PM Kisan Samman Nidhi announced. In 2019 also, it was very clear the BJP would win, and win even better. It's the same sentiment now. That didn't stop the government from doing income transfer announcements. So just going by historical example, precedent.
And the July budget, like in 2019, was pretty similar to the numbers they put out in the interim budget. So it was continuity in that sense. It was not wildly different. I mean, there was a very small difference.
So therefore, assuming they will treat it like a normal budget, what would you expect?
Well, if they do treat it like a normal budget, I would say there should be a very definitive plan. The taxman in me tells me that the government has done very well in terms of tax collection. 18% tax to GDP ratio is something we wouldn't have thought about 5 years ago. They've done well. They can continue to do better. But at a time when you have tax buoyancy, the banker in me tells me that you haven't done so well. Because, we haven't met any divestment target. At a time when the market is so bullish and your valuations are so rich, I would think that government should give a very definitive plan and say we will divest IDBI by a particular date, and that we have very clearly identified targets of what we will achieve during this current year. That's been the one miss every year for the last 3 years, Lata.
No, actually, there's nothing wrong with their targets. The execution has been seriously wanting.
Yeah.
Okay, let me get the economist in as well, Sajid Chinoy. member of the PMEAC and, of course, chief economist at JPM India with us. Sajid, can you make a case for a higher fiscal deficit? I know I read your report. You are stating that it should be 5.2, 5.3 because of the consolidation roadmap. But, you're doing well in terms of taxes at this point in time. Economy is doing well. And inflation is not an issue. Core inflation is actually going towards 3%. It's a good year to spend and stimulate, no? Will the 5.5 be taken very badly?
Lata, wouldn't counter-cyclical fiscal policy suggest exactly the opposite? Okay. So your emerging markets are very good to spend in the bad times, in crisis times. Where emerging markets need to improve is to be symmetrically counter-cyclical, which is in the good times to actually make space. So if you ask me, at a time where growth has picked up, at a time where, as was alluded to before, tax to GDP is picking up, right? What I'm looking closely at is this year's deficit numbers. And what you might find is gross tax collections at the center could be as high as 11.6% of GDP, which would be the highest in 13 years. And interestingly, the consolidation that we get this year from 6.4 to 5.9 was envisaged to happen through expenditure compression, but may well actually happen through tax buoyancy. So the way we think about it, all of the consolidation this year will be because gross tax to GDP is higher and non-tax revenues are higher. Expenditure to GDP is the same as last year. In fact, the quality is improved because CapEx could well be close to 3.4% of GDP, which is double of what happened 4 years ago. So for me, what all this tells me is this is the time to reduce the deficit and make fiscal space, stabilize debt and bring it down for the next big shock. I think the government is exactly right that the target for the next 2 years needs to be about 4.5% of GDP. And so you'd like to take a substantial chunk out of it. I think the question is going to be, if you have to bring the deficit down and still keep your leg on the CapEx pedal, which I think is crucial, how do you achieve that consolidation? And to the extent that the tax buoyancy that we've seen this year continues into next year, or efforts are made to make sure that happens next year, then we see less compression on revenue expenditures. I think those are the trade-offs that we need to contend with. But I do think this is the time with growth recovering, with tax buoyancy picking up, that we reduce deficits and make space for the next shock.
Mahesh Nandurkar, who's head of research at Jefferies India, is also with us. And Ashok, you were saying there's going to be a vote on account interim kind of budget. I know Mahesh differs. Mahesh thinks that this is going to be, a full-fledged budget. Mahesh, weigh in on that to begin with.
Yeah, it is technically an interim budget, but for all practical purposes, I think we should view this as a proper full-year budget, in my view. A couple of reasons for that. One is obviously we have a track record as to what happened in February 19 and what happened in the final budget in I think July 19. There was hardly any difference. I mean, if you just compare the numbers on certain assumptions and fiscal deficit and the other sort of capex growth and targets and things like that, there was hardly any like 0.1, 0.3, 0.5% difference. So we have that one precedent, to go with that. That despite being an interim budget, I think we should view this, as a full-fledged budget. Also, logically speaking, if the same party and if the same ministers are going to be assuming, the similar roles, it will be, very difficult to argue for, a very different budget in July, as compared to February. And the consensus today is that of a political continuity. So I would take this budget seriously and budget numbers quite seriously, because I think this is going to be, the budget for the full year, according to me.
All right, Mahesh taking it very seriously, but let's get in Neelkant as well. Neelkant, what is your sense, whether this will be purely a vote on account budget, or will we see a full-fledged budget?
I think that this will be more of a vote on account, and that's also, my belief is driven by public pronouncements from leaders in the government that this will be more of a vote on account. And that's, I think, as per the protocol as well.
Okay, so now that's the entire plate of menu of expectations. One expecting a full-fledged budget, the other expecting something that would be an also-ran. Sajid, assuming that they will choose to make pronouncements, what would you rather have in terms of, economic growth priorities? More income transfers, more capex? Can both be managed? Just, in terms of economic development, your priorities and expectations.
I think it's really important to continue with the capital expenditure push. I think the benefits of that are just being seen in the economy. I think the private sector will still take some time to fully rev up, and public investment multipliers are large. So I think there should be no letting up on the pedal of that. And ideally, we've already seen a very impressive effort. If capex to GDP this year prints at 3.4% of GDP, that would be a doubling over the last 4 years. Ideally, you want to see that ratio even higher. Can you go up another 20 basis points, take it to 3.6% of GDP? So I think that should be the first priority. I think on revenue expenditures, what we've seen is in the last few years, these have gradually been coming off as a share of GDP. We're still above where we were at pre-pandemic levels. So I think maybe there's some space for rationalization over there. But there again, I think we need targeted welfare support. I think given the recovery post-pandemic, targeted welfare support will be important, and I expect to see that. I think for me, the most exciting thing is on the revenue side. As I mentioned, this could be the first year where combined tax to GDP could be above 18%. So if we can ensure that that tax buoyancy continues, and while I don't expect announcements and asset sales now, I think that is the big opportunity in the July budget. I mean, if we're not selling assets, to reduce deficits and pay down debt in these market conditions at these valuations, when will we, right? So I think, and remember, consolidating your deficit by selling assets is the least contractionary way on growth. So what you want to do ideally is bring deficits down, power off debt, but not do so without hurting growth. And the best way to do that is through asset sales, though I do think that will be more safe for the July budget.
Although as someone in the morning, I think it was Arvind Sanger who said, right, don't say it, just do it. And I think that makes sense, because if you say it, I mean, market starts to assume it's coming.
To be fair to the government, I've gone through this with a lot of divestment ministry officials. They have a huge problem taking out all the non-corporate, these institutions were set up, for instance, SAIL. It was almost the entire Bokaro city was being run, or the entire Bhilai city was getting run. To just, like in VSNL, take away the land, take away all the other non-corporate items, assets, liabilities, and then, just the corporate entity has to be divested. It's becoming a huge problem for the government. So they're actually doing a lot of work, but it's not showing, because ultimately you have to sell and bring the money. That has to hit the till.
Okay, all right. Well, let's get in Sunil Singhania, founder of Abacus Asset Manager, who joins us on the show. Hi, Sunil. Good morning. Good to see you in. In a few minutes, we'll be hearing from the finance minister, and we'll have details with regard to the budget. What's top of mind on your expectation list?
So, it's very clear it's an interim budget, and going by the past, I don't think we're expecting too much. I think the reiteration of the stuff which they've been carrying on, that itself should be pretty good. We have seen over the last 6-7 years in particular, the mind frame of the government in pushing, planned expenditure, in ensuring that there is fiscal consolidation, as also, trying to kickstart the economy by, in between the budgets, propagating Make in India. I think all this is what we expect the budget speech to be all about. And it's an interim budget, so we don't expect at least major announcements, major changes.
A big income transfer, I mean, people are talking about it, an income transfer scheme, PM Kisan Samman getting increased to 8,000 or 10,000, and possibly, more schemes for affordable housing. Somebody was speaking about credit-linked subsidy coming back for affordable housing. Sunil, reactions? Do you think markets will react positively? Anything sector-wise?
There might be an announcement pertaining to all this, but I don't think they will announce the final contour.
Okay.
The interim budget, we don't expect anything major to be announced in terms of a scheme. Maybe they might make an announcement that, obviously the Prime Minister has always been vocal about, housing for all, water for all, gas cylinders for all. So all that will continue. But we don't expect any final scheme per se to be announced. Yes, we are running a good sort of a scenario in the sense that tax collections have been higher than what was envisaged. Maybe, some of the socialist measures might be introduced or increased, as you rightly said. But beyond that, nothing major.
These announcements, right, directionally, there's announcement effect because there's elections also. Sunil, but, just on that point, there was a time a few years ago when these kind of measures, the market would be very wary of, but not any longer. I think because of two reasons. One, there is acknowledgement that it is needed because of the K-shaped kind of recovery. And second, execution has been very good. So, you get the bang for the buck. Would you agree?
Also, I would agree with all the points you made, but additionally, it's not at the cost of fiscal consolidation. Earlier, this social measures used to be made without any credence to what the government balance sheet was looking like. I think now it is very clear they're balancing it well. And, markets have also changed, the economy has also changed. And I think, as you rightly said, people are realizing that we need to ensure that everyone grows. And to that extent, as long as the fiscal consolidation and the fiscal direction of going to 4.5% fiscal deficit is there, the markets are not going to take it negatively. The other thing, Prashant, is we don't have any fuel subsidy now, any note. Fertilizer subsidy has come down significantly. So it's all about just basically maybe the food subsidy. I think it's fine.
Yep, exactly. Sajid, that's the point. Would it be actually positive? I mean, if there weren't income transfers, would it be negative? And, if there were income transfers, either Kisan Samman Nidhi or some other scheme, it would be actually good, isn't it? Both as an economist and as a market watcher, because consumption has been so weak. PFCE, personal final consumption expenditure, up just 4% at a time when GDP is up 7%. So actually the absence is bad, you would say?
No, I agree. I think, we need consumption to broaden out. It's been driven by the upper end. And so having targeted welfare support, income support is important because the marginal propensity to consume is high at the bottom of the pyramid. So to the extent that this stokes demand, you then get more demand visibility, and that hopefully, along with the public investment, has private investment. So yes, you do want targeted welfare support, as I mentioned. I think the larger issue, Lata, from a 3-year perspective is, expenditure multipliers tend to be higher than tax multipliers. So if we have to consolidate our deficit, we need to do so without sharp expenditure compression, which then again puts the onus on the revenue side. If we can consolidate the deficit by higher tax to GDP, higher asset sales, that's the least contractionary impact on growth going forward.
Okay. Sunil, any pockets of value you're picking up now?
I think it's a tough market, frankly, not too much of momentum. But the good thing about India is that, we have so many listed companies in so many sectors. So banks have not performed. We continue to be optimistic on the bank despite all the so-called headwinds. But I think that is one segment where there is interest. And obviously, everything to do with the development of infrastructure in India. I think there is still a long way to go for that.
Sunil, within the banks, what's it? Private or public sector banks? The private ones clearly have been lagging.
I think the larger private banks have also languished. Yeah. And the public sector banks, obviously, the top 4-5 names, I think there is still a lot of value.
Okay. Ashok, we have barely, 60 seconds? Your last wish.
I wish they say that on dividend distribution going forward, individuals will only be taxed, like in capital gains, at 10% or 15%.
Okay.
So instead of normal tax of 39%, that is the highest bracket, just bring it down to a fixed dividend tax in the hands of individuals.
Yeah, Sunil is also going to love that because that will be extremely market friendly if they were to announce. I don't know if I should risk another question with Sunil or... okay, we have a minute more. Sunil, if you have one wish, what would you want them to say? Will it be capex, income transfer? Just last one wish.
I think continue with what they're doing. Obviously, what Ashok said would be music to the ears, but continue with what they're doing.
Okay. Sajid, best tax buoyancy number? 1.1, 1.3, what? 13% growth in taxes is fine?
So this year, we're tracking 1.4. We're getting 13% on a nominal GDP of 9, but I think the tax has been quite conservatively budgeted. I would expect 1.1 on a nominal GDP of 10.5.
Okay, so 12% tax growth.
Around 12 on a nominal GDP of 10.5.
All right. I think that's 28 seconds, 27 seconds. So I won't risk another answer because I might have to cut into you all. So Sunil, Neelkant, Mahesh, Ashok, all of you, Sajid, thank you very much for being with us. We're going to touch base with most of you after we listen to the speech. As we get into the speech, what's the state of the markets? Markets actually not doing too badly at all. We are still outperformers in the global firmament. We have just cast aside what the US has done. No rate cuts over here, except a bit on mid-caps, which anyway were overpriced. And there's a lot of green in the fixed income screen. None of you all care about it, but the bonds are soaring. 7.13 on the 10-year. It's like a 5-6 basis points lower. Yeah. That's almost a rupee higher on bonds. And the rupee as well. Strong rupee. With that, we welcome the Finance Minister's budget.
माननीय सदस्यगण, आपको बुलेटिन भाग 2 के माध्यम से पहले ही सूचित किया गया है कि माननीय वित्त मंत्री जी के बजट भाषण की प्रतियां आपको हार्ड कॉपी के रूप में उपलब्ध कराई जाएगी। अतः बजट प्रस्तुत हो जाने के पश्चात माननीय सदस्य बजट भाषण की प्रति प्रकाशन काउंटर से प्राप्त कर सकते हैं। आपको ये भी सूचित किया जाता है कि माननीय मंत्री द्वारा बजट प्रस्तुत किए जाने के पश्चात उसे मेंबर पोर्टल पर भी उपलब्ध करा दिया जाएगा। माननीय वित्त मंत्री जी,
Honorable Speaker, I present the interim budget for 24-25. The Indian economy has witnessed profound positive transformation in the last 10 years. The people of India are looking ahead to the future with hope and optimism. With the blessings of the people, when our government under the visionary and dynamic leadership of Honorable Prime Minister Shri Narendra Modi assumed office in 2014, the country was facing enormous challenges. With Sabka Saath, Sabka Vikas as its mantra, the government overcame those challenges in right earnest. Structural reforms were undertaken. Pro-people programs were formulated and implemented promptly. Conditions were created for more opportunities for employment and entrepreneurship. The economy got a new vigor. The fruits of development started reaching the people at scale. The country got a new sense of purpose and hope. Naturally, the people blessed the government with a bigger mandate. In the second term, our government, under the leadership of Honorable Prime Minister, doubled down on its responsibilities to build a prosperous country with comprehensive development of all people and all regions. Our government strengthened its mantra to Sabka Saath, Sabka Vikas, and Sabka Vishwas. Our development philosophy covered all elements of inclusivity, namely social inclusivity through coverage of all strata of the society, and geographical inclusivity through development of all regions of the country. With the whole-of-nation approach of Sabka Prayas, the country overcame the challenges of once-in-a-century pandemic, took long strides towards Atmanirbhar Bharat, committed to Panch Pran, and laid solid foundations for the Amrit Kal. As a result, our young country has high aspirations, pride in its present, and hope and confidence for a bright future. We expect that our government, based on its stupendous work, will be blessed again by the people with a resounding mandate. Inclusive development and growth. Our humane and inclusive approach to development is a marked and deliberate departure from the earlier approach of provisioning up to village level. Development programs were thus provisioned. In the last 10 years, however, have targeted each and every household and individual through housing for all, Har Ghar Jal, electricity for all, cooking gas for all, bank accounts and financial services for all in record time. The worries about food have been eliminated through free ration for 80 crore people. Minimum support prices for the produce of Annadata are periodically increased appropriately. These and the provision of basic necessities have enhanced real income in the rural areas. Their economic needs could be addressed, thus spurring growth and generating jobs. Social justice. Our government is working with an approach to development that is all-round, all-pervasive, and all-inclusive. Sarvangin, Sarvasparshi, or Sarvasamaveshi. It covers all castes and people at all levels. We are working to make India a Vikasit Bharat by 2047. For achieving that goal, we need to improve people's capability and empower them. Previously, social justice was mostly a political slogan. For our government, social justice is an effective and necessary governance model. The saturation approach of covering all eligible people is the true and comprehensive achievement of social justice. This is secularism in action, reduces corruption, and prevents nepotism, prevents Bhai Bhatijawad. There is transparency and assurance that benefits are delivered to all eligible people. The resources are distributed fairly. All, regardless of their social standing, get access to opportunities. We are addressing systemic inequalities that had plagued our society. We focus on outcomes and not on outlays, so that the social economic transformation is achieved. As our Prime Minister firmly believes, we need to focus on 4 major castes. They are Garib, Mahilaye, Yuva, and Annadata. Their needs, their aspirations, and their welfare are our highest priority. The country progresses when they progress. All 4 require and receive government support in their quest to better their lives. Their empowerment and well-being will drive the country forward. Garib Kalyan, Desh Ka Kalyan. We believe in empowering the poor. The earlier approach of tackling poverty through entitlements had resulted in very modest outcomes. When the poor became empowered partners in the development process, government's power to assist them also increases manifold. With the pursuit of Sabka Saath, in these 10 years, the government has assisted 25 crore people to get freedom from multi-dimensional poverty. Our government's efforts are now getting synergized with energy and passion of such empowered people. This is truly elevating them from poverty. Direct benefit transfer of 34 lakh crore rupees from the government using PM Jan Dhan accounts has led to savings of 2.7 lakh crores of rupees for the government. This savings has been realized through avoidance of leakages prevalent earlier. The savings have helped in providing more funds for Garib Kalyan. PM Swanidhi has provided credit assistance to 78 lakh street vendors. From that total of 78 lakh street vendors, 2.3 lakh have received credit for the 3rd time. PM Janman Yojana reaches out to the particularly vulnerable tribal groups who have remained outside the realm of development so far. PM Vishwakarma Yojana provides end-to-end support to artisans and craftspeople engaged in 18 trades. The schemes for empowerment of Divyangs and transgender persons reflect firm resolve of our government to leave no one behind. Welfare of Annadata. Farmers are our Annadata. Every year under PM Kisan Samman Yojana, direct financial assistance is provided to 11.8 crore farmers, including marginal and small farmers. Crop insurance is given to 4 crore farmers under PM Fasal Bima Yojana. These, besides several other programs, are assisting Annadata in producing food for the country and for the world. Electronic National Agricultural Market has integrated 1,361 mandis and is providing services to 1.8 crore farmers with trading volume of 3 lakh crores of rupees. The sector is poised for inclusive, balanced, higher growth and productivity. These are facilitated from farmer-centric policies, income support, coverage of risks through price and insurance support, promotion of technologies and innovations through startups. Empowering the Amrit PD, the Yuva. Our prosperity depends on adequately equipping and empowering the youth. The National Education Policy 2020 is ushering the transformational reforms. PM Schools for Rising India, PM Shri, are delivering quality teaching and nurturing holistic and well-rounded individuals. The Skill India mission has trained 1.4 crore youth, upskilled and reskilled 54 lakh youth, and established 3,000 new ITIs. A large number of institutions of higher learning, namely 7 IITs, 16 triple ITs, 7 IIMs, 15 AIMS, and 390 universities have been set up. PM Mudra Yojana has sanctioned 43 crore loans aggregating to 22.5 lakh crores of rupees for entrepreneurial aspirations of our youth. Besides that, Fund of Funds, Startup India, and Startup Credit Guarantee schemes are assisting our youth. They are also becoming Rozgar Data. The country is proud of our youth scaling new heights in sports. The highest ever medal tally in Asian Games and Asian Para Games in 2023 reflects a high confidence level. Chess prodigy and our #1 ranked player Pragyananda put up a stiff fight against the reigning world champion Magnus Carlsen in 2023. Today, India has over 80 chess grandmasters compared to little over 20 in 2010. Momentum for Nari Shakti. The empowerment of women through entrepreneurship, ease of living, and dignity for them has gained momentum in these 10 years. 30 crore Mudra Yojana loans have been given to women entrepreneurs. Female enrollment in higher education has gone up by 28% in 10 years. In STEM courses, girls and women constitute 43% of enrollment, one of the highest in the world. All these measures are getting reflected in the increasing participation of women in workforce. Making triple talaq illegal, reservation of 1/3 seats for women in the Lok Sabha and state assemblies, and giving over 70% houses under PM Awas Yojana in rural areas to women and giving over 70% houses under PM Awas Yojana in rural areas to women as sole or joint owners have enhanced their dignity. Exemplary track record of governance, development and performance. Besides delivering on high growth in terms of gross domestic product, the government is equally focused on a more comprehensive GDP, that is, governance, development and performance. Our government has provided transparent, accountable, people-centric and prompt, trust-based administration with citizen-first and minimum government, maximum governance approach. The impact of all-round development is discernible in all sectors. There is macroeconomic stability, including in the external sector. Investments are robust. The economy is doing well. People are living better and earning better, with even greater aspirations for future. Average real income of the people has increased by 50%. Inflation is moderate. People are getting empowered, equipped, and enabled to pursue their aspirations. There is effective and timely delivery of programs and of large projects. Economic management. The multi-pronged economic management over the past 10 years has complemented people-centric, inclusive development. Following are some of the major elements. 1. All forms of infrastructure, physical, digital, or social, are being built in record time. Number 2, all parts of the country are becoming active participants in economic growth. Number 3, digital public infrastructure, a new factor of production in the 21st century, is instrumental in formalization of the economy. Number 4, goods and services tax has enabled one nation, one market, one tax. Tax reforms have led to deepening and widening of tax base. Number 5, strengthening of the financial sector has helped in making savings, credit, and investments more efficient. Number 6, GIFT, IFSC, and the Unified Regulatory Authority, IFSCA, are creating a robust gateway for global capital and financial services for the economy. Number 7, proactive inflation management has helped keep inflation within the policy band. Now, the global context, Honorable Speaker, sir. Geopolitically, global affairs are becoming more complex and challenging with wars and conflicts. Globalization is being redefined with reshoring and friendshoring, disruption and fragmentation of supply chains and competition for critical minerals and technologies. A new world order is emerging after the COVID pandemic. India assumed the G20 presidency during very difficult times for the world. The global economy was going through high inflation, high interest rates, low growth, very high public debt, low trade growth, and climate changes. The pandemic has led to a crisis of food, fertilizer, fuel, and finances for the world, while India successfully navigated its way. The country showed the way forward and built consensus on solutions for those global problems. The recently announced India-Middle East-Europe economic corridor is a strategic and economic game changer for India and others. In the words of Honorable Prime Minister, the corridor, and I quote, will become the basis of world trade for hundreds of years to come, and history will remember that this corridor was initiated on Indian soil. Unquote. Vision for Vikasit Bharat. Our vision for Vikasit Bharat is that of prosperous Bharat in harmony with nature, with modern infrastructure, and providing opportunities for all citizens and all regions to reach their potential. With confidence arising from strong and exemplary track record of performance and progress, earning Sabka Vishwas, the next 5 years will be years of unprecedented development and golden moments to realize the dream of developed India by 2047. The trinity of demography, democracy, and diversity backed by Sabka Prayas has the potential to fulfill aspirations of every Indian. As Honorable Prime Minister in his Independence Day address to the nation mentioned, I quote, "There is no dearth of opportunities, as many opportunities as we want. The country is capable of creating more opportunities. Sky is the limit." Unquote. Strategy for Amrit Kal. Our government will adopt economic policies that foster and sustain growth, facilitate inclusive and sustainable development, improve productivity, create opportunities for all, help them enhance their capabilities, and contribute to generation of resources to power investments and fulfill aspirations. Guided by the principle, reform, perform, and transform, the government will take up next generation reforms and build consensus with the states and stakeholders for effective implementation. It is an important policy priority for our government to ensure timely and adequate finances, relevant technologies, and appropriate training for the micro, small, and medium enterprises, MSMEs, to grow and also compete globally. Orienting the regulatory environment to facilitate their growth will be an important element of this policy mix. Aligning with the Panchamrit goals, our government will facilitate sustaining high and more resource-efficient economic growth. This will work towards energy security in terms of availability, accessibility, and affordability. For meeting the investment needs, our government will prepare the financial sector in terms of size, capacity, skills, and regulatory framework. Aspirational Districts Program. Our government stands ready to assist the states in faster development of aspirational districts and blocks, including generation of ample economic opportunities. Development of the East. Our government will pay utmost attention to make the eastern region and its people a powerful driver of India's growth. PM Awas Yojana Gramin. Despite the challenges due to COVID, implementation of PM Awas Yojana Gramin continued, and we are close to achieving the target of 3 crore houses. 2 crore more houses will be taken up in the next 5 years to meet the requirement arising from increase in the number of families. Rooftop solarization and Muft Bijli. Through rooftop solarization, 1 crore households will be enabled to obtain up to 300 units free electricity every month. This scheme follows the resolve of Honorable Prime Minister on the historic day of consecration of Sri Ram Mandir in Ayodhya. following benefits are expected. Savings up to 15 to 18,000 rupees annually for households from free solar electricity and selling the surplus to the distribution companies. Charging of electric vehicles. Entrepreneurship opportunities for a large number of vendors for supply and installation. Employment opportunities for the youth with technical skills in manufacturing, installation, and maintenance. Housing for middle class. Our government will launch a scheme to help deserving sections of the middle class, and I quote from Honorable Prime Minister's words, living in rented houses or slums or chawls and unauthorized colonies, unquote, to buy or build their own houses. Medical colleges. Several youth are ambitious to get qualified as doctors. They aim to serve our people through improved healthcare services. Our government plans to set up more medical colleges by utilizing the existing hospital infrastructure under various departments. A committee for this purpose will be set up to examine the issues and make relevant recommendations. Cervical cancer vaccination. Our government will encourage vaccination for girls in the age group of 9 to 14 years for prevention of cervical cancer. Maternal and child health care. Various schemes for maternal and child care will be brought under one comprehensive program for synergy in implementation. Upgradation of Anganwadi centers under Saksham Anganwadi and Poshan 2.0 will be expedited for improved nutrition delivery, early childhood care, and development. The newly designed UWIN platform for managing immunization and intensified efforts of Mission Indradhanush will be rolled out expeditiously throughout the country. Ayushman Bharat. Healthcare cover under Ayushman Bharat scheme will be extended to all ASHA workers, to all Anganwadi workers and helpers. Agriculture and food processing. The efforts of value addition in agriculture sector and boosting farmers' incomes will be stepped up. Pradhan Mantri Kisan Sampada Yojana has benefited 38 lakh farmers and generated 10 lakh employment. Pradhan Mantri Formalization of Micro Food Processing Enterprises Yojana has assisted 2.4 lakh SHGs and 60,000 individuals with credit linkages. Other schemes are complementing the efforts for reducing post-harvest losses and improving productivity and incomes. For ensuring faster growth of the sector, our government will further promote private and public investment in post-harvest activities, including aggregation, modern storage, efficient supply chains, primary and secondary processing and marketing and branding. Nano DAP. After the successful adoption of nano urea, application of nano DAP on various crops will be expanded in all agroclimatic zones. Atmanirbhar Oil Seeds Abhiyan. Building on the initiative announced in 2022, a strategy will be formulated to achieve Atmanirbharta for oil seeds such as mustard, groundnut, sesame, soya bean, and sunflower. This will cover research for high-yielding varieties, widespread adoption of modern farming techniques, market linkages, procurement, value addition, and crop insurance. Dairy development. A comprehensive program for supporting dairy farmers will be formulated. Efforts are already on to control foot and mouth disease. India is the world's largest milk producer but with low productivity of milch animals. The program will be built on the success of existing schemes such as Rashtriya Gokul Mission, National Livestock Mission, and infrastructure development funds for dairy processing and animal husbandry. Matsya Sampada. It was a government which set up a separate department for fisheries, realizing the importance of assisting fishermen. This has resulted in doubling of both inland and aquaculture production. Seafood exports since 2013-14 has also doubled. Implementation of Pradhan Mantri Matsya Sampada Yojana will be stepped up to 1. Enhance aquaculture productivity from existing 3 to 5 tons per hectare. 2. Double exports to 1 lakh crore rupees, and 3. Generate 55 lakh employment opportunities in the near future. 5 integrated aqua parks will also be set up. Lakpati Didi. $83 lakh SHGs. 83 lakh SHGs with 9 crore women are transforming rural socio-economic landscape with empowerment and self-reliance. Honorable Speaker said, their success has assisted nearly 1 crore women to become Lakpati Didi already. They are an inspiration to others. Their achievements will be recognized through honoring them. Buoyed by the success, it has been decided to enhance the target for Lakpati Didi from 2 crores to 3 crores. Technological changes, new age technologies and data are changing the lives of people and businesses. They are also enabling new economic opportunities and facilitating provision of high-quality services at affordable prices for all, including those at the bottom of the pyramid. Opportunities for India at the global level are expanding. India is showing solutions through innovation and entrepreneurship of its people. Research and innovation for catalyzing growth, employment, and development. Prime Minister Lal Bahadur Shastri gave the slogan of Jai Jawan, Jai Kisan. Prime Minister Vajpayee, Atal Bihari Vajpayee ji, made that Jai Jawan, Jai Kisan, Jai Vigyan. Prime Minister Modi has furthered that to Jai Jawan, Jai Kisan, Jai Vigyan, and Jai Anusandhan, as innovation is the foundation of development. For our tech-savvy youth, this will be a golden era. A corpus of 1 lakh crore rupees will be established with 50-year interest-free loan provided. The corpus will provide long-term financing or refinancing with long tenors and low or nil. I repeat that sentence. The corpus will provide long-term financing or refinancing with long tenors and low or nil interest rates. This will encourage the private sector to scale up research and innovation significantly in sunrise domains. We need to have programs that combine the powers of our youth and technology. A new scheme will be launched for strengthening deep tech technologies for defense purposes and expediting Atmanirbharta. Infrastructure development. Building on the massive tripling of the capital expenditure outlay in the past 4 years, resulting in huge multiplier impact on economic growth and employment creation, the outlay for the next year is being increased by 11.1% to 11,111 crore rupees. This would be 3.4% of our GDP. Railways. 3 major economic railway corridor programs will be implemented. These are energy, mineral, and cement corridor. Number 2, port connectivity corridors. And number 3, high traffic density corridors. The projects have been identified under the PM Gati Shakti for enabling multimodal connectivity. They will improve logistics efficiency and reduce cost. The resultant decongestion of the high traffic corridors will also help in improving operations of passenger trains, resulting in safety and higher travel speed for passengers. Together with dedicated freight corridors, these 3 economic corridor programs will accelerate our GDP growth and reduce logistic costs. 40,000 normal rail bogies will be converted to Vande Bharat standards to enhance safety, convenience, and comfort of passengers. Aviation sector. The aviation sector has been galvanized in the past 10 years. Number of airports have doubled to 149. Rollout of air connectivity to Tier 2 and Tier 3 cities under UDAN scheme has been widespread. 517 new routes are carrying 1.3 crore passengers. Indian carriers have proactively placed orders for over 1,000 new aircrafts. Expansion of existing airports and development of new airports will continue expeditiously. Metro and Namo Bharat. We have a fast expanding middle class and rapid urbanization is taking place. Metro rail and Namo Bharat can be the catalyst for the required urban transformation. Expansion of these systems will be supported in large cities, focusing on transit-oriented development. Green energy. Towards meeting our commitment for net zero by 2070, the following measures will be taken. Viability gap funding will be provided for harnessing offshore wind energy, potential for initial capacity of 1 gigawatt. Coal gasification and liquefaction capacity of 100 metric tons will be set up by 2030. This will also help in reducing imports of natural gas, methanol, and ammonia. Phased mandatory blending of compressed biogas in compressed natural gas for transport and piped natural gas for domestic purposes will be mandated. Financial assistance will be provided for procurement of biomass aggregation machinery to support collection. Electric vehicle ecosystem. Our government will expand this and strengthen the e-vehicle ecosystem by supporting manufacturing and charging infrastructure. Greater adoption of e-buses for public transport networks will be encouraged through payment security mechanism. Biomanufacturing and biofoundry. For promoting green growth, a new scheme of biomanufacturing and biofoundry will be launched. This will provide environment-friendly alternatives such as biodegradable polymers, bioplastics, biopharmaceuticals, and bioagri inputs. This scheme will also help in transforming today's consumptive manufacturing paradigm to the one based on regenerative principles. Blue Economy 2.0. For promoting climate-resilient activities for Blue Economy 2.0, a scheme for restoration and adaptation measures and coastal aquaculture and mariculture with integrated and multi-sectoral approach will be launched. Comprehensive development of tourist centers. The success of organizing G20 meetings in 60 places presented diversity of India to global audience. Our economic strength has made the country an attractive destination for business and conference tourism. Our middle class also now aspires to travel and explore. Tourism, including spiritual tourism, has tremendous opportunities for local entrepreneurship. States will be encouraged to take up comprehensive development of iconic tourist centers, branding and marketing them at global scale. A framework for rating of the centers based on quality of facilities and services will be established. Long-term interest-free loans will be provided to states for financing such development on matching basis. To address the emerging fervor for domestic tourism, Honorable Speaker, sir, projects for port connectivity, tourism infrastructure, and amenities will be taken up on our islands, including Lakshadweep. This will help in generating employment also. Promoting investments. The FDI inflow during 2014 to 23 was $596 billion, marking a golden era. That is twice the inflow during 2005 to 14. For encouraging sustained foreign investment, we are negotiating bilateral investment treaties with our foreign partners in the spirit of First Develop India. FDI is First Develop India. Reforms in the states for Vikasit Bharat. Many growth and development enabling reforms are needed in the states for realizing the vision of Vikasit Bharat. A provision of 75,000 crore rupees as 50-year interest-free loan is proposed this year to support those milestone-linked reforms by the state governments. Societal changes. The government will form a high-powered committee for an extensive consideration of the challenges arising from fast population growth and demographic changes. The committee will be mandated to make recommendations for addressing these challenges comprehensively in relation to the goal of Vikasit Bharat. Amrit Kal as Kartavya Kal. Our government stands committed to strengthening and expanding the economy with high growth and to create conditions for people to realize their aspirations. Honorable Prime Minister, in his Independence Day address to the nation in the 75th year of our Republic, said, and I quote, "We commit ourselves to national development with new inspirations, new consciousness, new resolutions as the country opens up immense possibilities and opportunities. It is our Kartavya Kal." unquote. Every challenge of the pre-2014 era was overcome through our economic management and our governance. These have placed the country on a resolute path of sustained high growth. This has been possible through right policies, true intentions, and appropriate decisions. In the full budget in July, Honorable Speaker, our government will present a detailed roadmap for our pursuit of Vikasit Bharat. Revised estimates of 2023-24. The revised estimate of the total receipts other than borrowings is 27.56 lakh crores of rupees, of which the tax receipts are 23.24 lakh crore rupees. The revised estimate of total expenditure is 44.90 lakh crore rupees. The revenue receipts at 30.03 lakh crore rupees are expected to be higher than the budget estimate, reflecting strong growth momentum and formalization in the economy. The revised estimate of the fiscal deficit is 5.8% of GDP, improving on the budget estimate, notwithstanding moderation in the nominal growth estimates. Budget estimates for 2024-25. Coming to the year 2024-25, the total receipts other than borrowings and total expenditure are estimated at 30.80 and 47.66 lakh crore rupees respectively. The tax receipts are estimated at 26.02 lakh crore rupees. The scheme of 50-year interest-free loan for capital expenditure to states will be continued this year with an outlay of 1.3 lakh crore rupees. We continue on the path of fiscal consolidation, as announced in my budget speech of 2021-22, to reduce fiscal deficit below 4.5% by 25-26. The fiscal deficit in 2024-25 is estimated to be 5.1% of GDP, adhering to that path. So the gross and net market borrowings through dated securities during 24-25 are estimated at 14.13 lakh crore rupees and 11.75 lakh crore respectively. Both will be less than that in 23-24. Now that the private investments are happening at scale, the lower borrowings by the central government will facilitate larger availability of credit for the private sector. Vote on account. I'll be seeking vote on account approval of the Parliament through the appropriation bill for a part of the financial year 2024-25. I will now move to Part B. Honourable Speaker, sir, over the last 10 years, the direct tax collections have more than trebled and the return filers swelled 2.4 times. I would like to assure the taxpayers that their contributions have been used wisely for the development of the country and welfare of its people. I appreciate the taxpayers for their continued support. The government has reduced and rationalized tax rates. Under the new tax scheme, there is now no tax liability for taxpayers with income up to 7 lakh rupees, up from 2.2 lakh rupees in the financial year 2013-14. The threshold for presumptive taxation for retail businesses was increased from 2 crores to 3 crores. Similarly, the threshold for professionals eligible for presumptive taxation was increased from 50 lakh rupees to 75 lakh rupees. Also, corporate tax rate was decreased from 30% to 22% for existing domestic companies and to 15% for certain new manufacturing companies. Honorable Speaker, sir, in the last 5 years, our focus has been to improve taxpayer services. The age-old jurisdiction-based assessment system was transformed with the introduction of faceless assessment and appeal, thereby imparting greater efficiency, transparency, and accountability. Introduction of updated income tax returns, a new Form 26AS, and pre-filling of tax returns have made filing of tax returns simpler and easier. Average processing time of returns has been reduced from 93 days in the year 2013-14 to a mere 10 days this year, thereby making refunds faster. Indirect taxation. By unifying the highly fragmented indirect tax regime in India, the GST has reduced the compliance burden on trade and industry. The industry has acknowledged the benefits of GST. According to a recent survey conducted by a leading consulting firm, 94% of industry leaders view the transition to GST as largely positive. According to 80% of the respondents, it has led to supply chain optimization, as elimination of tax arbitrage and octroi has resulted in disbanding of checkposts at the state and city boundaries. At the same time, tax base of GST more than doubled, and the average monthly gross GST collection has almost doubled to 1.66 lakh crores this year. States too have benefited. States' SGST revenue, including compensation released to states in the post-GST period of 2017-18 to 2022-23, has achieved a buoyancy of 1.22. In contrast, the tax buoyancy of state revenues from subsumed taxes in the pre-GST four-year period of 2012-13 to 2015-16 was a mere 0.72. The biggest beneficiaries are consumers, as reduction in logistic cost and taxes have brought down prices of most goods and services. We have taken a number of steps in customs to facilitate international trade. As a result, the import release time declined by 47% to 71 hours at inland container depots, by 28% to 44 hours at air cargo complexes, and by 27% to 85 hours at seaports over the last 4 years since 2019, when the national time release studies were first started. Tax proposals. As for tax proposals, in keeping with the convention, I do not propose to make any changes relating to taxation and propose to retain the same tax rates for direct and indirect taxes, including import duties. However, certain tax benefits to startups and investments made by sovereign wealth or pension funds, as also tax exemption on certain income of some IFSC units, are expiring on 31/3/2024. To provide continuity in taxation, I propose to extend the date to 31/3/2025. Moreover, in line with the government's vision to improve ease of living and ease of doing business, I wish to make an announcement to improve taxpayer services. There are a large number of petty, non-verified, non-reconciled, or disputed direct tax demands many of them dating as far back as 1962, which continue to remain on the books, causing anxiety to honest taxpayers and hindering refunds of subsequent years. Honorable Speaker, sir, I propose to withdraw such outstanding direct tax demands up to 25,000 rupees pertaining to the period up to financial year 2009-10 and up to 10,000 rupees for financial years 2010-11 to 2014-15. This is expected to benefit about 1 crore taxpayers. 1 crore taxpayers would benefit out of this. Economy then and now. In 2014, when our government assumed the reins, the responsibility to mend the economy step by step and to put the governance systems in order was enormous. The need of the hour was to give hope to the people, to attract investments, and to build support for the much-needed reforms. The government did that successfully, following a strong belief of nation first. The crisis of those years has been overcome, and the economy has been put firmly on a high, sustainable growth path with all-round development. It is now appropriate to look at where we were then. I repeat, it is now appropriate to look at where we were then till 2014 and where we are now, only for the purpose of drawing lessons from the mismanagement of those years. The government will lay a white paper on table of the House. The exemplary track record of governance, development and performance, effective delivery and Jan Kalyan has given the government trust, confidence and blessings of the people to realize whatever it takes, the goal of Vikasit Bharat with good intentions, true dedication and hard work in the coming years and decades. With this, Honorable Speaker, I commend the interim budget to this august House. Jai Hind.
Well, it's a huge positive in terms of fiscal rectitude. Not only is the next year's fiscal deficit reduced to 5.1, I didn't get a single respondent expecting 5.1. So obviously all guns blazing in the bond market. The fiscal deficit, on fiscal rectitude, it's a AAA for the system. But I believe the finance minister is still speaking.
1 of the Fiscal Responsibility and Budget Management Act 2003, medium-term fiscal policy cum fiscal policy strategy statement and macroeconomic framework statement.
Item number 3, Srimati Nirmala Sitharaman.
Sir, with your permission, I rise to move for leave to introduce the Finance Bill 2024.
प्रश्न ये है कि विधेयक को पुनर्स्थापित करने की अनुमति प्रदान की जाए। जो सदस्य इसके पक्ष में हाँ कहें, जो सदस्य विरोध में ना कहें, मेरे विचार में।
Okay, so that's just the voice vote for the presentation of the speech and the budget. The important point really is fiscal rectitude. That's come in really good. Besides that, even the net borrowing program, our poll gave a number of 12 lakh crore net borrowing as the conservative estimate. It's now coming in at 11.5 lakh crore, 11.7 lakh crore. So that again has sent the bond markets booming. It's about 7.1 now compared to 7.18 before the speech started. So there's a fair degree of, positivity over there. And I think it will advantage even the banking stocks. I saw PSU banks booming. Obviously, they have a lot of bonds and the bond prices are going to rise. So there are mark-to-market gains to be made, which will be carried on March 31. So immediate EPS impact on these banks. The other big announcement really is that expenditure in the current year is lower. It's not markedly lower. The original number was 45 lakh crore. She's brought it down to 44.9 lakh crore. So that again is a big positive. in terms of fiscal rectitude. Largely that, but in terms of positivity for the stock markets, the capex plan at 12% higher. There were some expectations of 20% higher. I think it's about 11% higher. Even then it's higher. So over a 35% jump in capex in the current year and 11% to 12% jump in the current in the next year will be treated as positive. So we will have to keep an eye on the construction railway stocks as well. I didn't see many of them rising, but I think that will be slowly interred.
The point is the buoyancy, tax buoyancy expected to be very strong? I mean, the numbers that she gave.
No, the number is only 12%. Now, I don't know what kind of nominal GDP they've assumed, but it is only 11.9% actually growth in taxes that they're assuming. Considering that it is 14 or 15% this year, on top of that, I wouldn't consider it a very ambitious announcement.
In fact,
it's a very conservative announcement.
In fact, every year, if you see year after year for the last 3 years, the government estimates are far lower and what you actually get up is much, much higher. So I'm not surprised that she has budgeted so much lower buoyancy on taxes.
Okay. I think the market is giving up because, we were outperforming global markets. So there is a bit of giveaway in the stock markets. But really, there's nothing in the budget unless you were expecting some massive capex, rise to 12 lakh crore. She's short of that at 11.5 lakh crore in terms of the capex bill. A little short of perhaps outrageous expectations or optimistic expectations, not outrageous. Likewise, perhaps the expectations on the PM, Kisan Samman Nidhi, we were expecting that 8,000 rupee. It can still come, but it hasn't come in the budget. But there is a lot of announcement on rural houses and as well on farming, on fisheries. So maybe if you add all that, there is a lot of income transfer waiting to happen. Yeah. But at the moment, that income transfer, I wouldn't see much for FMCG stocks at this point in time, because I think they were banking on a big rural transfer.
Ashok, you were absolutely right. And our long speech, one of the shortest, right? That we've seen. Will we see more in the budget documents as and when we get them? I mean, things on divestment, etc. I mean, to that point about taxes assumed, nominal GDP assumed, will there be more detail?
Could be. For example, they announced the extension of tax exemption for sovereign wealth funds in the infrastructure sector. But given that the two pillars have been infra and manufacturing, we didn't hear the same announcement on the new manufacturing, which was also sunset in this year. So it's quite possible that the budget statement will have many more details than what we have heard. But generally, it seems to be status quo on tax matters, status quo on GST, status quo on import duties. I think the two big announcements, as you said, are really the fiscal deficit, the macros, the fiscal, the borrowings, and continuing expenditure on infrastructure, which I think is great news.
I think that PM Kisan Samman Nidhi, somehow the buzz was that from 6,000 rupee transfers, it would be increased to 8,000. That's not happened so far. It can still be an election promise, but it's not in the budget. So that could be something which the market may complain, that we expected consumption to get a pep up, and that did happen. But that's actually minor. I think the important point is there is a lot of encouragement for rural housing. I think I'll just pinpoint the number. I think it was 20 million homes. Yes, 20 million rural homes to be built in the next 5 years. Now, that's a large number. So that can be seen as positive because homes is a many-sided multiplier impact. And on that note, why don't we get the man of all, the last word on housing. KK Mistry, the former CEO of HDFC, is with us. Mr. Mistry, first thoughts on the entire budget. Extreme fiscal rectitude, way better than what the market was expecting. As well, housing. The key point for you is 20 million rural homes is the target that they have set themselves for in the next 5 years. So clearly, the Rural Awas Yojana is getting a huge pep up.
Absolutely, Lata. I think it's a fabulous budget, truly a fabulous budget. There is something in this for everyone. And I think the biggest strength, as you said, is the fact that the fiscal deficit has been kept much lower, significantly lower than what anyone expected. People were talking of 5.5 and at best 5.3, and we end up at 5.1. So I think that's great for the system. As far and there is something in this budget for everyone. For each and every individual, there is something in this budget. I don't think we could have expected changes in the tax laws, because that, to my mind, would come after the elections in the final budget. So I don't think that was expected. One can always debate on what those changes can be in future. But growth for everyone, growth in infrastructure, target on housing, as you said, 3 crore houses have got done under the rural house program. Another 2 crore houses. The target is to do another 2 crore houses. And we must remember that housing creates a huge amount of multiplier effect in the economy. So it's not just the people who are employed in the housing sector, in the construction sector. It is also a multiple of industries. Cement, steel, paint, power, and multiple other ancillary industries which are benefited when housing gets a benefit. So I think all in all, fabulous budget.
Okay, and I guess thank you very much for that, Mr. Mistry. Please stay on. The bond yields have now gone below 7.1 to 7.08, and I think as the matter seeps in, that even the gross borrowing is far less than this year. This year it was, I think, 15.7. They're reducing it next year to 14.7, when $25 billion is likely to flow. So something like 2 lakh crore of foreign funds money is going to come in because of the index inclusion. So that's a very light load on the banks. That will mean that bond yields have still space to go down. And that's very positive for the corporate sector, because after all, you price it over a spread over the sovereign. So if the sovereign yield falls, the cost of capital for corporates also falls. So I think this is actually a very pro. It's almost like a tax cut. I mean, it's almost like a rate cut. You don't get a rate cut from the Reserve Bank, but if the yield falls by 10 basis points, it's as good as a rate cut. So I would be very surprised if the banks did not
actually,
show some
for
kind
now,
of
the
positivity.
reaction is coming on bond markets. Equity markets are absolutely flat. It's actually just turned into the green. And I was wondering maybe the reaction on equities is also just interim. And it'll pick up. As Lata, you said, I mean, as the markets digest what has happened, right? And the favorable fiscal math, which should percolate through banks and, I mean, various other... And of course, Mr. Mistry said there is actually, we've only barely scratched the surface in terms of the big fiscal numbers, but there is a fair bit for... I think pretty much all sections. Madhu Khela is also with us, founder at MK Ventures. Madhu, great to have you with us here. Good afternoon. You heard the budget speech. What did you make of it? Status quo on taxation and those matters, but on the fiscal side seems to be very, very favorable.
Yeah, I think overall it's a fantastic budget. I would say that, given the election year, there was slight bit of nervousness that the government may deviate from the fiscal path, but not only they have adhered, but they have also given a clear direction for 2026 of adhering to 4.5% of the fiscal deficit. I think from a market perspective, this is the best possible outcome for this budget. Also, the next year borrowing number actually is slightly lower than the current year, which is again a very, very good news, I would say, from the market, from a market perspective. So I would say, given that it was an election year, and given that, there was all the reason to be a little bit more populist than what they have been, I think it's a very good news for the markets.
Oh, absolutely. Okay. This is actually a big signal to the market, right? And I think now the market is starting to pick up a bit. The Nifty, the Sensex have moved into the green, although by a very small amount. But the glide path to fiscal consolidation is something that will continue. And I think the street is going to take that very, very positively. Madhu, the other big signal that has come through from this budget is that it is a through and through budget that's focusing on infrastructure and housing, right? We spoke about a big boost to housing, but even the FY25 capex outlay is up about 11.1%. That's largely in line with expectations, but that's been the main focus area for the government. How are you looking at these two spaces, infra, capex, as well as the housing sector?
I think it's a clear continuation. If you look at the first part of the finance minister's speech, we don't realize how much road has got traveled, whether we talk of affordable housing, whether we talk of infrastructure, whether we talk of job creation, loans being given to smaller entrepreneurs, Mudra Yojana. So, on a year-on-year basis, it is not looking, as impactful as when it is spoken for the last 10 years. So I think there's a clear-cut continuation. And though personally I would have liked to see the capex number a little bit higher than what they have done, but considering that it is an election year and there will not be much of the movement in the first 3-4 months of the year, this number is still good. But I think fantastic continuation for housing and infrastructure of the old policy, which again, I would say is a great news from a market perspective.
Yeah, actually the total capex expenditure is 11.1 lakh crore compared to 10 lakh crore. So it's about an 11% increase in the capex bill. I'm coming to Mr. Mistry, but the man who would be most delighted with the fiscal deficit cut would be Sajid Chinoy. Sajid, you were voting towards the 5.2%. You were the most optimistic, by the way, or if I want to say most conservative. She's done better than that. Your comments?
I think the budget needs a huge congratulation. You know, the foundation of macroeconomic policy is to be counter-cyclical. And when the economy needed, we saw a big push over the last 3 years. Now growth is recovering. And it was really important for the fiscal to scale back for two reasons. One is what we're not seeing is that even as the center is consolidating this year, state deficits have widened. So the consolidated deficit is larger than is believed. And this was a year where despite strong growth, public debt to GDP actually will inch up. And that tells you the deficits had to come down for peace times. I think the government has hit exactly the right chord. We need fiscal conservatism. And what's really important is that the capital expenditure was not compromised at the altar. So we've got both a combination of capex being held steady and the deficit coming down. I'll be curious to see how much of the consolidation happens on the revenue side, where we had more buoyancy last year, how much will happen through asset sales, perhaps announced in the July budget, and how much happens through expenditure rationalization. But for now, I think this is just what the doctor ordered. And this is what, the focus now has to be macroeconomic stability, given the focus on growth the last few years.
Yeah, the tax growth is seen at 11.9%, not even 12%. Very legit,
very conservative. That's very conservative. I think there'd be upside to that. And what happened this year? Taxes were budgeted conservatively so that the entire consolidation happened on the revenue side, not on the expenditure side. So
I think it's more conservative than that, Sajid, because from what I see, and I haven't seen the actual budget table, I'm only going by the memory of the speech. She said that the total net tax receipts are 23.24. The budget estimate itself was 23.3. So looks like the revised estimate is not taken into cognizance the better performance this year as well. It looks like that, but I could be speaking too early. I'm only speaking by what I heard. If on this lower, conservatively estimated base, they are seeing a 11.9%, then the actual estimate is even more conservative. But I could be corrected. I could stand to be corrected. She has not revised the number higher, though the actual performance of the first 10 months is much higher. So I could have,
And again, we have last installment yet to come. The last installment is yet to come.
Oh yes,
and
the
that
fourth
could be
quarter
very,
is
very
yet to
robust.
come. So it could be much better. There's no doubt about that. Mr. Mistry, what do you see in the housing sector now? With overall interest rates itself, the sovereign borrowing so much cheaper, are you expecting rates to go down even without a rate cut? The effective borrowing cost coming down?
I think liquidity in the system should hopefully get better over a period of time. And as liquidity gets better, rates will certainly start coming down. But the buoyancy in the economy is so high. The feel-good factor in the economy, the feel-good factor amongst people is so very, very high that a 0.25%, 0.5% difference in interest rates is not going to make a very material difference in terms of people's willingness to go and buy a house. I think the demand is strong. We've seen 16% growth for housing loans in the system on a base which is continuously increasing 16% year after year. And in my opinion, the growth prospects in the years ahead could be upwards of 15 to 20% over the next several years.
Now, this is something both Mr. Mistry and Sajid should hear. The assumption of dividend from the RBI and public sector banks is 1.5 lakh crore. That is the revision in the FY24. I'm still FY25, they're expecting the same amount of 1.5 lakh crore from RBI and PSU banks. Now, PSU banks are going to do very well. So I think the assumption of this non-tax revenue is a very big buffer. So overall total receipts, I think, is going to do much better than tax receipts. That's my guess, but I'm still waiting for the entire table. Madhu, you have to tell us something about stocks, yaar. Looking at this, are you a buyer? You're a buyer in what sectors? Public sector banks, just for your information, if you don't have the screen in front of you, they're all jumping higher because mark-to-market gains on the bond book is very much there. Your thoughts, anything you would go out and bet on now, sector-wise? Madhu?
Yeah, I think, Lata, we continue to be very positive on the public sector banks. You have heard me many times, so I'll not repeat it again. We continue to be positive. We continue to be positive on the overall capex space, specifically the EPC companies, which are yet to be discovered by the market. But Lata, the broader theme is that, you know, what we spoke even last time, the broader theme is that it's like a sigh of relief for the overall market that government has adhered to fiscal consolidation even in a year of election. So that's, I think, the biggest message. So the party in the market continues, you know, it's a buffet out here. You choose what you want to buy.
Absolutely. I think you're underlining an important point. Why would a government not go and be, you know, a spend-on budget? Because they're pretty confident politically. So that is also perhaps a message. Yes, Mr. Kanaba.
One thing which I didn't hear was anything on disinvestment, because given how the PSU shares have moved up, really I was hoping there'd be some announcement to say this is what we are wanting now to do on disinvestment because the prices
I
will go
am
down.
sure it is there in the table. I'm sure it'll be there in the table, but she's decided to keep it a short speech. So she hasn't told us, but it's quite possible that there is going to be a better divestment number. But let me get more guests in. Ramdev Agarwal, chairman and founder, co-founder of Motilal Oswal Financial Services with us. Ramdev, first thoughts. What do you make of the budget?
Yeah, so I think the fiscal deficit coming at about 5.1 is a kind of a way beyond anybody's expectation. Absolutely. And that has its implications in the government borrowing, government expenditure growth. And so I think one has to see the details, but clearly it is positive for the bond markets. The rush for the bonds will be less, and hence the yield will fall, which market immediately signaled that. And in any case, we are talking about globally interest rate drop kind of a situation on a 12-month basis. So maybe it is good for the equity markets as we go forward on a lower interest rate scenario.
Ramdev, hi, good afternoon. For banks and financial services, where people have made such big bets, so far has not really worked out. What does this mean? I mean, we were discussing this earlier, and you also briefly mentioned it. Cost of funding, cost of money perhaps reduces without actually seeing a rate cut.
Yeah, so let's see. I mean, right now, there's a lot of dichotomy in the sense that credit growth is 15-17%, your M3 growth is only 9%. So there is a lot of liquidity squeeze, and I'm sure the RBI is keeping it for keeping the inflation under control. Maybe you ask all the economists who are coming there why there is a gap and how does it get resolved. Good thing is that economy is speeding past at the rate of 7.5%, and that is a I mean, government has got that growth rate. So I don't think they want to put further fuel. Last year before, economy was coming out of COVID and all, so they really upfronted the capital expenditure. Now, since the economy has got its pace, I think they want to take a breather, and they want to allow the private sector to take up the things. But we'll see how exactly the interest rate scenario shapes up, and how strongly the private sector responds in a given situation.
All right, well, markets are absolutely flat right now. So let's get you some more opinion coming through. Let's cut across to Shireen, who is joined by NK Singh and the former CEA, KV Subramanian. Shireen, over to you.
Well, guys, it really has taken Nirmala Sitharaman to show the country what an interim budget looks like, at least in terms of the duration of this speech, 57 minutes, and we're done. No one was expecting it. Joining me here, of course, are the two budget editors, veteran of many budgets, NK Singh, the chairperson of the 15th Finance Commission. Also with us, of course, KV Subramanian, former chief economic advisor and ED at the IMF. Mr. Singh, straight to you. Fiscal consolidation. Everyone was talking about 5.5, 5.4, 5.1. That's the number that Nirmala Sitharaman has delivered.
Quite extraordinary, isn't it, Shireen? Because considering that I was also the chairman of the Fiscal Responsibility Management Act, from the fiscal perspective, 0.7% expected consolidation, considering what GDP, 1 percentage point of GDP looks like, in absolute terms is a fairly daunting target. It's a clear signal on the government's continued commitment to a path of macroeconomic stability,
fiscal consolidation, and I have no doubt that the debt numbers would also show this kind of a fiscal resolve and look in a southward direction, which is very important by way of signals to investors and to rating agencies on India's continued adherence, even in an election year, to a continued belief in the path of fiscal consolidation.
And I think that context is important because, Mr. Subramaniam, as we were speaking in the morning, the expectation was that there could be some big ideas, some big schemes like PM Kisan. In fact, they haven't even touched PM Kisan, which was the big expectation that they would hike the number from 6,000. That hasn't happened. I think there is a tinge of disappointment on the capex number. You would agree, because you were hoping for a higher number as well. At 11 lakh crore rupees, you know, that a little bit of a disappointment there?
So let me start by giving my initial big picture assessment. I have 3 words for the budget: JNV, judicious, non-populist, visionary.
JNV, judicious, non-populist and visionary. That's a nice acronym there.
And the reason I actually say that is, in an election year, resisting the populist pressures. And I remember mentioning earlier as well, for instance, I never viewed the PM Kisan scheme as a populist scheme because of the economic benefits that it brought. So it is consistent with the theme of this government, which is actually focused on judicial macroeconomic management. As I said, it's non-populist. But there is one big idea which I'll come to just in a minute. Visionary, because it has actually, done, there are 2 aspects to it. One, what has already worked very well, they're continuing on that, rather than trying to change too much. And at the same time, also laying out a vision. And now here's where I want to talk about the big idea that I have seen, which is the 1 lakh crore for innovation and research and development. As a researcher, that gladdens my heart enormously, because, I think if India has to be a developed economy, and you would recall, Sherin, we had written a chapter on innovation in 2020. For the first time, India broke into the top 50 nations on innovation. I think that momentum needs to be carried forward. 1 lakh crore, 50-year loans, which is, almost interest-free, would I think be a big spur to R&D and innovation. On CapEx, I actually do think that there is space. I do think that as long as the money goes into capex and delivers growth, thereby making sure that the R minus G differential is negative. I am not someone who actually believes in the 3%, 3% fiscal deficit, 66%. That's from the Maastricht Treaty, which is a political document. So for me, I think given the demand for infrastructure, I would want to see a greater allocation for capital expenditure.
Mr. Singh, state capex loans for FY25 to continue at 1.3 lakh crore rupees as well. There has been no change there. Your big takeaway as far as the announcements that have come in from the finance
minister. Let me put it this way. Subra used a different way of describing. I want to go back to something that she herself said, which is TCB, trust, confidence, and the blessings. Things which have worked well, do not tinker with them unduly.
So why fix it if it ain't broken?
Why fix it if it isn't broken? It reinforces trust of government's continued path of what it said on fiscal and overall macroeconomic management. It exudes confidence, as I said at the beginning, because notwithstanding other kinds of populist pressures, it had stuck to delivering something which is responsible, credible, and embedded in India's long-term growth story. You talked about the states, Shireen. I think that's a very big change. If you look at the document which was put out by the Economic Division, it looks as though the states have begun to utilize this in a very purposive way. The utilization last year has been close to about 86, 90%, over 90%, which means that the states themselves have switched over their expenditure pattern into believing on the long-term multiplier growth. So from that point of view, continue to trust the states in providing this additional thing will add to the long-term growth story, a decisive move towards Viksit Bharat.
A decisive move indeed. So just again, for the benefit of our viewers who might just be joining in, FY25 PM GKY outlay at 2.05 lakh crores, and For the MNREGA, the outlay for FY24 BE was 60,000 crores, and I think it is unchanged at that. And the PM Kisan, the FY25 MNREGA allocation is now increased to 86,000 crore rupees versus the BE of 60,000 crores. And as far as PM Kisan is concerned, the allocation remains unchanged at 60,000 crores. So broadly, what's the expectation now, given what has been delivered, on what we should expect from the full budget?
So I think the emphasis on capex, and just to add to what Dr. Singh was saying, that given the utilization of the 50-year interest-free loans, you would recall 1.3 lakh crore had been provided for, and 98,000 crores of that has been utilized, which has resulted in a 47% increase in capex by states. I think that's again, it builds back to the big theme I said. What has worked well, they've actually doubled down on it. So the 75,000 crore that was announced by the Honorable FM, I don't know what, again, that is interest-free loans for states. What category is it in? Is it a subset of the 1.3 lakh crore? I'm actually not clear. I hope, that'll get clarified in the press conference. And also the loans for tourism development to states. Again, that is part of the same theme, which is what has worked well. When states are being given incentives to do capex, they're responding. And I think that is the, so overall the emphasis on capex, growth multipliers, just a visionary, sort of move, I think, in the budget.
Mr. Singh, I'll just come back to you in 1 second. We've got the State Bank of India Chief Dinesh Khara joining us as well. Bank stocks are on a tear. Mr. Khara, many thanks for joining us here on CNBC TV 18. I think the big headline as far as the banks are concerned, as far as the financial sector is concerned, is that fiscal deficit number much ahead of what anybody was estimating, much ahead of what anybody was expecting. Your first takeaway from Nirmala Sitharaman's sixth budget?
I think when it comes to the fiscal prudence, that is something which is very clearly demonstrated. And on the top of it, the kind of tax revenues which are coming in. So actually the tax to GDP ratio has improved significantly. So I think this is a very, very promising budget in terms of the revenue going up, and also enabling the government to shore up the capex also is something which is very encouraging. And I think it's actually quite a growth-oriented budget. Apart from that, I would also like to mention that the new solar program, which has been indicated in the budget, I'm sure it will go a long way in terms of not only showcasing the value of solar for individual households, but also it will also help in terms of conserving the fossil fuel, and also improve the green index of the economy across the globe. So I think this is quite significant in terms of the country's commitment for achieving the zero carbonization kind of initiatives also. So I think it's quite a laudable budget. I would like to say like that.
Growth-oriented budget. But Ramdev, just to pick up on some of the themes that, for instance, we just heard on that rooftop solar scheme, which we had heard from the Prime Minister, the budget is taking it forward. The concessions that the IFSC entities will now get beyond the earlier sunset. In terms from a market's perspective, the themes that you believe this budget will now take forward and markets will play on.
Yeah, I think the current the expansion of the market through retail of about 30-40 million customers coming every year, that itself is a revolution itself, and that is because of the digital infrastructure and conducive environment of the attitude of the regulators and all. That is happening. On top of it, now in this budget, they are saying that fiscal deficit will be significantly lower, and that should have a little more play in terms of lower interest rate. Globally also the interest rate environment is likely to be a little more easier. So I think all of it is going to play out, and economy is likely to grow at about 7.5%. So everything looks perfect, and this consolidation, fiscal consolidation is going to come as a boon for the markets.
You wanted to make a point.
I wanted to make 2 points, Shireen. First, is to elaborate on a point that Dinesh just made, you know, for the first time, the revenue numbers added together will exceed 18%. This is after a very long time. The revenue numbers both for the central government and for the state government look in the direction where we would like to be. This is not the end of the story, of course, because the finance minister has not touched the revenue rates. But in terms of the overall compliance effect and in terms of the kinds of structure which is already built, it has resulted in an improved tax GDP ratio, which we have been hoping for quite a long time. So that is on the revenue side we need to recognize that it has been a major contributor in realizing the daunting fiscal numbers. Second, I think I want to make a comment on this story of the push towards a green economy and towards India's adherence. Now, you see, this solar rooftop program, apart from the numbers and the allocations which have been made, has one very important policy thrust. One of the difficult tasks in terms not only from the viewpoint of the environment, but wearing the hat of the Finance Commission, which I chaired, the biggest elephant in the room of state finances is the state of the state electricity boards and the power distribution companies. Now, this program of the solar rooftop, if it can spur, incentivize, and push the repair of the state power distribution companies, it would be a deep structural reform for the Indian economy.
Well, that is an important point that you make, but let me toss it back across to Lata, Prashant and Sonia in the studio. Guys, over to you.
Okay, well, we now have some more assumptions of the budget, the macro assumptions, and I want to toss them to the economist, both K.V. Subramaniam and Sajid Chinoy, who's with us. Sajid, the assumption of nominal GDP growth is only 10.5. So it is, okay, we don't have, okay, we should get to Sajid in just a minute. It's only 10.5. You know, there were expectations that they could assume 11% growth, but only assuming a 10.5% growth in nominal GDP, still the tax growth assumption is only 11.9. That works out to about a 1.2%, 1.2 times tax buoyancy, which, going by the performance of the current year where tax buoyancy is almost 1.4, this is an extremely conservative assumption. Another conservative assumption is that current year they have collected far more taxes in the first 10 months, and yet the revised number is not revised higher. It is revised lower by a few rupees only. It was 23.30 lakh crore. They've actually revised it down to 23.27 something. So the point is that the base can be revised higher. The actuals will be higher unless you assume a real fall in taxes in the fourth quarter, which is no one's base assumption. So if the revision is higher, then actually they're assuming even lower tax revenues, which explains perhaps this buoyancy in the bond market. They may not even borrow 14 lakh crore gross and 11 lakh crore net, so it seems. Mr. Khara, you think that there is a big Diwali waiting to happen in the bond market? You're going to have a lot of mark-to-market gains?
Yeah, it should be there, but I think apart from this, immediate reaction, I think on an ongoing basis also, it should actually moderate a little more, and which will actually push the interest rate regime also towards the lower side. So I think this is a welcome development, particularly for a developing economy like us. This means quite a lot.
Yeah, I'm going to come back to all of you and to the former CEA on the macro numbers. Just hold on for a minute, gentlemen. We have to address the stock markets as well, and Prashant Khemka has joined us. Prashant, what do you make of what is an excellent macro budget, but no details in terms of, you know, a transfer of incomes to the lower classes, which was what was one of the expectations? First, your overall comment.
No, thank you, Lata. I think overall it's a good budget, a budget of continuity. Over the last several budgets, particularly the last budget, was very well received by the market and investors at large. So continuing the policies of the prior budget is again a positive. There's no major negative in the budget. That's always a positive in itself. there were some concerns of it being a pre-election populist budget. That hasn't played out. In fact, as you highlighted very much, the most significant positive of this budget is the budget fiscal deficit estimate of 5.1%. Yeah, so the concerns on populistic budget has been dispelled. At the same time, the capital expenditure outlay has been increased by double digits on back of a 33% jump last year. So within a span of 2 years, a 50% jump in capital outlay. That goes a long way to towards building the capital stock or the infrastructure stock of the country. So for an interim budget, I think in 3 succinct points, I would say it's a budget of continuity with big positive in fiscal deficit, at the same time increasing the capital outlay.
All right.
Okay, I want to get a word on stock market. Sorry.
Yeah, sorry, please.
Ramdev, to you. See, there are two positives. The immediate positive for people like Mr. Dinesh Khara, the mark-to-market gains on bond holdings. So those kinds of stocks are doing well. But basically, if the government is going to pay only 7.07% now, 10 basis point fall in the 10-year benchmark paper, if the government cost of capital is falling, won't it also mean fall in the cost of capital for corporates? So, do you see EPS gains, other kinds of gains for corporates? Your thoughts?
Yeah, so when the interest rate tends to go down and the global environment is also for softening of the interest rate, in that case, the attractiveness of the fixed income vis-a-vis equity markets, that equation further tilts in favor of equity markets. And then if the cost of borrowing for the corporates are lower, the operating leverage will tend to work, financial leverage will tend to work, and for a given growth at EBITDA level, I think the net profit growth will be a little higher. So higher profit growth, lower cost of money, so a higher multiple, I think that should be directionally positive for the equity markets.
By the way, another pack which should benefit is life insurance companies. I mean, in terms of the fallen yield, mark-to-market. I mean, I think life insurance, I'm not sure if there's a reaction or not, but that's another pack worth watching. Ramdev, how much of this is priced in? That's the question, right? The government over the last so many years has opened up so many sectors. Railways has become pretty big now in terms of, they talked about converting 40,000 wagons into Vande Bharat. So 16 bogies a train, that's about 2,500 trains. I mean, if you go by what we have so far. But I think 1,000 trains, the government has already spoken about over the next couple of years. We have about 40 right now. So it's a big program. Maybe that's has been expanded. We'll have to check. Defense is another area there was some focus on. But the point is, markets price a lot of this ahead, right? So how much of all of this is in the price in that sense?
Yeah, so actually in this budget there's no specific provisions, at least not in the budget speech. In the papers there might be some further detail, but since the government has not expanded that big because of fiscal consolidation, there I think total budget expansion is only 5-6%. So in that situation, I think almost like a status quo kind of situation, that whatever happened last year in the name of capex, I think capex is more or less just about 1 lakh crore higher or something like that, from 12.5 lakh crores to 13.5 lakh crores, something like that. So I don't see, and for the 12.5 lakh crores, market is clearly aligned. So I don't see too much of surprises for the markets from that allocation point of view. So they are fully priced. I mean, fully into the budget speech per se has not given any surprise. So today is the day of surprise, and surprise has come from the fiscal deficit number for the 24-25. So I would think that it is more to do with the banks. Particularly banks they have been underperforming for last 12 months or so. So I think this might be the turn of this. It's a very large sector. It's almost like the largest profit pool and almost 30% of the market. So if that turns around, you can imagine what it can do.
Yeah, absolutely. The top gains, if you take the CNX 100, Bank of India up 3%, Union Bank up 2.6%, Bank of Baroda up 2%, Canara Bank, Axis, HDFC Bank. I mean, it's the banks who are up and away because of this big gain they will have in their mark-to-market. What you say, Ramdev, about the infrastructure stocks is well taken. I think the market was running away with the expectations that there could be a 20% rise in the capex bill. It is more like a 11% rise in the capex bill. As Ramdev pointed out, it's more like 11.1 lakh crore, the central government's own expenditure. Plus, if you take the PSUs, it comes to about 13.5, as you pointed out. it's more or less in line with expectation, and therefore L&T has reduced its losses from, I think it was -4%, it's now come down to -2% in terms of the stock performance. But I think it's in the price that the capex will benefit them.
I think also the railway stocks, right? All the railway stocks are under pressure right now and selling off quite a bit, IRFC, etc. The railway capex as well was expected to perhaps be much higher, considering that the expenditure in railways has been the highest in year to date. But that didn't come through. It was slightly lower than expectation. So we're seeing a little bit of profit.
Another such a bumper. You had all those stocks running up 130%, 150%. So now I think it's the day of reckoning.
So this is the interim budget. July we'll get the full budget. Is there a chance we'll get wildly different numbers in July? Or what's the tradition, I mean, here? From the interim to the actual budget?
Historically, numbers have been quite consistent between the interim and the final budget.
Wow.
So you will probably get more of the same. I mean, you will get more granular detail, you will get specific tax cuts or announcements. My own sense is that if the market and general economy continues to perform as well as it has through till July, you probably can see a watershed budget again in July. I mean, I would think, given the first year, given where the economy is, given that even this budget seems to have been well accepted by the market. And I think, Lata, the point you made most important. We are completely underestimating the tax collections. We think we will come up significantly higher, and that's really what the bond market is really elated about, because that higher collection effectively means much lower borrowing by the government.
Mr. Kanabar, you wanted to come in, please.
2 points. One is, as Ashok rightly mentioned, generally the final budget really it takes on from this. But given that, assume for a moment that this government is back in power, there will be the first budget they will present for the next 5 years. So I would see a lot of policy changes really come about, and new announcements, new policies, etc. And of course, a lot of tax things. Here we have seen nothing. But normally in any budget, you would see at least anywhere between 60 and 150 changes. So there is nothing here. So all that is for the shape of things to come. And Lata, you were mentioning, a small little point regarding those tax write-offs. Very interesting, nothing really earth-shattering. But for the government to come back and say that if there are old dues right up to 2009, of 25,000 rupees a year, we are unable to trace those people just carrying forward write-off, and then beyond 2009 to 2014, 10,000 rupees write-off. What we'll do is to clean government's books. Today, the amount due to what is collected is a very poor ratio. We'll just improve that ratio.
I think the focus on the budget is, it's a very business-like budget. That's to me comes as the word. It's a very business-like budget, telling us that I'm getting into a new era of next 5 years. And this next 5 years is going to be very different and very business-like.
Exactly. I think we should get the economists in. Dr. Singh and Dr. Subramanian have been waiting by patiently. First to you, Dr. Subramanian, the numbers, I mean, the assumption is only 10.5%. Okay, that is a conservative. And then you have a conservative tax assumption of 11.9%, which I think is conservative considering that this year we have done well. It's also conservative because this year's number has not been revised higher. If you look at the year-to-date available numbers, taxes have grown by about 14.5%, taking direct and indirect. And the assumption was 11. So they have not revised that higher. So we must expect higher taxes. I mean, your comments on all this, very conservative assumptions, you would say?
So Lata, I think this has been part of the trend. If you've seen the budgets in the previous years, starting from the COVID budget, it has been a case of under-promising and over-delivering. If you look at this year's, the target was 5.9% fiscal deficit, and what has been delivered is 5.8%. Now, to come to the assumptions, I actually think that the 10.5% growth number, nominal growth number itself is quite conservative. The reason I say that is if you take real growth to be 7% and the GDP deflator to be 4%, which I think should be reasonable given, the WPI, the huge increase 2 years back and then the negative territory last year. The median of 4% deflator, I think, is reasonable to expect. That translates into a nominal growth of 11.3%. Now, I want to make a small correction. The tax buoyancy that is assumed here for a tax growth of revenue growth of 11.9% is actually 1.13. I think that's very conservative, given that if we look at the tax buoyancy has been 1.6 this year, and I've looked at, over the last decade itself, it has been between 1.5 to 1.6. So a tax buoyancy of 1.2 is very reasonable to expect. So my sense is that once again, we will have nominal growth about 11.3%, and actual tax or overall revenue growth will be closer to 13.5%, assuming tax buoyancy of 1.2. So again, I think that 5.1% number that has been promised for FY25, my sense is we may be actually seeing 5% or 4.9% come next year, unless there is a drastic change in the budget that is presented in July. If you just go by the numbers right now, I think it's again a case of under-promising and over-delivering, on the fiscal front in the coming year as well.
Okay, and that's always a good thing, right, from a market standpoint as well. By the way, the market has not moved an inch. It is absolutely flat. I guess it's a very mature reaction because nobody expected too many things to come out of the interim budget. We have Sunita Reddy, who's also joining into the discussion. She's the MD of Apollo Hospitals. Sunita, welcome to the panel. I'll just come to you in a bit. We have Dr. Singh as well, who's been sitting by waiting patiently. Dr. Singh, your views, how would you rate this budget on a scale of 1 to 10? And what do you think is the biggest takeaway, apart from, of course, what we spoke about, which is fiscal profligacy?
Well, let me say this, that I don't want to get into this arithmetic of 1 to 10 business, but I rate this budget as an outstanding response, looking at the impending elections, staying away and steering away from a path of any kind of a suggestion of fiscal profligacy or making it populist, a great degree of confidence that the achievements already speak for themselves. You do not really have to add to that, and a great confidence of what they will do in July. I think few governments which go into an election in the next few months exude this kind of a confidence in the interim budget. This is the 14th interim budget from the inception of our budgetary process, and very few interim budgets have reflected this kind of a confidence. This is one. Second, I fully agree that this is a case of overperforming and under-promising. I think this has been done more than once, and I think that this is based again on the fact of an assurance of continuity in the growth story. I think that definitely both on the real GDP and on the deflator, there may be some room, and I think this is, if anything, really a conservative estimate of 10.5. It will definitely be better. On the revenue, looking at the performance in the last 1 or 2 years, definitely these buoyancy numbers are on the conservative side. As I said, that the GST is improving every month, and this is notwithstanding the fact that we have abstained from making deep rate rationalization, because in the case of GST, there is a very credible case that the GST rates need to be rationalized further, which will give a new fillip on the GST buoyancy numbers. So I fully agree that this is a case of under-promising in the expectation that it would be more than realized in the full budget is coming. This is yet another demonstration of the renewed confidence and the renewed expectations that the government has on returning to power and returning to office without a shadow of doubt.
Take your point, sir, that they don't even need the prop of unwarranted populist measures or giveaways. That confidence is demonstrated, and that political stability is something which the market will take home. At the moment, of course, in the grip of the FOMC announcement and a 1% fall or almost a 2% fall in US markets. So perhaps the reaction is slow to come now. There are more position adjustments. But I just want to make one more math before I come to you, Sunita Reddy. The tax to date, that is April to December tax collection, is higher by 14.3. And the assumption of the revised estimates is only 10.7. Now, one would assume that they will assume at least a 14% growth in the full year. They have not taken that assumption in the current year. They've taken a lower base. So that is why I think that there are two good reasons why this year the fiscal deficit is absolutely much lower than what even the numbers that the budget is reflecting at this point in time. they are going to make much more money on taxes. Well, with that, let me invite Sunita Reddy to the conversation. Ma'am, thank you very much for your patience and your first takeaway from the budget.
Thank you. I think all the economists on the panel have spoken about healthy economy, growth, and a very good movement in terms of fiscal deficit coming down from 5.6 to 5.1%. So let me talk about the source of growth, which is the focus on women and maternal health, which I think is very much needed. Cervical vaccination for women, for children from the age from 9 to 14. The fact that we are going to add more medical colleges and therefore get more women into the workforce. And I think overall the focus on women and childcare is something that is going to increase the number of women coming into the workforce. What has really excited us at Apollo is the amount, 1 lakh crore amount kept for research and innovation, which will hugely benefit research, clinical outcomes. And this is interest-free loans for a period of 50 years. So long-term guarantee of better clinical outcomes for the country. And I'm sure that, with this leverage, we will be able to do much more for the country as well as attract international patients to India.
Right. That point is well taken. A stable macro and unchanging tax regime, a stable tax regime should be very big attractions. But more importantly, I think it's the macros that usually attract outsiders. Mr. Khemka, what do you say for this? It looks like the cost of capital for corporates in general is likely to fall because the government borrowing rate yield has fallen. How do you approach the market now? Will banks be your favorite because they make money on their bond book? Or will it be across the board corporates because the cost of capital falls?
Certainly. So, see, the banks, particularly the PSU banks and those with big bond portfolios, would benefit to the extent of the treasury gains. But otherwise, on the whole, there were not dramatically different expectations from the budget, given that it was budget of continuity. As we already talked about in case of infrastructure, despite a double-digit jump in the interim budget to the layout, still the infrastructure stocks aren't really reacting, positively. So it's the case of a company where if expectations are already very high, even if the company delivers on a high note and delivers what was expected, the stocks might not react positively. So the outcome in that the market is reflecting today is not surprising in that case. So not any particular sector that I would say which stands to materially benefit over and beyond was what was already factored in at this point, and all the eyes would now be on the July budget, Lata.
Would you be a BFSI bull now? I mean, if you were, I don't know if you were.
So we tend to structurally have much higher allocation to financials, particularly the banking and also the NBFCs, and we continue to be in that position at this time as well.
Dinesh Khara is listening to you. As you say, the banking sector already, most investors bullish on that segment. If we can get KV Subramanian in again. Dr. Subramanian, like I've been saying, the assumption of tax collection for the current year is far lower than the demonstrated collection in the first 9 months. The first 9 months growth is 14.3. The budget is assuming a 10.7 growth. I mean, way lower than what has already been demonstrated. What is the usual practice? Will they revise higher in July?
So actually, that is what I expect. The 5.8% fiscal deficit number that the Honorable Finance Minister mentioned for this year, my sense is when the revised estimates will come, it'll be lower than that. So I think the actual fiscal consolidation path will be even stronger than what has been spoken in the numbers that the Honorable Finance Minister mentioned. I actually will mention, you would recall, Lata, that there was a break from the past that was done when off-balance sheet items would be hidden, there would be no transparency. From there, actually, to put everything upfront transparently and to be conservative in projections has been, these have been two key changes that have happened in the last few years, and this is a continuation of that, I think, which is an excellent. In general, I'm someone who actually likes governance to be one where you under-promise and over-deliver. And I think emerging out of COVID, that kind of fiscal math, I think, will give a lot of credibility. And hopefully the rating agencies are paying attention. I had written about it when I was in office as a CA. My successor has written about it as well. I think it is absolutely high time that the sovereign rating agencies look at actually their models and modify the rating. The current rating makes absolutely no sense, in my opinion, given how credibly the government has been delivering on the fiscal numbers.
Well, absolutely, and point taken, sir. By the way, just a quick look at the insurance companies. I think that is the only sort of pack of stocks which is moving on the back of what's been announced, and it's an indirect move. Apart from, of course, what's happening with banking and financial services. Look at SBI Life, look at ICICI Pru, look at HDFC Life. Most of these stocks are about 4-5% off the lows from before the budget speech started. Last time, remember, for insurance companies, there was a fair bit of negative and stocks sold off. This time there is no negative, and at the margin, perhaps, bond portfolios benefit. Mr. Dinesh Kumar Khara is still with us.
Just a word on the banks,
yeah.
Prashant, of course, please go to Mr. Khara, but he would also like to hear. Now the bank Nifty itself is up 0.6, and the public sector banks are like absolutely going through the roof. UCO Bank is up 4.6, Union Bank 4.5, Bank of India 4.3, PNB 4.2, Central Bank 4.2, Canada nearly 4%, 3.7, Bank of Baroda 3%. I mean, it's like huge. State Bank, the mighty giant, which has already been rising, up 1.5%.
And not that they needed any particular help, because they've been doing so well over the last so many months now. Mr. Khara, you run a fairly sort of large insurance subsidiary, one of the largest insurance companies in the country. Is there a significant impact because of bond yields falling for insurers, life insurers as well?
Yeah, that will also impact them. But the fact of the matter is that what you mentioned about the last budget, there were some kind of restrictions which were imposed in terms of the tax relief for buying insurance beyond a particular threshold. So that was the reason why they had seen some kind of a dip. But this time, see, overall, when the investment market becomes positive, insurance has got a lot of income which flows through the investment portfolios. So that will certainly be of advantage to them. And in any case, all of them have got a reasonably decent ULIP portfolio. So in the ULIP, when it comes to this debt market instruments and falling interest rate will certainly be to their advantage. So that is the other reason why they can create more value for their insured customers.
Got it. All right. We have Nilesh Shah of Kotak who's joining us into this discussion now. Nilesh, I'll come to you in a bit. I have Sajid Chinoy who's also waiting by. So before we come to you, let me just get a final word in from Sajid. Sajid, there are no SOPs or big rural transfers that were announced this time around. So some of these FMCG stocks have come under a bit of pressure. But I guess it's good to see that there are no major populist measures despite it being a pre-election budget. What is your take on how things on the rural side are going to shape up? Because clearly this has been a pocket that has struggled at least for the last 4 to 5 months. Do you expect something big to come through in the main budget in July?
I was just saying earlier, I think the effectiveness of policy is to be counter-cyclical. And I think what today's budget has done is to demonstrate that counter-cyclicality is symmetrical. I think the need of the hour was to bring the deficits down, given where starting points were. The need of the hour was to ensure that capital expenditure was not withdrawn. So we've seen that maintained as a share of GDP. And of course, the welfare support will need to be targeted. Now, just a couple of quick clarifications. Lata had brought this up. If you look at gross tax to GDP, that has been budgeted much higher in the RE compared to the BE. But net taxes are lower because the transfer to the states is higher. So we have to be cognizant of that. Number one. And number two, for next year, the accounting is conservative. nominal GDP of 10.5, one should expect a buoyancy of higher than 1.1. What that will do is let the deficit be consolidated more on the revenue side than the expenditure side. Currently, if you look at next year's B, most consolidation is on revenue expenditures, which from a quality of expenditure perspective is good. But if you do end up getting more tax buoyancy, and I've been harping on the asset sales for a long time, if in the July budget there's a focus on asset sales, then essentially you can get more consolidation on the revenue side and protect expenditures even further. But the accounting in general has been very conservative, and the need of the hour was just to double down on a fiscal consolidation path, which I think this budget has done very effectively without compromising capital expenditures.
All right. Well, in fact, Nilesh Shah is also joining in. So let me get his thoughts in. Nilesh, as Sajid was saying, the need of the hour is to double down on fiscal consolidation. And that's pretty much what the government has done. You think it's a win-win situation from here on? And from a market standpoint, is there anything in the budget that can help the market see incremental gains?
So one, the fiscal consolidation path given by the budget is way ahead of the street. No one was expecting 5.1% fiscal deficit. Hopefully that will give confidence to the market. Second, on infrastructure allocation, there was fear that this year maybe the allocation will not be enhanced as much. 11.11 lakh crore on the revised estimate of 9.5 lakh crore is a 17% jump. That's fairly positive. And overall, clearly, our economy today faces two challenges. One, consumption at the bottom end of pyramid is not growing as fast as the top of the pyramid. And private sector capex is not growing as fast as the government capex. In this budget, at least there is supply side availability for private sector capex. Net borrowing program aided by debt FPI flows will leave enough credit in the banking system and market for private capex. And some of the steps announced on housing, fisheries, agriculture will hopefully support consumption at the bottom end of the pyramid. It will be fair to say that markets will be satisfied with the vote on account as it achieves the impossible trinity of creating inclusive growth, spending on infrastructure for future, and yet maintaining path of fiscal prudence.
Well, I must point out to Dr. Subramaniam, to Sajid, to Nilesh, you as well. The amount of bonds that are getting redeemed this year is 2.7 lakh crore. When I say this year, I mean FY25. So we were expecting a 2.7 lakh crore difference between gross and net borrowing. It's actually, the difference is only about 1.2 lakh crore. What I understand is the entire compensation, GST compensation cess, is being used to redeem those bonds. So the difference between gross and net is not the assumed 2.7 lakh crore. It's much less. It's half of that. The other half is being taken from the compensation cess fund of the GST. That's just by way of information. We are getting it as we read the fine print. So net. Yeah, go ahead, Nilesh. Yeah.
But there is also possibility that there will be a switch between government and the RBI in the days to come. And that would reduce the net borrowing program probably.
No, the switches have been announced at 1 lakh crore. That is also there. But I think this is separate from that. And that explains why the borrowing is so attractive for the market that you're seeing the bond prices jump, because they are not going to borrow from the market, but adjust it from the compensation cess. Sunita Reddy, if the cost of capital falls, do you see that as an attraction for investment? Already, hospital chains and healthcare is a burgeoning sector. Do you think if the cost of capital falls, cost of money falls, that is a very big, injection, fuel injection for you all?
Yes, certainly. I think that especially at Apollo hospitals, where we're looking at adding over 5,000 beds, the cost of capital is key, and it will bring down the cost per bed, and therefore I think the whole country will benefit from this, and our sector especially.
Yeah, Prashant Khemka is also with us. Prashant, afternoon. I'm sure your team must also be feeding you information in terms of what they are doing as the speech comes through. Although it's an interim budget, it was a short. Anything actionable which you've kind of discovered? I know you're not a very short-term kind of a sort of a person in that sense and how you operate the fund, but anything strikes you across sectors?
No, thanks, Prashant, for the question, but nothing really exciting necessarily from the budget that would prompt any action. I think we do spend time analyzing and understanding what the longer-term direction of the policy is, and what we've discussed so far is that it's a continuation of what was laid out last year and what has been the direction over the last 10 years. So that in itself is a big positive and would be very well taken by investors, particularly the global investors. Nothing in the budget that negatively surprises, and it's the message of continuity, which is a very good message.
Okay, Prashant, will you all be positive on the public sector stocks, the ones that already ran up a goodish bit, but is there any juice left in any of them?
So again, see, in a portfolio that is constructed with in a manner that doesn't necessarily trade in and out on a daily basis, 2-3% move is not something that would prompt action. As I was saying earlier, BFSI, which is the most significant beneficiary of the most significant positive of this budget, which is the fiscal deficit estimate coming at 5.1, that it's already is a very big, the largest allocation in our portfolio. Structurally, it has been the largest allocation in the portfolio. So in a way, we find ourselves in a position that we might have brought ourselves into if we weren't already there. So as a result, there's nothing that we believe at this time, at this point, on an incremental basis, we need to do.
So we are itching to go to the CII because they will be, best placed to say what they can do with the cheaper cost of capital. But Shireen, before I come to you, just one word from Nilesh Shah. Nilesh, does this make debt attractive? Debt was the stepchild, debt mutual fund was the stepchild of the previous budget. Now with bond prices rising, is there a macro-oriented positivity in debt funds?
So undoubtedly, there will be some catalyst, but we still need to deepen our bond market. It's a work in progress for long. And debt mutual fund to grow will also require some sort of support or level playing field. Today, if you invest in NPS and you are a salaried employee, you get 10% tax exemption. You get tax exemption up to 10% of your salary. At the highest slab, that's 3.9% incentive. In insurance, some tax concessions have gone, but below 2,50,000 rupees, there is a tax incentive. So debt market will need to be deepened, and debt mutual fund will require level playing field before investors actually start allocating to debt mutual fund.
Absolutely, and easing bond yields should also give some relief to borrowers, right? Home loans, personal loans, etc., which will eventually lead to higher disposable income for individuals. So that's a positive as well. Thank you for that. But let's toss it across to Shireen now. Shireen, back to you.
Well, thanks very much, guys. And, we were just talking about this with KV Subramanian. What does this mean now as far as the monetary policy is concerned? We've got one coming up in another few days. What kind of room does this make available to the MPCs?
I think I would say ample. Primarily two considerations. One, of course, the global environment. And this is something that we discuss in the fund very regularly. If we look at the overall inflation trend, globally it's been coming down. And that will prompt monetary easing by several other central banks. I think the Fed and ECB should be this year, lowering interest rates. Together with the very judicious policy mix that has been adopted in this budget, with a strong fiscal consolidation, which I actually think will be stronger than what has been announced, given the very conservative assumptions. That leaves ample space for, monetary policy to loosen. And my sense, I was hearing some of the discussion on the banking stocks expanding. My stance is that, the yield curve, with the risk-free yield curve coming down, and then that will mean lower cost of capital for a lot of borrowers, which should increase the supply of, bank lending. And that might be the part that is actually getting reflected in the banking stock. But overall, I think just to reiterate what I said, JNV, which is, it's a judicious budget, it's a non-populist budget, and it's a visionary budget.
Well, the MPC will meet, so we will have to wait to see what is delivered. But the governor, in his conversation with me just a few days ago, made it very clear that there is no question of acting on a rate cut just at this point in time.
May not be immediately, but later.
Yeah. Sure. Sunil Vachani, many thanks for joining us. You know, the budget came early for you because the cut in tariffs from 15% to 10% came a day ahead of the budget. But overall, on balance, what do you believe this does now in terms of consumption, in terms of demand?
Yeah, I think first talking about the steps which were announced yesterday, a day before the budget, I think the finance minister has sent a very clear signal that when it comes to manufacturing for the world, India is the place to be. And I think just to explain what these duty cuts actually mean to the industry, I think they're very significant because first what they do is that they improve the competitiveness of the Indian industry as far as manufacturing for the domestic market is concerned. Two, I think these duty cuts will also help expand the market for mobile phones because obviously these duty cuts, will be passed on to the consumers. Yeah. And I think they're quite significant. So I think definitely it'll give a huge boost to the mobile phone industry in terms of consumption. And we've seen that the market has not been really growing, in the last couple of years. So I think this is a very positive step. And I would say this also, helps in our global competitiveness because even though the philosophy, the policy is that we will not export our duties and taxes, but eventually when the custom duties are high and the tier 2 and the tier 3 suppliers do not get a refund of these duties, we end up exporting these taxes and duties. So the lower duty structure would also mean better competitiveness in the global markets.
Well, yes, that certainly is the hope. But, in terms of private capex now, and there were, of course, allocations, etc., made for semiconductors and so on and so forth. But given where you find yourself in terms of demand visibility and now to push the export story, including the domestic story, capex at this point in time, would you need to put in any fresh money?
Yeah. So, Shireen, I think if you look at the Make in India policy, I would call it Make in India 1.0. I think it's been very, very successful in our industry, which is the ICT industry. And the numbers definitely speak for themselves. If you look at the total consumption of ICT products, which includes, mobile phones, laptops, and all appliances and TVs, the total demand is about $130 billion. And it's probably for the first time that almost $100 billion worth of goods, of ICT goods, were manufactured in India. So I think now what is demand, you think? Is the domestic demand, $130 billion. Out of that, $100 billion was manufactured in India. The first level of manufacturing was done in India. And now I think what we need is a very strong and robust component ecosystem to make this sustainable. So I think as an industry and as a company, I think we would see now CapEx coming in into the component side of it, and also definitely the semiconductor. But of course, the first step would be the ATMP, and of course.
So what are we talking about? Ballpark capex numbers?
Are you talking about Dixon?
Dixon specifically,
I think if you look at the last couple of years, it's been around 350 crores. This year we'll end up probably at around 500 crores. And I think next year will definitely depend on the projects, some of the projects that we're working on, which I won't be able to talk about right now. But I think if you leave that aside, I think the numbers will be similar, around 500 crores.
Well, on that note, we are going to have to listen in to what the Prime Minister is saying. He is addressing the media post the budget.
Inclusive और इनोवेटिव बजट है. इस बजट में कंटिन्यूटी का कॉन्फिडेंस है. ये बजट विकसित भारत के 4 स्तंभ युवा, गरीब, महिला और किसान सभी को एम्पावर करेगा. निर्मला जी का ये बजट देश के भविष्य के निर्माण का बजट है. इस बजट में 2047 के विकसित भारत की नींव को मजबूत करने की गारंटी है. मैं निर्मला जी और उनकी टीम को बहुत बहुत बधाई देता हूं. साथियों, इस बजट में युवा भारत की युवा आकांक्षाओं का, भारत की यंग एस्पिरेशंस का प्रतिबिंब है। बजट में 2 महत्वपूर्ण निर्णय लिए गए हैं। रिसर्च और इनोवेशन पर 1 लाख करोड़ रुपए का फंड बनाने की घोषणा की गई है। बजट में स्टार्टअप्स को मिलने वाली टैक्स छूट के विस्तार का भी ऐलान किया गया है। साथियों, इस बजट में फिस्कल डेफिसिट को नियंत्रण में रखते हुए कैपिटल एक्सपेंडिचर को 11,11,111 करोड़ रुपए की ऐतिहासिक ऊंचाई दी गई है। अर्थशास्त्रियों की भाषा में कहें तो एक प्रकार से स्वीट स्पॉट है। इससे भारत में 21वीं सदी के आधुनिक इंफ्रास्ट्रक्चर के निर्माण के साथ ही युवाओं के लिए अनगिनत रोजगार के नए अवसर तैयार होंगे। बजट में वंदे भारत स्टैंडर्ड की 40,000 आधुनिक बोगियां बनाकर उन्हें सामान्य यात्री ट्रेनों में लगाने का ऐलान किया गया है। इससे देश के अलग अलग रेल रूट पर करोड़ों यात्रियों में आरामदायक यात्रा का अनुभव बढ़ेगा। साथियों, हम एक बड़ा लक्ष्य तय करते हैं, उसे प्राप्त करते हैं और फिर उससे भी बड़ा लक्ष्य अपने लिए तय करते हैं। गरीबों के लिए हमने गांवों और शहरों में 4 करोड़ से अधिक घर बनाए। अब हमने 2 करोड़ और नए घर बनाने का लक्ष्य रखा है। हमने 2 करोड़ महिलाओं को लखपति दीदी बनाने का लक्ष्य रखा था। अब इस लक्ष्य को बढ़ाकर 3 करोड़ लखपति दीदी बनाने का कर दिया गया है। आयुष्मान भारत योजना ने गरीबों की बहुत मदद की है। अब आंगनवाड़ी और आशा वर्कर, उन सबको इस योजना का लाभ मिलेगा। साथियों, इस बजट में गरीब और मध्यम वर्ग को एम्पावर करने, उनके लिए आय के नए अवसर बनाने पर भी बहुत जोर दिया गया है। रूफटॉप सोलर अभियान में 1 करोड़ परिवारों को सोलर रूफटॉप के माध्यम से मुफ्त बिजली प्राप्त होगी। इतना ही नहीं, सरकार को अतिरिक्त बिजली बेचकर लोगों को 15 से 20 हजार प्रति वर्ष की आय भी होगी और ये हर परिवार को होगी। साथियों, आज जिस इनकम टैक्स रेमिशन स्कीम की घोषणा की गई है, उससे मध्यम वर्ग के करीब 1 करोड़ लोगों को बड़ी राहत मिलेगी। पिछली सरकारों ने सामान्य मानवी के सिर पर दशकों से ये बहुत बड़ी तलवार लटका कर रखी थी। आज इस बजट में किसानों के लिए भी बहुत महत्वपूर्ण और बड़े निर्णय लिए गए हैं। नैनो डीएपी का उपयोग हो, पशुओं के लिए नई योजना हो, पीएम मत्स्य संपदा योजना का विस्तार हो और आत्मनिर्भर ऑयल सीड अभियान हो। इससे किसानों की आय बढ़ेगी और खर्च कम होगा। मैं एक बार फिर सभी देशवासियों को इस ऐतिहासिक बजट के लिए शुभकामनाएं देता हूं। बहुत बहुत धन्यवाद।
Well, that is the Prime Minister there on the budget speech that's been delivered by Nirmala Sitharaman, her 6th budget. We've got a packed house here at the CII. Gentlemen, I have to say, Nirmala Sitharaman, speaking to you at CII, had made it clear this is going to be a vote on account. She's delivered on that. Perhaps one of the first few finance ministers really sticking to the script on what a vote on account is and what a vote on account should be. Dinesh.
Yes, totally agree. As you said, it was on our event where she mentioned this. I think she has walked the talk. But equally so, she has given the direction in terms of what it's going to be. So I think that's great.
Oh, absolutely. She made it very clear we're coming back for the next 5 years. So that pitch was made. But Rajiv Memani, nothing for you to do today. No changes as far as direct or indirect taxes are concerned. But, you know, we were discussing the fiscal conservatism, and that was the point that you were making as well.
Yeah. So just to answer on your first point, I think it's this is a budget of a very confident government, both politically and economically. So no, big softies announced or everything. Just a very good articulation of what they've achieved, or what they've done over the last 10 years. And then a broader vision of what they intend to do going forward. And even if I look at the macroeconomic thing, all of us have been covering and seeing the tax growth. Direct tax growth of almost more than 20%, indirect tax growth of 11%, actually GST growth of 11.5%. So everyone was estimating that the revenue, the tax growth this year will be higher than budgeted, and the expenditure will also be higher than the budgeted.
It's actually lower, a little bit lower.
Both of them are slightly lower. So my guess is when we eventually end up, and the gross number and the net number. So I'm assuming they are doing a lot of refunds will be given in the next few months. And next year, what they've assumed is that the gross tax revenues will be 11.5% growth and the net tax revenues will be 12% growth. So, I mean, we are threading, but I think overall just a lot of conservatism, or I would say realism, built in the numbers. So there's enough cushion. We are living in a world which is volatile, uncertain. So there's enough cushion that's built in. And they've always delivered in the last 3 years on the numbers that they've said. So this 5.8% to 5.1, my presumption is maybe lower than 5.8%, the budget, but coming down to 5.1%, I think that's really great.
Yeah, that was the point that KB Subramaniam was making as well, that the 5.8 number is likely to be lower as well. But this point about delivering on the numbers, and that's a valid comment coming in there from Rajiv Memani.
In fact, actually, an aspect that I want to highlight is that, even if you look at the previous vote on account, 2019, many people reckoned that the PM Kisan was a populist scheme. At that time I actually had said as well that it will bring in investment, and as I've said, research by Pulak Ghosh has demonstrated that. Yeah. So the theme that I want to say is that this government actually has shown judiciousness, not profligacy in an election year, even previously. So this is consistent with its theme. It's not different at all compared to, and I think that reflects the overall, and having had the privilege to work very closely with both the Honorable Prime Minister and the Honorable Finance Minister, this reflects their themes. They actually think about, about running the economy well, and handing it over to the next government, which quite likely is going to be them, but is still handing the baton over in a very judicious manner. So the non-populist part and the judicious visionary. I will emphasize once again the R&D part. I think not too many people have paid that much attention, but I think that is a very important stem which ties in with the equivalent of the National Science Foundation that was actually announced in the 2019 budget, and I think steps have been taken to action that. When you put the two together, I think that can be a big big idea really in the budget.
Innovation fund.
Yes,
the innovation
1 lakh crore actually, and that's 50-year money. So
interest-free 50 years is
in fact, see, having some of my early research was on innovation, and gestation periods are long, so 50 years actually, but not 50 years. So that's a very large, very, very important step.
Yeah, TB?
No, I think, again, it's a prudent budget. I would think it's prudent because of the fiscal, what we talked about, the borrowing part of it, and I think that really puts in a lot of ease into both the real and the nominal interest rates, I would think that's going to be very critical. And I really like the texture of the spending in terms of, while we can talk about that capital expenditures, I mean, that could have been more.
We needed Vinayak back, because Vinayak had said here on CNBC TV 18 that 13.5 lakh crores will be the number, but of course it is lower than that. You know, still, if you look at it over the previous year as well, it is a significant growth.
It's a significant growth, number one. And number two, if you really look at the way it has been balanced over physical infrastructure and the social infrastructure, and really going into the rural housing and rural infrastructure, I think that's very, very critical and important.
Well, let me also invite Sanjeev Puri to join us here at our CII Budget Headquarters. Sanjeev, many thanks for joining us. As you take your seat, from a consumption point of view, from an FMCG perspective, what do you believe the budget has delivered? He's sitting. No time to sit. No time to sit.
That's a usual thing.
Hit the ground running.
So you see, consumption, of course, is an outcome of the manner in which the economy progresses. It's one facet of it. And what we have seen is consistency of vision and strategy, and really laying down the roadmap for execution. That's what we've seen in the budget. And the whole focus is on creating productive deployment of resources. And with all that is being done, for example, in certain agriculture sectors, in the housing sector, in the rural, and I'm sure the public capex also will find its way, its fair share, more than its fair share in rural. You know, there's also the support to the state that is coming in as far as infrastructure. That also has a footprint in rural. So I think all of that over time should enable or strengthen the virtuous cycle, so that we start getting uptick in consumption.
You know, on consumption, Sanjeev, is there concern, because the expectation was that at least in the hands of the farmer, in the hands of the rural economy, that disposable income would perhaps be enhanced by way of additional sweeteners. That has not been the case. Even PM Kisan, which was widely expected to be enhanced, has not happened. So what does that mean then as far as volume growth is concerned? I mean, are we to contend with a volume growth of 2 to 4%? Is that what we should continue to budget in?
You see, look, as the economy progresses, it's a matter of time when consumption will pick up. So I do not see any reason to believe that is going to be the trend. It's a matter of time when it will pick up. See, whilst you may find that direct money may not have been specifically called out, but there are many avenues that will create productive utilization of the human capital in rural areas, that will pump in resources into the rural areas. I think once agriculture gets competitive, incomes will improve. The fact that you are having Lakpati Didis, that will have a footprint in agriculture. There are a lot of them actually can become village level entrepreneurs to support agriculture. Rural housing will create employment. So all of that is potential. Even when you expand the coverage of healthcare, ultimately the discretionary or the incomes in the rural end also go for health. Now, if you kind of provide it in another fashion, then the rest of the money is available. So I think the deployment of resources in rural has been done in a more productive fashion, following the themes of the prior years. So over time, I'm sure it will lead to an uptick in consumption.
Yeah, you want to make
I just want to actually bring out, if we look at overall the rural economy, the fact that the spending on Manrega has declined, because we know very well Manrega is distressed, is demand-based, and it's higher when it's distressed, when the rural economy is distressed. The fact that that is not happening is actually symptomatic of the fact that the rural economy is doing fine. One more aspect, and I think which is something that I think economists need to pay far more attention. I mentioned it earlier too. If you look at the participation rate of women, that has increased by almost 15 percentage points in the rural areas, and that is in a space of just 5 years, 15% from about 25 something to 40. I think that's phenomenal, and the reason it has happened is because now women have more time from the productivity. They actually need less time to cook. They don't need to go as far to actually bring water, etc. And that is also, reflective of the strength of the rural economy. So I think what the government is basically seeing is that there is no need for, as such, at this point in time, an additional impetus, given all the PM Awas Yojana, the Manrega, all these actually that are already working well.
Yeah, no, I just wanted to add 2 points to what has been discussed here. So if you look at this government, I think from even during COVID and post, their focus has been on making sure the spending is for productivity increase and inclusive growth. So rather than actually put money into the hands of the consumer, they have made sure that the consumer or the society becomes more productive, thereby getting more money. So if I look at the two other aspects to whatever we spoke about, one is the focus on MSMEs and especially their transition for both sustainability and also the making sure that they can transition properly into the digital growth. So if I look at these 4-5 pillars coming together, then I think going back to Sanjeev's point, it will have a trickle-down effect to both the rural and the economy to aid consumption.
If I could just add one more very important point, a very innovative step being taken, this whole facet of incentivizing reform at the state. Now, you see, that can unlock the potential of agriculture also. That's similarly, there are other reforms that in fact are awaiting last mile execution and very progressive reforms. So I think that also will unlock the potential of the economy, and that's, I think, a very, very positive development.
So I think one other area which we should really focus on, especially when it's coming with the global challenges and where we talk about SME and Indian manufacturing, is the focus on both technology and R&D and green manufacturing. And I think that's going to be very critical. And the fund type of when we are talking about a 50-year fund and encouraging even the small scale to transition to a green, I think that will be very, very critical for when we look at a very strong, robust, connect with the global supply chain.
No, so gentlemen, at the end of this now, let's talk about private capex. Sanjeev, let me start by asking you, what should we expect now in terms of private capex? We've been talking about incipient signs for a while now. Are we likely to see private capex picking up?
So I think it's already starting to pick up. The situation on the ground as far as domestic is concerned is fine. The global situation is very weak. So we have a little bit of a mixed bag, but capacity utilizations are up. I think all the macros favor investment because there is liquidity, balance sheets are good, health of financial sector is good, corporate income tax have been rationalized some time back. So I think all the enablers are in place and it is already starting to pick up. Things related to infrastructure, cement, chemicals, pharmaceuticals, the industry that I come from, multiple industries, we are seeing investment. Tourism is seeing a lot of investments on hotels. Real estate is seeing a lot of investments, right? So it is already starting to happen. It could have been faster if the global situation was better, but I think as we move ahead, this will only. I think the finance minister also today acknowledged that in the speech.
Every time you say that the capital outlay and the capex has been increased in the budget, but when will private sector? Today you had the acknowledgement of the private sector already started doing it.
But I would say even the strong capital markets. I mean, India has had the largest number of listings, and I think so the capital provision also that's required, the confidence that's required, a lot of that has gone to pare down debt. So, I feel pretty confident that the investments will happen, and I think it will be led, obviously, in the existing sectors, but this entire energy transition that's happening, whether it's electrons or green electrons, green molecules, I think that's going to be the big bucks where the big.
But the 15% sunset extension that hasn't come through, and we didn't hear her say anything on FAME specifically, though she did talk about electric mobility.
So I think that I would say amongst everything, if you have to pick up one thing which I was expecting, which would happen, hasn't happened. They have extended for sovereign wealth funds, they've extended for GIFT, IFSC and others. So all those things they have done. But I think this one is one area where we were all anticipating that they would do, given the lift that's happening in manufacturing, which is not happening.
Just to, I think, two data points here. I wouldn't actually call the private capex, incipient, because if you look at the data, capex by corporates, and this was, the CA's report showed that it increased by 28% in, FY22, 23% in FY23, and 10% in the first half of the year. So, that is demonstrative of, CapEx coming. And one more, with some caveat on the, on the deflator. If you look at the gross fixed capital formation to GDP in real terms, not in nominal terms, that is touching 35%, which is also a good sign. The other third indicator which I would actually mention is if you look at non-food credit, take personal loans out of that, that is increasing at 13%. And I think that is for sure would be going into private capital expenditure. My sense is that, whatever uncertainty there is, actually, corporates are waiting for the elections. And here I would want to mention, this is a sort of a clarion call to the corporates, to not look at the global situation that much. India has clearly shown, in a global economy which is struggling to grow at 2.5%, Indian economy is growing at 7%. So why should the corporates wait and watch for global economy? Go and, invest in the capex now.
Go and invest in capex now. Forget about what's happening in the world.
Yeah.
You've got enough working for you here as far as domestic demand is concerned. Rajiv Memani, from what we've heard now and the journey to June or July, whenever we see the final budget, what would the expectation be?
No, I think people will look at the March numbers. I think most of us feel they'll do better in March. Like the RE is always better than BE, and the RE2 is always better than the RE1. So I think the numbers will be better. So hopefully they'll have more fiscal space, and if they can address and work on some of the issues which don't have a budgetary impact but will have an impact in terms of ease of doing business, ease of paying taxes, which the government has done a great job of. I think that'll be great, and continue to invest in technology. One of the reasons why personal tax collections have gone down is the number of people who get SMSs between 15th March to 31st March saying that your ASI data or your data is showing X, your return is showing Y, do you want to revise your assessments, or have you fully filed this, are you fully, in end of December, end of March. And I think if they continue to do the analytics, continue to invest in technology behind it, they've assumed 12%, but I'm hoping that the actual revenue collection is even higher, giving them more space to extend and spend more on the capex side.
Speaking of capex, and again, ladies and gentlemen, our reporters are working the field, and this is a story that my colleague Sapna Das has just broken. Remember the OMC, the capex for oil marketing companies of 30,000 crore rupees, it has been revised lower and it's been deferred to FY25. OMCs will raise funds after the 31st of March, so that's important as far as oil marketing companies are concerned. They will defer their fundraising plans to FY25. The interim budget has shifted the OMC capex to FY25, and OMCs have sought a lower capex of 15,368 crore rupees for FY24 versus the earlier budget aim of 30,000 crores. So that's as far as the oil marketing companies are concerned. And of course, lots of fine print coming in at this point in time. So gentlemen, on balance, before I let you go, CB, I'll start by asking you, sixth budget, she's created history, the second finance minister after Morarji Desai to do so. How would you sum up Nirmala Sitharaman's sixer?
So I think it was a good success. It crossed the stadium, if I can say in a way. But more seriously, I think I like the prudence, the prudent approach. No shocks. The entire feeling of a predictability, both in the taxation front, that was very important. And I really liked, and I repeat, going back, when you talk about manufacturing, capex, what I like is the focus that India is doing today on, say, biomanufacturing, which came in, the focus on EVs, and therefore one sees newer avenues of the way we encourage green manufacturing, and that's going to be a very, very important trend which is coming out of the budget as I was looking at it. And I see definitely a lot now that would need to be done is to take it to the states, and I think lot of work there because the states have got a great opportunity, being focused on agriculture, but it needs to be taken forward in a great way as far as states are concerned.
K. Subramaniam.
As I said in my first words, I'll repeat that: JNV, ambitious, non-populist, visionary, reflecting a confident, resurgent India.
Consistent, equitable, gives the right direction for the main budget.
Sanjeev?
I would go along with that, consistent and delivered on ticked all the boxes, and ticked all the important facets for building competitiveness, growth, also looked at inclusive growth, sustainability, and more importantly, again I will emphasize, has also touched upon the very important element of reform at the state. So all in all, an excellent budget.
Rajiv Memani, I'll give you the final say.
3 C's: credible, consistent, confident.
3 C's: credible, consistent, confident. We've got J and Y competing with the triple C's. J and B
I must mention, actually, for the first time, 3 C's are being used in a positive way.
That is true. That's true. Let's not go down that road. That's a whole other story. Gentlemen, appreciate you joining us here on CNBC TV 18 at the budget headquarters. And of course, we will look forward to seeing you again later through the day. But Sonia, the markets at this point in time slightly lower. The story on the Sensex.
It's actually very, very quiet. I think it's been a status quo budget largely, you'd have to say, and that's something that the market has taken in its stride and has perhaps moved on now. If you look at it, the Nifty is very, very flat. The mid-cap index is under a bit of pressure, down about 400 odd points. And, we have Rahul Arora joining in here, CEO of Nirmal Bang Equity. So I do want to get him on board. But just for the people who've joined in late, the one thing that stands out as a big positive is the glide path to get the fiscal deficit below 4.5% by FY26. That will continue, and the government is firmly committed to that particular fiscal glide path. So that's the big positive. But apart from that, it seems to be largely a status quo budget, if you'd have to call it that. In fact, no rural SOPs, etc. The government has resisted the temptation to go populist in a pre-election budget, which is always a good thing. But Rahul is here with us. Rahul, your key takeaways, and from a stock angle, anything that stands out for you?
In a very tacit sort of way, this is kind of an election budget. I think if you look at Manrega going up from 60 to 86,000 crores, directly targeted at rural, so that will be a benefit, and I assume the rollouts will be very soon. And the interesting part is that 1 crore taxpayers that had disputes outstanding up to 25,000 rupees, they're gone, just like that. So somewhere tacitly they have, it is a very soft touch at an election budget, if you will. And she's given the market what they wanted to hear on the fisc, right? So she's gone with 11% on capex. She's spoken about 4.5% by FY26. She's ensured that the bond market will be stable. I think the yield should probably be hovering between 6.9 to 7.1% for the better part of the year. As this allows the RBI to cut rates, depending on what the Fed does. So I was just talking to my economist and I said, okay, what's the view now? So she thinks there is a good chance of a 50 basis point rate cut in the next fiscal. And I think the Fed may act in accordance as well. Maybe they'll take the first move. But I think she's given the market what they wanted to hear. She's tacitly hinted at an election. And I think she's kept the larger buzzwords of, green energy, EVs and so on and so forth also intact.
Homes.
Absolutely. 2 crore homes. And that will obviously benefit the affordable housing and anyone that's, doing affordable housing. So, I mean, of course, you'll have to see how asset qualities and margins move. But, people immediately may get, excited about the Avases and the Aptuses and the Home First and the LIC housing finances of the world. But just on this, can you assume that all of these guys will grow at 20% plus? I don't know. But net, as she said in Hindi, in the next budget, she will lay the foundation for a Viksit Bharat. It'll be very interesting to see how they begin that journey. Because I think, Sonia, just in conclusion, I'd like to say, if you look at the last 10 years of this government, right, it's been a lot about regulation through DMON, GST, RERA, IBC, NCLT, bankruptcy, all of that. Then, of course, as any head of state, he had to contend with COVID. But then after COVID, he spent a lot of time balancing external sector, our relationships in the world. He's made a lot of trips across the world to secure relationships, right? And then the Ram Temple has opened. So I think if you look at from a macro standpoint, what could the next 5 years entail? It has to be about development. So I think the next budget could probably land up being the biggest and the best budget of this government that they have had since inception, because everything that he was voted to do in power over the last 10 years has been done. And there's nothing else to do but focus on the economy right now. So the big call to, ask is, can the Nifty potentially be at 50,000 by the time you go into the next election in 5 years, which is about a 15-16% compounded number, maybe a little higher than that. My sense is he's going to lay the foundation of that in July.
All right. Okay. Well put, Rahul. And we'll come back to you in just a bit. But there are so many individual names, right, which are moving, and the market is not doing very much. The Nifty Bank has, by the way, come off and given up pretty much all gains. And like we've seen over the last couple of days, it's not private banks, it's only public sector banks which are doing well. And why not? I mean, there is, of course, this mark-to-market and bond gains. But also, I mean, just look at third quarter earnings for PSU banks. There is potential for earnings upgrades. None of that for private sector banks, where there has been, at margin, more disappointments. So let's talk about some of these individual names. Aurobindo Pharma, for example, is one which is down sharply, I think recovered a little bit from the day's low. Sources say that its Unit 4 facility is being inspected by the US FDA. Ekta is here with details. Ekta.
Thanks for that. Well, yes, sharp reaction which is coming for Aurobindo, and the rumor is that the street seems to be concerned about this Unit 4, which is currently getting inspected by the US FDA. Now, my sources have told me that the inspection did begin last week, and there are some concerns that maybe it could probably not be going as well as what was anticipated, though that is not confirmed by the company. Now, this Unit 4 is an important plant for the company. I'll come to that in just a bit. It does manufacture injectables as well as ophthalmics, and is a part of the Eugia Specialities arm, which is basically the injectables arm of Aurobindo. This particular Unit 4 was transferred to Eugia in 2021 and was after that called Eugia 3, which is basically Unit 3. Now, it has around 105 drugs which are approved from the facility and 31 drugs which are pending for approval. So it's one of the most important facilities for Aurobindo when it comes to fresh filings as well as current drug approvals. We don't know the outcome. The company has given a clarification to the exchanges. They did not comment on our story specifically, but they did say that the US FDA inspection of Eugia 3 has not been concluded yet. They will inform the exchanges about the outcome once the inspection is completed. So let's see what the outcome of the inspection is and what the remediation pattern, if any, would be undertaken by the company.
All right, Ekta, thanks a lot for that. Well, Godrej Consumer is really one of the stocks of the day, 10% higher on the back of strong Q3 numbers. Mangalam is here to give us the fine print. Mangalam, over to you.
Well, it's a record-setting, move that we've seen in Godrej Consumer. Double-digit gains is what we're seeing. Impressive domestic results. And it's not that the street was caught off guard, because the company had given the third quarter update as well. But what really stood out this time around was a solid operational performance, sharp margin expansion. And of course, overall, year-on-year, the revenue optically looked lower because of the LATAM currency impact itself. So the revenue at 36,660 crores is actually better than street expectations. EBITDA 841 crores. The street was working with a number of just around 799 crores, and the net profit was above expectations as well. Domestic organic volume grew 5% versus a poll of 4 to 5%. And if you include the Raymond Consumer Care brands that the company acquired, volume growth was 12%, which again is best in class. Importantly, the company continued to spend on ads. And if you just take a look at the geographies and categories as well, in the key category, home care grew about 5%. But the two big positives are the new launches that the company has done. In household insecticides, a business which has not been doing too well for them, the company said they're on track and they've launched Goodnight Agarbatti in January. Now, earlier, in the insecticide space itself, a lot of the unorganized market share was going to the Agarbatti space, and in which Godrej launching this tells you that there is an increased total addressable market of close to 1,200 crores, in which they do have exclusivity to that molecule itself. They've also launched a disruptive Fab liquid detergent in South India at a disruptive price of close to around 99 rupees per litre. So all these things are doing well for Godrej Consumer, and the stock is understandably excited in today's trading session.
Okay, well, that's a big move, 7.5% on Godrej Consumer. Mangalam, thanks for that. Oil marketing companies' capital infusion of 30,000 crores has been revised lower, and there's also been a deferral to FY25. Sapna is here with more. This is the investment plan that they had. Sapna, over to you.
Yeah. So what we have understood is that basically it's oil marketing companies who had sought a lower amount. However, in the current financial itself, so 30,000 crores was the original allocation. Some around 15,000 crores had been sought. But, the companies have taken this call. So basically looking at their own cash flow projections and their own requirements, it now stands deferred to FY25. So that's why the capex has been shifted. The OMC capex has been shifted from this year to next year. And the companies companies will now go ahead with their fundraising plans only after March 31. So this is like basically to put these numbers into context and the timeline into context, because the numbers do look it's almost like 50. They're almost lower by 50-odd%. So the question does arise that was this a cut on by the government, or the industry feedback has come? So it's a combination of both, looking at the overall numbers and plus the requirements of the OMCs. Two aspects here: a, lower capex of 15,368 odd crores, and plus deferral in the fundraising plans, because this interim budget has now given that capex allocation shifted it to FY25.
Okay, thanks a lot for that, Sapna. Appreciate it. Well, fertilizer stocks are also on our radar. The stocks have actually slipped after the government has cut fertilizer subsidy by 13%. Sonal is here to decode the budget impact. Sonal, over to you.
Thank you so much for that. Well, there was an expectation that fertilizer subsidy would be cut because gas prices, remember, were lower. So that would have largely impacted the urea subsidy. But this time around, the NBS subsidy has seen a sharper cut. So the fertilizer subsidy overall is cut by 13%, after which urea subsidy is cut by 7.5%, while the complex or the NBS subsidy is cut by 25%. So IIFL has put out a note where they say that the NBS subsidy, it would be relevant to the likes of Coromandel International and other complex players, while the urea subsidy would be relevant for the likes of Chambal fertilizers. That one is down lesser than what we saw for complex fertilizers. Though the cut in allocation looks steep for NBS, and that is something which could impact the stocks like Coromandel International because of lower subsidy, they say that this could be taken negatively for such players. But they are saying that the government has been revising allocation through supplementary grants in a particular season, the Rabi season that is, if they think there is a shortfall. However, they see a downward revision this year amid the noise of increase in raw material prices dashes the hopes of industry, where they are expecting any upward revision to fertilizer subsidy as well. So all in all, the cut has been steeper than what the street was working with, and that's why the stocks which are in the complex fertilizer space, the likes of Chambal fertilizers, they could be negatively impacted.
All right, Sonal, thanks very much for that. Rahul is still with us. Rahul, I'm sure you've been in touch with your team as well. Anything they've picked up sectorally, bunch of stocks where there is an impact one way or the other, based on what we've heard?
No, I think it's going to be a lot PSU oriented is my sense. I think, of course, I'm sure you've discussed this 3 railway corridors as well and the impact, and we were discussing this in the morning as well. I think probably the best way to play any sort of infrastructure, Prashant, in India is cement. I think it's because of the cash flows. And I think those kind of cash flows can fund the capex themselves. I heard you talk about public sector banks. I think one of life's biggest mysteries for me is that SBI is an 18% ROE company, Bank of Baroda is a 16% ROE company, and they go at just 1.1. I'm not saying you need to give it an ICICI Bank kind of multiple, but do you need the discount to be so large? I mean, intuitively, if I reverse the question and ask you, is there one corporate that you can name today that's going to go bust in the next 1 year or 2 years? The situation is very different from where it was a decade back. Retail slippages thoda idhar-udhar ho jayega, by and large. Net interest margins maybe for a quarter or two. But logically, SBI and Bank of Baroda, according to me, should be at least 50% higher than where they are today. The entire PSU basket, whether it's railways, defense, across the board, have re-rated multiple times over. So I think that's probably something that one can look at. And lastly, I think because as Sonia was talking about affordable housing, I think the way to probably play it could potentially be through stocks like Kajaria. I think that's we like the tile segment, and I think there we do have an upside of almost 30-35% on that name. I think reasonable to assume a 14-15% kind of volume growth if these numbers are to come through. So I think probably that's one way to play home improvement in addition to the housing finance companies we spoke about. So I think those will probably be specific to this, but can these immediately react? I don't think so. It's just an announcement. It has to be implemented and then it will come into the numbers. But Prashant, I've always learned one thing after seeing cycles: focus on cash flows, focus on dividend yields, focus on growth. It'll stand you in good stead. I mean, your colleague was just talking about OMCs right now. I don't know how many people are aware. It's the only sector in India and probably one of the only sectors in the world where the free cash flow yield and the dividend yield is higher than the price to earnings multiple. Logically, the OMC should be multi-baggers from here theoretically, but obviously there's an overhang. But there's a lot to play. I mean, just because the Nifty is at 22,000 to say that, there's nothing to buy, I don't buy that.
Okay. By the way, the big story still remains what happened with Paytm, right? I mean, after that 20% circuit down. So I'm going to come to you in a bit. My colleague Ritu is standing by. In case you missed out on the news, you want to know what's the latest over there, Ritu is here to explain what this means, the impact, and what brokerages have said. There have been a slew of downgrades that have come in post this news flow, Ritu.
That's right. First, just to distinguish between the app you and I would be using on a daily basis, the Paytm app, which is owned by 197 Communications, that is unaffected, untouched. The restrictions have come in very much on Paytm Payment Bank, and with the restrictions that have come in from RBI, it is pretty much, the business is kind of shut, at least as of now. What RBI has said that Paytm Payment Bank must stop onboarding any new customers with immediate effect, and this action has been taken because of material supervisory concerns and repeated non-compliance with RBI directions over the last several months. In fact, since 2022, as we understand. So no further deposits, no credit transactions, no top-ups for wallets, no use of fast tags after the end of February, end of this month. By 15th March, of course, all the other, actions have to be wound up, whether it is, the nodal accounts of 197 Communication and Paytm Payment Services to be terminated and so on. But, in summary, no banking services can be offered. Now, why this action, stringent action on Paytm? And I'll take you back to March of 2022, which is when first RBI, stopped the bank from onboarding new customers because of deficiencies in their IT systems, in their KYC, risk monitoring, and so on and so forth. And now this circular does not even have a sunset clause where it says if you're able to satisfy certain compliance conditions, RBI will revoke this embargo. That is not mentioned at all. So, we'll have to see how this pans out. As far as the impact on customers is concerned, you can withdraw your balances or utilize your balance in your wallet, which, as per our sources, is not more than 3,000 to 4,000 crores of total deposits that is sitting with Paytm Payment Bank. As far as brokerages are concerned, you have the likes of Bernstein saying that, for all practical purposes, this ends the operations of Paytm Payments Bank, adds to the already heavy regulatory overhang, but there will be no immediate impact to the UPI payment business, which is the bulk of the business. Macquarie believes that these lapses are quite material, and it is indirectly revoking the PPI license of Paytm by imposing these restrictions. Jefferies believes that the direct impact can be 20 to 30% of EBITDA, which, by the way, Paytm has also said that the annual EBITDA impact will be about 300 to 500 crores because of these restrictions.
Okay, Ritu, thanks a lot for that. So that is the big headline of the day. Let's do one thing. Let's take a quick commercial break, but don't go anywhere. We'll continue with our coverage on the union budget, big takeaways, as well as the market. Market has clearly moved on. It's absolutely flat. The mid-cap index is under a bit of pressure, but the bank nifty has recovered in a big way. Lots of PSU banks are doing pretty well. Don't go anywhere. We'll come back in a bit.
So we got in, I think, around the 10.50 odd level, or perhaps a little lower than that. We got in at an attractive price. Why did we get in? ME Organics supplies intermediates to some of our larger pharma holdings. So, for example, ME Organics supplies intermediates to Divi's Lab, Divi's lab is the 5th largest maker of APIs in the world. Different part of AMI, the lithium-ion piece, that's a business based out of Noida. That's a business they acquired a couple of years ago. And looking at India's import-export data, we figured out that this is a very high margin that AMI is involved in. Basically, they're supplying stuff into the ecosystem, going not just into EVs, but also into the semiconductor ecosystem.
Welcome back. You're with us here on CNBC TV 18. We are starting closing bell half an hour early, and we got the entire closing bell team here. Rima, hi. Surabhi, hi. Nigel, welcome back.
Long haul, Prashant? Good going.
But it's, this is the definition of the interim budget, right? I mean, it's actually just, in a way, a hand-holding exercise until, of course, the big one comes through in the month of July. Markets have been very well-behaved, no real big volatility. They've been quiet. I mean, 15 points lower as we speak on the Nifty, 21,710. We'll discuss more market stocks, etc. in a bit here. But let me go straight across to Mr. Amitabh Kant, who is the G20 Sherpa and the former CEO of Niti Aayog, who is joining us with his reaction to the budget and what we've heard. Mr. Kant, good afternoon. Great to have you with us here, sir. Prashant this side. Your first thoughts, first impressions of what you've heard. Many were thinking that this is going to be, a full-fledged kind of a budget. I think that view was in the minority. Most thought this will be interim, and we've got exactly that. So I have two questions. One, do you think what we've heard will be continued through in the big budget in July, or will we see big changes? And two, what are your first thoughts on what we've heard? Capital expenditure, spending growth, and of course, the fiscal deficit and the consolidation we've seen there. Go on, sir.
So, Prashant, I think it's a budget by a government which is demonstrating confidence that it will come back. And also, it's a budget by a government which believes in fiscal discipline. So I was quite impressed by the fact that it's talking about fiscal deficit at 5.1% and then bringing it down, laying down a clear roadmap for 4.5% the subsequent year. And I think that's really critical because that would really mean that government will borrow less, interest rates should come down, the private sector should be able to access resources at a much lower rate of interest. We should be able to kickstart private sector investment in a much bigger way. I think those are all critical messages to be sent out, and I think this demonstrates a huge level of fiscal discipline. Also, the fact that, from 2013-14, from 1%, it has taken the capex to about 3.3%, and now this year to 3.4%. Now, government has done its bit in terms of capex spend, and my view on that is that we should now crowd in private sector investment into infrastructure as well. And that will be important because if you want productive efficiency in the economy, if you want good private-public partnership, if you want good operation, good design, good execution, you need to bring in private sector in a big way, and that's important in all sectors, including, we need private sector to come into areas like railways also. And I think that, to my mind, is a clear signal that government wants private sector to come in over a longer period of time. And the third is this clear messaging that which to my mind is very important, that if you want the country to grow at rapid rates, then you need the states to improve. And a lot of reforms now need to be driven by the states. So if you're putting in 75,000 crores saying that this is linked to reforms, and you are going to give money for infrastructure creation if you carry out reforms, it's a big message, and it's all milestone based. So it's incentivizing the states to push for reforms. And if the eastern part of India, which is talked about, if the eastern part of India can really avail of the 75,000 crores, they will really kickstart infrastructure in a big way. And I think the focus on the 1 lakh crore for R&D for the private sector, that will be critical. But, one point I want to make, which is about yesterday, the finance ministry reducing the duties on a vast range of items which are used for mobiles. Mobile manufacturing, a range of items, the duty rates have been brought down yesterday. And I think that will make India a very, very competitive in the global value chain, which is to make India a leading manufacturing nation for export of mobiles from India. And that is a good move to my mind. And so these are my few comments.
Mr. Kant, good afternoon, sir. Great to have you on the program. Just to press that point a little further, Atmanirbharta and manufacturing, make in India. I was speaking to, a couple of members of industry and the tax circles, and I think one surprise was that while the sunset dates on several, tax exemptions were increased, for instance, Gift City, etc., that all-important 15% concessional tax rate for new manufacturing units, that was actually not increased. So I just want your perspective on how we should read this. There's a lot of talk about Viksit Bharat, becoming a developed economy by 2047, but no specific new announcements or no big mention on manufacturing. I mean, schemes like PLI, etc. So is it just because it was a vote on account, and maybe we'll hear more big bang stuff in July? Is that how we should interpret this?
Yeah, I think you should wait for a long-term budget. This is an interim budget, and I think it's truly an interim budget. It's not the main budget, so I think you should wait for that. And that's why not too many giveaways in terms of taxes, etc. I think we should wait for the longer budget. Don't have too many, don't pin your too much hopes on too many policy announcements at this stage. This is a very good interim budget. This is an outstanding interim budget to my mind.
Absolutely, and very crisp, very short. And on a side note, we were planning for almost a 2-hour budget speech, so we had to change up as well. Mr. Kant,
so the speech was designed. The speech was truly designed for an interim budget, and I think it's done. It's hit all the right notes for an interim budget, and I think you should wait. You don't expect too much. Wait for the long-term budget, but I think as an interim budget, it's an outstanding budget.
And I absolutely agree with you. Mr. Kant, just to one quick point on divestment. It's come up again and again. I mean, I think the RE has been revised to 30,000 and the budgeted estimate is 50. this is as good a time as any. I mean, maybe the best time for the government to collect funds. And many in the market believe, well, will we see that in a big way? And why not in the first year of the new term? Yeah.
No, I totally agree that I'm a great believer that if the country's productive efficiency has to improve, if India has to grow at higher rates, and incidentally, my view on this, on the nominal growth rates, is that it's very moderate rates have been put into the interim budget, and probably we'll end up faring better. But my view on this is very clear, and I've been a long-term advocate of the fact, as the Prime Minister has been advocating that it's not the government's job to be in businesses, except a few areas. Government should disinvest, government should do asset monetization in a bigger way. All this helps to bring in private sector, and I'm a believer that private sector brings in greater productive efficiency in the long run. In the interim period of the last 3 to 4 years, government has created a lot of infrastructure, but it should, in a transparent, competitive manner, put it out for private sector to bid and do operation and maintenance. A lot of more disinvestment should kick in in the coming years, and that will bring in, because the government will get the right values. This is the best time to get the right values. Otherwise, and it'll bring in great efficiency into the economy in long term. If you have to look at a 2047 vision, it's very clear that private sector will have to play a far more critical role.
Mr. Kant, while in the speech there was a focus on women, youth and farmers, etc., and even the rural economy, but we haven't seen big measures which can boost consumption, particularly at the rural end, which some people in the market find surprising considering we are in an election year. How would you respond to that?
Well, I'm not a great believer in a consumer-led growth story. I'm a great believer in infrastructure-led growth story. It takes a little more time, but in the long run, that's what drives the economy. If you're looking at 2047, if you want to get into 9 to 10% growth rates over a long period of time, many countries of the world have done it. There are challenges in the global economy. But the only way for India to grow on a sustained basis is infrastructure, infrastructure, and infrastructure. And that will create rural demand. If you're going to create roads in rural areas, if you're going to put electric buses in rural areas, if you're going to provide rural houses, which the budget does, if you're going to do a rural solar rooftop, if you're going to provide piped water connection in rural areas, if you're going to do toilets in rural areas, whom will it benefit? It will benefit the rural population. It should all be infrastructure-led, which will create great consumer demand in due course. And that is how the country will grow in the long run. So don't get into this bogey of creating artificial consumer demand.
That's put forward forcefully, as always. Mr. Kant, just one last question from my side. You wear so many hats. You're so involved with the industry on so many in different industries, really. Will we see, private participation in infrastructure spending picking up in a big way? Can you see telltale signs of that? Your thoughts, sir?
I think post-election, you will see, after this government comes back, you will see a lot of more private sector. Private sector investment is going to kick in a big way. You can see all clear signals of that. And capacity utilization is at a good high. Interest rates will come down. There's good consumer demand. I only wish that the global scenario also improves, and you will see long-term private sector investment. We should put out many more roads, many more projects, well-structured, fully de-risked. After taking all approvals, we should put those SPVs out into the markets for private sector to bid for, and you will see good demand. Move over to a lot of more well-structured, well-cleared, well-defined infrastructure projects, and you will see very good bidding for those projects.
Okay. Mr. Kant, so then to wrap it up with final thoughts, I'm going back to what the finance minister was saying in the speech when she outlined some of the key priority, pillars for this government, for Prime Minister Modi, where she mentioned Garib, Mahila, Yuva, and the Annadata. As we look over to the concept of the Viksit Bharat, and she said that the next 5 years will be years of unprecedented growth, and that fills us with a lot of hope. How do you think the priorities will shift, if at all?
No, I've worked with this government for a very long time, and this government actually believes in inclusive growth. It believes in cutting across all segments. It doesn't, when you're implementing schemes on ground, and I did the aspirational district program with this government, it doesn't look at any particular section, it doesn't look at caste, it doesn't look at religion, it doesn't look at creed. It believes in saturating a scheme at the grassroots level. So if you're saturating all schemes at grassroots level, you're making a dent on poverty. And that's why, the multidimensional poverty index shows that 25 million people, such a vast segment of 25 crore people have got lifted above poverty line, because you've actually taken all the government schemes and actually saturated them at grassroots level. So the level of implementation has just been enormous. I mean, it's been phenomenal level of execution on ground at the grassroots level of all the central schemes, and that has made a difference to the lives of citizens. And I think we should continue to just do that. Have schemes which get fully implemented. And the power of digitization has really helped us. The benefit of that has been just enormous in terms of better quality implementation on ground, because the leakages have been very few now. I mean, there's just no leakage. Everything is reaching the actual beneficiary.
All right, Mr. Kant, we appreciate you joining in here on CNBC TV 18 and giving us your first thoughts on the budget. Looking forward to chatting up with you rather soon.
Thank you.
Well, for the markets as we speak, we are trading at more or less the flat line, mildly move into the green. That's because a couple of big names have moved up. Reliance Industries has moved to the high point of the day, so I think you'd like to get that stock back up. It moved into the green, now it's recovered a little bit, and that's a big weight in there. Adani Enterprises as well, smashing it out of the park. In the last few minutes, you have Adani Enterprises that's just taken off. That's moved to the high point of the day, and Adani Ports as well is seeing a bit of a pep up as we speak. Shiv Puri, founder and managing director at TVF Capital Advisors, joins us on the show. Hi Shiv, good afternoon. Thanks so much for joining in. Well, I wanted your first thoughts on the budget. At the start of today, people were saying, let's see if there is something for the rural economy to pep it up. And also the eye was on capex spends. What is your first thoughts on what we've heard?
I think the first thoughts are really fiscal discipline, which we have seen across heard from other people across the board. I mean, it's interesting. We're moving from a glide path of, say, 5.7, 5.8% to 5.1, and the U.S. fiscal deficit's at 6.4. The roles have reversed, and I think this is a budget that really shows fiscal discipline at the moment. That's India is going to be hopefully in the JP Morgan bond index by July. That's the expectation. So if you've got fiscal discipline, you've got the ability to attract foreign capital into the bond market, that is going to bode well for domestic, for liquidity and for the currency. So I think the macro is in really good shape. The other highlight, of course, is on capex. While the number's up, I think about 11%, it's actually up a lot over a 2-year basis. Maybe 45 or 50%. Is the number for the last 2 years. So there's a major focus out there, and of course that has ripple down effects onto many industries in India. Rural spend is up, but I think that is much needed, and we all know the rural economy is a little soft. So perhaps something a little bit more happening on that front would be nice to see, I guess, when the full budget is presented in July.
No, absolutely. Shiv, hi, good afternoon. And every time I see you, you look younger. I don't know what the secret is. Congratulations.
Thank you.
Shiv, I don't think we've spoken after that entire HDFC Bank sort of saga played out post-earnings. Financials is your #1 bet, has been for years. How do you read this entire thing on HDFC Bank? And do you think this is a great opportunity for those who want to buy?
Well, first, let's start with the industry. It's quite clear that we have a liquidity crunch in the market. I think the shortfall is something to the order of 45 to 50,000 crores. So therefore, deposits the rates have gone up, and at the same time, you're going to see the NIM pressure is therefore clearly there. At the same time, you saw over-provisioning during COVID, and so NPAs were artificially low, and that is going to course correct and come to a more normal cycle. So I think temporarily, you're seeing across banks slight NIM pressure, as well as slight increase in NPAs. Banks are in pristine condition. It's just the base was really low. So that's applicable to all banks. I think specifically with HDFC, the issue has been around the merger. And pre-merger, there was the expectation that the earnings would be accretive, that the NIMs would remain steady. But it seems that along the way, once they've actually presented the combined company, there's been pressure on both those fronts. I don't think that is something that is structural. I think it's an issue that will get fixed over the next few quarters.
So Shiv, you would be looking to buy into HDFC Bank at current reckoning and current valuations?
Not making any recommendation on any specific stocks, but what I would say is with respect to HDFC, as you see, that there is pressure which is very cyclical in nature. There is no structural issue that is there, I think, with the bank long term.
Shiv, would you bet on more interest rate cuts by the Reserve Bank of India based on what we've seen, the lower gross borrowing by the government, the decline that we've seen in the 10-year bond yield? And if that's the case, do interest rate sensitives, apart from financials, which you spoke about, do they make an attractive bet? I want to know what has changed for you in the last 24 hours with this budget.
Well, I think along with the budget, also you're seeing global interest rates that are softening. That's happening over the last couple of months. I mean, the Fed didn't cut rates yesterday, but if you look at the 1-year rate, the 3 and the 5-year, even the 10-year treasuries, they've all softened quite a bit. The 10-year has gone from 5 to 4%. So clearly the trajectory is for lower interest rates globally. Inflation is coming down globally. In India, we're seeing the same thing. Inflation is within the band. My sense is that the RBI is a little cautious on what's happened on certain segments of retail lending, as well as that inflation is still on people's mind, front and center. But as that recedes, I think interest rates are only going to head lower. And like you said, with the fiscal deficit at 5.1% of GDP, if we do manage to get to that number, that's an incredibly strong fiscal position to be in for monetary policy to ease.
So, Shiv, then sort of putting all these things together, really let's talk about the overall positioning for anybody who's interested in Indian equities, right? We are heading into an election year, and as we were just discussing earlier, we'll probably get a better sense of bigger policy announcements or anything more big bang, in the second half of the year. So therefore, given where we are, where valuations are, the banking issues that we've already discussed, what should the stance be, or what would your stance be on equities in the foreseeable future?
I think the backdrop for equities continues to be very constructive. And there are a few reasons for that. One, of course, is overall economic growth. You're seeing that to be pretty strong. India will this year undoubtedly be, again, the largest, the fastest growing large economy in the world. Therefore, you see it'll attract not only domestic capital, which we're seeing, but also foreign capital. Second, there is a push on very productive uses of capital within India, which is infrastructure and capex. Third, you are sensing from entrepreneurs increased optimism in doing capex and expanding capacity in the manufacturing sector. And fourth, you're seeing consumption increase, whether it's in domestic travel, healthcare, and other services. So when you put all of that together, along with the fact that you will see global interest rates declining and likely, therefore, a weaker dollar, that bodes very well for the Indian equity market. So I continue to remain constructive.
Shiv, just to wrap it up, you like financials. I remember you liked hospitals as a space. Just what else as themes?
Financials, you have healthcare services, which is hospitals, consumer, which is not only just FMCG, but consumer services. I think these are the three big areas. Manufacturing selectively, I'm not sure sold on the China plus one just yet. There are some pockets of beneficiaries, but there are some really incredible manufacturing companies in India. I would say these will be the few themes that we look at this year.
Shiv, you mentioned consumer services. I have to ask you if you could elaborate. I mean, are you talking things like hospitality, tourism, or what exactly do you mean by consumer services?
Yeah, hospitality and tourism as one area. I mean, I think what you're seeing happen is also quite interesting, where, you know, you saw this over the last decade, where a lot of people in China, when they got wealth of a certain level, started traveling the world and spending money across the world. And that's changed in the last couple of years. But as India hits that phase of GDP per capita, this might be a little different. You know, we might choose to travel within the country and spend a lot of money within the country. And therefore, I think the benefit of that to the whole sector can be very structural in nature.
Shiv, we leave the conversation here for now. Thank you very much for joining in. We will slip into a very short break on that note. On the other side, we'll be joined by Nilesh Shah of Envision Capital and Dharmesh Mehta of Capital Advisors to talk more about the markets. Shireen will also be joining in with a whole host of guests.
We think three segments, mainly roads, airports, and what they call a new energy ecosystem, are currently worth more than what all of Adani Enterprises is valued at right now. The segment that I'm probably most positive on, I would say within 5 years, is probably airports. This is a segment I think can do $1 billion plus of EBITDA within 3 or 4 years. Close comps are trading at 20 times that, so you could see within 3 or 4 years, Adani Enterprise look to demerge that business at a value close to 20 to 25 billion, and Adani's Enterprise's current market cap is just 40 billion. Beyond that, you look at new energy ecosystem, which includes solar manufacturing, wind turbine manufacturing, and then there are plans for green hydrogen ecosystem. That green hydrogen ecosystem, which actually is not in our current valuation, is something that could, within 10 years, do, call it $7 billion of EBITDA. Here you're getting airports, your roads, renewable energy, called old energy or fossil fuels, with what they do with mining and call it commodity trading. So it's call it a diversified play on India, but with leadership that I think has proven success of growing above market rates. I do think that has been a hindrance. I think some of that has been the lack of institutional coverage on the Adani Group. There's not many analysts out there writing research on it, which, when we first kind of stumbled upon it, was a bit surprising, given I think it's the 10th largest non-financial stock in India, which is, now the most populous country in the world. So I do think that's a bit surprising in terms of feedback we got. We thought interest was very good.
The fundamentals piece has been
Welcome back. Adani Enterprises is surging after reporting their numbers. The net profit is more than doubled to 1,800 crore, which compares with a number a little less than 900 crore rupees. So 1,888 on the bottom line. The EBITDA too for the company has gone up 98% and the stock has moved up. Reliance Industries too is seeing some buying. On the way down, L&T continues to struggle. I think since the start of the day, or at least in the last 2 hours, it's been the top Nifty loser. Following yesterday's 4% cut, we've got another 2.5% gone in that. Nilesh Shah, MD and CEO of Envision Capital, is now with us on the show. Nilesh, before we get to the budget and the nitty-gritties, Paytm, just the way the RBI has relentlessly come after. I'm not sure if that's the right way to put it, but it's just that it's been, a lot of bad news for Paytm, and now particularly this latest one on Payments Bank. How would you read it?
Yeah, so I think the series of bad news just doesn't seem to be stopping for Paytm. I think the
The regulatory challenges probably started maybe more than a year back, and it's been kind of been there very periodically. And I think this time it's probably the most damning one. I wouldn't say it's an existential crisis, but it surely is a very big challenge. And it could take some time for them to kind of overcome this challenge.
So if someone holds Paytm shares, if there is an possibility of an existential crisis, would you recommend selling out if they get a chance?
See, I think the stock price is surely going to head a lot lower, undoubtedly. And the reason for that is because these are growth stocks. They're not even growth stocks. Expectation are these are hyper growth stocks. I think right now hyper growth is ruled out. Growth is ruled out for the foreseeable future. You're not talking about whether you are in a position to even hold your base, hold your core. I think that's really where the big challenge or the big vulnerability is. So I think the case to own it for now doesn't seem to be there. And I think it's the first day of the bad news for them. This is something which could linger for some more time. And in this kind of a situation, even if it takes, say, another month for them to sort it out, a month can be a very long period of time.
3:30, by the way, there is a conference call.
Yes.
And we'll hear from maybe Vijay Shekhar Sharma, Madhur, etc. will be on the call and they will take questions. Wonder if that can do anything to, because the RBI circular is so damning in that sense, right? I don't know how much they can do. But instances like this, I mean, I'm going off a tangent also bring up the old topic of circuits, right? But there's no exit. I mean, if you, as Rima was saying, if you own shares, you just wait and try at 9:15 in the morning. And but as you said, it perhaps could head a lot lower.
Yeah, I think that's a challenge, and I think unless a stock is not in the futures and options stock thing, I mean, once it hits the circuit, lower circuit, you obviously don't have the exit, and that's the challenge. Maybe if this situation happened maybe a year or two later, when it was part of F&O or maybe part of an index, then this situation would not have been there. But that's what it is, and I think this whole circuit system, whether we like it or not, it's been working well for our capital markets, our equity markets. I've seen this for the last 10, 20 years, and I think, it has its positive, it has its own set of challenges.
Nilesh, okay, let's talk about the one set of stocks that's cooling off finally a little bit, and I'm talking about PSUs now. I don't know what to call it. I mean, after a 200% rally, you get a 2%, 3% cool off. You know, how would you approach this part of the market, considering that, you know, this interim budget is out of the way, but then you have July, and then you need to see what comes forward in terms of more policy continuity. Even today, there was some mention on railways, but no major, you know, capex numbers thrown around. What would you do with PSUs now?
So I think for now, the valuations surely look challenging. They definitely look overstretched. Okay, leave aside the PSU banks, because this budget is done a lot of good to them. The whole path to fiscal consolidation, a significantly lower fiscal deficit estimate for next year, obviously is cooling off bond yields and driving up bond prices, which is good for PSU banks. But outside of PSU banks, I think most PSUs right now look very richly valued. They have gone up quite significantly. They're getting priced in like growth stocks, and they no longer represent the kind of value which they represented 2 or 3 years ago. So I clearly think for now, while there might be a structural change to them and they might end up becoming much bigger enterprises in the next 5 to 10 years, but I think a cool-off is warranted in them. I'm not saying a very severe sell-off, but a cool-off is surely warranted, and maybe wait for better or lower prices to get into them.
You know, just on that, a follow-up. Now, once the election is out of the way, one is waiting to see if this, divestment really starts taking off. And Prashant was also discussing this with our earlier guest, that this is as good a time as ever, right? And I don't know why they waited, but they have, maybe elections. As and when those OFSs start hitting the market, could it really puncture the whole PSU move? I mean, is that a risk that we're kind of walking towards? Or do you think the market will treat the divestment and digest it quite well, actually?
Yeah, I think it will treat it well. See, I clearly think right now, I mean, 2 years back or 3 years back, some of these OFSs were being looked upon as basically capital raising exercises. Today, the government's finances are not as constrained, and so they are not getting perceived as capital raising exercises. If at all, mutual funds or some of the institutional investors who are getting fresh liquidity, they're looking at this as an opportunity to be able to park that liquidity and buy into them. So the whole negative narrative has now become actually a positive narrative. and a more free float, which means the chances of getting into market indices, having a higher weight. So that's now that's how the narrative is now playing out.
OFS is no longer bad.
It's no longer a bad word. It's no longer a bad word.
You know, it's a stark contrast to what we should see a few years back, right? And OFS is announced, you have LIC coming and picking up bulk of that, and after some time the stock starts trickling down.
Yeah.
Case in point being in NHPC. You know, they didn't, government took some money off the table. In the last 10 days or so, the stock is up, what, 15-20% or even more than that. So the entire perception actually has changed. And also, if you look at, you know, companies like Concord, IDBI, yes, we're waiting for the divestment to take place, but the stock price is still at the 52-week high. That's telling you the kind of interest in some of these names. Just thought we'll put that point on board.
Yeah. And one more thing, I think, is also some of these PSUs are in sectors which have become the flavor of the season. So 2, 3, 4 years back, nobody wanted to buy energy stocks. Renewables was pretty much unheard of. Today, when you talk of names like NHPC or some of the other PSUs, they are part of emerging themes. Whether you call this as energy transition or renewables or any of the other, they've become clearly the flavor of the season, and that's also what is attracting investor interest into them. And they seem to be meaningful players. I mean, whether you look at NTPC and you speak to most investors, they really don't talk about it as now a thermal energy company. They are talking more about their initiatives of investing in renewables, the green energy, and all of that. Versus that 2, 3 years back, they were supposed to be, you know, guys who are probably spoiling the environment.
Indeed, and I pity those who said touch me not, you know, for some of these companies, because you missed on the biggest rally possibly. Now let's just hold that thought. You know, let's get in Dharmesh Mehta as well, Managing Director and CEO at DAM Capital, who joins us on the show. Hi Dharmesh, good to speak to you. Would like to speak to you more often though, but on the big day you join us. Tell us, what are your first thoughts with regard to Budget 2024 that was just announced?
Hi Nigel and the team, how are you? Well, this was a non-event in that sense because nobody expected the budget to finish so fast. Everybody was, you know, surprised, including you guys, saying what happened suddenly. That we have the shortest interim budget ever. And I think so, you know, the economy is in such a good shape. You don't need to tinker around too much any which way. So I think it was the most ideal time for a short budget and not to tinker on anything, especially in the interim, and wait for the elections to get over and then come with the full and final budget.
Okay. Dharmesh, hi, good afternoon. You know, you look at a lot of the deal action, the primary market action so carefully. And that's what I want to ask you about, because we heard some noises today and we'll probably hear more on a lot of the sunrise sectors, right? AI, digital and things like that. As more announcements come through, what is that entire ecosystem telling you in terms of primary market offerings? What are the valuation, what's the valuation chatter like? And what should we prepare for in terms of new paper hitting the market as we roll on beyond the election season?
I would say it is still too early for these companies to hit the primary markets. There will be more private markets which will absorb this paper first. And as you see in the tech companies also, you know, people took a lot of time to understand those tech companies, and even now they're struggling with the valuation. So I believe the sunrise sector is still a little far away for the primary market as of today.
Dharmesh, hi, afternoon. What about, you know, stake sales in PSU companies, government companies? Will we see a big year for that in 2024?
I would say it's the ideal time because there is enough demand in the market, and as I always say, supply brings demand, not the other way around. So if they intend to sell them, I think so, those, you know, sales will go like hotcake. But, you know, if I'm a government, I will also see what is the need of the money as of today. And these companies are going to do actually better day by day the way things are shaping up. So there's no rush to sell because you've seen the valuations have actually moved up substantially in the last few years. So they'll take their time to sell it down rather than just sell it because, you know, markets are hot. I believe these companies are on a good growth path and the government will be very sensible to sell them not too early.
And I think the sense also is that some of these valuations are not fleeting, right? I mean, there's no, maybe in some cases there is, so I can't say that for all, but smaller, but very few. Generally, the larger ones, I mean, there is a growth story. The company is actually doing well. Actually, we were just discussing earlier with someone that if you look at the third quarter earnings season, it's the public sector banks which will perhaps see earnings upgrades. Private banks have all at the margin, you know, disappointed a little bit here and there. Dharmesh, how's the market itself looking to you from here?
I think so. It's a tough market if you look at, because valuations are not cheap. But if I look at the large caps, they're actually very reasonable. My Nifty P is not at the highest or we've seen or it's crazy. I think the valuations are reasonable on the large caps. And I believe that's what's going to drive the FI flows this year. And they actually come to India because they missed out India last year, as you know. And the China story is not looking great as we speak. There's no other option to actually come to India. So, and the large caps are reasonably valued, not overvalued. So you'll see a lot of FDI and FI money still coming in this country over a period of 1 year. Small caps have the exuberance, but those are high risk stocks which people know when they invest in. But are we looking at some catastrophe, or you're talking about some large scale sell-off? It doesn't look like as of now. Even in the mid-cap segments, you'll have your regular correction of 20-25%, or not some real scare, which generally we see sometimes.
Dharmesh, there are 8 strategic divestments which are currently in various stages. You've got IDBI Bank, BEML, Shipping Corp, and then some others, on the unlisted side like Ferro Scrap Nigam. And the government is also yet to seek expressions of interest for Container Corp. So amongst these, which ones do you think will move the fastest?
I'd not like to name few of them, but I'm very sure if government is out to sell strategically, many of them will see very strong interest and in fact good valuations. I believe there's a lot of value to be made in PSU stocks. So as and when people buy strategically versus financially, there's humongous amount of money which you make strategically. So I won't be surprised if you see a lot of strategic investors coming in those names.
By the way,
few months will be difficult as we see the banks or something, but the rest of them actually should get very strong interest.
Since we're on the subject of PSU stocks, I thought I'll pick out some names. I mean, look at the way these moves are happening in an ITDC, Indian Tourism Development Corporation, surging 17% right now. There's a Hoodco, which is up about 15-odd%. Then, of course, there are banks, the PSU banks, which are up and about. There's also NBCC, which is having a great afternoon, about 5% higher. So while some of the PSUs on the railway side are seeing a little bit of a cool-off, and you've got new names surging on the screen really there, up and away. So Dharmesh, we were discussing primary market action. You said that, okay, wait up on the new sunrise themes of AI, etc., or maybe even energy transition. So, what else? Again, going back to that question, will it be sort of any specific theme? Are you seeing a lot of buzz? For instance, we've had some defense companies come out. We've had the whole EMS space very, very active. What do you see on the horizon in terms of primary market action as we go on through the year, in the foreseeable future at least?
See, we were the first in the EMS space, and we still continue. That space is going to see a lot more demand coming in. The kind of growth opportunity which you see in EMS, you're going to attract a lot of capital. So I think so the EMS party continues for some more time. Valuations may correct a little bit, but I think that there's going to be strong interest in EMS and manufacturing as a whole. So I think so that strategy still continues. And you're going to see a lot of consumer companies also coming in slowly, and you're going to get some kind of, IPOs coming in that space. Anything related to defense, railways is hot cake right now. So those are getting sold like, very, very fast. But I think so you're going to see a lot of paper coming in the market. So the only thing is there's infinite amount of paper coming to the market. So one has to be a little cautious on this. But if they are priced rightly, I think so there is enough demand today. If you look at mutual funds, they're getting almost 17,000 crores SIP every month. So they have to invest that money, and they are the ones who are actually going to slowly load up those IPOs which come at a reasonable valuation.
Okay, all right, Dharmesh, good to hear that. On that optimistic and positive note, we'll thank you for joining in and giving us your first thoughts in terms of the budget as well as the outlook on market. Wishing you a good rest of the day. But let's get in Timsy now. She joins us to give us more details on the new direct tax scheme. Timsy?
Well, as you rightly mentioned, the new direct tax scheme, something that found a special mention in PM's address, and Finance Minister Nirmala Sitharaman also said categorically about. It's about stability, tax stability and ease of doing business. That's what the aim is, and this time the idea is to give benefit to the taxpayers who've been paying taxes, and that's what the government said, that they will withdraw old, petty, non-verified, non-reconciled or disputed outstanding direct tax demands. Now, this was at the lowest strata, and about 1 crore taxpayers, that's what they are looking to address to. 1 crore taxpayers will get the benefit. Now, what will be the withdrawals for? The withdrawal of demand will be for up to 25,000 rupees pertaining to the period of up to FY 2009-10. And when it comes to the other demand withdrawal, up to 10,000 rupees for financial year 2010-11 till 2014-15. The scheme to benefit around 1 crore taxpayers And yes, the aim being scheme to ensure ease of living and ease of doing business. So 1 crore taxpayers will get this boost, will get this benefit of non-verified, non-reconciled and disputed demands, outstanding direct tax demands. That's what the government is looking at addressing.
Okay, all right, Timsy, thank you very much for that. Guys, anybody has any outstanding tax issues with the tax? Some good news, huh? If there are old legacy ones, I'll go and check up just in case.
Actually, I know, but I think it doesn't fall in the
that
up
threshold.
to that.
It's pre-2010. Basically, if the tax dispute was 25,000 up to 25,000.
Pre-2010 to 14 is 10,000.
Your disputes must be around 2, 3, 4, 5 lakhs. Nothing less than that.
Pre-2010. No, it is a real pain. So in that sense, it's a great move, right? It's a big irritant. It causes anxiety and all kinds of things. So withdrawing some of this, really good.
And absolutely, I mean, it's pretty much in line with the ease of living kind of thing. So I think it's good. It's good that at least some of these small old irritants, which are large in number, I think are just kind of eliminated. I think it's a big positive.
I just wanted to get your thoughts in again on this capex number. So one of the big drivers for the PSU stocks was this large capex spend of 35% last year. And that drove very strong order wins. The order book was swelling, and therefore the market was giving their expected earnings multiple, earnings growth and multiple going ahead. Now, if that growth rate of spend is going to come down from 35% to 11%, will that not slow down the kind of order wins we're going to see for some of these, PSU companies, and therefore will it hurt the earnings expectations?
So I think, Rima, it's got a bit to do with the change in reality. 3-4 years back, nobody wanted to actually invest in infrastructure or lend to infrastructure projects. That was pretty much a no-go area, and therefore clearly it had to be the government which had to step in as the anchor investor, as the anchor lender, and come in and therefore allocate more money from the budget to the sector. In the last 3 to 4 years, infrastructure now has become no longer the kind of no-go area, and now private capital is willing to come in, either through equity investment or through lending. Also, you're going to see foreign capital come in as the Indian bonds become part of the indices, all of that. So now probably the government is trying to pass on the baton to the private sector, saying is that, look, you guys can now come in and lend or invest. And therefore, the need for government to kind of now incrementally allocate that much capital may not be there. Keep in mind, 11% still is a very large number on a base which has probably gone more than 2x over the last 4 years. And secondly, as a percentage of GDP, that number still is 3.4% versus 3.3%. That 3.4% is like at a historic high. I mean, many years back, that number was sub 2%. So these numbers are huge. So to that extent, I think it's still kind of, it's par for the course.
On the point of capex, sorry, just to come in over here, since Rima asked that question, we had Mr. Amitabh Kant on the show just a while back, and he was, constantly making that point that it's time for the crowding in of the private sector.
Yes.
Haven't seen too much sign of that as yet. Your thoughts on this, Nilesh?
So private capex, yes, it's still not yet picking up. Though, of course, the government had reduced the tax rate for manufacturing companies maybe 5 years back so that they could basically be incentivized to come in and expand capacity and set up new units. That has probably not happened to the extent that it may have been desired. But that's because the capacity utilization was trending below long-term averages. Now that is trending above long-term averages. So I think probably, again, it might just be a matter of a few months before the private sector comes in with its own share of capex. But otherwise, still that doesn't happen. I still think the economy will have to rest on this pillar of public sector capex.
Okay, all right, Nilesh, we appreciate you coming down to the studio. Thanks so much for joining this afternoon. Looking forward to chatting up with you rather soon. Well, for the time being, let's turn our attention to one of the top sectors of the day, the PSU banking names. They're doing very, very well after the government stuck to fiscal prudence, and that's what's caused bond yields to cool off as well, which in turn will result in treasury gains to PSU banks. Abhishek joins us to fill us in with a quick analysis on that. Abhishek?
As you mentioned, fiscal prudence will aid in GSEC yields to soften. I've been speaking to various analyst estimates and to certain treasurers as well. They say that there are good chances of, bond yield or 10-year GSEC cooling off by anywhere between 50 to 100 basis points is what the range they have given me. So this positive news for PSU banks that FY24 budget deficit target is at 5.8% of GDP, FY25 is at 5.1% of GDP, and target is to reduce the fiscal deficit to below 4.5% by FY26. So prudent fiscal targets will aid in decline of 10-year GSEC yields as well. Gross and net market borrowing through securities for FY25 is estimated at rupees 14.1 lakh crore and rupees 11.75 lakh crore respectively. Now FY24 RE gross market borrowings is at rupees 15.43 lakh crore. So lower borrowings can also aid in bond yields softening down, and this can help the treasury profits of the entire PSU pack who have GSEC securities in their portfolio, especially in the available for sale category. Back to you.
All right, Abhishek, thanks very much for that. I mean, that's a sector which is doing well, and the PSU Nifty PSU Bank Index is it was up 3. It sold off about 1.5%. It's back up, I think, almost a full 3%, 2.93 or so. We'll take a very quick commercial break here. On the other side, we'll be joined by Sandeep Bhatia of Macquarie. Devin Choksi will also be with us, and Gautam Trivedi of Nepean Capital will come in as well. Focus stays, of course, markets last 40 minutes of trade coming up.
Because I don't think anybody watching this show needs to be reassured on HDFC Bank's fundamentals. It's been 20% loan book growth for many, many years. Over the last 6 months, over the last 6 years, take any horizon, this bank has pulled market share at a rate not seen in Indian banking. No other private sector bank, even in the current fiscal, no other private sector or public sector bank has come close to matching the rate at which HDFC Bank has pulled market share. For the last 5 years, the price to book has come off from, I think, 4.5 down to now 2 almost. This is trading at the lowest price to book it's ever traded at. And therefore, that's why in the last 6 months, we increased the position size quite sharply in HDFC Bank.
बंद करूं? अरे ये नहीं छाता बंद कर दो यार छाता पीछे कर दो क्या कर
Welcome back. Well, we're going through budget announcements one by one, and now let's look at railways. It seems the capex announcements have kind of disappointed the street a little bit, or perhaps it's just become an excuse for profit-taking after a surge of 200, 300, 350% on a lot of these stocks. We have Hormaz joining in with the latest. So Hormaz, little bit of red today, right?
Absolutely, a little bit, as you can say. It's not a 5-6% kind of a cut, but a 2 to 3% cut. And as we can call it with the railway stocks, they are kind of sulking at the moment because of the capex announcements, as you mentioned. So IRFC, RVNL, IRCON, RailTel, all of them are trading lower between 2 to 3% after the FM speech. And the capex announcements that were made today, they may have disappointed the street because 2.52 lakh crore were allocated to the Ministry of Railways. That was higher than the 2.4 crore number last year, but not as high as the street was anticipating, because this is around about 5% growth compared to last year, but the street was anticipating somewhere between 10% on a conservative basis. And brokerages like Nirmal Bang also said that railways should get a higher share of the capital allocation that the FM makes in this interim budget. Now, some of the other announcements made by the minister during the budget speech were the 3 new railway corridors that she has announced. And those 3 corridors are the energy, mineral and cement corridor, the port connectivity corridor, and the high density traffic corridor, which according to the finance minister will improve efficiency and also reduce logistics cost, thereby accelerating the country's GDP. And the other announcement that they made were around 40,000 ordinary bogies that would be converted onto Vande Bharat standards for the safety and convenience of passengers. So not extremely big bang announcements, but which is kind of expected considering it was the interim budget and not a full-fledged budget. But as you said, that the stocks having had a run like that, having gone up 100%, 200, 300%, and with RVNL and IRFC in particular, they were up 70% in January itself. So a little bit of profit taking, not unsurprising, but par for the course, as you can call it.
Okay, all right, Hormaz. It seems some of these railway companies, looks like they missed a couple of stations. They zoomed ahead, and now, in fact, they're just catching up because the way these stocks have run up in the last year or so. Well, before we move on, just want to pull up the Maruti stock. Those numbers look quite good. They almost clocked 200,000 units in a single month. That's a big growth if you look at it on a year-on-year basis. It's close to around 15% growth on a year-on-year basis, so that's looking quite good. Exports on a low base were very strong, though. That's up close to around 37%, and domestic sales as well, up in the early teens, up close to around 13%. That explains why Maruti now is one of the biggest gainers, speeding away as we speak. But let's welcome our next panel. We have Sandeep Bhatia of Macquarie, Deven Chauksi, as well as Gautam Trivedi of Nepean Capital, who joins us on the show. Good afternoon, gentlemen, and thanks so much for joining in. Well, Gautam, let me put this question across to you. And my colleague Hormaz was just talking about these railway stocks flying away. And maybe, in fact, now they're a little bit disappointed because we were prepared for an interim budget, but maybe the street was hoping for something more. What's your view on this entire railway as well as defense theme? Because both those two pockets are a little bit soft today, though they've seen a big run in the last 12 to 18 months.
Well, I think to your point, Nigel, the run in the last 12 to 18 months itself has played out very well, and it's factoring in a lot of more. I think I would say factoring in as much as FY26 into the numbers in terms of the way these stocks have run up. So I think given the fact that, yes, I think that the push from the government for both these sectors still remains very strong. But the fact is, I think profit booking at some point was necessary. And I think that's exactly what's happening. Nothing has otherwise significantly changed from an order standpoint, at least not in the budget.
Sandeep, the question for you is that is there anything in the budget which changes your investment narrative? Would you be making any changes in your portfolio, weightages up, weightages down, in, out, based on what we've heard?
I think this budget essentially gives me the message that India is in a long-term growth path with actually lower interest rates than would be for most Western countries. The consolidation in the fiscal deficit consolidation is a very good thing, and India has been on this path for at least 3 years. India did a lot of right things, especially post-COVID, because we didn't spend as much. The US, the largest economy in the world, is actually cranking up a fiscal deficit. It is not able to control its inflation as much. India, on the other hand, has controlled fiscal deficit and continues to be the largest large economy, which is the fastest growing economy. If you look at this just 3 years, if you project this 3 years on, assuming the same kind of policies continue, after the elections, India's entire consumption, durable, banking sector will all be for a massive positive benefit. We've seen some benefit come through in Maruti, in autos. Interest rates will continue to trend down. There would definitely be, therefore, better lending. Corporates will also benefit. Currency will remain stable. So I think it actually shows you what can be done if we have a stable policy, and that continues for the next 3 to 5 years, which I hope will happen.
All right. Hi, Sandeep. Good afternoon. Nigel on this side. You know, the street was bracing for this mid-teens earnings growth. Suddenly it appears some of these banking names a little bit under pressure. Could be just in the near term. Not a big structural change. But give and take everything that we've seen from the banking names, is that earnings growth at risk that we are factoring in for FY25?
I think near-term earnings growth will be at risk. I think there was a lot of anticipation that this kind of positive cycle will continue. I think there's been a bit of a hiccup there. But if this fiscal deficit consolidation cycle continues, I think public sector banks are the largest beneficiaries. SBI is a beneficiary there. The private sector banks, I think they may not be as clearly a beneficiary as the public sector banks, because most people think the public sector banks are very short cycle. So the benefit to the public sector banks potentially is higher, because this could be a longer cycle benefit for public sector banks.
You know, I want to extend this debate around banks with the rest of the panel as well. So let me bring in Deven. Deven, good afternoon. Good to have you on the show too. So initial thoughts, of course, I mean, on the interim budget or any specific takeaways. And then really the question to both you and to Gautam, because I think this banking dilemma is the immediate sort of issue before the market in the near term right now. And I want to get both of your sort of comments and thoughts on this, and whether this is just a passing phase, whether we're making too much of it, or whether this could become a bit of a slightly more important hiccup that the market can't ignore. Deven? Deven, I think you're on mute.
Okay,
I think while we fix that, Gautam, let me take that question to you in the meantime. You know, banks, and really, I don't think the street was prepared for any kind of sort of disruption at the end of the third quarter. Maybe just some minor compression on margins, but what we've got are bigger questions than that. How do you see it?
Fair question you raised, given the fact that I think the government still, you know, whether we like it or not, seems to be still the biggest spender in terms of whether it's infrastructure and, you know, doling out, you know, subsidies, etc. So the bulk of the capex is still being shouldered by the government of India. Unfortunately, we've not seen that pick up as yet in the private sector, which, you know, we've been waiting for the last at least 2 to 3 years. So the fact is that on the corporate lending side, you know, you don't see that pickup. Almost every second promoter that I meet ends up saying, I want to get to net debt zero. So there is some sort of a race to get to net debt zero, in the hope that, you know, that basically we end up having better cash flows. You know, the market ends up re-rating our stock price, and the burden of debt, you know, which is unfortunately, you know, the wrong way to look at it, because every company should be having a judicious mix of debt and equity. But there seems to be some aversion even now to debt, given what's happened to some of the over-leveraged companies. So given that backdrop, what the question I have really is that, will banks be focusing still and competing with each other more on the retail side and less on the corporate you know, borrowing side, which is the government doesn't come to banks to borrow, the private sector does.
All right. You know, Gautam, I think we had this chat a couple of weeks ago and we spoke about various other financials. And I think IRFC as well was another stock that we had discussed at that point of time. And I think you were still fairly positive on it. And after the big run, the stock did even better. What's your view on that, and how do you look at the other financial themes?
You know, I think IRFC is a unique case. And again, not all of them have performed as well as it has. So my view is that, you know, continue holding something that's performing for you versus trying to sell something a book profit. And because then what do you do with the money, given exactly what Sandeep said, that, you know, the next, I guess, few years for India look extremely sound from a fiscal standpoint, from a corporate earnings standpoint, and political stability standpoint. So given all of these factors, I think, you know, my view to people is, if you've made money in a stock, even if it's made 2 or 3x for you, but if the runway is still strong, you're still looking at a 20 to 30% top line CAGR, earnings CAGR, hold on to these stocks. Don't sell them.
Sandeep, L&T is the poster boy of India's infrastructure spend, capex spend, but the company is struggling when it comes to its numbers and the old legacy orders. Thoughts on L&T from here on?
So L&T is a very complex entity, and it essentially has multiple parts to it. The large part, which is sort of still growing strong, is of course the international orders, and the domestic orders are also there. I would think it is a slow burn situation, as pointed out by Gautam. The capex cycle is coming in much later than what people thought it would come in at. So on L&T, I think there's still some time, and the wait would be a year. In the interim, please watch out for geopolitical movements. We have seen that, time and again, the construction companies, especially for international orders, face pressure when there are some negative developments overseas where they are operating and the projects get impacted. So I would be careful about that. So I would still think the best stories would be India domestic, especially in the manufacturing and capex side.
So, Sandeep, just to expand on that point, since you're still optimistic on manufacturing and capex, just complete that point on banks as well. And what's your own thought? Gautam raised a very, very, very interesting perspective, and it's true. 10 years back, everybody was over leveraged and everybody wanted to expand, and today we're in the polar opposite world. So in that context, how are you looking at large cap financials, and what do we do with the historic high price to book multiples? I mean, do you see them coming back?
So if this current fiscal path continues, India will benefit from longer term lower interest rates. Consumers will benefit from lower term interest rates. The most important statement which Gautam made was the attitude of businessmen is still to cut debt, right? And that is a fact which we all witness. And the memories of what happened in 2012, 13, 14 are still fresh in the minds of people. I would think if we see this fiscal consolidation happen, there would be therefore a mix of debt and equity coming through. Today, equity looks extremely cheap because the PEs are very high, and we can see capital raising happening. A bit of semblance of correction, therefore, in the market will actually help companies to look at raising some more debt, rather than just depend only on equity or so on. So I would think wait for 6 to 12 months. Capex definitely will pick up. There's no doubt about that in my mind. But whether it gets funded entirely by equity or by debt or a mix of both, we'll need to wait and see.
So what's the better play, Sandeep, then from a market standpoint? I mean, if you want to play for capex, then should you stick to the big names like an L&T or an ABB, etc., or should you play it through financials, which has been traditional wisdom?
I think the big names of L&T, ABB cannot be the bulk of your portfolio. The advantage of playing financials is that you get not only the consumer lending, not only the corporate lending cycle, but also you get the consumer lending cycle. And on top of that, which I've been highlighting from the very beginning in this conversation, you get the the lower interest rate benefit also come through. So all told, I think financials should still be the bulk. The real question for every market participant is that whether we will see continued fiscal consolidation and responsible fiscal outlook. If that happens, public sector banks are the best place.
Okay, all right. Just hold that thought, gentlemen. We have Titan's numbers that are flashing for you on the screen, and we just have the profit number that's flashing as of now. And it appears just on the bottom line, there was a very, very small miss. Top line, I think, is fairly in line with what we're working with. For the time being, the stock is down. But I think the two numbers that we've got pretty much in line with what we were expecting. A small miss on the profitability front, and the top line, I think, is more or less in line. We'll wait for the profit number as well. Remember, for Titan, we get a cheat sheet that already comes out, an operational update. So we already have that with us. These numbers look pretty much okay, but the room for disappointment is very limited, going by the valuations that the stock is trading at. Mangalam will join us to give us a quick insight into that name. But since we're talking about, inward-facing themes, Gautam, I wanted your view on the real estate theme. We have real estate companies, the MDs, the promoters who join in, and they sound so confident, that it's just the second or the third year of this 10-year cycle that we're talking about. It breaks my heart because I can't get into a bigger home. But be that as it may, how would you approach that theme? Would you look at real estate companies? Would you play it, say, via pipe, cement, or would you go for housing finance companies? How do you play this theme if you're bullish on it?
Yeah, fair question. I think the demand in real estate, of course, also has been aided significantly by the money made in the equity market. So it's every bull run, I've seen this in my working career, that as the bull run, I wouldn't use the word peaks, but as the bull run, at some point, people realize that maybe we should book some profit and buy a home for us, for our children, or move into a bigger home, which I hope you do also very soon. But the fact is, I think that momentum which is there in the real estate sector, which was dead literally for the last 8 years, has come back with a bang, which is the good news. And I think even today's budget, in some sense, again, it's more lower income housing. The fact is, the runway for housing in this country is huge, and it will continue for the next several years and maybe several decades. So I think from that standpoint, the real estate companies, in terms of the run-up in the stock price, has been phenomenal. Now, I was talking to, for example, one of the ceramic tile manufacturers. I'm currently in Delhi, and I was meeting some of these folks. They said that last quarter hasn't been great, but the fact is that a lot of their demand comes towards the end of the construction cycle of projects, and they're expecting the next 12 months to be actually quite good. So I think given the run-up in the real estate stocks themselves, I think cement and the building material space is where I today put money on.
Okay, all right, got that. By the way, just take a look at Titan's numbers. The top and the bottom line didn't look too disappointing, but on the EBITDA front, there's a miss. There's close to an 80 basis points miss in comparison to our poll, and that explains why the stock is down closer to around 2.5% or thereabouts. But let's get in Deven into the conversation. Hi, Deven. Good to see you in, and glad we got all of that sorted out, so we have you back with us. Your view on Maruti first. The biggest gainer, I think, today on the Nifty, it's up close to 4.5%. We had the operational numbers that came out. They almost clocked close to 200,000 units in a single month, with good growth both on domestic front as well as exports. Your view on the stock?
Hi, Nigel. Good afternoon. Well, I think the most importantly for Maruti, the product portfolio shift is definitely helping them more in the area of margin than in the area of revenue alone. And that's practically very important. As I think more amount of cars being bought, which is the SUV category, where the margins factor remains relatively on the higher side, it ultimately helps, I think, the companies like Maruti, even for that matter, even Tata Motors in this particular scenario, where I think the larger amount of optic on the SUV is basically giving them a better amount of realization in the margin. So this trend is likely to continue. As we see it, I think most of the companies are introducing the models in this category. So this trend is likely to continue. And as we see in this particular month, I think some amount of price increase taking place. Along with that, in the later part of the year, the prospects of interest rates coming down, they all are well as far as I think the likely position for the auto companies in particular is concerned. We should be seeing relatively better performance continuing in the subsequent quarters as well from most of the auto players.
Okay. By the way, just looking at global markets as well, while we're digesting, of course, all these big events here at home, gentlemen, just want to point out that European markets are still sulking a bit. There's a little bit of red, and we of course had that disappointment from the Fed overnight. Some of the Asian markets are weak. So in that context, I think we've done rather well. We've kind of brushed aside some of the disappointing global developments, and then Gautam, therefore, let me ask you, what next really? We're done with the budget. Now we move to the general election. I think the market's, going in with complete consensus on that. So what lies ahead? 2% away from all-time highs. What next for this market?
Yeah, so I think let's look at, separate two things. One is the market. One is the, underlying fundamental economy and how that's behaving. If you look at on the fund flow side, I think it's the biggest concern that I've voiced over the past about 6 months or so, including on your channel, is the fact that the re-emergence of China, and that's really a concern from a FPI flow perspective. I don't think that impacts domestic flow, and that obviously remains extremely strong. I've spoken to a whole bunch of domestic mutual fund managers, and they still continue to see strong momentum in domestic flows into their funds, which is good. But on the FPI front, we've seen already in the month of January 25,000 crores of selling. China's taken in already 6 billion of net northbound inflows into those markets. So as a result, I think our concern, given where we are in terms of absolute valuation, 21 times calendar 24 PE versus China, which is about 9.5 times, I think that is potentially a concern from a flow perspective. But otherwise, I think domestically, as I mentioned earlier on this interview, that the fundamental economy is doing extremely well. I don't think domestic investors care much about FPI flows because the SIP momentum, which is there, I don't think is going to get turned off or slow down anytime soon.
You're basically saying China will do well, right, Gautam? There are some China mutual funds offering these China funds as well.
My point really is, I'm not China expert. All I'm saying is, in terms of valuation, when I speak to foreign institutional investors, they find China at this level significantly more attractive than other emerging markets.
Sorry.
No, go on.
No, I was just saying that there are, I think there is Mirai runs a fund, there are a few others. But, the last time people got really bullish on China tech, that went down. There was another downturn, a bigger downturn. But maybe, at some point this year, we will see the final bottom and things will start to do better. These things are cyclical more than anything else.
And the counter argument to this India versus China thing is, India is getting premium valuations because you are giving premium earnings.
No, but the thing with China is what I was saying was that the problem is what's happening in China and whom do you believe? Because just over the last 24 hours, you've got the Caixin PMI numbers, which are showing third straight month of expansion. That number is above 50. Then you have the official data, which is showing contraction. So sitting here in Mumbai, kind of hard to guess what's going on.
But everything's good at a price, I think, and that's the reason why I think
it's all at some price, basically. All right, gentlemen. Thanks very much for joining us, Sandeep, Gautam, Deven. Appreciate your time here on CNBC TV 18. It's always a pleasure. We'll move on our segment, D Street Chatter. Nimesh has been speaking with a whole bunch of people across dealing rooms to get a sense of what they made of the budget and, of course, what from here. Nimesh, tell us more.
Hi, Prashant. So, day of consolidation as the two big events are out of the way, right? The Fed outcome last night and the interim budget. From an interim budget point of view, the market feedback is no bad news, is good news. So life moves on, and there are individual gainers as well. The mid-cap index may look weak, down 0.5%, but there are equally amount of large gainers as well in today's market. The PSU basket, the PSU housing stocks, a lot of PSU stocks are buzzing in trade. The drawdown in the broader markets is largely on a few large stocks like, Paytm is down 20% down circuit, India Cement was down, so is Aurobindo Pharma. So those stocks are dragging the broader markets down, but there are equal number of gainers as well. I've been saying for the last many days, the institutional interest seems to be within the financials in the PSU stocks, and that's PSU bank stocks. And that's playing out again in today's trade. Big move on the PSU bank stocks. Of course, the cool off in the bond yields is helping. But generally, there is money now chasing the PSU banks. So that's the overall feedback. So net, life now moves on, and there is equal amount of interest back in the broader markets now.
Nimesh, what about stocks? What have you picked up today?
Well, a couple of large blocks that will have an impact on the overall institutional data as well. So watch out for a large block, a disclosure in PB FinTech. There is a large block, 5% equity got changed hands. I understand the P investor was a seller in block, which was an FDI, so it will only reflect in the institutional data. So is the case with the Indus Tower block deal as well. 9% equity got changed hands. A couple of large, P investors sold out. They were FDI investors, and a clutch of domestic and FIs were buyers in today's block. So both the disclosures will be quite interesting, but that will have an impact on the overall institutional data. The second name is Kalyan Jewellers. After the results, a bit soft in today's trade, but Citi is now anticipating a large block. Remember, there is a P investor who's been selling constantly. So again, a large block is expected from the P investor in Kalyan Jewellers as well. So that's the second name. The third name is Eicher Motors. Overall, the autos have done well in trade today, but Eicher stands out largely on back of very strong buy flow. So expect high delivery volumes, and that's largely on the buy side from the larger institutions. And the last name is Bank of Baroda. I spoke about the PSU banks overall, but Bob stands out on strong buy flows, as well as there was a Nomura update as well today morning. So that's helping Bob to outperform in the PSU basket today.
Okay, all right, Nimesh, got that.
So
Thank you very much.
Just one minute. Nimesh, have you heard anything on Fusion MFI? Because they're also, I think, Warburg, and I think there's one more entity which owns. Is that stock's been down sharply since the morning? Anything you picked up?
Not really, Prashant. I spoke to a few large investors as well. Looks like, the Paytm concern is spreading out to all the other financials as well. So whether it's NBFCs, whether it's MFIs, all are under pressure today. It's not only Fusion Microfinance. There was a block as well. Looks like one of the, not the private equity investor, but one of the FI investor would have sold out. But no specific reason for the stock to be down more than 10% in today's trade.
Okay.
Sometimes when you ask Nimesh, have you heard? I want to say he's definitely heard, but I don't know how much he can tell us.
He can say on air.
television.
Yeah. Probably that's the case. All right, Nimesh, we'll let you go on that note. Won't pull your leg any longer. But, since you mentioned Paytm, aside of the budget, that is the biggest story of the day, really. So let's bring in Ritu to just once again dial back and understand all the concerns that the RBI has raised on the fact that, after the 29th of February, customers cannot use, any of the services, not even put more money in the wallet or withdraw from the wallet. From now till the 29th, there is a window open. Let's go to Ritu to understand all the specifics. Still a 20% slam dunk on that stock, Ritu.
That's right, Surbhi, because for all practical purposes, Paytm Payment Bank cannot operate until what period of time? That is yet to be known. But just to distinguish for the viewers, the Paytm wallet or the Paytm app rather that you and I use to make UPI transactions, etc., that is not affected. That's a different payments part of the business. This is the payment bank part of the business on which restrictions have been imposed. What has RBI said? It is said that Paytm Payment Bank cannot onboard any new customers with immediate effect. There will be no deposit, no credit transactions on any of the customer accounts. Even wallet top-ups will not be allowed after the 29th of February. However, if you are a customer who has some money in the Paytm payment wallet, you're free to utilize it or to withdraw your money without any restrictions whatsoever. But no banking services can be provided by the bank, and that includes your bill payments, your IMPS transfers, etc. Because remember, this is a payment bank, which means it cannot lend. All it can facilitate is transactions. And that is where now the activity has been completely stopped. Why this action? And I'll take you back to March of 2022, because right now RBI said it had to take this drastic action because of material supervisory concerns and persistent non-compliance from Paytm. So in March of 2022, they had barred the payment bank from onboarding any customers because of deficiencies in their IT processes, KYC, risk monitoring, and so on. And that even after 22 months, RBI finds has not been satisfied, which is why you've seen them take this action. But that aside, there was already an embargo on them onboarding new customers, and that now continues indefinitely as of now, because there's no sunset clause or no wording in the circular which says that if you're able to comply, we will lift these restrictions. Now, Paytm has said in its statement that this will have an impact of 300 to 500 crores on their EBITDA because of these restrictions, but they're continuing on their trajectory, working towards the path to profitability, and they will be working with other banks here on and not Paytm Payment Bank for the payments business. Now, brokerages, of course, are quite negative on the stock. You have the likes of Jefferies downgraded to underperform with a target price of 500 rupees. Bernstein believes that this practically ends operations for Paytm Payments Bank and adds to the already heavy burden of regulatory burden on the stock. Macquarie believes that this is as good as RBI indirectly revoking the PPI license for Paytm, which remember rests with the payment bank, and that the bigger issue is that Paytm is not in RBI's good books. So will its lending partners, for instance, also relook at the relationships? That remains to be seen.
Okay, Ritu, thank you very much for that. Let's also get in Amrish Baliga on the show now. We've got about 12 minutes left for markets to close on budget day, and things are very, very quiet. The Nifty is just a shade below 21,700, 35 points down, while the Sensex is lower by 120 points. Amrish, first, straight away, let's get to the stock that you're recommending, and that's TVS Motors. I remember when the numbers came out, it was on the same day as Bajaj Auto, and Bajaj Auto went up 3%, while TVS Motors was under pressure. So tell us why you like TVS Motors.
It was under pressure despite the fact that the performance was better than what the analysts were expecting. But then clearly I see still value in this stock. I mean, a leader in two-wheelers. They have manufacturing facilities in Tamil Nadu, Karnataka, and Himachal, and overseas facilities in Indonesia. If you look at the installed capacity, it's about 55 lakh two-wheelers and 2 lakh three-wheelers, and they have a very decent global presence. If you look at the last 9 months, they have sold about 31.28 lakh two-wheelers and three-wheelers. And the industry growth is expected to be 16% CAGR, which is huge over the next 10 years. And in this, the contribution from EVs would be significant. And because of which, for TVS, this is a focus area. About 1,000 crores capex is planned out. They've sold about 48,000 two-wheelers in Q3. If you look at the January numbers, which have just come out, it's about 15,000 EV two-wheelers they have sold, which means they have about 18 to 19% market share. And this segment is growing at about 60%. If you look at the Q3 numbers, which I was talking about, I mean, they had the highest ever revenue which they reported, 25% growth Y-on-Y, EBITDA margins about 11.2, PAT has improved by 68%. So looking at that, my EPS expectations for FY26 is about 61, and my target here is about 2,440.
Okay, that's TVS Motors. Ambarish, good afternoon. Also want to ask you about the stock of the day, ATM. What thoughts? And I don't know if anyone's going to be a braveheart enough given the uncertainties, but what would you advise to people who are even holding right now and watching the circuit?
I think they have to just keep watching, because there could possibly be another circuit, because market is clearly pricing in the fact that this part of the business, this vertical, will be shut down. But then we should remember that they've still not cancelled the license. So I suppose that small window is still there. And I don't know when the markets will start, giving some weightage to that small window which is open. But then very difficult to stick my neck out and say that it's a buy at an X price. I mean, I'll still continue to watch.
Right, Ambrish, hold that thought. Let's get in Jay Bala as well into this discussion. Hi, Jay. Good afternoon. Good to see you in. How are you feeling about the Nifty Bank? I want to ask you about that index, because 3 straight sessions, it's being a relative outperformer. Is it a bit of a dead cat bounce? So you expect it to go and visit lower levels, say the 200 DMA? Your view?
And that's what it looks like, Nigel. And thanks for having me on the show. And the bounce for SBI, if you recall, go back to my prepared notes of Tuesday, I've mentioned there that SBI could go back to reclaim the 660 high, all-time high, and slightly go over, but it will not be sustainable. So the banking index, in all probability, has put in a medium to long-term top. I'll be quite surprised if the banking index goes any further higher than 47,000. That's the max I'm seeing in this pullback. So to me, it's just a counter-trend rally.
Just what, 2% away from where we are, and that's it. On the higher side, right? Jay, coming to you, Jigar Mistry of Boyne Capital is also with us. Jigar, great to see you as always. What did he make of things? And I wanted to come in on this banks.
Yes.
I don't know if you heard Jay was saying that he thinks banks have made a medium-term kind of a top, but that's technical, in reading of the charts. But your thoughts?
Right, Prashant. So as always, great being here in the studio with all of you. I think, see, when you're looking at Bank Nifty, sometimes we think that's a representation of all banks in India, but you look at HDFC Bank and Kotak, that account for 40%. Now you look what's happening in the banking sector since COVID. Other than these two, a lot of other banks have actually gone up. So essentially, you could now make a case that, those banks which have not run up may continue to not run up, but a lot of other places and other banks might continue to see value. So bottom up, we see, values in even the sort of top private banks per se. But I don't completely concur with what he says.
So you've been bullish on banks for a while. HDFC Bank, have you topped up after the fall?
Yeah, that sort of continues to be among... So for the first time in 8 years, I would say that we have been running this fund. It features even in the top 5 ownerships, but now it's in the top 3. So for the first time, we think... Look at sort of, at 1450 odd levels, 100 rupee EPS, 200 rupees sort of, subsidiary valuations. You then think that, oh, this is the ownership issue, this is what they communicated versus what it is. But you go back, say, 2017, ICICI was in a very similar space. 2018, SBI was in a very similar space. So as we spoke last time around, it's one step away from being a meme stock. We might be getting into that zone very soon.
Any other bottom-up ideas in the last, 1 or 2 weeks or recent?
No, I think, see, what we are approaching increasingly is that small and mid-cap space in general, given the flows, given the low free float, is getting very, very difficult to pick and choose, right? So sort of the way we have positioned the fund is get a lot more into larger caps. Banks within that is the clear winner. But pharmaceuticals is interesting. Some bottom-up ideas are interesting as well. But that is where we are.
Pharma, financials.
Pharma, financials, some small and mid caps. We can discuss a lot of sectors, but see, think of automotives, right? Two-wheelers, 80% of incremental volumes will be EVs. Now, the market, those stocks have gone up 100%. The market seems to be believing that that's equally profitable as the ICE, which is virtually impossible to happen. correct? So why are we paying such a huge valuation premium? Yeah, they were inexpensive. Now they are not all that expensive, which is the same argument made for IT as well. Right? That sector has had the worst performance in the current quarter results. We are hiring the lowest number of freshers into that sector. Captives are hiring more than the third-party products. So increasingly, it's not expensive, it's not cheap, but there is no growth, so let's go ahead and buy that at least.
So my sense is you're not too optimistic on IT, because frankly, when the reaction after the Q3 numbers with pedestrian commentary, pedestrian performance,
but
the stocks got, the stocks were rallying as if, wow, there's a breakthrough. So
yeah, so I think it's very similar to a lot of, back in the sell side days, a lot of my IT sort of colleagues used to tell me, ADR is up, so results must be good.
Since you're talking about a sell side days, then you should track the metals sector very closely. What's it? I mean, some of those numbers are looking very good. The stocks but are not moving too much up because they seem to be factoring in that in. Do you think ferrous and non-ferrous is looking good from here? Or would you say, Nigel, there are plenty better opportunities? Now I'm not on the sell side where I have to put out a note. I rather avoid it.
Right, Nigel. So there is a reason why I'm no longer in the
But give us a view. I mean, you've tracked the space so close.
So I think back in the day, Nigel, we used to have this whole super cycle, right? Because one country was building it out, and that's not the first time that has happened. You look at post the sort of Korea War, 45, Vietnam War, America used to rebuild, and during that time you had this super cycles where you start looking at steel in use, aluminum in use, and then you make your estimates from there. The way China growth was different from the other parts was that, let's take aluminum, right? With no bauxite, no alumina, no coal to make power that you can smelt it into aluminum, you become the largest exporter of aluminum. So the way in which China has grown has sort of disrupted the sector so badly that everybody had to create these virtual walls, right? So it started with Europe, went on to US, then India did it as well. So now you're just playing off for those 20-25%. You don't really have years when, say, iron ore is up 100% each year for 3 years in a row.
So that we're not getting those long cycles. I think we're just a minute away from close. Jay, very quickly, before we hit the bell, what is the mothership telling you? The US market, we had the Fed overnight, and we've got this wobble now, so what indications? NASDAQ, S&P 500, what are the cues?
Yeah, if you recall from our December conversation, Surabhi, I had said be prepared for a January surprise, and I don't know if you count the Fed chairman saying that rate cuts in March is out of the table. Most probably that's as a surprise. And we got inflation data in January where people are saying that it's if you exclude shelter, inflation is actually not going up. So, my belief is that one final low for the US 10-year yields, maximum, or it's already bottomed. We're going to see inflation come back with a vengeance. That's what the chart setup is. So, the technicals for the Dow is such that it's still got one more higher high to come through. But most probably technology and the broader S&P has possibly topped out. If we see the Dow Jones go up to make higher high and the technology and broader S&P not make new highs, that'll be a confirmation. That's the final top.
Okay, no, got that. I think we're just racing to the market close now. Maybe we can squeeze in one more question. Ambrish, with this, with the budget out of the way, and we heard a little bit about the railway sector, right? 40,000 wagons to be converted into the Vande Bharat, right? Absolutely. So, are we going to see something there? I think the government's already said they plan to build out 1,000 Vande Bharat trains. The number is under 100 right now. But this number, this 40,000 number would equate to, a much bigger number of trains, I think 2,000 plus. Any thoughts?
No, because 100 Vande Bharat trains are different. I mean, those are new trains. Here, they're talking of replacing the existing 40,000 rail bogies into Vande Bharat standards. So this is going to be a new order flowing out to all these companies. So I think this is extremely good news for people like Titagar.
Although we don't know that, Amrish, we need to wait, because if that's going to be what we heard was 1,000 new trains, but now with this announcement, so we'll need to get maybe some clarity as we go along. But I think we'll wrap up the discussion here. Thank you very much, Ambrish, Jay, and of course, Jigar, thank you very much for dropping by. Appreciate your time here, as always, on CNBC TV 18. We are ending with about a 30-point cut. So, like the interim budget, it's a very interim kind of a close as well.
Well, let's wrap up the markets then, Prashant. With all the day's action. So today, for the entire day, we moved in a band of close to around 170 points, 160 points or thereabouts approximately. And from there, in fact, we ended more or less flattish. Well, in terms of stocks that were in focus in today's trading session, you had Maruti that was one of the big gainers in trade today. You had Cipla as well that was up and about in today's trading session. And Eicher Motors, that's been a rank outperformer for this week itself. On the losing end, well, a couple of these domestic-facing themes as well did see some selling. So whether it was UltraTech Cement that was under some pressure, you had JSW as well that did see some selling in trade. Titan came out with its numbers. Well, the stock was a little bit under pressure in trade. And you had L&T as well that was down in today's trading session. From the broader market, the stock that was really in focus was Paytm. It got a rap on the knuckles from the RBI, and that one, in fact, went home with a cut of close to around 20%. And a couple of these lenders as well, Indiabulls Housing Finance, Fusion Micro, both of them were down more than 10%. And there were two stocks that were reacting even to a negative news flow. One was Oro Pharma because of reports of, a visit from the US FDA, from the regulators out there. So that was under some pressure. And you had India Cements because the ED, well, they had visited them. So both those two go home with some cuts. So to wrap things up, well, we moved in a band of close to around 200 points approximately in today's trading session. But, we ended with a mild cut of around 15 to around 20 points out, guys.
Okay, well, that wraps up the market. Bank Nifty, I guess, was the shining star. It managed to retain most of the gains over there, and we'll see if there's any further continuity. But otherwise, mid-cap setting, I think just the market digesting the event, letting it get out of the way, and then perhaps taking a fresh guard from tomorrow.
Absolutely. Historically what happens is if there is a big move on the budget day, you get a move in that same direction, up or down, over the next 1 month. But today, this is nothing, right? I mean, this is absolutely flat kind of a close. So neither here nor there. But I think it's goodbye from all of us here on closing bell. But the coverage will continue here on CNBC TV 18 in just a moment from now. Stay with us.
OCL as a payment aggregator for online offline merchant, and already works with various other banks, and Paytm Payment Bank is one of the key banks in that. And from here on, we are very clear that we will work with only other banks and not PPBL. And PPBL is just one of the various other banks, any which ways. OCL has already been working with other banks since last 2 years, and especially when embargo had come to the payment bank, we already had started to work and accelerated the plan for movement to other banks, and other banks have actually already started working with us. So it is an important thing for me to tell you that we continue to decline and decrease the slant-wise dependency on Paytm Payment Bank, but there is still significant enough dependency, I would rather say, there. And we now accelerate the plan and completely move to other payment banks partners. And remember, these are payments related relationships, which means all banks have necessary technology and capability already there. And I'm very happy to tell you that we are genuinely overwhelmed by the support that we've received from the various banks, large banks of this country and our country, and those who are already a partner, and more additional large banks have reached out at very, very senior level to say that they will be very happy to help us and happy to execute relationships that we in past have been doing with Paytm Payment Bank. And we obviously very clearly, we are going to take that as a step forward and work with current and many more incremental bank partners. Going forward, the keyword is that we will not work with Paytm Payment Bank, and that is what probably means that other banks will come. With regard to the direction on termination on nodal account of OCL, that is 197 communication PBSL by Feb 29, OCL and PBSL are already in process of moving nodal account to other large commercial banks, and that will be done definitely before the due date. And OCL's marketing and financial services businesses, where we market and sell other services to the consumers, are not affected due to these directions. And these directions are towards the associate company, Paytm Payment Bank Limited. It is important for me to point out that there will be requirement to have operational change for the merchant relationships that we have, where the merchants have relationship with Paytm Payment Bank, and those relationships needs to be operatingly be changed, and there will be an operation change there. Overall, I can say that it is on behalf of Paytm, I can say that it is more of a big speed bump, but it is something that we believe that with partnership of other banks and capabilities that we have already developed, we'll be able to see it through in next few days or quarters, as the case would be. So thank you so much. And with this, we'll take the question answers.
First question is from Sachin Salgaonkar. Sachin, you may unmute your line and ask your question.
Thank you. Vijay, I have 3 questions. First question, actually, can you help us and understand what exactly went wrong where, I mean, for some time we were hearing from you guys that, this should get resolved, but when we look at some of the words being used of persistent, non-compliant, need continued material supervisory concerns, can you help us explain what is something where RBI is not fully comfortable and what further needs to be changed from that perspective?
We are in recipient of the same letter that is very public.
Sachin, could you just ask all 3 of your questions, then we can answer it all at once? Sorry, Vijay.
Okay, yeah, that's right.
Yeah,
because
sure,
we want to take a lot of questions, so we will suggest that whenever you are asking questions, just put all 3 questions or 2 questions that you are asking to.
Got it. Okay, so that was first question. Second, Madhur, if you could help us understand how to quantify the 300 to 500 crore impact on annual EBITDA, i.e. how much is coming from revenue, how much is from EBITDA, and I presume this is for this year, right, you are looking for. And third, what Vijay mentioned in the opening remarks, the operational changes which are needed from a merchant perspective. Just wanted to understand what kind of changes are these and how much time will it take?
Okay, so I'll take the first one, Sachin. As you saw the letter that is publicly sent there is another letter that bank has received. But based on that, I cannot foresee what we did not see or not see. There is obviously RBI believes, and we totally are believing of the fact that there is something that RBI would have seen. Have they sent us details? Answer is no, they have not sent us any details. So something that is based on over the period what different audits they would have done and their solutions based on that is the opinion that has come based on. So we don't know the exact nuance, what triggered or one line item.
And then Vijay, so how does one get a comfort that RBI should get comfortable going ahead with these changes, right? Because if you are exactly not clear, Paytm is not exactly clear in terms of where RBI was not fully convinced, then, I mean, how do you look to fix those issues?
Actually, the key word here is that it is in discussion with Payment Bank, and Payment Bank cannot share these facts with, let's say, parent or shareholders out there. So that's also one of the reasons that we can't discuss this. This is an interaction between bank and Payment Bank, central bank and Payment Bank.
Sorry, so if I can just clarify, there's certain direction, as Vijay said earlier, there's certain direction that they've given to Paytm Payments Bank with respect to their operations. If we are doing a service in partnership with Paytm Payments Bank, those services, and we'll come to your third question, would go through some operational changes and so on. But like Vijay said, going forward, we would work only with third-party banks who don't face such issues from the RBI, and who also do provide these services to other consumer technology companies. As I'm sure you're aware that that is a pretty standard business model in the industry, where consumer technology companies such as ours, who have a lot of app traffic, will work on payments products with various large banks, right? In our case, we were doing various things with other banks, but various things also with Paytm Payments Bank, and those services would be affected. So that's sort of the Paytm point of view on this, about what we need to do going forward. With respect to your second question, the 300 to 500 crore that we have mentioned is the worst case annual EBITDA impact. That does not take into account the expectation that we will be able to, sort of continue all the businesses or that Paytm Payments Bank, that we're dependent on Paytm Payments Bank for. That is primarily there's primarily two lines of businesses that we do. One is Paytm Payments Bank has a wallet. For that wallet, we provide two services. One is that we are the app on which a vast majority of customers come and add money to that wallet. On that, we make some revenue and some profitability. And the second is that we are a payment provider effectively. And the second is that we also offer, as a part of our merchant services, where we provide payment services to merchants, both online and offline. We also allow those merchants to accept Paytm wallet. In those cases, the merchants pay us a revenue, and we pay an interchange effectively to Paytm Payment Bank. So the worst case margin, EBITDA margin impact of that is 300 to 500 crores. We have called that an annual EBITDA impact. I do expect that we over time will be able to offset this in a big way, but we have called that out as a sort of an annual impact.
Okay, thanks, Madhu.
Pavish, did you want to take the third question that Sachin had?
Sure. So Sachin, the operationalization piece means two things basically. So when you are a merchant, you have and it's an offline and online merchant conversation. So I'll take both of them, but let's start with the offline merchant, where you see a Paytm QR, which is powered by Paytm Payment Bank, right? And now that QR has a VPA, a virtual payment address of the Paytm Payment Bank. So now that QR will have to be changed. The VPA will have to be changed to any other sponsor bank. And we have multiple sponsor banks who anyway work with us, large sponsor banks who anyways work with us, while we used to predominantly work in the offline space with Paytm Payment Bank, but in large enterprise and online space, we work with other operators in the UPI space, etc. So when we say operationalizing difference, we basically now have to work in making sure that the VPA is changed to another bank. We have multiple options of the banks that we are currently in conversation with. We'll obviously conclude one bank, two bank, or a large number of bank to make sure that we're able to do this exercise. This will be a large exercise, so it will be split into two parts. One, there is a new acquisition, which is much easier, that the new acquisition can immediately start to happen on other bank BPS. So we decide. So that decision will take in the next maybe a week or so, because there'll be some commercial involvement, etc. And we have proposals to that regard already in the system. So we are evaluating them appropriately. And then there will be, how do we move the existing merchants who are accepting on UPI to any other bank or banks. So that discussion will involve discussions with regulator, NPCI, etc. That can it be a one-time movement or a case-to-case movement. So we have had some discussions, but obviously they are yet to be concluded formally. And it will take maybe a couple of days more when we have more direction on how we do this migration.
Right. Bhavesh, one small question. Will the terms of VPA with Paytm Payments Bank and other banks be materially different and hence expensive for Paytm?
No, it will be largely similar, because the fact is that today, purely from a P2M, there is a UPI incentive component. So we have a commercial on sharing of incentive with the other VPA banks that we have, which is largely in the similar range that we have with Paytm Payment Bank.
Got it. Thank you so much.
Hello. Hi. Next question is from Vijit Jain of Citibank. Vijit, you might go ahead.
Yeah, hi, thanks. So just a clarification. First question is on the 3 to 5 billion rupees impact that you're talking about. Is that basically assuming wallet ceases to operate? Is that it, or are you assuming some kind of a smaller size of the wallet business? And does it also include different commercials as you move some of these relationships, including the nodal account, to other banks? And related to that, I would just request if you could break down, your core net payment margins a little better, the 7 to 9 bips a little bit better, so we have a better handle on that post these developments. So that's my first question. My second question would be, so if you need to, let's say, shut down PPBL, either because, it doesn't take deposits, so has lower reasons to exist going forward, could you take over the Paytm UPI and the Paytm wallet products back into OCL? Are there challenges with that if you wanted to do something like that? That's my second question. And any commentary on the financial services side from your partners post this development? Those are my three questions.
So Vijay, let me take the questions in the reverse order. So we've been working with our various partners. So our equity broking and our insurance business obviously remains unaffected, because they do this business independently of any relationship that they may have with Paytm Payment Bank. So that business is 100% unaffected. With the lending business, lending business has no relationship of any kind with Paytm Payment Bank, other than the fact that there would be merchants who may have taken a loan and have their repayments coming from a Paytm Payment Bank account, which is not a very large number, but I would give you a directionally number, maybe about 10-15% odd merchants on a ballpark number who would have the repayment set up happening from the PPBL bank account, because they were taking settlements there. There we have to move their settlement accounts to any other bank account that they would like to take the settlement, so the repayments can keep coming. And that process is already on. It's not a very large process, because we have about live 400,000 merchant loans. Even if you take 15% of this, we're talking largely about 60-70,000 merchants. And we have a 30,000 sales force on the ground, which is already in the market to make sure that those repayments and the settlement account changes, etc., are done on or before 29th of February. Same is on the personal loan side, that there is a much lesser number than 15% who have their e-NACH or autopay set up through the PPBL account, and hence they have to be changed as a mandate. That work obviously is also on. It will not be physical work, but will be done digitally. So we are in the process of doing that piece. Earlier, the effort was to make sure that they are able to convert their autopay into other mandates or with other banks that they have. And that effort is now got amplified further, just to make sure that that exercise can get completed before 29th of February. Beyond that, there is no operational challenge for the continuation of the lending business. Obviously, the new lending business will not have an option for the user to have a PPBL bank account as a repayment bank account. And hence, the new business can continue as it is. Having said that, as expected, because it's a material development in one of our associate companies, each lender have their own set of areas of concern and clarification that they seek from us. We are in the process of discussing and engaging with them on clarifying a lot of nuanced questions like you may have and others have as to what's the impact on the portfolio, what's the impact on the overall business. We've been able to answer all those questions, and now they have to process those questions and come out with their further incremental questions or call to action. Till that time, we have proactively worked with our partners to say, till the time we're able to make these operational changes, let's pause the new origination of loans for that period of time. And once we are able to solve the operational things for existing and the new one, we restart. So there will be some disruption, and hence this 300 to 500 crore number that Madhur was saying will have some impact from coming in from lending, that we will not be originating loans for maybe a couple of weeks before we solve for the operational challenges, and then we go back to normal.
Okay, well, that is optimistic, and that is coming in from the Paytm management. Vijay Shekhar Sharma and Madhur Deora addressing questions and taking questions from analysts on the Paytm call after, of course, what the RBI circular said yesterday. Remember, the stock ended 20% lower. I mean, it started in the morning down by 20% and never sort of, circuit never opened through the course of the day. The last part of the answer, the Paytm management essentially saying that, maybe origination of loans, they'll be able to do maybe in a few weeks' time once they solve for some of these issues. Is it going to be as simple and as fast a resolution as that? Something which we will need to see. Ritu is with us. She's been, of course, tracking the story. Ritu, you've been listening to the full call.
Yeah.
Top takeaways?
Well, to begin with, it's very clear from Vijay Shekhar Sharma's commentary that, beyond what is publicly available as to why RBI has taken the action, and they're also linking it back to what happened in 2022 when, they were first asked to stop onboarding customers. There's nothing beyond that which had warranted this action. So I believe they'll also be, seeking some sort of redressal on that front. Operationally, yes, he said for a couple of weeks, loan origination may be hit. Again, to clarify to the viewers, this is a payment bank, which means it cannot lend. The lending is with, tie-ups with other NBFCs, etc. That's what it does. That will pause, he said, for a couple of weeks. Interestingly, he called it a speed bump. And he said,
a big speed bump.
A big speed bump, which could be resolved in the next few days, a few quarters. It remains to be seen. But that is not the reading of the RBI notification if you look at it, because there's nothing that says that once you're able to rectify these deficiencies, whether or not this embargo, these restrictions will be lifted. So the street is viewing it a little more negatively than the management, of course. And there's nothing much that they've been able to add, but they made it clear. Because this embargo on onboarding new customers on Paytm Payment Bank was in place since 2022, they've already started to work with other banks, and which, by the way, is a rule, which NPCI says if you have more than 5% market share in the UPI transaction market, you must be banking with at least 2 players. And that happened after Yes Bank had, issues back in the day, and then, some, transactions were getting affected. So NPCI came out with this rule that if you have a large share, you must have at least 2 banks in place. In the case of Paytm, it was only Paytm Payment Bank. And since that embargo was brought on, they said they've started to work with other banks. And that is what I think he's reiterated through the first half of the call. We have these relationships in place. We're very humbled that some of the large banks have already reached out to us. And, we will be able to resolve this going ahead. But, we have to see, because, Macquarie, for instance, saying the fact that you're constantly in crosshairs with the RBI, is it also going to affect your lending relationships? When others come for tie-ups, for loans, are they going to think about it twice? But of course...
But on the call, that statement that you said, I think one of the things was overwhelmed by the support we received from banks in the country, right?
From large banks,
so that I'm assuming is now.
I think he was talking about the prior period, but not since last night. In general, talking about they're deepening their tie-ups and relationships with other banks.
I believe he was talking about the support he's got since this RBI action was taken.
Okay.
Because they've already started engaging with banks because of the embargo. But I think since this new action, and they have to shut down, any ties with Paytm Payment Bank, they have to bank with others. And so that's what he's referring to by saying we've got overwhelming support from other large banks.
But Ritu, the interpretation, I mean, the management constantly, kept maintaining that things will kind of get back to business as usual, maybe in a couple of weeks or a couple of quarters with respect to loan originations. But again, the interpretation, this needs to pass through the RBI. The RBI needs to come out and say that they're satisfied with the operational changes that, Paytm Payment Banks has made. So,
very much.
I mean, it can't be taken as something which is in the management's hands right now, right?
It's not, and typically when we've seen embargoes on various other financial entities in the past, it's taken, like in the case of HDFC Bank, it's taken over a year for them to lift those restrictions. In the case of Paytm Payment Bank, it's already been 22 months since that first embargo was placed on onboarding new customers. So clearly RBI is not satisfied with the sort of progress that the bank has made, and therefore this drastic action that they've now put in place.
Sorry, just a basic question. Did they address what is the reason behind the action? Did they say?
Yeah, I think that was the first question. And they said that, there is little that we know outside of what is in public domain, that, in their audits and in RBI supervision, they found some deficiencies because of which they've taken this action. But beyond that, he said, even we're not aware if there was anything besides this that caused them to take this action. And that's, I think, one of the first few questions Vijay Shekhar Sharma did address.
No, absolutely. I think a lot of sort of analysts who've written on the subject are on that call. So we'll leave you to listen to the call and sort of come back with more details. But I think we'll wrap up this special broadcast. Stay tuned. There's more coming up in terms of news and updates after a quick commercial break. Stay with us.
So we got in, I think, around the 1050 odd level, or perhaps a little lower than that. We got in at an attractive price. Why did we get in? ME Organics supplies intermediates to some of our larger pharma holdings. So, for example, ME Organics supplies intermediates to Divi's Lab. Divi's Lab is the 5th largest maker of APIs in the world. Different part of ME, the lithium ion piece, that's a business based out of Noida. That's a business they acquired a couple of years ago. And looking at India's import-export data, we figured out that this is a very high margin that ME is involved in. Basically, they're supplying stuff into the ecosystem, going not just into EVs, but also into the semiconductor ecosystem.
transparency and assurance that benefits are delivered to all eligible people.
No surprises from Finance Minister Nirmala Sitharaman as the government opts for prudence over populism in this interim budget. No change to income tax rates and capital gains tax, pegs nominal GDP growth for FY25 at 10.5%. Finance Minister sticks to the path of fiscal consolidation and springs a pleasant surprise, projects a fiscal deficit target of 5.1% of GDP for FY25, expects to end this financial year with a deficit of 5.8%. Government banks on lower borrowing and higher revenue mobilization to keep the deficit in check, proposes to borrow just over 14 lakh crore rupees from the market, which is 8% lower than last year's estimate. Also pegs gross tax revenue growth at over 11% in FY25. Government's infrastructure push continues. Capital expenditure outlay hiked by 11% to more than 11 lakh crore rupees. Finance Minister Nirmala Sitharaman promises to build 3 major rail corridors. 40,000 rail bogies are going to be upgraded to Vande Bharat standards. Stock markets give up early gains to end marginally in the red. The rupee gained strength and bond markets cheer the budget after the government scaled down its borrowing plan. The government sets another big 50,000 crore rupee divestment target for FY25 after a tepid show so far in FY24. Even the revised target, 30,000 crores for FY24, is well above market estimates of near 20,000 crore rupees. A sharp 13% cut in fertilizer subsidies helps trim the overall subsidy bill. The outlay for food subsidy is also 3% lower at just under 2 lakh crore rupees. No capital infusion for oil marketing companies this financial year. The government halves the 30,000 crore rupee funding plan and defers it to FY25. The government overshoots the FY24 budget for the Rural Employment Guarantee Scheme by 43%, maintains the revised 86,000 crore rupee number as the outlay for FY25. Finance Minister proposes to set up a research and innovation fund with a corpus of 1 lakh crore rupees, promises long-term financing at low to nil interest rates for a tenure of 50 years. Well, those are the big headlines from the budget. You are watching CNBC TV 18 and I am Ritu Singh. Here are the other headlines that we're tracking for you this evening. Shares of Paytm plunged 20% after the RBI crackdown. Brokerages believe that the new restrictions will end all operations of Paytm Payment Bank for all practical purposes. This even as Paytm clarifies or claims that the annual EBITDA impact will be 300 to 500 crore rupees. Viacom 18 is in advanced stages of talks to buy a majority stake in Disney India, according to a Wall Street Journal report. The deal will likely value Disney India business at around $3.9 billion. Global markets remain largely subdued after US Fed Chair Jerome Powell signals a rate cut is unlikely in March. Crude oil prices also post the first monthly gain since September.
Honorable Speaker, I present the interim budget for 24-25. We need to focus on 4 major castes. They are Garib, Mahilayeं, Yuva and Annadata. Their needs, their aspirations and their welfare are our highest priority. The revised estimate of the fiscal deficit is 5.8% of GDP. The outlay for the next year is being increased by 11.1% to 11,11,100 11 crore rupees, our government will launch a scheme to help deserving sections of the middle class to buy or build their own houses. Prime Minister Modi has furthered that to Jai Jawan, Jai Kisan, Jai Vigyan and Jai Anusandhan.
भारत में 21वीं सदी के आधुनिक इंफ्रास्ट्रक्चर के निर्माण के साथ ही युवाओं के लिए अनगिनत रोजगार के नए अवसर तैयार होंगे.
At 57 minutes, this was the shortest budget speech by Finance Minister Nirmala Sitharaman. Now, there were no surprises as the government opted for prudence over populism. No changes were made to income tax rates and capital gains tax, as well as nominal GDP growth for FY25 has been pegged at 10.5%. The government has stuck to the path of fiscal consolidation, projected a fiscal deficit target of 5.1% of GDP for FY25. However, the government expects to end this financial year with a deficit of 5.8%. The government is now banking on lower borrowing and higher revenue mobilization to keep the deficit in check. Now, she proposed to borrow just over 14 lakh crore rupees from the markets, which is about 8% lower than last year's estimates. The minister also pegged gross tax revenue growth at over 11% in FY25. Now, what did India Inc. make of this? Here's a slice of that conversation. Shireen Ban with top industry leaders on their budget take.
Gentlemen, I have to say, Nirmala Sitharaman, speaking to you at CII, had made it clear this is going to be a vote on account. She's delivered on that. Perhaps one of the first few finance ministers really sticking to the script on what a vote on account is and what a vote on account should be. Dinesh.
Yes, totally agree. As you said, it was on our event where she mentioned this. I think she has walked the talk. But equally so, she has given the direction in terms of what it's going to be. So I think that's great.
Oh, absolutely. She made it very clear we're coming back for the next 5 years. So that pitch was made. But Rajiv Memani, nothing for you to do today. No changes as far as direct or indirect taxes are concerned. But, you know, we were discussing the fiscal conservatism, and that was the point that you were making as well.
Yeah. So Shireen, just to answer on your first point, I think it's this is a budget of a very confident government, both politically and economically. So no big softies announced, everything. Just a very good articulation of what they've achieved, of what they've done over the last 10 years. And then a broader vision of what they intend to do going forward. And even if I look at the macroeconomic thing, you know, all of us have been covering and seeing the tax growth. Direct tax growth of almost more than 20%, indirect tax growth of 11, actually GST growth of 11.5%. So everyone was estimating that the revenue, the tax growth this year will be higher than budgeted, and the expenditure will also be higher than the budgeted.
It's actually lower, a little bit lower.
Both of them are slightly lower. So my guess is when we eventually end up, you know, and the gross number and the net number. So I'm assuming they are doing a lot of refunds will be given in the next few months.
All right, let's now go across to Suman Berry, Vice Chairman of Niti Aayog. Mr. Berry, thank you and welcome to CNBC TV 18 on Budget Day. Over the last few weeks, we were hearing about some big ticket schemes, maybe increased interest subvention for MSMEs, maybe increased allocation under PM Kisan Samman Nidhi, maybe a 12,500 crore rupees FAME 3 scheme. None of that has happened. Why do you think, and what is the thinking of the government for sticking to the path of fiscal discipline? When it came to the interim budget in 2019, you had the PM Kisan Samman Nidhi, you had certain tax tweaks also for the middle class. Why do you think the government has stayed away for some of the popular measures, some of the big bang announcements that were being discussed in the media and also by analysts?
Well, it just proves to me that the media exists to create its own bubbles. I'm sorry. Am I speaking over you? May I go ahead?
Sure, sir. We can hear you.
Okay, fine. Look, I think the important thing about this budget, and indeed this government, is that it is sober, responsible, credible, and confident. Okay, so it was indicated that, by the FM in the media that this was going to be, in effect, an interim budget. I don't know if that exists kind of constitutionally. And so it proved, particularly on the tax side. To me, what is perhaps under-remarked is really the fiscal consolidation guide path. I know that the markets have been rather excited about this because of what it means for, as it were, the demand on bond markets. But let me make the larger point, which is also picked up in the FM speech. I don't think this government gets the kind of credit that it deserves for what is referred to in the budget speech as economic management. So we are not that far away from COVID, the fastest growing major economy in the world, inflation more or less under control, reasonably, certainly buoyant stock markets, looking now for both FDI and for the private sector to start investing. You don't get here, as it were, by luck or by chance. And so to me, I think it would have been a mistake to spoil this track record with last-minute populism. And frankly, the recent election results suggest that there wasn't a particular need to do so. Back to you.
Right. Mr. Berry, when it comes to job creation, it is often said that a lot of people are actually going back to agriculture, so there is actually a lot of unemployment in the country which needs to be addressed. Now, how will this budget do in terms of encouraging job creation? We're looking at the defense sector as well, which has got a major allocation, a record over 6.2 lakh crore allocation to the Ministry of Defense, 1.72 lakh crores for the defense budget, that is the capital acquisition budget, 1 lakh crore corpus for deep tech, for youth and for companies, 2 crore more houses under the PM Awas Yojana, schemes for helping slum dwellers living on rent or to build their own houses, a new housing scheme for the deserving middle class as well. Overall, these are quite a few things that I've mentioned across sectors, but overall, how do you think this budget will increase job creation?
Parikshit, I'm not sure what time horizon you are talking of. I have, my job is to look at the medium term and to work with the Prime Minister on a vision for India, Viksit Bharat. Now, I think the philosophy in the budget is crystal clear, which is that we can't anticipate where the new jobs are going to be. What we do know, and one reason for the focus on CapEx, is that the immediate multiplier from capital expenditure is a great deal higher than revenue expenditure and certainly subsidies. And so I have not had a chance actually to look at the fine print of the allocations. Obviously, you have done so. But I just want to talk about the underlying philosophy of the budget speech, and indeed of the government's policies overall. They are to equip individuals with the skills and the financing to allow them to realize their entrepreneurial capabilities, to explore new options, and frankly, to get away from what had been the goal of our educational system, which was to prepare graduates for Babu jobs. that is not the India of the future. That's not the India of Viksit Bharat. And so the focus is on skills. The focus is on women. The focus is on empowerment. Now, there's a lot of controversy about the, what employment numbers to track and follow. And, we are 1/5 of humanity. A lot of our employment is so-called informal. I would also say that the minister's budget speech pays a lot of attention to what they call formalization, okay? Which is that moving people from, mom and pop operations into registered entities, be they startups. And formalization is partly responsible for our very buoyant taxes. I would also say, while again, it's not easy to measure, the indications that we have is that by and large rural wages have been going up. And I hear from people who are in the South, this is anecdotal, that there are huge skills shortages.
Right. On that note, sir, I'll request you to hold on. The Finance Minister has just started speaking. We are going to cut across to that press conference. Let's hear from the Prime Minister in a post-budget press conference.
Honorable Finance Minister, Minister Nirmala Sitharaman ji in Parliament today. The Finance Minister is joined by Honorable Ministers of State for Finance, Shri Pankaj Chaudhary ji, Dr. Bhargav Karaj. Also on the dais are Finance Secretary and Secretary Expenditures, Dr. T.V. Somanathan, Secretary Economic Affairs, Shri Ajay Seth, Secretary Deepam, Shri Tuhin Khan Pandey, Secretary Revenue, Shri Sanjay Malhotra, Secretary Financial Services, Dr. Vivek Joshi, and Chief Economic Advisor, Dr. V. Anantanageshwaran. A warm welcome to the Finance Minister and her team at the National Media Center. At the beginning of the press conference, Finance Minister will make her opening remarks. After that, we will open the floor for discussions and questions and answers. Thank you. Over to you, Minister Ma'am.
So thank you for coming here today. Thank you very much for coming here today. Slightly longish opening remarks. I'll try to cut it down. But over and above what you heard me say, I just want to give the overall perspective, so I'll take a bit longer than I desire. See, this is an amendment presented just before the election, obviously. The four large things that I want to draw your attention to is GDP. You get the numbers, you see it and so on. But I want to bring in this dimension, that governance, development and performance. On all of these three heads, I'd like to say what actually we have achieved, because that forms the backdrop. So, on governance, we have delivered on development. We better manage the economy with correct intentions, correct policies, and correct decisions. So it's a governance with care, conviction, and confidence. If that stood for the GDP's G, the D stands for people living better, earning better, and having high aspirations for the future. And if I move to the P, the performance, 3 consecutive years of 7% growth. Fastest growing economy in G20, all parts of the country participating in the growth. Price stability and inflation management. handling the health and economic fallout of COVID, build out of physical, digital, and social infrastructure, DPI as a factor of production almost for formalization and financial inclusion and growth of the economy, cleaning up the banking system, GST, one nation, one market and one tax, the IBC. So if you were to look at performance, I've listed some of them. So your GDP, as we look at governance, development, and performance, I have something to say on each of these. So this budget, or vote on account, is getting presented with the GDP that we want to speak to you about. And in that, the fiscal management actually is something which I would like you to spend some time, even as you go through the budget. But I'll flag it here. Bringing down the fiscal deficit in spite of very challenging times, as per the announced consolidation path, and with transparency and prudence. So in fact, I was just remarking to my officers this morning, most of you all had already calculated the figures, RE revenue, RE expenditure, this is what it is, because every month you get the reports coming out. So you don't need to wait till the budget statement. Every month you get the accounts, and so budget process has become absolutely transparent and questionable. If there are any you're there to question, we are here to answer. But we set in the process of keeping everything brought on budget and nothing kept aside from it or underneath it. So with that, the budget deficit, fiscal deficit, 5.8%, which is much lower than the 5.9, which was at the BE. Similarly, for the 24-25 budget, we've given 5.1 as the fiscal deficit, so clearly indicating that we are on track to meet the glide path which was set in 2021-22, and that we are well on track to meet the 4.5% fiscal deficit, on or below 4.5 even by FY26. If this is the background with which I'm talking and the presentation of the budget happened, I want to very clearly put some things under the heading, if you want to call it that, Disha Nirdeshak Baatein. You must have heard the Honorable Prime Minister speak before the Parliament session, well before the session commenced. His usual customary remarks. He said the budget will be presented tomorrow and you will have some Disha Nirdeshak Baatein in it. So, what are those Disha Nirdeshak Baatein? There are about 5 of them I highlight. Social justice as effective and necessary governance model. So it's not just a slogan for us, social justice, we'll have to work for Nyay. No, we've shown you that it is a governance model and a successful one at that. So social justice as an effective and governance, necessarily a governance model. Then 4 major caste groups, as we call it, as Prime Minister has emphasized, the poor, the women, the youth, and the Annadata. So Disha Nirdeshak Baatein, you have the second point. Third, focus on infrastructure. This year, again, massive increases of capex happened in the last 4 years. This year, too, there is 11% increase, resulting in a very recallable number, 11,111 crores. So continuing the trend of the last 4 years, where capital expenditure has been the route, one for revival earlier from COVID, and now for sustained growth towards towards the Vikasit Bharat goal. Fourth is the using of technology as a huge opportunity. DPI as almost a new factor of production. So it is actually bringing in the value addition to the economy. It is facilitating every sector to bring in the value addition which is so required and improves on our productivity. And the last Disha Nirdeshak Batein is high-powered committee for extensive consideration of challenges arising from population growth and demographic challenges. So if these are Disha Nirdeshak Batein, what were the major announcements? I'll recall very quickly 12 of them. I'm not spending any time except for reading out what those 12 are. 2 crore more homes under the PM Awas Yojana. We already completed nearly the 3 crore. Housing for middle class. Rooftop solar for at least 300 units of power generation every month, which will be muft bijli for the households. There will be some assistance and some kind of a funding which will be extended. So you're generating renewable energy, providing the renewable energy generators the free they would want to use, and over and above that, the surplus that they produce can be used for selling and earning money out of it. Enhancement of target for Lakpati Didi from 2 crore women to 3 crore women. Preparing and empowering the MSMEs to grow and compete globally. Aligning regulatory environment for them. The sixth is making sure that the eastern region, and when I say eastern region, I'm not talking about Northeast. Northeast will get the attention that they've been getting all the while. They will still continue to get it, and they will be on the top of our priority. But when I say the eastern region, I'm talking about Bihar, Jharkhand, Chhattisgarh, and Orissa, making sure that they'll become the engines of growth for the new Amritkal India that we are trying to use as a bridge towards leading to towards Vikasit Bharat 2047. And Eastern India, I've missed out on West Bengal, please add it. Bihar, Jharkhand, Orissa, Chhattisgarh, and West Bengal. Next generation reforms will be carried on, building consensus with states and stakeholders for reform, perform, transform. 3 major corridors, which are programs for railways, for logistics efficiency, and they have been explained. The important point that I want to highlight there is to make sure for Vikasit Bharat, you just don't need to build for better passenger convenience. You need to build for better passenger convenience. You need to give them safety. You need to shorten the traveling time for them. So one of the corridor is going to give emphasis for high density routes where passengers traffic is very high. We need to bring efficiencies and better safety in those areas. But for Vikasit Bharat, passengers need to move as they wish. But equally, materials, raw materials, building goods, cement, rare earths, minerals, we need them to move efficiently as well. So the corridor will take care of that as well. So the synergy between movement of people and movement of goods is what is being highlighted in the 3 corridors that we're talking about. Ninth announcement, that is urbanization, looking at Metro and Namo Bharat. One of the railway related things which I missed out on telling you, 40,000 bogies are going to be improved in the standards with which they can be effective rolling stock and also give the convenience in the passenger experience inside the bogies as well. So 40,000 coaches are going to be brought up to the level of Vande Bharat standards. Metro and Namo Bharat I did mention, so that urban transformation through transit-oriented development can happen. The 10th announcement which I draw your attention to is 1 lakh crore corpus for research and innovation by private sector. So that's coming in at the 10th. 11th is boost to tourism, including spiritual tourism. Interest-free loans will be given to states so that they can build on iconic tourist centers. And the 12th one is supporting reforms in state. They are separate from the development of tourism centers, and therefore I want you all to have the clarity that help to centers are supporting reforms in state is slightly different from boost to tourism. There will be a white paper on economic performance of the last 10 years compared with the previous 10 years. The 12th announcement is so much a statement that I would like to make, which is what I made in the budget speech as well. Government has got the trust and the confidence and the blessings of the people based on its exemplary track record of GDP, as I said, governance, development, and performance, effective delivery, and also on Jan Kalyan. So highlighted points have been realized as goals of Vikasit Bharat till now, and they are the realizable goals also continuing to be so, because what we want to underline is we govern with good intentions, true dedication, and hard work in the coming years. And that's why Amrit Kal is also now called Kartabya Kal. In short, that's the budget. Thank you very much.
Yeah. The Finance Minister has just now encapsulated the key highlights of the budget. We'll now open the floor. We can begin with the front row here. Please go ahead, 53. Please hand over the microphone here.
Hello, ma'am. This is Priyashmita from Informist Media. Ma'am, I wanted to know about the projections in your tax collections. So tax collections are seen currently growing at about 14.4%. Your April to December data shows. However, the projections in your budget are lower than that. So a back of the envelope calculation shows that you're going to get about 55,000 above your revised estimate if the collections continues. So your estimates are conservative, would you say that?
I'll certainly ask Somanathan to come in on that. Estimates are always realistic with us.
So let me clarify this. If you look at page 6 of the budget, you can look at it later. I'll just explain it to you. We are projecting that gross tax revenue. Now, this gross tax revenue in this sheet is net of refunds. So net of refunds, we are projecting that in this financial year, it will grow by 12.5% with reference to last year's actual. So from 30.54 lakh crores last year to 34.37 lakh crores this year is what is presented in our revised estimates. However, the sharing of taxes with the states is different for different taxes. Not all taxes are shareable in the same ratios. What has happened this year, if you look at the numbers, and they are given on page 6, union excise duties have actually shrunk. They have not increased. Most other taxes have grown at, as you say, 14%, etc. Union excise duties have grown minus 5%. That reduction is almost entirely on the account of the center, because the same way that cesses are not shared, reduction in cesses is entirely borne by the center. So as a result, the state's share has increased by 16.5% in our revised estimates. Between the state share in the revised estimate and the state share last year, there's an increase of 16.5%. So taxes are growing 12.5% net of refunds. State share is growing 16.5% net, and therefore net to center is growing only 10.8% approximately. So there is no expected further padding or anything here. This is our realistic but slightly conservative estimate.
Yeah, the next question, please. 65. Please go ahead.
Hi, ma'am. Yeah. I'm Kriti from Informist Media. So you mentioned that CAPEX, there has been a push towards CAPEX. However, the CAPEX jump for this year is 11%, right? Which is lowest in the last 4 years. So are we moving towards a place of moderation in capex? And secondly, while the budget, this is another unrelated question, while the budget clearly says that you are committed to your 4.5% target, you have also been recommended to bring down your debt to GDP ratio to 40% level, which still stands above 50%. So how are we looking towards moving towards that target? Thank you.
First of all, I'm on the second, your second bit was on the debt to GDP. What was your first one on? CAPEX. 11% growth in CAPEX. You've got used to about 30%, 23% from a low base. And today 11% on a high base appears low, informist. 11 lakh crores going for capital expenditure. And you're seeing also that the private sector is coming in with their investments. So one has to have a clear understanding that when the government wants to spend through capital investment, it can be for one, triggering the economy so that private sector also comes in. At a time when private sector didn't come in, we still fully came in. Now we are seeing also signs of private sector also coming in. So it's only natural for two reasons, therefore, for you to look at. One, on what base are you saying 11% is less? Growth it is. And second, please do look up if private sector is coming in or not. Does that answer you?
Yeah. The next question, we'll take it.
Wait.
Still?
On your 40% of, first of all, that was a figure that was set before COVID. Its relevance today is something that has to be looked at completely afresh. And in fact, in 21-22, the finance minister had set out a particular fiscal consolidation glide path, which is the post-COVID glide path. I would only point out that today India's debt to GDP ratio is one of the lowest in the G20 apart from other countries. So we have to look at things in today's context, not based on a historical relic of a report which was prepared long ago before COVID happened.
Yeah.
And again, our external debt also is something which you should notice is never been high, not high even now.
Yeah, second row, I would request you to confine to one question, please, because there are many questions coming up. Yeah, thank you very much. Please go ahead. Yeah. दूसरा दे दीजिए. Give this another.
नमस्कार मैम, आलोक प्रियदर्शी हूँ मैं CNBC आवाज़ से. मेरा सवाल मैम ये है कि एक कंज्यूमर के नाते, एक टैक्स पेयर के नाते हमेशा लोगों की ये उम्मीद रहती है, या इस देश में कैसे कह सकते हैं कि चुनाव इतने ज़्यादा आते हैं कि लोगों को लगता है कि जब चुनाव आएंगे तो उनकी जो मांगे हैं वो पूरी हो जाएंगी, टैक्स के मोर्चे पर कहें, या फिर जो पॉपुलिस्ट मेजर्स सरकार लेती है. लेकिन क्या इस मिथ को क्या ये सरकार तोड़ना चाहती है कि जब चुनावी साल होगा तो पॉपुलिस्ट बजट नहीं देंगे? जिस तरह से फिस्कल प्रूडेंस की आपने बात करी, आपने फिस्कल प्रूडेंस को लेकर काफ़ी जोर दिया है इस बार बजट में, तो ये इस बात का कॉन्फिडेंस सरकार को ज़्यादा है कि वो अगली बार पूरी तरह से आके और जनता के जो उनकी उम्मीदें हैं उनको पूरी करेगी, या फिर सरकार इसी तरीके से जिस तरह से फिस्कल प्रूडेंस का जो रास्ता है उसको अख्तियार करेगी और उसी हिसाब से चलती रहेगी, और चुनाव के मौके पर लोग आम आदमी एक्सपेक्ट ना करें कि कोई पॉपुलिस्ट बजट आ सकता है?
आप डिस्कशन जैसे प्रश्न पूछ रहे हैं भाई. मैं पहले से बोलते आई हूं और माननीय प्रधानमंत्री जी भी इस विषय में बोलते थे, कल परसों भी उनका बयान है. वोट ऑन अकाउंट क्या है, कैसे है, आपको मालूम है. सो वी लार्जली केप्ट vote on account as vote on account, but also showed how the economy will be moving forward and what's our plan for it. Who are we going to aim at when in July, when we come back to present a budget? Who are the sections who will be addressed? What are the kind of investments we'll make? However, very clearly showing that on capital expenditure, we are showing an increasing growth. More money is being put in for that, for innovation, and so on. सो अनाउंसमेंट्स भी है, ये नहीं है कि वोट ऑन अकाउंट है इसमें कुछ और नहीं है, अनाउंसमेंट्स से दिशा निर्देशक बातें भी है। सो वोट ऑन अकाउंट एंड इंटरिम बजट को कैसे किस हद तक उपयोग कर सकते हैं और वो भी कॉन्फिडेंट सरकार, उस हद तक हमने यूज ही किया है।
Yeah, Z Business, and after that you hand over the microphone to your right. Yeah.
मैम, आपने दो बड़ी स्कीम्स का ऐलान किया, एक अर्बन एरिया के अंदर हाउसिंग स्कीम का, दूसरा रूफटॉप सोलर के लिए। मैम, इसका बजट एलोकेशन कितना है? एक सवाल। दूसरा सवाल मैं मैम पूछना चाहूँगा डाइवेस्टमेंट के ऊपर। मैम, पिछली बार 51,000 करोड़ का टारगेट था, वो टारगेट नहीं मीट हो पाया। इस बार बजट में ये नहीं मिल पाया कि कितना टारगेट अगली बार के लिए रखा गया है, और ऐसे टाइम पे टारगेट नहीं पूरा हो पा रहा है जब मार्केट, इक्विटी मार्केट बहुत अच्छा परफॉर्म कर रहा है।
पहली बात तो मैं ये स्पष्ट करना चाहूँगा कि जो डिसइन्वेस्टमेंट है उसमें हम वैल्यू लॉकिंग का प्रिंसिपल लाते हैं। आपको एक मैं छोटा सा उदाहरण देता हूँ। हमारे जो 61 लिस्टेड CPSCs हैं और 16 PSBs हैं, एक यानी कि 1 जनवरी 2021 में, यानी कि 3 साल पहले उनका कंबाइंड मार्केट कैप 15 लाख करोड़ था और आज के वक्त में वो 58 लाख करोड़ है। तो हमने 42 लाख करोड़ की वेल्थ क्रिएट की है पब्लिक सेक्टर में, और उसको माइनॉरिटी शेयर होल्डर्स जो उसमें हैं उन सब के साथ उनकी वेल्थ शेयर हुई है। तो आप वेल्थ इफेक्ट नहीं देख रहे हैं, आप सिर्फ उसमें से वेल्थ में से हम क्या निकाल रहे हैं, लेकिन वो जो वेल्थ जनरेट करना भी इक्वली इम्पॉर्टेंट है। एक साल अलोन में हमने 25 लाख करोड़ का एडिशन किया है। तो आप समझ सकते हैं कि 2014 से जब हमने 4.2 लाख करोड़ का डिसइन्वेस्टमेंट किया है और 4 लाख करोड़ का हमने डिविडेंड लिया है CPSC से, 8.5 लाख करोड़, उसके मुकाबले एक ही साल में 25 लाख करोड़ का हम मार्केट कैप ऐड कर रहे हैं। तो ये जो वैल्यू अनलॉकिंग स्टोरी, इसका मतलब ये है कि आपको डिसइन्वेस्टमेंट करना है तो वेल्थ भी इम्प्रूव करनी है, शेयर की वैल्यू भी लेनी है, और तब डिसइन्वेस्टमेंट कैलिब्रेटेड वे से करना है। इसलिए सरकार ने डिसइन्वेस्टमेंट का एक तो हमने कोई फिक्स टारगेट भी इसे नहीं रखा है। हमने ये कहा है कि हम एक अदर रिसीट्स में एसेट मोनेटाइजेशन हो, डिसइन्वेस्टमेंट हो, वो सब जाते हैं। और दूसरा रिसीट का एक इशू है कि हम कभी भी यदि हमें अपॉर्चुनिटी मिलेगी इससे ज़्यादा भी कर सकते हैं, लेकिन एक उसको फिक्स्ड मार्केट सिग्नल ये देना कि हम शेयर बेचेंगे ही बेचेंगे, इसी प्राइस पे बेचेंगे, उसके कारण उसका प्रतिकूल असर मार्केट में पड़ता है। इसलिए जो हमारा वो है, अर्थ ये है कि हमारा जो रेवेन्यू है, और दूसरी हमने इम्पॉर्टेंट स्ट्रैटेजी है कि डिसइन्वेस्टमेंट और डिविडेंड ये दोनों ऑपोजिट डायरेक्शन में हैं। जब हम कंबाइंड कह रहे हैं हम 92,000 करेंगे तो कंबाइंड आप देखिए, और नॉन टैक्स रेवेन्यू इज़ द बिगेस्ट स्टोरी। लगभग 75,000 करोड़ का नॉन टैक्स रेवेन्यू ऐड हो रहा है और हाईएस्ट ग्रोथ उसमें ही है। और अब लगभग 1 लाख करोड़ जो है, यदि आप बजट से देखें और नेक्स्ट बजट में देखें तो 1 लाख करोड़ का नॉन टैक्स रेवेन्यू हम ऐड कर रहे हैं। और नॉन टैक्स रेवेन्यू ऐड में डिविडेंड की बहुत बड़ी भूमिका है और डिविडेंड हम एक्सीड कर रहे हैं। तो इसलिए आप कंबाइंड वे से इस सारे, यदि इस सेक्टर को देखें तो हमको एक नई दिशा में जाने की ज़रूरत है, जो हम गए हैं।
Regarding the new schemes, रूफटॉप सोलर के लिए 10,000 करोड़ का प्रोविजन है बजट में। As regards the urban housing scheme, its contours are being worked out, and there is a token, and it will be funded when the exact contours are finalized.
Yeah, the next question, please go ahead. 81, please. Okay, I mean, I'll...
Hello.
Yeah, go ahead.
Yeah, sir, Prakash Pedashi from ET now. Ma'am, the benefit of lower tax rate of 15% has been extended for startups and investment by sovereign wealth funds. My question is, I mean, has it also been extended for manufacturing unit? No, I'm asking, I'm seeking clarity. No. Thank you.
Yeah, Bloomberg, Ruchi.
Ma'am, some of the rating agencies have said that they will take a call on a ratings upgrade for India only after the next budget. But given that this budget of yours, you did say that it has been transparent, you've maintained the path of fiscal prudence as well, what will be your message for rating agencies?
Not only aligning with the fiscal consolidation roadmap that we gave earlier, but bettering it. Is that one simple, straightforward message which every rating agency should take on board? Should take on board.
Ma'am.
Yeah, please go ahead.
Yeah. Sapna here from CNBC TV 18. Ma'am, two questions. One very broad, generic. Excellent work in terms of fiscal consolidation. Just want to understand, is it slightly ambitious to have a 5.1 number right away in the interim budget? I mean, broadly expectation was July budget, you will start kind of... No, I don't mean that. No, I don't mean that, but just try to understand, like in 2 years, you'll be able to do below 4.5%. Very broad understanding, ma'am. One is that. Second, ma'am, you're talking about next generation reforms. Within that context, the government has had a massive privatization agenda. There doesn't seem to be, any mention of that as of now.
Just heard Tuhin. Sapna, you're asking the same thing.
No, but
you went elaborately on it.
But will you still be sticking to it? Just broadly wanted to understand.
Yeah, please go ahead.
Yeah. Timsi Jaipuria from CNBC TV 18. Ma'am, in your budget speech, you've given a very ambitious target of 1 lakh crore worth of a fund for private sector for research and innovation, where you've promised 50-year interest-free loan. If you could give the contours of this scheme, which are the sectors who will benefit in terms of the private sector, which are the specific sectors who can avail this corpus, and what kind of work or research and innovation are we focusing on? Sectors and how this scheme will work.
So I'll tell you the quantitative part, and Secretary EA can expand on the sectors. There is the 1 lakh crore is a provision over a period of time as the need emerges. This will be provided as a 50-year interest-free loan to a financial institution which will be identified, which will be within the government ambit of financial institutions, who will then finance or refinance projects at long tenors and at concessional rates of interest. Money has been provided in this budget in the Department of Economic Affairs for multiple purposes, including this one. So there is a provision for this in the Department of Economic Affairs, which covers many other things also. As regards the sectors, I'll leave Secretary.
See, as announced in the budget speech, these are the sunrise sectors. And what is the economic logic behind it? These are the innovations and research. Investments are needed today, and the private sector, the returns will come a couple of years down the road. And those couple of years can be 4 years, 5 years, 10 years. For some investments, it can be even longer. So it will not be commercially viable for private sector to invest if it were to be a commercial money for them. So this is what the fund will help them. Clear identification of those sunrise sectors will be through a stakeholder process.
Yeah, business line.
Namaskar, ma'am. Shishir here. Just two clarity, ma'am. One is about the TCS. Some changes have been made in the TCS on the LRS. So what are those changes? There is not much clarity because explanatory memorandum is not there. And the second part is the housing scheme. Will it be just like an interest subvention scheme, or what will be the contour of that?
So you are aware that, sometime I think last year, maybe in June or July, there was a press release in which the TCS rates were later on changed from what were announced in the budget of 23-24. So basically it is just to align those TCS rates with what was announced in the press release. There is no further change from what was announced in the press release.
Your question on housing was?
What will be the contours?
It's still being worked out.
Interest subvention, will there?
It could be one of the features of the scheme, but nothing has been finalized yet. It's under discussion between Department of Financial Services, Ministry of Housing and Urban Affairs. Multiple options are being considered on how to achieve the purpose that has been set out.
Hello, ma'am. Ruchika Chitravanshi from Business Standard. One question was regarding relating to the announcement you made about the withdrawal of demand for outstanding tax. What will be the cost to Exchequer for the tax that will be foregone? And second, a small clarification: the 75,000 crore 50-year loan that is linked to the milestone reforms. Yeah, is that in addition to the 1.3, or is it part of it?
So all of you would be aware, that there are a large number of small demands that are pending with respect to income tax, wealth tax, gift tax. They number in all about 2.68 crore such demands. The total amount, of course, is very high, which is 35 lakh crore of outstanding demand. A lot of it is in litigation. But many of these demands, about 2.1 crore, in fact, 2.1 crore out of 2.68 lakh demands are valued less than 25,000 rupees. Now, many of these demands are very, very old, dating from 1962, when Income Tax Act was enacted, and right now till very recently till today. So this has been causing a lot of hindrance, especially for the taxpayers, because these demands are very old. Many of them are unreconciled because of systemic issues. We shifted, our CPC, all the tax records, centralized them in 2010-11 year. And so that's why a cutoff has been taken at 10-11, because previously the demands were decentralized. And so we are unable to, verify many of them, causing disruption and hindrance in payment of refunds. So out of this 2.1 crore demands, which are less than 25,000 rupees, about 58 lakh demand entries for the period pertaining to financial year 9-10. And then from 10-11, these are less than 25,000, as already announced by the Honorable Finance Minister, and another 53 lakh entries pertaining to the remaining 5 years from 10-11 to 14-15. So 1.1 crore small demands, 25,000 and 10,000 for the 5 years. These are being remitted. The total amount is less than 3,500 crore rupees.
The 75,000 crores is part of the 1,30,000 crores.
Yeah, go ahead, please. Yes, go ahead.
Hi, ma'am. This is Pushpita from the Core. You mentioned about that nearly 40,000 rail bogies will be converted to Vande Bharat standard. But if we look at the price of Vande Bharat, is comparatively higher than the other ticket prices. So considering the affordability of the passengers, what will be the pricing and how will it be decided? If you could.
It's up to the railways, but Vande Bharat trains are one thing. The bogies, 40,000 being upgraded to the Vande Bharat standard is another thing altogether. Those bogies probably cannot even take the speed with which we want to improve the high density areas with better speedy transportation for the common man. Equally, the inside bogie experience is also not up to the mark because they've been so for a very long time, and as time passed by, their quality has also come down a bit. So we are talking about the bogie quality matching with the Vande Bharat standards. As to which of those lines of traffic that they will get connected to, and as a result what will be the rationalization of the ticket price, is not something that we can talk about. That's something which the railways will work out gradually. But progressively, that point proves that through the 40,000 bogies that we're talking about, the quality of the Indian rail bogies, which are so important for safe travel, and also ease of living, travel, and comfort will need upgradation, and this is what we're aiming.
Yeah.
All right, so that was Finance Minister Nirmala Sitharaman addressing the media after the budget. Broadly, they were the key highlights, but I think one of the big headlines that's to come out from this press conference is the budget outlay for the rooftop solar scheme, and that is at 10,000 crore rupees. Several other highlights that we have for you on our ticker flashing right now. Thanks for tuning in. With that, we've come to an end of this special edition. But stay with CNBC TV 18. More news and updates will continue after this break.
Distributed fairly. All, regardless of their social standing, get access to opportunities. We are addressing systemic inequalities that had plagued our society. We focus on outcomes and not on outlays, so that the social economic transformation is achieved. As our Prime Minister firmly believes, we need to focus on 4 major castes. They are Garib, Mahilaye, Yuva, and Annadata. Their needs, their aspirations, and their welfare are our highest priority. The country progresses when they progress. All 4 require and receive government support in their quest to better their lives. Their empowerment and well-being will drive the country forward. Garib Kalyan, Desh Ka Kalyan. We believe in empowering the poor. The earlier approach of tackling poverty through entitlements had resulted in very modest outcomes. When the poor became empowered partners in the development process, government's power to assist them also increases manifold. With the pursuit of Sabka Saath, in these 10 years, the government has assisted 25 crore people to get freedom from multi-dimensional poverty. Our government's efforts are now getting synergized with energy and passion of such empowered people. This is truly elevating them from poverty. Direct benefit transfer of 34 lakh crore rupees from the government using PM Jan Dhan accounts has led to savings of 2.7 lakh crores of rupees for the government. This savings has been realized through avoidance of leakages prevalent earlier. The savings have helped in providing more funds for Garib Kalyan. PS Nidhi has provided credit assistance to 78 lakh street vendors. From that total of 78 lakh street vendors, 2.3 lakh have received credit for the 3rd time. PM Jan Man Yojana reaches out to the particularly vulnerable tribal groups who have remained outside the realm of development so far. PM Vishwakarma Yojana provides end-to-end support to artisans and craftspeople engaged in 18 trades. The schemes for empowerment of Divyangs and transgender persons reflect firm resolve of our government to leave no one behind. Welfare of Annadata. Farmers are our Annadata. Every year under PM Kisan Samman Yojana, direct financial assistance is provided to 11.8 crore farmers, including marginal and small farmers. Crop insurance is given to 4 crore farmers under PM Fasal Bima Yojana. These, besides several other programs, are assisting Annadata in producing food for the country and for the world. Electronic National Agricultural Market has integrated 1,361 mandis and is providing services to 1.8 crore farmers with trading volume of 3 lakh crores of rupees. The sector is poised for inclusive, balanced, higher growth and productivity.
No surprises from Finance Minister Nirmala Sitharaman as the government opts for prudence over populism in the interim budget. No changes to income tax rates and capital gains tax, pegs nominal GDP growth for FY25 at 10.5%. Finance Minister sticks to the path of fiscal consolidation and springs a pleasant surprise, projects a fiscal deficit target of 5.1% of GDP for FY25, expects to end this financial year with a deficit of 5.8%. Government banks on lower borrowing and higher revenue mobilization to keep the deficit in check, proposes to borrow just 14 lakh crore rupees from the market, which is 8% lower than last year's estimate. Also pegs gross tax revenue growth at over 11% in FY25. The government's infrastructure push continues. Capital expenditure outlay hiked by 11% to more than 11 lakh crore rupees. Finance Minister promises to build 3 major rail corridors. 40,000 rail bogies will be upgraded to Vande Bharat standards. Stock markets give up early gains to end marginally in the red. The rupee gained strength and bond markets share the budget after the government scaled down its borrowing plan. The government sets another big 50,000 crore rupee divestment target for FY25 after a tepid show so far in FY24. Even the revised target, 30,000 crore for FY24, is well above market estimates of near 20,000 crore rupees. A sharp 13% cut in fertilizer subsidies helps trim the overall subsidy bill. The outlay for food subsidies also 3% lower at just under 2 lakh crore rupees. No capital infusion for oil marketing companies this fiscal. The government halves the 30,000 crore rupee funding plan and defers it to FY25. The government overshoots the FY24 budget for the Rural Employment Guarantee Scheme by 43%, maintains the revised 86,000 crore rupee number as the outlay for FY25. Finance Minister proposes to set up a research and innovation fund with a corpus of 1 lakh crore rupees, promises long-term financing at low to nil interest rates for a tenure of 50 years. Well, those are the big headlines from the budget. You're watching CNBC TV 18 and I'm Ritu Singh. Here are the other headlines that we're tracking for you this evening. Shares of Paytm plunged 20% after the RBI crackdown. Brokerages believe the new restrictions will end all operations of Paytm Payment Bank for all practical purposes. This even as Paytm claims the annual EBITDA impact will be 300 to 500 crore rupees. Viacom 18 is in advanced stages of talks to buy a majority stake in Disney India, according to a Wall Street Journal report. The deal likely values Disney India business at around $3.9 billion. Global markets remain largely subdued after US Fed Chair Jerome Powell signals a rate cut is unlikely in March. Crude oil prices post the first monthly gain since September.
Honorable Speaker, I present the interim budget for 24-25. We need to focus on 4 major castes. They are Garib, Mahilayeं, Yuva and Annadata. Their needs their aspirations and their welfare are our highest priority. The revised estimate of the fiscal deficit is 5.8% of GDP. The outlay for the next year is being increased by 11.1% to 11,11,111 crore rupees. Our government will launch a scheme to help deserving sections of the middle class to buy or build their own houses. Prime Minister Modi has furthered that to Jai Jawan, Jai Kisan, Jai Vigyan and Jai Anusandhan.
भारत में 21वीं सदी के आधुनिक इंफ्रास्ट्रक्चर के निर्माण के साथ ही युवाओं के लिए अनगिनत रोजगार के नए अवसर तैयार होंगे.
At 57 minutes, this was the shortest budget speech by Finance Minister Nirmala Sitharaman. Now, there were no surprises at all as the government opted for prudence over populism. No changes were made to income tax rates and capital gains tax, and nominal GDP growth for FY25 has been pegged at 10.5%. The government stuck to the path of fiscal consolidation and has projected a fiscal deficit target of 5.1% of GDP for FY25. However, the government expects to end this financial year with a deficit of 5.8%. Now, the government is banking on lower borrowing and higher revenue mobilization to keep the deficit in check. Now, Finance Minister proposed to borrow just over 14 lakh crore rupees from the market this year, which is about 8% lower than last year's estimate. The minister also pegged the gross tax revenue growth at over 11% for FY25.
Building on the massive tripling of the capital expenditure outlay in the past 4 years, resulting in huge multiplier impact on economic growth and employment creation, the outlay for the next year is being increased by 11.1% to 11,11,111 crore rupees. This would be 3.4% of our GDP. The revised estimate of the fiscal deficit is 5.8% of GDP, improving on the budget estimate, notwithstanding moderation in the nominal growth estimates. We continue on the path of fiscal consolidation, as announced in my budget speech of 2021-22, to reduce fiscal deficit below 4.5% by 25-26. The fiscal deficit in 2024-25 is estimated to be 5.1% of GDP, adhering to that path.
Okay, my colleague Parikshit Luthra also joins us with leaders from industry body FICCI on their budget verdict.
Finance Minister Nirmala Sitharaman has delivered the interim budget. No big bang announcements as were being predicted, as were being spoken about. The government has stuck to the path of fiscal consolidation and good macroeconomics. Joining us right now is Shubhrakant Panda, former president of FICCI and managing director of Indian Metals and Ferro Alloys, Anand Goenka, vice president, vice chairman of the RPG Group. Gentlemen, thank you very much for joining us. Shubhrakant, if I can begin with you, how do you see the budget? A lot was being discussed about PM Kisan, about capex growth to the tune of maybe 30%. Are you disappointed, or are you feel that it's good that the government has stuck to the rule book as far as the interim budget goes?
So, I think it's a very clear articulation of intent on the part of the government, with the finance minister highlighting the accomplishments over the past decade or so, as well as charting out, the trajectory for the, going ahead. And in that context, the clear articulation of the the areas of focus, which is the poor, the women, the youth, and the farmers, means to build on their capability and empower them to contribute to Viksit Bharat. I think all of that was laid out very, very, clearly. And in that context, I think taking forward the Viksit Bharat journey further, the focus now is on getting the states on board. And to that extent, the 75,000 crore outlay for milestone-linked reforms, I think is a good measure. But specifically on the capex question that you asked, I don't think it is something that we should be disappointed, because keep in mind that last year was a significant 33% hike to 10 lakh crores, and a further 11.1% hike on that record number is not something to be scoffed at. I think the government has done a very good job of doing the heavy lifting and providing support to the economy when it was needed the most. And now the finance minister has acknowledged in her speech that private sector capex is starting to pick up, and buoyed by tax receipts, etc. What they're looking to do is cut back on the borrowing so as to give headroom to the private sector to fund its own expansion plans, etc. So, I think the public and the private capex working in tandem is what will take us forward. But most importantly, I think from an industry perspective, and indeed on a larger perspective of the economy, is the commitment to fiscal prudence. So containing fiscal deficit at 5.8% for the current year and bringing it down sharply to 5.1% forecast for FY25, I think is something which is absolutely commendable.
Right. Let me go across to Anand Goenka, Vice President of FICCI at this point. Anand, what do you feel about this path that the government has taken, especially the commitments, the targets around fiscal deficit of 5.8% for FY24, 5.1% for FY25. So do you feel that this is a government which does not want to fall for populism, which wants to stick to the path of fiscal consolidation, good economics? And as far as the RPG group goes, are there certain announcements in the budget which make you excited, make you more confident?
Right. I think this reflects a lot of focus on continuity by the government, the fact that they're continuing the journey on fiscal prudence, especially in an election year. So to me, it's a very positive sign that they're continuing to stick to improving on fiscal prudence, and better than what was expected. So that's very positive. With respect to the RPG group, I'd say the positive has been the continued investment in infrastructure, highways, which bodes well for our company, KEC International. In addition to that, I'd say the infrastructure spends are very well divided across the board, whether it is roads, ports, railways, all areas of infrastructure are being looked at. And I think that will have a positive impact as a multiplier on the economy, as well as infrastructure companies across the board.
Right. Let me go back to Shriprakath at this point. Shriprakath, just yesterday we had seen a reduction in duties on certain components. This was with regard to the mobile phone division. Now, when it comes to adjustment of duties, reduction of customs duties, for the sake of Atmanirbhar Bharat, we didn't hear of too many announcements, but the push towards green energy, the push towards solar and renewable schemes, how do you see all of that?
So, the finance minister articulated in her speech that in keeping with the tradition of vote on account, there are no direct or indirect tax proposals contained in the interim budget. But I guess from what was announced yesterday for the mobile phone sector, etc., is something that was needed for a very, very important sector, one which has grown rapidly. So that's where that stands. But clearly, coming to the question you're asking about green growth, I think all of us agree on one thing, that what we need is not just growth, but sustainable and inclusive growth. And the interim budget had clear directionality on both, carrying forward the good work of the government of previous budgets. So when it comes to sustainable growth, the viability gap funding for up to 1 gigawatt of offshore wind, the emphasis on EV ecosystem, including charging infrastructure, public e-buses for public transportation, and not to mention the rooftop solar scheme for households, which will benefit 1 crore households, if I'm not mistaken. I think these are all very, very significant measures which shows India's commitment to the energy transition initiative. And this is something, keep in mind, that has the emphasis and the push from the very top, with the Honorable Prime Minister, making it a making it a hallmark of his government and talking about initiatives like LIFE, which is lifestyle for the environment. So there is plenty of steps in there in terms of directionality, in terms of vision for sustainable growth, and from an inclusivity perspective as well. Looking out for those at the bottom of the pyramid, and that is something that I think all of us support. That where help is needed, it must be provided. So and not just in that manner, but also creating opportunities through the R&D fund, etc. I think sustainability and inclusivity are the hallmark of not just this interim budget, but sustained action over the past several years.
Right. Anand Goenka, does this budget in a way give you confidence about capex deployment, about the private investment cycle?
No, absolutely. I think as Shubhrakant mentioned, this is already on a high base of 33% increase that we saw last year. We are seeing a further 11% increase. Implementation of projects has been excellent. If you look at the number of kilometers of roads that are being laid, is the highest ever that we have seen in the country under Minister Gadkari. So to that extent, not only are projects or investments being announced, but they're actually being implemented at a great pace. They have been very targeted investments also that have been announced. Corridors for certain elements such as cement and minerals that were announced on the railway side, port connectivity, decongestion of high traffic zones. So each of them are very focused and will result in high ROI as that investment as well. So to that extent, it will bode very well for business. It will bode well for the auto industry, for the infrastructure segment, as well as decongesting the entire logistics space where India has some area to cover. Logistic cost as a percentage of GDP is around 14%, and through Gati Shakti, the government is looking at single digits. So all of this will help in various sectors across the board.
Thank you so much for joining us, giving us your views on the interim budget, and how do you see this encouraging the private sector to invest more in the coming months. Thank you once again for being with us, and that's a wrap of this broadcast for the moment, but our live coverage of Budget 2024 continues on CNBC TV 18. Keep tuning in through the day.
Well, it continues indeed, Parikshit, but we have to take a short break. Don't go anywhere. We're back with our budget special coverage on the other side.
These are facilitated from farmer-centric policies, income support, coverage of risks through price and insurance support, promotion of technologies and innovations through startups.
We think three segments, mainly roads, airports, and what they call new energy ecosystem, are currently worth more than what all of Adani Enterprises is valued at right now. The segment that I'm probably most positive on, I would say within 5 years, is probably airports. This is a segment I think can do $1 billion plus of EBITDA within 3 or 4 years. Close comps are trading at 20 times that, so you could see within 3 or 4 years, Adani Enterprise look to demerge that business at a value close to 20 to 25 billion, and Adani's Enterprise's current market cap is just 40 billion. Beyond that, you look at new energy ecosystem, which includes solar manufacturing, wind turbine manufacturing, and then there are plans for green hydrogen ecosystem. That green hydrogen ecosystem, which actually is not in our current valuation, is something that could, within 10 years, do, call it $7 billion of EBITDA. We think three segments, mainly roads, airports, and what they call new energy ecosystem, are currently worth more than what all of Adani Enterprises is valued at right now. The segment that I'm probably most positive on, I would say within 5 years, is probably airports. This is a segment I think can do $1 billion plus of EBITDA within 3 or 4 years. Close comps are trading at 20 times that, so you could see within 3 or 4 years, Adani Enterprise look to demerge that business at a value close to 20 to 25 billion, and Adani's Enterprise's current market cap is just 40 billion. Beyond that, you look at new energy ecosystem, which includes solar manufacturing, wind turbine manufacturing, and then there are plans for green hydrogen ecosystem. That green hydrogen ecosystem, which actually is not in our current valuation, is something that could, within 10 years, do, call it $7 billion.
Welcome back to our budget special coverage, and my colleague Parikshit Luthra also spoke to Anisha of M&M on the budget, what he made of it, how it could impact his business and the economy. Listen into that conversation.
This is actually an excellent budget. It's very thoughtful. It's not easy to meet all the constituents' needs, but I feel that this does it well, because first, let's start with the long-term vision, which is really around Viksit Bharat and positioning India in the world as a growing power. And there are a number of elements of the budget that enable that. In terms of the logistics focus that we have, in terms of the states that are brought in and the incentives given to be able to make business easier. And these are actions that will really position India very well in the long term. In addition to that, it's an inclusive budget. Because there's a lot of emphasis on social empowerment, on homes, and a number of other areas that address the four constituents that you mentioned. And beyond that, it's also one that showcases and takes further India's leadership on the climate front. And a number of initiatives that have been outlined in the budget that will be climate friendly. So on balance, I would say that this is one that is very positive for the country overall for the long term, and for the industry, and for various different constituents in the country.
Right. Let me speak about the climate action and the opportunity there. The rooftop solarization scheme, which would cover 1 crore households, and they will be able to obtain up to 300 units of free electricity. The government believes this will lead to savings of 15,000 to 18,000 annually. Then you have the green growth schemes, where you have spoken about coal gasification, viability gap funding for offshore wind energy for about 1 gigawatt. You've also spoken about phased mandatory blending of compressed biogas in CNG. How do you see these measures, and how do you think the industry will pick up cues from this?
So the world is concerned about energy transition, and there are multiple discussions around that. I think India is showing the way. India is showing leadership in energy transition in terms of how it can happen. It started with utility scale solar plants, and now hybrid, which is solar, wind and storage that have come in as well. And with rooftop solar now and other incentives around it, this is one that will transform the way India uses energy. And first, it's cheaper, and therefore it's beneficial for users, whether they're industries or individuals. And second, it's cleaner, and that will enable, again, a better environment, which is something that we all look forward to. But beyond that, for the long run, it really helps in that fight against climate change. So I think it covers a number of areas. Today we see utility scale solar plants being much cheaper than fossil fuel based plants, and that's something that is not only at the utility level, but even as we put in smaller captive plants for specific uses, and as we extend that to rooftop solar, that's exactly the same principle. The technology is there, it is better overall, and this budget is enabling it. So industry should welcome it and actually drive a much faster conversion to renewables for everyone.
Right. I would just like to quote Anand Mahindra as well. He tweeted some time back, "For many years I have been saying that we create too much drama around the budget and raise expectations of policy announcements to an unrealistically feverish pitch." What do you think India has done by giving a budget which covers all the major segments of the population, of the industry? No big bang announcements, as this is a vote on account, but at the same time also indicates that we don't want to go in for open populism. We want to maintain fiscal discipline. How do you see the messaging in this budget?
For this, I would look at the past few budgets, not only this one. And we've seen economics really play center stage as compared to politics. And that is always better for the economy. As you rightly said, there are no big bang announcements, there are no populist measures. At the same time, it's about inclusive growth, and there are segments of society that are not left behind. And therefore, I think this balances everything really well.
Right. And finally, there was no announcement on the FAME scheme, but yes, the FM indicated that the support for electric mobility would continue. A payment security mechanism for electric buses will also be brought in. How do you see that? Are you hoping for some clarity on the FAME scheme?
I believe there will be clarity in terms of the operating mechanisms. That was not required in the budget itself. But the positive aspect is that that scheme is continuing right now. And the other aspects also around buses as well as around the EV charging infrastructure is a positive step forward, because we will see the country really starting to adopt EVs as we see a slew of EV products start coming in over the next 12 to 18 months.
Okay, so that's as far as the budget is concerned. But in other big news that we've been tracking for you today, shares of Paytm hit lower circuit on opening. This after the RBI imposed major restrictions on Paytm's payment bank yesterday. Now, as per brokerages, the restrictions are likely to cause reputational risk. It may also hamper the firm's ability to retain customers. Now, while immediate impact on business is ruled out, analysts believe that it can have medium to long-term repercussions on revenue and profitability. Further, Macquarie claims that Paytm has not been in good books of the regulator, and additionally, Jefferies also downgraded the stock to underperform and trimmed the target price to 500 rupees per share. Now, during the con call, founder Vijay Shekhar Sharma called the restriction a big speed bump and said that the company will sail through with the support of banks and that many have already reached out to him. Remember, Paytm had earlier outlined that the impact of this move is going to be about 500 to 600 crores on the EBITDA. Hear him out.
Going forward, the keyword is that we will not work with Paytm Payment Bank, and that is what probably means that other banks will come. Paytm, I can say that it is more of a big speed bump, but it is something that we believe that with partnership of other banks and capabilities that we have already developed, we'll be able to see it through in next few days or quarters, as the case would be.
Okay, with that, we're going to wrap up this special show. Thanks very much for watching, but stay with CNBC TV 18. Our budget coverage and other news will continue after this break.
Yeah. Here you're getting airports, your roads, renewable energy, called old energy or fossil fuels, with what they do with mining and called commodity trading. So it's a diversified play on India, but with leadership that I think has proven the success of growing above market rates. I do think that has been a hindrance. I think some of that has been the lack of institutional coverage on the Adani Group. There's not many analysts out there writing research on it, which, when we first kind of stumbled upon it was a bit surprising, given I think it's the 10th largest non-financial stock in India, which is, now the most populous country in the world. So I do think that's a bit surprising in terms of feedback we got. We thought interest was very good.
The fundamentals piece has been good for 25 years. I don't think anybody watching this show needs to be reassured on HDFC Bank's fundamentals. It's been 20% loan book growth for many, many years. Over the last 6 months, over the last 6 years, take any horizon, this bank has pulled market share at a rate not seen in Indian banking. No other private sector bank, even in the current fiscal, no other private sector or public sector bank has come close to matching the rate at which HDFC Bank has pulled market share. For the last 5 years, the price to book has come off from, I think, 4.5 down to now 2 almost. This is trading at the lowest price to book it's ever traded at. And therefore, that's why in the last 6 months, we increased the position size quite sharply in HDFC Bank.
A large number of institutions of higher learning Honorable Speaker, I present the interim budget for 24-25. We need to focus on 4 major castes. They are Garib, Mahilayeं, Yuva and Annadata. Their needs, their aspirations and their welfare are our highest priority. The revised estimate of the fiscal deficit is 5.8% of GDP. The outlay for the next year is being increased by 11.1% to 11,11,111 crore rupees. Our government will launch a scheme to help deserving sections of the middle class to buy or build their own houses. Prime Minister Modi has furthered that to Jai Jawan, Jai Kisan, Jai Vigyan and Jai Anusandhan.
भारत में 21वीं सदी के आधुनिक इंफ्रास्ट्रक्चर के निर्माण के साथ ही युवाओं के लिए अनगिनत रोजगार के नए अवसर तैयार होंगे.
Well, at 57 minutes, this was the shortest budget speech by Finance Minister Nirmala Sitharaman. There were no surprises as the government opted for prudence over populism. No changes were made to income tax rates and capital gains tax, and nominal GDP growth for FY25 has been pegged at 10.5%. Now, the government has stuck to the path of fiscal consolidation and has projected a fiscal deficit target of 5.1% of GDP for FY25. However, the government expects to end this financial year with a deficit of 5.8%. The government is banking on lower borrowings and higher revenue mobilization to keep the deficit in check. Now, the finance minister proposed to borrow just over 14 lakh crore rupees from the market, which is about 8% lower than last year's estimate. The minister also pegged gross tax revenue growth at over 11% in FY25.
Building on the massive tripling of the capital expenditure outlay in the past 4 years, resulting in huge multiplier impact on economic growth and employment creation, the outlay for the next year is being increased by 11.1% to 11,11,111 crore rupees. This would be 3.4% of our GDP. The revised estimate of the fiscal deficit is 5.8% of GDP, improving on the budget estimate, notwithstanding moderation in the nominal growth estimates. We continue on the path of fiscal consolidation, as announced in my budget speech of 2021-22, to reduce fiscal deficit below 4.5% by 25-26. The fiscal deficit in 2024-25 is estimated to be 5.1% of GDP, adhering to that path.
Okay, my colleague Abhimanyu Sharma also spoke to Commerce Minister Piyush Goyal on the interim budget presented today. Listen into that conversation.
We are joined by the Union Minister for Commerce and Industry, Consumer Affairs, Food and Public Distribution and Textiles, Mr. Piyush Goyal. Sir, thanks for speaking with CNBC TV 18. Though it's an interim budget, of course, many announcements, many data points have been highlighted by the Finance Minister. Your first take on the budget?
Well, I think it's remarkable that Prime Minister Narendra Modi and Finance Minister Nirmala Sitharaman ji have been able to demonstrate their care and concern for the poor, their desire to see a developed India on the back of 140 crore Indians' work, Sabka Prayas, and do all of this within fiscal prudence, keeping the macroeconomic parameters extremely stable and strong. I think it's a remarkable budget, very progressive, very forward-looking, full of hope to meet the aspirations of young India, new India, and a very comprehensive budget touching upon different sectors of society, touching upon a better future for the poor, opportunities for our youth, women-led development, and increase incomes of the farmers. So every segment of society have been addressed in this budget, interim budget. Madam Sitharaman ji spoke about transforming India through reforms and through very aggressive performance to make sure that the fruits of development reach the last man at the bottom of the corridor. We see inclusive and sustainable development.
The FM also spoke about the fact that FDI into India has increased in the past 9 years to the extent that it's double than the preceding 9 years. How do you see this momentum sustaining since we are seeing global uncertainties? There are several geopolitical reasons as well as inflationary concerns in the West. What is the rearguard action being planned by the government in this regard?
Well, very clearly, foreign direct investment has been on an upswing almost since the time Mr. Modi came in. And a lot of it is to do with trust, the fact that today the world looks upon India as a trusted partner, as a friend, where they would like to work and expand more. And Prime Minister Modi has been able to give confidence of a decisive, honest leader who has devoted his entire life for the welfare and for the better future of 140 crore Indians. Having said that, I think it's important to note that the country today stands on the cusp of rapid growth and development. Fiscal prudence has prevailed. Even our last year's fiscal deficit target has not only been maintained but bettered. From 5.9, we'll actually end up with 5.8%. This year it is expected to come down to 5.1% and next year go down to 4.5%. This shows that most of the money that we are borrowing is going in for development of infrastructure. 11,000 crores being given for infrastructure development is truly phenomenal. And I have absolutely no doubt in my mind that this budget, based on strong macroeconomic fundamentals that we've been able to achieve over the last 10 years, will be a budget for all and a budget for the laying the foundation of a developed India by 2047.
The FM spoke about the spirit of first develop India. Now, even as India is looking at not just self-sufficiency but also export competitiveness in several domains, is there any policy measure or any larger government plan for duty rationalization across several segments as India wants to become more globally competitive? We are also negotiating several bilateral investment treaties and FTAs.
Well, if you will note that this has been a very dynamic government. It's always been proactive in its approach. It's always been ahead of the curve to meet the challenges of the day. In fact, only yesterday we were seeing vaccine wars. And it shows that this is a Prime Minister who has always seen and been ahead of his peers. When the world was grappling about what to do with COVID pandemic, the Honorable Prime Minister was already figuring out that science will find the way out of the vaccine of the COVID pandemic. And clearly, even in the deft handling of the economy, we have seen a similar trend. He has focused largely on strong macroeconomic fundamentals. He has focused on providing opportunities for the youth, providing women-led development as the mantra for the future, ensuring that farmers get a better deal going forward. And the sub-theme, subtext of all his work and the roadmap towards Viksit Bharat is on the strength of making sure that just like in the last 10 years, we have removed 25 crore people from multidimensional poverty. Even in the years in the future, our government will be focused for the welfare and a better future for every poor, every middle-class family in this country.
There has been an extension of benefits, not just in tax, but in several other areas till March 2025. Now, speaking of tax benefits particularly, there have been exemptions and relaxations for sovereign wealth funds. How is that going to benefit Indian companies, particularly startups, in the short to medium term?
Well, we've seen significant traction in foreign direct investment current year, of course, because of geopolitical situation or rising interest rates in developed world, we've seen a little bit of slowing down of FDI in the short run. But clearly, the India opportunity is so compelling. The 3Ds, the demography, the democracy and diversity that India offers, leading to increased demand, is such a compelling case that foreign direct investment is going to find opportunities in India. We're doing a number of free trade agreements. We're doing a number of bilateral investment treaties which will further give an impetus to international trade and investments into the country.
Well, that is the Commerce Minister Piyush Goyal in conversation with my colleague Abhimanyu, laying out his thoughts on what the budget has highlighted, more importantly, the road forward from here. Well, it is that time of the evening when we are joined by the budget makers at our budget headquarters here in the capital, the team that's been working day and night over the past several months to get the budget ready and, of course, has been delivered today. Thank you very much to the CBIC and the CBDT chairman for joining us here today. Nitin Gupta, the chairman of the CBDT, and Sanjay Kumar Agarwal, the chairman of the CBIC. Gentlemen, many thanks for joining us. Relieved the interim budget is out of the way, but you've got another couple of months and the full budget coming up. Sir, all set for that?
Yes, definitely.
You know, I want to start by asking you about where the government believes it has been conservative as far as tax collections are concerned, or at least that is a perception that the market has that the government has been conservative. I know that the finance minister was asked this question and she said, we've been realistic. But if you can explain to us the calculations on page 6, which the benefit of our viewers don't have at this point in time, to explain why you have decided to factor in 10.5% as far as tax collections are concerned.
I'll talk about the direct taxes, and if you see the numbers, our revised estimate is 19.45 lakh crores, and this growth is around 17% over what we have achieved last year. Our BE, the budget estimate which was laid down in the last year's budget, was 18.23 lakh crore. So we are moving ahead with 1.22 lakh crore more, despite paying more refunds. Which are around 11% more refunds we have already paid this current financial year. So our growth over the last, what we have achieved last year of 16.63 lakh crore has been 17%. So I believe this is quite a fabulous numbers, and with this number we would be having highest tax to GDP ratio, direct tax to GDP ratio in the entire century of this, from 2000-2001 onwards till date. And for the next year, we are growing at the rate of 13%. The budget estimate is 21.98 lakh crores, which is 13% higher than 19.45 crores. So lakh crores. So there is sizable increase so far as direct taxes is concerned, and I think we would be in a position to achieve these.
You know, you said that we are achieving the highest that we've ever seen as far as tax to GDP ratio is concerned. What is the aspiration from here on, given the fact that you've been able to deliver on this promise and this number? What is the potential? Where do you see this number?
See, we are working consistently, and despite the reduction in tax rates, a new regime which has been set into, so the trajectory is quite good, and we hope that we would be moving ahead in the same direction and bringing better results for the government.
One question, though, was that the 15% concessional tax rate, the sunset clause, comes into effect at March 2024. The expectation or the ask of industry was that extended by another 2 years, but the government has chosen not to go down that road. You've done it only in very specific cases. Why is that? Why did you feel the need not to extend it?
This is interim budget, that's it.
So we should have hope that in the full budget perhaps there could be...
Can't say anything as of now.
But is that the thinking?
There could be change in tenor, there could be change in anything. So it's again a discussion stage. So as of now we are where we are. That's the point.
Well, that's a very important point that's coming in there from the CBDT chief, that this is an interim budget and perhaps the window has been left open to make some changes. We don't know. We're speculating on the back of the comment that you've made. But let me get Mr. Agarwal into the conversation, the chairman of the CBIC. Sir, GST numbers ahead of the budget, in fact, just 24 hours ahead of the budget, coming in very strong, and you've revised those upwards now to 1.74 lakh crore rupees. What's the assessment now in terms of what you can do as far as GST is concerned, given this run rate?
For GST, the budget estimate is 9.57 crores in the indirect tax revenue of the central government. And on GST side, we are seeing a very healthy growth in revenue. And in fact, for the third time, the revenue has crossed the mark of 1.7 lakh crores. And in the month of April, it was record high at 1.87 lakh crores. And in the month of January, the revenue collection on GST front was 1.74 lakh crores. That is the second highest. And the growth in GST revenue is healthy, and it is above the nominal GDP growth. And we are expecting that this growth will continue. And the indications are that, looking to the collection in the month of January, we will do very well in the financial year and will achieve the target.
So 1.7, you've achieved that number, crossed that number 3 times already. Should we expect that to become the sort of ballpark as far as collections are concerned going forward?
Yeah. In the current financial year, in the first 3 quarters, the average monthly revenue collection is 1.66 lakh crores. And that could set the benchmark for the next financial year on GST side.
One question that I had, and of course this was a decision that came ahead of the budget, the tariff revision from 15% to 10% as far as the electronic components are concerned for the mobile phone manufacturers specifically. That of course has been taken very well, very positively, welcomed by industry. But the expectation was that we could perhaps see tariff revisions for other sectors as well. Is that a proposal under consideration?
Regarding the mobile parts, I can mention to you that there were certain disputes on the rates, and there was a need felt that on the mobile parts we must rationalize the rates, and therefore on certain parts which are mechanics or die cast parts, on which rates have now been lowered from 15% to 10% to rationalize it and to take care of the disputes which have arisen in past.
But more sectors and more revisions likely under consideration could be taken forward ahead of the budget even?
Yeah, it's an ongoing exercise, and maybe when the full budget will be presented, that time many more such steps will be taken.
The suspense continues ahead of the full budget. A quick question on excise and why we've actually seen the drop as far as excise collections are concerned.
On excise, on union excise duties, I would like to mention that it is levied only on very few items. Mostly it is collected from petrol, diesel or aviation fuel. So on that the rate is drastically reduced in May 2022, and the reduction was 8 rupees per litre on petrol and 6 rupees per litre on diesel. That has impacted the revenue collection on union excise duty. Apart from that, another levy has been levied, that is known as special additional excise duty, more popularly known as windfall tax, and that is linked to the international crude prices. So depending upon that, the windfall tax rate is fixed, and this year the windfall tax has gone down by 56% depending upon the international crude oil prices, and that has impacted the collection on union excise duty.
Okay, sir, let me ask you, Mr. Gupta, as far as what the finance minister said, that there were about 10 or 12 items in terms of the Nai Disha Ki Baatein. Now, as far as tax was concerned, the expectation was a long one that the budget would address or at least directionally signal the government's position and stance as far as the BEPS regime is concerned, for instance, or the capital gain simplification, which has been a long-standing demand. So again, suspense there, wait till the full budget?
BEPS is a continuing discussion stage, so even at the international arena, the discussions are on. So nothing can be said as of now. So the benchmark date is March 24. But on capital gains and there are other aspirational issues, I think that will be taken care of in the regular budget when it comes.
But have the consultations reached some degree of finality as far as capital gain simplification is concerned? Because this has been a process that's been underway for several budgets now.
It's a complex process. You should understand the asset class, the period of holding, the rate of taxation. So it's a complex process, and
with very competing demands being made of the government.
So let us see at the time, whenever the opportune time comes, we'll definitely work on it.
So there is no finality or no consensus or no agreement on the treatment of any of these issues at this point in time?
As of now, at the interim budget stage, no.
Okay. Where do you get comfort from as far as tax collections are concerned today, given the fact that we are now likely to see the economy grow closer to 7%, even in FY25? That's the projected estimate. What's giving you comfort at this point?
Comfort is arising out of, our corporate tax rates are growing at a lower rate as compared to the personal income tax. So income tax is giving us a good buoyancy, and technology is the biggest enabler for us, and we are serving the taxpayer in the right spirit, and we are getting the benefit of that arising therefrom. And the growth in the personal income tax is around 27%, 26 to 27%, which is giving us the real jump in collections.
And, you talked about technology, and I want to ask both of you this question because we have now seen both departments working much more closely together, using technology to be able to make sure that we get the tax that the government is owed. On the back of that, this improvement that you spoke about as far as tax GDP is concerned, how much of this is linked to the efficiencies that you've been able to draw as far as technology use is concerned?
Very difficult to put into some classification. It's a cumulative effect. It's the effect which is coming out from a number of factors which could be there. So it's difficult to identify that role of technology into the development, means increase in taxes and therefore the tax GDP ratio.
Again, there were expectations that as far as income tax is concerned, there would be some sweeteners. Going by the fact that the 2019 budget had brought in sweeteners on standard deduction. So, again, the government choosing not to do anything at all in this budget. But is there a case to be made now as far as, enhancing limits are concerned? Is that something that is under consideration at this point in time?
Last year, we have come out with a new regime, sweetened new regime. And this is the first year for the operation of the regime. Let us see what happens, in what way benefit.
Are you more satisfied with the migration?
We will actually know in July, because the due date for filing return will be July. But I think, as I said last year, we'll see a very good range of migration running into 60% or so.
60%, that's the expectation?
Yes. Sharon, you mentioned about the use of technology and the department. I can mention that we are using the big data, because we are now getting the transactional data and we are receiving the data from other sources. And now, as you mentioned, there is a data exchange between Income Tax Department and GST. So that is helping us in ensuring, by doing the data mining, using the data analytics tools, to identify the areas where there is leakage taking place. And apart from that, we are using GSTN to upfront informing the taxpayer that if there is a gap between their different returns, so that gap is intimated to them so that they can voluntarily bridge that gap, make that differential payment.
Right.
So we are encouraging that voluntary payment by the taxpayers. And apart from that, the return filing by the GST taxpayers have now gone up to the extent of 90%.
Okay.
So that is a very good return filing, even by world standards.
Okay, so good news coming in there as far as GST return filing is concerned. But good news that is expected or hoped for on the GST front is, when will we move to a 3-slab GST regime? And I know that this is not a budget-related issue, but I would imagine that perhaps in the next budget, the government could signal its intent to move closer to that, or to a 3-slab regime. Has there been any work, any consultation at the level of the officers, etc., with the state officers as well on the move towards that?
I would like to mention that GST Council, they have already set up a GOM, that is a committee which has been set up to look into the rates. And that committee has now recently been reconstituted also.
Yes.
So that committee would look into all this rate structure and will make their recommendations, which will go to the GST Council.
What do you think is a viable rate structure? Is a 3-rate structure a viable rate structure for the Indian economy?
As we all understand that, yes, there should be one mean rate and there should be a lower rate for essential goods. and there may be a higher rate for the luxury commodities. So that should be the ideal rate structure, but it will depend upon how the recommendations will be made by GOM, which will be placed before GST Council, which is the ultimate deciding authority.
Which is why I said it's not a budget item specifically, but of course the government, the union government will directionally signal its intent to take this forward and get the states on board. But let me understand from you, sir, there was an announcement as far as the dispute withdrawal scheme was concerned as well. If you can explain to us the contours of that and how that's likely to work.
It's not dispute withdrawal scheme. There is nothing like dispute. See, you have to see it in the perspective of demand management. And whatever outstanding demand we have on our register, see, our act came into operation from 61, 62, and it's such a long time has elapsed that there could be demands of any era, any period. And when the taxpayer may not have the records, we may not have the records. There were manual system of, like if a taxpayer makes the tax payment, there were manual system of adjustment because earlier there was no online payment. So it's a legacy issue. And while doing the demand management, we are of the view that on the bigger demands, we are working separately through Demand Management Center at Mysore, and they are working through our entire chain of offices on higher demands. But these small demands are a matter of concern to us insofar as the grievances are arising out of that. We are not able to process the returns in a faster way. Like the FM has said, Honorable FM has said that 10 days we are processing, the average time is reduced to 10 days. So from the overall perspective, the decision has been that if we can extinguish these demands at the source stage itself, that will cleanse our books of accounts, and we will be able to focus more on the effective way on a larger demands, and we will be able to give a taxpayer service which is expected of us. So it's an innovative step taken by us. I think all tax department will be facing this sort of problem, that old legacy issues are pending, and because it's a 61, 62 we are in operation, you can think of, and the taxpayers are not aware of the issues, that it could be because of tedious mismatch, smaller demands. We want to clean our books of accounts and give a relief to the taxpayer as well.
Well, since we are talking about demand, let me address the issue of demand notices that have been going out both from the Income Tax Department as well as from the GST wing. Practically every other day there is news or reports suggesting that there is somebody that's being searched, somebody that's being raided, and so on and so forth. Can you explain to us the quantum of these operations, of these demand notices that have gone out so far, and what concerns you there?
I don't think these are two different matters. One is the enforcement matter, that what you are talking about, some search or survey or something, which is on a different perspective, and the demand notices being issued on completion of assessment, which is a regular exercise, and obviously it picks up at the end of the financial year because the time available for the assessing officer is limited, so it picks up at the end of the assessment year, at the end of the financial year. So that could be, these are two different phenomena which will happen simultaneously.
No, so on both these parallel tracks now, especially as far as the enforcement operations are concerned, I mean, what is the universe of companies that is currently under sort of scrutiny?
I won't have the data often because the selection of cases is through computer-assisted selection methodology, and so I won't have the data right now with me on this.
But good news coming in for the department, with the Delhi High Court upholding the anti-profiteering provisions of the GST law, which was something that many companies had moved the courts against. And I want to understand from you at this point in time, again, many notices being sent out by the GST department, especially a whole bunch of insurance companies and so on and so forth. What are the pockets of concern for you today?
You mentioned about number of GST notices which have gone to the taxpayers recently, but that was mainly because of the time limits which were going to expire in the end of December or in the end of March. So depending upon that number of show cause notice which were selected, cases of scrutiny or audit or enforcement action were to be issued within the time limit. So therefore number of show cause notices have gone to the taxpayers, but I have already issued instructions to the field formations that they should be careful, they should examine the representation made by the taxpayers. And after considering their representation, then only once they are satisfied that a demand notice is to be issued, then only they should issue the demand notices.
But any sectors, like for instance, we've seen virtually every insurance company being sent a notice. Are there any sectors in specific where you find that there are vulnerabilities that the department is looking at?
You mentioned about the insurance sector. In that, certain notices have gone to them on certain issues, and we have received the representations. Those representations are being examined by the respective committees which are set up in the GST overall framework. That is, one is the law committee, other is the fitment committee. They are looking into these issues, and in due course, after examination of issues, the matter may be taken up.
Mr. Gupta, as we head now to the full budget, the odds, the possibility of a higher upward revision on the numbers that have been presented.
Can't say that now.
Does it look like a strong case for an upward revision, you think, on the back of the available data?
Can't say anything as of now.
Can't say anything as of now. What will be the priorities as we move closer to that date?
The priorities are already set for the tax department, and we are working in that direction. And like the first quarter will be very important for us to give taxpayer services for the entire year's data, AIS statement, which is being used by the taxpayer, the return form availability, the softwares, and that is a regular exercise which we do for the months in June and July. So that will be the priority, simultaneously budget formation. So that's.
And the use of AI, I want to understand from both of you what both departments are doing in terms of using artificial intelligence, if at all, at this point in time, or is there a roadmap or a plan to be able to do that? I'll start with you, sir.
See, the system side is very complex, and it will not be appropriate to talk about this right now because it's a separate exercise altogether. It's a huge, because everything is on the system now. And our endeavor is to put whatever is not available on the system to put it on the system. So it's a immaculate exercise, a very huge exercise which is being done definitely at our end. So it's a separate. We can discuss it separately at any point in time.
Fair enough. We look forward to that because that's going to be important as well. Let me get you to comment on that as well.
Yeah. Use of AI is definitely happening in the department on GST side as well as on custom side. We are using AI to refine our target because we are adopting a targeted approach, and now we are refining our targets so that we can increase the facilitation percentage in case of imports, and because of that we have now able to increase the facilitation percentage to that extent of 85%. So that is the use of AI in the department on custom side, and we are not only using AI, we are using many more multiple tools. Like machine learning we are using, and we are using generative AI also for tax analysis. So these are the new tools which we are using for provide better services to the exim community and to increase the facilitation percentage. And that is leading to decrease in average release time. So we are conducting these studies on regular basis, and that has indicated that there is drastic reduction in the average release time on import side as well as on export side.
So I'm going to go back to the suspense that we were speaking of. We were given to understand that maybe about 40 items are up for consideration as far as customs duty revisions are concerned. We only saw the components linked to mobile phone manufacturing being changed. So that's up for discussion, up for approval perhaps in the next few months?
I would like to mention, Shireen, that in customs, now all the conditional notifications, they have the end date. So before the end date, all those customs notifications are examined, whether there is a need to continue them or they have to be phased out. So that exercise is an ongoing exercise. And you might have seen that recently government has extended the date, which was 31st March 24 to 30th September 2024, so that this exercise can be completed and maybe before the full budget.
Maybe before the full budget. Well, gentlemen, a well-deserved rest for the two of you this evening as you presented the interim budget, of course, part of the budget makers team. Thank you very much to both the CBIC chairman and the CBDT chairman for joining us here at the CNBC TV 18 budget headquarters. We look forward to seeing you in a few months from now as the full budget is unveiled.
Thank you very much.
Thank you so much for joining us. More budget makers joining us right after this short break. Don't go anywhere. We're back in a moment with more.
Namely, 7 IITs, 16 triple ITs, 7 IIMs, 15 AIMS, and 390 universities have been set up. PM Mudra Yojana has sanctioned 43 crore loans, aggregating to 22.5 lakh crores of rupees for entrepreneurial aspirations of our youth. Chess prodigy and our #1 ranked player Pragyananda put up a stiff fight against the reigning world champion Magnus Carlsen in 2023. Today, India has over 80 chess grandmasters compared to little over 20 in 2010. In the full budget in July, Honorable Speaker, our government will present a detailed roadmap for our pursuit of Vikasit Bharat. Revised estimates of 2023-24. The revised estimate of the total receipts other than borrowings is 27.56 lakh crores of rupees, of which the tax receipts are 23.24 lakh crore rupees. The revised estimate of total expenditure is 44.90 lakh crore rupees. The revenue receipts at 30.3 .
Well, we're going to address some news that is just coming in, and this is on the Byju's front, and the troubles do continue because now we have been given to understand that a bunch of shareholders that represent nearly 30% of the shareholding, in Byju's because of their investments in the company, have now issued a notice to the founders, to the board of directors of Think and Learn, which is the parent entity of Byju's, asking them to convene an extraordinary general meeting on the 29th of February, citing concerns about the persistent issues relating to corporate governance, mismanagement and compliance, seeking to change the existing leadership, seeking to reconstitute the board of directors. Now, who is on the board of Byju's parent Think and Learn at the moment? After the resignation of multiple investor shareholders, it is only now left with Baiju Ravindran, the founder, the co-founder Divya Gokulnath, who is also his wife, and Baiju Ravindran's brother, Riju Ravindran. So these are the three members that remain on Byju's board. And these investors who we've been given to understand include the likes of, Peak 15, Safina, the Chan Zuckerberg Foundation, General Atlantic, Prosus, Owl and Sands. They've requested for this EGM to be convened. Now, they say that the request comes after several earlier notices of requisition which have been sent to the Think and Learn board of directors in the months of July and December last year, and these were disregarded according to the notice that has been sent by the investors, which we at CNBC TV 18 have reviewed, and therefore now they've put forward the request for this EGM to consider the resolution of the outstanding governance, financial mismanagement and compliance issues, so that the current company is no longer controlled by the founders of Think and Learn, seeking a change in the leadership. Now, I think this is the very first time that you have the investors of Byju seeking the removal of Baiju Ravindran from the board, from the management of the company, because so far, there have been protests, there have been internal letters, there have been discussions, there have been nudges about various issues from corporate governance to management to whatnot. The company even brought on the likes of you have Rajneesh Kumar and Mohan Das Pai as advisors to the board to sort of rectify the path after the multiple exits that we saw from the board. But despite all of this, it seems things are heading nowhere. And this is just coming days after, Baiju said it is seeking to raise about $225 million through a rights issue from its existing shareholders. And now you have the shareholders raising these concerns, seeking to change the management. So it's a big question mark on the rights issue itself as well, on whether that will go through or not. But this is the development that has just come in that we'll continue to track for you here at CNBC TV 18. But for now, it's time for a short break. Don't go anywhere. We'll be back in just a moment with more news and updates.
₹3 lakh crore rupees are expected to be higher than the budget estimate, reflecting strong growth momentum and formalization in the economy. The revised estimate of the fiscal deficit is 5.8% of GDP, improving on the budget estimate, notwithstanding moderation in the nominal growth estimates. Budget estimates for 2024-25. Coming to the year 2024-25, the total receipts other than borrowings and total expenditure are estimated at 30.80 and 47.66 lakh crore rupees respectively. The tax receipts are estimated at 26.02 lakh crore rupees. The scheme of 50-year interest-free loan for capital expenditure to states will be continued this year with an outlay of 1.3 lakh crore rupees. We continue on the path of fiscal consolidation, as announced in my budget speech of 2021-22, to reduce fiscal deficit below 4.5% by 25-26. The fiscal deficit in 2024-25 is estimated to be 5.
No surprises from Finance Minister Nirmala Sitharaman as the government opts for prudence over populism in the interim budget. No changes to income tax rates and capital gains tax, pegs nominal GDP growth for FY25 at 10.5%. Finance Minister sticks to the path of fiscal consolidation and springs a pleasant surprise, projects a fiscal deficit target of 5.1% of GDP for FY25, expects to end this financial year with a deficit of 5.8%. The government banks on lower borrowing and higher revenue mobilization to keep the deficit in check, proposes to borrow just over 14 lakh crore rupees from the market, which is 8% lower than last year's estimate. Also pegs gross tax revenue growth at over 11% in FY25. The government's infrastructure push continues. The capital expenditure outlay is hiked by 11% to more than 11 lakh crore rupees. The finance minister promises to build 3 major rail corridors. 40,000 rail bogies will be upgraded to Vande Bharat standards. Stock markets give up early gains to end marginally in the red. The rupee gained strength and bond markets cheer the budget after the government scaled down its borrowing program. The government sets another big 50,000 crore rupee divestment target for FY25 after a tepid show so far in FY24. Even the revised target, 30,000 crore for FY24, is well above market estimates of nearly 20,000 crore rupees. A sharp 13% cut in fertilizer subsidies helps trim the overall subsidy bill. The outlay for food subsidy is also 3% lower at just under 2 lakh crore rupees. No capital infusion for oil marketing companies this financial year. The government halves 30,000 crore rupee funding plan and defers it to FY25. The government overshoots the FY24 budget for the Rural Employment Guarantee Scheme by 43%, maintains the revised 86,000 crore rupee number as the outlay for FY25. The Finance Minister proposes to set up a research and innovation fund with a corpus of 1 lakh crore rupees, promises long-term financing at low to nil interest rates for a tenure of 50 years. Those are the big budget headlines that we're tracking for you. You are watching CNBC TV 18. I am Ritu Singh. Here are the other headlines this evening. Shares of Paytm plunged 20% after the RBI crackdown. Brokerages believe the new restrictions will end all operations of Paytm Payment Bank for all practical purposes. This even as Paytm claims the annual EBITDA impact will be 300 to 500 crore rupees. Investors in embattled edtech company Byju's call for an extraordinary general meeting on the 23rd of February, seeking a change in leadership among others. Sources say multiple investors are signatories to the EGM notice. Viacom 18 is in advanced stages of talks to buy a majority stake in Disney India. According to a Wall Street Journal report, the deal will likely value Disney's India business at around $3.9 billion. Global markets remain largely subdued after US Fed Chair Jerome Powell signals a rate cut unlikely in March. Crude oil prices post the first monthly gain since September. All right, so back to our budget coverage then. Prashant Nair spoke to Amitabh Kant, who's the former CEO at Niti Aayog, for his take on the interim budget.
Mr. Kant, great to have you with us here, sir. Prashant this side. Your first thoughts, first impressions of what you've heard, many were thinking that this is going to be, a full-fledged kind of a budget. I think that view was in the minority. Most thought this will be interim, and we've got exactly that. So I have two questions. One, do you think what we've heard will be continued through in the big budget in July, or will we see big changes? And two, what are your first thoughts on what we've heard? Capital expenditure, spending growth, and of course, the fiscal deficit and the consolidation we've seen there. Go on, sir.
So, Prashant, I think it's a budget by a government which is demonstrating confidence that it will come back. And also, it's a budget by a government which believes in fiscal discipline. So I was quite impressed by the fact that it's talking about fiscal deficit at 5.1% and then bringing it down, laying down a clear roadmap for 4.5% the subsequent year. And I think that's really critical because that would really mean that government will borrow less, interest rates should come down, the private sector should be able to access resources at a much lower rate of interest. We should be able to kickstart private sector investment in a much bigger way. I think those are all critical messages to be sent out, and I think this demonstrates a huge level of fiscal discipline. Also, the fact that from 2013-14, from 1%, it has taken the capex to about 3.3%, and now this year to 3.4%. Now, government has done its bit in terms of capex spend, and my view on that is that we should now crowd in private sector investment into infrastructure as well.
Mr. Kant, just to one quick point on divestment. It's come up again and again. I mean, I think the RE has been revised to 30,000, and the budgeted estimate is 50. This is as good a time as any. I mean, maybe the best time for the government to collect funds. And many in the market believe, well, will we see that in a big way? And why not in the first year of the new term? Yeah.
No, I totally agree that I'm a great believer that if the country's productive efficiency has to improve, if India has to grow at higher rates, and incidentally, my view on this, on the nominal growth rates, is that it's very moderate rates have been put into the interim budget, and probably we'll end up faring better. But my view on this is very clear, and I've been a long-term advocate of the fact, as the Prime Minister has been advocating that it's not the government's job to be in businesses, except a few areas. Government should disinvest. Government should do asset monetization in a bigger way. All this helps to bring in private sector. And I'm a believer that private sector brings in greater productive efficiency in the long run. In the interim period of the last 3 to 4 years, government has created a lot of infrastructure, but it should, in a transparent, competitive manner, put it out for private sector to bid and do operation and maintenance. A lot of more disinvestment should kick in in the coming years, and that will bring in, because the government will get the right values. This is the best time to get the right values. Otherwise, and it'll bring in great efficiency into the economy. In long term, if you have to look at a 2047 vision, it's very clear that private sector will have to play a far more critical role.
Mr. Kant, while in the speech there was a focus on women, youth and farmers, etc., and even the rural economy, but we haven't seen big measures which can boost consumption, particularly at the rural end, which some people in the market find surprising considering we are in an election year. How would you respond to that?
Well, I'm not a great believer in a consumer-led growth story. I'm a great believer in infrastructure-led growth story. It takes a little more time, but in the long run, that's what drives the economy. If you're looking at 2047, if you want to get into 9 to 10% growth rates over a long period of time, I mean, many countries of the world have done it. There are challenges in the global economy. But the only way for India to grow on a sustained basis is infrastructure, infrastructure, and infrastructure. And that will create rural demand. I mean, if you're going to create roads in rural areas, if you're going to put electric buses in rural areas, if you're going to provide rural houses, which the budget does, if you're going to do a rural solar rooftop, if you're going to provide piped water connection in rural areas, if you're going to do toilets in rural areas, whom will it benefit? It will benefit the rural population. It should all be infrastructure-led, which will create great consumer demand in due course. And that is how the country will grow in the long run. So don't get into this bogey of creating artificial consumer demand.
Well, that is Amitabh Kant there with his take on what the budget means for the economy. And of course, we have to wait for the union budget for many of those measures that he was talking about. We continue our lineup of budget makers. Joining us here in the CNBC TV 18 budget headquarters, the Chief Economic Advisor Anantha Nageshwaran and the Revenue Secretary Sanjay Malhotra. Gentlemen, appreciate you joining us here on the program. And I would imagine that today will be a day of well-deserved rest at the end of the interim budget. But the clock starts now for the main one.
Well, it's the well-deserved day of rest. We have to wait for one more day at least.
But this was just a promo, a teaser?
You can say so.
You know, your review, which came ahead of the budget, sort of set the tone for what the budget was going to unveil and what the budget was going to say. I think the big highlight really has been as far as fiscal consolidation is concerned, and the very sharp 70 basis point cuts that the government is estimating as far as fiscal consolidation goes. Do you believe that that opens up the room now, even for the MPC to act going forward and look at lowering rates?
No,
what will this mean as far as cost of borrowing is concerned?
Shireen, I don't want to go into what MPC should be doing, so I'll leave it there.
But what do you believe will happen as far as cost of borrowing is concerned, given the fact that aggressively you're chasing fiscal consolidation?
Absolutely. I mean, it's realistic. It's not aggressive. It's realistic, and we are not overestimating growth. We are not overestimating revenue buoyancy.
In fact, the quibble is that you're underestimating.
Exactly. So we are doing it realistically, and that shows that we are being the path of prudence and transparency that has been followed over the last several years is paying dividends. And I think the rating agencies will, and I hope, and they should take note of it.
So an upgrade is what you expect on the back of the glide path that has been stated today?
No, our expectations don't really matter. What matters is what matters is what we are doing. We are doing all the right things. And therefore, it is for them to take notice of that.
But, you know, a 70 basis point shaving off as far as the fiscal deficit is concerned, what do you believe could be the potential challenges in being able to achieve that?
Well, one could always talk about the global environment, the price of oil contributing to lower GDP growth, etc. But I think the fact remains that our assumptions are realistic enough, like it was this year. For example, this year, nominal GDP growth is going to be less than what we assumed, but yet the numbers are able to give us, we're able to achieve a gross fiscal deficit ratio of 5.8%. So in that sense, the conservatism, it will stand us in good stead. despite the fact that the world economy is still rife with uncertainties.
Yes, the world economy is rife with uncertainty, and I'll come to that in just a second. But let me get the Revenue Secretary also to address this issue of conservatism that people are highlighting and what you see as the road ahead from here on.
No, I think, it's a very realistic budget. And the very fact, that we have been able to continue to spend on and budget, for the capital expenditure and not giving, not increase, the revenue expenditure so much should bring in confidence in everyone that the fiscal numbers, the deficit numbers, the numbers for our revenues are very, very realistic and very achievable.
You talked about the capital allocation. I want to get both of you to comment on that, because there was an expectation that there would be a tempering as far as that number is concerned, given the fact that we are coming off record high numbers in terms of capital allocation. Would it be fair then to assume that, the 10-11% would now be the new normal as far as capital outlays are concerned?
We don't need to think too far ahead. At this point, as the FM also mentioned in the press conference a while ago, this 11% growth is coming on a very high base.
Correct.
Now, obviously, next year, if we get to 11 crores, 11.11 lakh crores, etc., the base will be even higher. So, and if the private sector is kicking in, we will basically cross each bridge as we come to them.
On the private sector, and I think the Finance Minister alluded to that as well, that the reason why there has been a seeming pullback as far as the government sort of capital outlay is concerned, because you see the private sector coming in, and you've been, of course, talking about incipient and now very clear signs of private capex picking up. Lay out for us where you believe we're likely to be over the next few months.
No, first of all, I would like to clarify, Shireen, that the government is not pulling back on capital expenditure. It is the rate of growth, that is rate of growth of capex increase, that is slowing down. The government is not pulling back.
Yeah. Fair enough. Yeah, but on private capex.
No, we are seeing it in the data. I mean, on listed companies, private sector capex has been rising. And if you look at the announcements, if you look at the data on new fundraisings, all these things point to the fact that, and the revival in the manufacturing sector, all these things are pointing to a good growth in private sector capex. I can't put numbers on it because, after all, it is an aggregation of so many companies out there, thousands of them. And I think we are seeing a very good pickup even there as well.
I just had the CBDT chairman here, Mr. Malhotra, and of course, one of the big highlights is the tax to GDP ratio, which is at a century high, as the CBDT chief is also pointing out. In terms of prioritization now, if this was the promo and this was the trailer, there are many sort of unfinished things on the agenda that need to be considered. What is being mulled at this point in time, whether it is capital gains simplification, that of course has been on the anvil for a long time. We don't know whether there is any more clarity on how you intend to take that forward. Lay out for us what the roadmap could potentially look like.
No, right now we are looking at consolidating, and we are looking at, being able to achieve whatever are the numbers that have been given to us. Number one, that is, most important for us, because if, the CA and, if the fiscal numbers have to be actually met, the target that has been given to us for revenue, that has to be achieved. And you already mentioned that it is coming, on a very high buoyancy, a buoyancy of 1.4, because the economy, is expected to grow at 8.9%. And the overall tax revenues this year are expected to grow at 12.5%. They are growing at 13% right now. So that means a buoyancy of 1.4. And then, again, a buoyancy of 1.1 next year. 10.5% GDP expected to grow, and 11.5% tax revenues gives us almost, a buoyancy of 1.1. So to be consistently improve revenues more than, the growth rate in GDP, that is, going to be the first challenge. And that is, that is very important. Having said that, of course, for us, and that is, without increasing any tax rates. You have seen, there are no tax rate increases this year. Last year, there were huge tax rate cuts. Before that, there have been tax rate cuts, both, on corporate tax as well as, on the personal income tax rates. So we are certainly, not looking at increasing the tax rates. So how do we do that? Of course, we have to deepen, our tax base. We have to widen our tax base. And we have to make it, easier for people to file tax returns, easier to, do compliances, and easier, to make those payments and plug, whatever are the loopholes that are there. So that's going to be, the areas of focus.
Well, unlike last year, where there were a couple of points of controversy, including, of course, what we saw happen as far as gaming was concerned and TCS this time around, and nothing much to quibble about. But on both of those issues, and I know you clarified that there is no change as far as the TCS rate is concerned, it is basically legitimizing or just reaffirming the rate that was put out as far as the press release goes. But on gaming specifically, now the matter is sub judice. Where do things currently stand?
Let me first of all tell you, that the changes that were made for online gaming, of course this is not a budget issue, but since you have asked this, from 1st October, our revenues have multiplied to 6 times. 6 times. Over the 3 months, that revenues that we have got, they are averaging about 1,200 crore, vis-a-vis 200 crore per month revenues that we were getting.
And only from the online gaming platform?
Only from the online gaming platform. This does not include, the casinos, etc. So there was a huge potential which was there, which was untapped, and which we have been now able to tap. Insofar as the question as to whether, these changes were retrospective or prospective, of course, these changes were prospective. Retrospectively also, our belief was that the online games were liable to pay a 28% tax rate because these were actionable claims. Their claim is that these are not actionable claims, and so, they are liable to pay 18% on what is called GGR. So that dispute is in the court. But going forward, there is no issue. All of them are paying 28%, and they are paying 28% on the actual value paid.
Let's address the global uncertainties that you just spoke of. And we just had the Fed present its commentary last night. And the expectation is now that a March cut looks unlikely, and the cut is probably moved further down the road. There is also, of course, what is happening in the Middle East, specifically what's happening in the Red Sea and the potential of that impacting inflation if this were to be a protracted, long-drawn affair. How do you read both these developments?
Well, I think the decision by the Federal Reserve to probably give an indication that rate cuts are not imminent isn't really going to materially affect the glide path for our economy or the interest rates, etc. I think we saw that the Indian economy's interest rate increases weren't really walking lockstep with the Federal Reserve over the last 2 years. So that we can kind of leave it out of the picture for the time being. Now, more important thing is what you mentioned about the Red Sea conflicts and the implications that they carry for supply chain disruptions and therefore potential for inflation. However, it's interesting that in a way, since the conflict broke out in October in Middle East, and oil prices have still been quite subdued, very well contained, and over the last 4 months now. So we'll have to wait and see. The supply disruptions have to be much larger, overcoming the demand slowdown that is occurring because of slowing growth in the US and in the Eurozone, etc., and also the continuing economic stagnation in China, etc. The demand side is also helping to cushion the possible uncertainties, but these are things that we can't really map out far too many scenarios at this point, except to keep an eye out for them.
Yes, these are developing situations and scenarios at this point in time. But, from a Make in India aspiration, and we've, of course, seen a continuation of measures being announced, whether it was the PLI scheme or just ahead of this budget, the cut as far as import tariffs were concerned from 15% to 10% on electronic components for the mobile phone manufacturers. Your assessment on how things are working on that front, especially keeping in mind the supply chain diversification that's currently underway. Are we really making good of the opportunity that exists? And what more perhaps needs to be done?
No, absolutely. These changes that were brought in with regard to the import duties on mobile phones, again, that's a step towards simplification, because if we have, too many rates, and we had, a 10%, a 15%, and a 20% rate on similar products, on overlapping kind of items. So this was a move, towards simplification. Not so much, I don't think it is so much, about reduction. It is, of course, we have reduced those rates, but it's more about, providing clarity. So going forward, again, the import duties, as you have seen, wherever, the PLI schemes are there, we will continue to support the PLI schemes. The import duties are there not, primarily as a measure of revenue, because they are quite small. 2 lakh, out of a total budget revenue target, of about in excess of 35 lakh now, touching almost 40 lakh. So it's 6%, maybe about 6%. So it's not so huge. So the customs duties are changed basically to promote our manufacturing and keeping in view, the inflation. So we will continue to support that.
One of the expectations was that the 15% concessional tax for new manufacturing facilities would be extended beyond the sunset of March 2024. That hasn't happened. Does that mean that the window is closed on that, or does the window remain open perhaps for the next budget?
That window certainly will close, on 31/3/2024 because it's not been extended. See, it doesn't help. If you extend it, for another 6 months, 9 months or 1 year, it really doesn't help, because industries, have a gestation period of at least, 2 years. Big industries, for them to come in, they need, certainty for a long period of time, because to make those investment decisions first and then to, put them on ground takes a lot of time. And so when, this scheme was actually announced in 2019, sufficient period was given. It was further extended because of COVID. Sufficient time was given for that, and we are beginning to see, benefits of those number of companies have actually started, manufacturing. Some of them are taking benefits thereof.
Right.
Also keep in mind that the corporate tax rates today are very competitive. I mean, 22% is not a very high number.
So the window closed as far as being able to avail of that 15% concessional tax rate beyond March 2024. As far as consumption is concerned, and again, the expectation was that perhaps to further drive the rural consumption, there would have been an enhancement of the PM Kisan scheme, for instance, also factoring in inflation, etc. That has not been the case. Of course, there are other announcements that have come in, particularly around housing and solar rooftop and so on and so forth. On balance, from a consumption perspective, how much do you believe the needle has moved?
I think there was an announcement before the budget last month about the extension of the PM Garib Kalyan Yojana for 5 years.
Yes.
And I think that was a very big announcement. That was a very big support to consumption. And as you yourself pointed out right now, there is the extension of the PM Gramin Awas Yojana and then the Lakpari DT scheme. So, and if you look at the data on automobile sales, starting from two-wheelers at the end of the calendar year 2023, there has been a definite pickup in the sale of these vehicles, starting from scooters all the way up to four-wheelers. So I think, and lastly, I would say this is an interim budget, so we should remember that.
It is an
interim. The focus has been really, over the years, as you have seen, last year, this year, and before that, on capex. And capex in itself, of course, increases consumption in itself. So employment, incomes, and then consumption. So I would rather see that as a positive.
Right.
That we have been able to spend more and more on capital expenditure.
Yes, and that certainly has been the case. Gentlemen, thank you very much for joining us here on CNBC TV 18 with your take on the interim budget. And of course, more is likely in the next few months as the government gets ready to prepare the full budget. But thank you so much for joining us here this evening. Appreciate your time, and we look forward to seeing you again. We will take a break, but budget makers continue here on CNBC TV 18. Don't go anywhere. We're back in a moment with more.
%1% of GDP, adhering to that path. So the gross and net market borrowings through dated securities during 24-25 are estimated at 14.13 lakh crore rupees and 11.75 lakh crore respectively. Both will be less than that in 23-24. Now that the private investments are happening at scale, the lower borrowings by the central government will facilitate larger availability of credit for the private sector. A large number of institutions of higher learning, namely 7 IITs, 16 triple ITs, 7 IIMs, 15 AIMS, and 390 universities have been set up. PM Mudra Yojana has sanctioned 43 crore loans aggregating to 22.5 lakh crores of rupees for entrepreneurial aspirations of our youth.
Now, shares of Paytm hit lower circuit today after the RBI imposed major restrictions on Paytm's payment bank yesterday. Now, addressing a con call with analysts today, its founder Vijay Shekhar Sharma called these RBI restrictions a big speed bump and said that the company will be able to sail through with the support of banks and that many banks have already reached out to the company to extend their support. Essentially, the reason why RBI took this action goes back to March of 2022 when they first barred Paytm Payment Bank from onboarding new customers. Now, we've been given to understand that this action was taken after deficiencies were observed in the KYC processes, transaction monitoring and risk alerting system of the bank, and these are not rectified even after 22 months, leading to this kind of a change. Now, we've also been given to understand that Paytm Payment Bank has approximately 3,000 to 4,000 crores worth of deposits with it at the moment. Now, Paytm in a statement clarified that it expects an annual EBITDA impact of 300 to 500 crores because of the restriction and that it is now going to be working with other banks and not with Paytm Payment Bank for the payment business anymore. Brokerages, of course, are negative on the stock. You have the likes of Jefferies downgrading the Paytm stock to underperform with a target price of 500 rupees. The likes of Macquarie equating this, to RBI virtually invoking or revoking the PPI license granted to Paytm, and Bernstein saying that this actually ends the operations of Paytm Payment Bank for all practical purposes. Hear out its founder Vijay Shekhar Sharma on what he had to say on this issue.
Going forward, the keyword is that we will not work with Paytm Payment Bank, and that is what probably means that other banks will come. Paytm, I can say that it is more of a big speed bump, but it is something that we believe that with partnership of other banks and capabilities that we have already developed, we'll be able to see through in next few days or quarters, as the case would be.
In other corporate news then, Viacom 18 is in advanced stages of talks to buy a majority stake in Disney India, according to a Wall Street Journal report. Now, this report says that the deal likely values Disney's India business at around $3.9 billion. Nisha Podar joins us now with more details on the story. Nisha, take us through what's happened so far and what you're picking up.
Well, that's right. It's a large transaction that is brewing in the media and entertainment space, and reports do suggest that Viacom 18 is likely to buy a majority stake in the India operations of Disney. Now, remember that the valuation, as reported, has taken a dip for Disney India, is what reports have been suggesting, to $3.9 billion. Earlier estimation was much higher than this. A few of the factors has really impacted the valuation for these businesses, especially losing the mainstay IPL rights, and that has also lost a lot of subscribers for Disney's India business. And on the other hand, Zee being incapacitated to pay up for the TV rights for the men's cricket that it had earlier agreed to buy from Disney because of the Sony merger falling through. So all these, along with the fierce competition that is being posed in this particular segment, well, Disney India
India's valuations are likely to be much lower than earlier anticipated. As part of the deal structure, reports suggest that Disney is likely to own about 40% in its India business, and majority stake would be sold off and merged into Viacom 18 and Bodhi 3 joint venture, in which Viacom 18 is likely to have the majority stake and could be paying about $1.5 billion of cash as part of this deal structure.
Nisha, thanks very much for joining us with that story. Now, the U.S. Federal Reserve announced that it has left interest rates unchanged after its two-day Federal Open Market Committee meeting. The Fed's statement indicated that it is not ready to start cutting rates, with inflation still running above the central bank's target. Addressing a press conference, Fed Chair Jerome Powell said policymakers are waiting to see more data on the lowering of inflation near its 2% target. Powell also added that a rate cut is unlikely in March as well.
We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. It's not that the 6-month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably under 2%?
In the earnings space today, Adani Ports reported a strong third quarter. The net profits rose more than 67% to 2,200 crore rupees, while revenues jumped nearly 45% to 7,000 crores on an annual basis. Now, during the quarter, the company hit its highest ever quarterly cargo volume of 108 million metric tons. In other earnings then, Godrej Consumer shares hit record highs today after an in-line third quarter. Quarterly profits beat expectations owing to stronger gross margins and better cost management. The revenues were also in line with estimates but grew only 2% year-on-year, owing to an 8% decline in the company's international business. Okay, on that note, we're going to have to slip into another short break, but don't go anywhere. We're back in just a moment with other news and updates.
Chess prodigy and our #1 ranked player Pragyananda put up a stiff fight against the reigning world champion Magnus Carlsen in 2023. Today, India has over 80 chess grandmasters compared to little over 20 in 2010. A large number of institutions of higher learning, namely 7 IITs, 16 triple ITs, 7 IIMs, 15 AIMS, and 390 universities have been set up. PM Mudra Yojana sanctioned 43 crore loans aggregating to 22.5 lakh crores of rupees for entrepreneurial aspirations of our youth. Chess prodigy and our #1 ranked player Pragyananda put up a stiff fight against the reigning world champion Magnus Carlsen in 2023. Today, India has over 80 chess grandmasters compared to little over 20 in 2010.
Welcome back. You're joining us at the CNBC TV 18 budget headquarters. The budget makers continue to be with us. Joining us now is the Finance Secretary, Mr. T.V. Somanathan, and the DPAM Secretary, Tuhin Kanta Pandey. Gentlemen, appreciate you joining us here. A little bit of a reprieve at the end of today with the interim budget being done, but this is only a trailer because the big one's coming up, Mr. Somanathan.
Yes, that's true.
Let me start by talking to you about a comment that you made in the press conference. You said our estimates on collections, tax collections, are realistic but slightly conservative. If you can highlight for us why you believe that you've decided to err on the conservative side, and how much room does that give you then for an upward revision?
No, I think I was reacting to a discussion I heard which suggested that we were being extremely conservative.
That's the consensus view, by the way.
Which is absolutely incorrect. So I actually think we will be very close to our estimates in terms of what revenues we will get. And the reason for this is I think people are misreading the non-congruence between the gross tax revenue and the net revenue to the center. The non-congruence has a very specific and factual reason. Gross tax revenue, we have shown it growing at 12.5%.
Yes.
This is the amalgam of all the taxes, including indirect taxes and including union excise duties. Among those taxes, many of them are growing. Some are growing at 14, some are growing substantially. But union excise duties, in our own estimates, I don't think anybody would contradict that, is likely to be down 5%.
Yeah.
So the item which is down 5% is a particular component which is not shareable with the states. So the entire 100% of the decline accrues to the center on that item. The increase on the other items is shareable with the states. Now similarly, each tax has a composition in terms of tax, cess, surcharge, which results in a different combination of how much is shareable with states. The net effect of that combination, particularly with union excise going down and being almost fully shareable, if you look at another part of the same statement, the states' share, the devolution to the states is increasing by 16.5% against a tax revenue increase of 12.5%. Now, if the deduction is increasing 16.5%, the top line is increasing 12.5%, then the net doesn't increase at 12.5%. It increases only at 10.8%. And that is being interpreted as some conservatism which is undue.
Okay, so that's explaining the conservatism or non-conservatism.
It's realism.
It's realism. Yes. You know, the big boost that came in today was, of course, the government's fiscal consolidation roadmap and that 70 basis point cut that you have signaled. And the bank stocks were up and about today on the back of that. The bond markets reacted as well. You know, what do you believe that this could lead to, both in terms of the possibility of a ratings upgrade, as well as bringing down the cost of capital for the private sector?
So I'll respond to the second first. I think it will help in bringing down cost of capital for the private sector. There is a quantitative impact in terms of the fact that our borrowings are going to be lower next year in a larger economy than they were this year in a smaller economy. So with a bigger economy size, we have less absolute borrowing. That's a substantial vacation of space for the private sector to absorb. So I think it will, in the long run, if we continue in this manner, we will see improved costs of borrowing across the private sector. So that's a good thing for the economy. It's growth positive. On rating agencies, I have nothing to say. I have no hopes from the rating agencies. I don't believe they are fair, and I don't believe these things matter much to them. So they will do what they do, and we will live with what we live with.
You don't believe they're fair?
I don't believe. I think we have a very clear articulation of why we think they're not fair, which is brought out in the paper, occasional paper that the Department of Economic Affairs has brought out. And I think there's enough evidence to see that there are double standards. But we live with those double standards. We're very realistic. So I will not comment on any ratings outcomes. We are not targeting any ratings outcomes through these actions. We are doing them because we think they are the right thing to be done for the economy and they're good for the economy. What the raters think about it is left for them to decide.
Before I get the DPAM Secretary in, a quick word in as far as the capital allocation is concerned, the CapEx is concerned. Growth of 11%, and of course this comes on the back of the historic rise that we have seen in the last few years. Would it be fair to assume that, yes, of course there is a base that we're dealing with, that this would now be the sort of run rate that we should expect?
I'm sorry?
Yes, to you, the CapEx.
The CapEx, the run rate. Well, you see, the run rate depends not just on what we want to provide, but also on what is necessary. It also depends on the right proportion of investment between the public sector and the private sector. So we have increased it very substantially. I think 11% on top of what was increased earlier. It's a very substantial increase. And I think this is the right dose for this year. What's the right dose for next year will depend on what happens then. But I think for the 24-25 period, I think we have optimized it and I think we have the right number.
I would also like to add on capex, on top of, whatever 11 lakh plus crore, which is being targeted from the budget, you have about another one which is put together the effective capital expenditure. It makes it about 15 lakh crores. And if you top it up also the public sector capex, which is another, 3.5 to 4 lakh crores. So we're talking in the range of 18 to 19 lakh crores of capex.
Yes, it is a substantial amount. The expectation of the ask was, again, that this time around there would be a 20% hike, for instance. So I think that has been made clear by the government. Let me also welcome on the program Vivek Joshi, the DFS Secretary, and also with us Ajay Seth, the Secretary of Economic Affairs. Gentlemen, thanks very much for joining us. But Mr. Pandey, let's address the issue of disinvestment and what you believe is a paradigm change as far as the government's disinvestment strategy is concerned. You're moving away from targets. You're now saying that, look, let's look at wealth creation and let's also look at the contribution that comes in from dividend. And of course, non-tax revenue seeing a significant bump up on account of that. So realistically, what should we now expect the disinvestment philosophy, the disinvestment roadmap, the disinvestment idea to be from here on?
I think if you look at the public sector and how we went about it is to, sort of create that wealth and distribute it to the wealth through the issue of shares. Now that is, listing of the company. But thereafter, it's also important that the companies do well, the banks do well, the governance is there, the commercial imperatives are there, they participate in the capex, in their growth story. And that creates wealth, which is also then in small tranches, you are able to again offload the shares in a collaborative way. If we really want to become very target-oriented and try to just put everything linked to the budget and looking at only one number, it creates actually distortions. Now, just to give you an example, in 3 years ago, on the 1st of January 2021, the combined market cap was about 15 lakh crores for our 61 listed CPSEs and 16 PSPs and PSICs put together.
Right.
Now this has risen to today 58 lakh crore. So we have added 42 lakh crores over a period of 3 years. Now that's not something that we have actually created that much of capex but this is actually the value unlocking which has come. In one single year, the value unlocking is of 25 lakh crore. And I think it's very important that we also reward our minority shareholders, look at them, their needs and capital gains and dividends and put together. At the same time, we keep on looking at our companies and how they perform. It is a very important segment of the economy. I think if they do well, so we have to calibrate the strategy. That's what we call it a new paradigm. Not to look at one single number and just to do it in a particular year, come what may. That's not the way we should look at disinvestment, or we should look at it holistically to include dividend as well.
Fair enough. You wanted to make a point on that. What I also want to understand then is as far as privatization is concerned, I mean, outside of Air India and one or the other, there hasn't been any movement on privatization, which is the stated policy of the government. So is there a paradigm change there as well?
No, I mean, there, when the privatization strategic disinvestment transactions are launched, they take a lot of time. And whichever ones are going on, they are ongoing and we are keeping them informed, but they are necessarily time-taking, particularly when you have the other issues like demergers, non-core assets and so on. So all of them are actually on board. But, as I said, that when we are looking at the overall strategy, it has to be, again, look at the opportunities, but don't get fixed about one number.
Don't get fixed about one number, or don't get fixed about one sector that was up for possible privatization. Mr. Joshi, banks, I mean, this is an interim budget, but this announcement had been made by the finance minister previously, but no legislative movement has happened to ensure that this is taken forward.
So I think what Secretary Deepam has answered applies to banks as well. We have to look to the opportunity movement, and then only we can say, and the example he gave about the market capitalization, same applies to the banks also.
So you're saying that PSBs are also seeing a big uptick as far as their share price is concerned and the market caps are concerned. So would it be fair then to assume that it's on the back burner?